Hello, my dear students. I hope you're all doing good. I hope your studies are happening well. So you just have one more month left over for your examination. Effectively 1 month which is left over for your examination. I hope your preparations are going very well. So I am here to start the marathon with respect to your taxation subject. I'll be discussing both direct and indirect taxation. So let us, without wasting a single second, start our discussion. Now, as you all know, in your executive, so this marathon is exclusively for whom, sir? This marathon is exclusively for CS executive students. In your executive, you have a paper called as paper number 7, correct? Paper number 7 talks about what? Paper number 7 talks about tax laws and practices. Hey, what is paper number 7 talking about? It talks about tax laws and tax practices. Now, in this paper number 7, basically, this is divided into 2 more parts, meaning basically the paper is tax paper only, but this tax paper, I'll just check once whether I am live online on YouTube. So this paper number 7 which is there, this paper number 7 has 2 parts in it. What are those 2 parts, sir? One is called as your direct taxes. Another one is your indirect taxes. Correct? When your direct tax which is there is for 60 marks and indirect tax which is there is for 40 marks. Now, in your direct taxes, what do you have? In your direct taxes, you have a subject called as, or you have a topic called as income tax. Basically, direct taxes has only one thing, which is income tax. And in indirect taxes, what do I have, sir? In my indirect taxes, yes, I am live. Direct taxes, what do you have? In your direct taxes, you have a... Okay. Very good afternoon. Very good afternoon to all the students who have joined live with me. Yeah. So in your indirect taxes, what do you have? In your indirect taxes, you have 2 things. One is your GST and another one is your customs. So this is how your syllabus is divided. Correct? I'm just kept my phone also over here. So I'll be watching your comments, etc. Whatever questions you have, you can definitely ask me those questions. Yeah. So let us start now. So you have a paper called as paper number 7 talks about tax laws and practices. It is divided. This paper is for how many marks, sir? This paper is for 100 marks. It used to be a MCQ based question paper, but now it is a practical question paper which you have to answer. Now it has 2 parts. One is called as direct taxes, another one is called as indirect taxes. Direct taxes is for 60 marks, indirect taxes is for 40 marks. Direct tax majorly will cover what, sir? It will cover your income tax law, and indirect taxes will cover your GST and customs. Wherein in this, no, the GST will normally come for how many marks? 35 marks, and customs is for 5 marks. This is basically how your subject is divided. Now talking about your question paper pattern. Sir, also talk about question paper pattern, sir. The question paper pattern which is there. Now your question paper will have 2 parts. One will be with respect to income tax. Another one will be with respect to GST and customs. Wherein you are going to get a total of 6 questions in your examination. Okay, question number 1, question number 2, question number 3, question number 4, or question number 4A. These are the questions which will be there under income tax law, and you will have question number 5, question number 6, or question number 6A. Basically, these will be the questions which will be there under GST law. Normally, the questions which you are, so you are going to get this for how many marks, sir? You are going to get this for your 40 marks, and this will be for your 60 marks. Normally, each of the questions will be for how many marks? Normally, each of the questions will be for 20 marks. Of course, every question will have subparts. So a question can be divided as 7 plus 3 or 7 plus 7 plus 6 or 7 plus 3, 7 plus 3 or 5 plus 5 plus 5 plus 5. Meaning the question can, a single question, let us talk about say 6A. Now 6A may have 4 questions of 5 marks each, or it may have 2 questions of 7 marks and 1 question of 6 marks. So this question, I mean the question paper pattern will be, the pattern basically is this, meaning you will have totally 6 questions to answer, in which there will be an option given in question last question of each of the section. Under income tax also last question will be will have an optional question, and under GST also the last question will have an optional question. Now sir, this though we understood sir, but what are the different questions which are going to come sir? Whether the question paper which is going to come in the examination will it be a practical based question, will it be a theory based question? See, when we talk about income tax, no, income tax is majorly practical question. Practical means what sir? Here you will have to do some type of computation. The question paper is going to ask you to do some type of computation. So here you will have to use your calculator, you will have to do a working, you will have to write working notes, etc. So there will be practical based question as well as there will be theory based question. Now since the time when the new syllabus has started, I have just done a question paper analysis. I was just going through your question papers, okay. For last few attempts, I was just going to all the question papers which were issued in last few attempts. Now what I identify, what I found, I will tell you. In income tax, no, almost your 45 marks questions which are there, okay, 45 marks questions which are there, that will be a practical question, meaning you are required to solve, you are required to do a calculation, you are required to do a computation. So computation will be involved, and there will be 15 marks questions which will be completely theoretical. Of course you will get extra questions also, but 15 marks question which will be completely theoretical, okay, which you are supposed to attend. Similarly, when we talk about your GST and customs, here questions will not questions will be practical questions and case study based question. Now many students are of an interpretation that case study based questions are theoretical questions. No, yeah, there is a theory which you have to write for those case study based questions, but case study based questions are mostly provisional questions. They will be linked with respect to some provision. There will be a provision of law. With respect to that provision, they are going to give a case study, and based on that case study you are required to give the answer, and there will be theory question, of course. Now practical questions, from which topic it comes, we will discuss it when we are when we start our marathon class. As and when we are doing that marathon, we will discuss about which are the topics for which practical questions will come. Okay. Yeah, so practical questions will come for how many marks? Are the practical questions which will come is for your 30 marks, and you will have straightforward theory question worth 10 marks in your indirect tax laws. So if I want to say majorly how your question paper pattern will be, that is 75% of your question paper will have practical questions or case study based question, and 25% of your question paper will have theory, straightforward theory lifted from the material, meaning no extra thinking at all. If you are thorough with that theoretical part, you will be able to get full marks in that theory. Okay, so this is how your question paper pattern is going to be, and this is how your subject is divided. Now sir, can you also tell what are the most important topic which I have to study, sir? Can you also tell that point before the beginning of the class only, so that we also get a fair idea about that, and then accordingly we can continue. Yeah, see, in your income tax, no, in your income tax, the most important topic from priority I'm telling is your business income. PGBP is one of the most important topic. Almost 10 to 12 marks question will come from PGBP. Then you have your income from salary. This is another important topic. So almost 5 to 7 marks will come from this. Actually, it is 7 to 10, but yeah, I'm taking it on a lower side. Then you have your income from capital gain, same marks. Income from other sources, income from house property, same marks. Income from other sources will come for around 3 to 5 marks. Then there is a topic called as clubbing of income, set off and carry forward, and deductions. This will give you around 8 to 12 marks combined together. All these chapters combined together will give you 8 to 12 marks. Then you have your TDS, TCS, advance tax. Okay, this will give you around 6 to 8 marks questions. And you will, of course, the total income, which has the different the remaining sections or remaining part will give you the balance marks. Okay, under GST and customs, because it is very small, so valuation of customs, one for sure question will come for 5 marks. One question of valuation, 5 to 7 marks also they are asking that question. Then in your GST, if you ask me, what is most important is your input tax credit topic, then your value of supply topic, then your this registration topic, your supply topic. These are something which are most important. Of course, there are other topics also like time of supply is there, exemption. Yeah, one more topic called as exemption. Now, meaning what, sir? From these topics, question will for sure come. Wherein value of supply and ITC will have mostly your practical questions, and your registration, your supply topic or exemption topic, time of supply topic, place of supply topic, etc. They'll all be your case study based question. Okay, so this is a broad overview of how your what questions they have asked in the examination. Okay, what questions they have asked in the examination. Accordingly, while going through the syllabus, of course, I will tell you what are those points which are very important and which are those topics which are very important. For example, there is a complete change in this entire chapter called as income from capital gain. So for understanding or studying this income from capital gain is one of the most important, because this attempt in the sense both for June and December, the important topic for your discussion will be income from capital gain, and there are some amendments in business income chapters also. So wherever there is amendment, no, whenever you are writing your first paper, meaning in a year the first paper is your June paper, correct? So when you are writing your June paper, the most important point which you should keep in your mind is the amendments which have come in the law. So under GST as well as income tax, both has amendment, but income tax has little more amendments. So those amendments are little very important. Okay, with this being said, I hope I have covered the basic whatever questions you had. If anyone has any question, you can ask me. If you don't have any questions, I'll directly start my discussion. So I am just seeing your chat. So if anyone has any question, Raja says, can you be a little louder? Am I not audible to you all students? I feel that in my phone, the audio is coming good only. Okay. Now let us right away start the discussion. See, please note, this will be a full-fledged discussion. I'll also solve questions. We will solve questions together. I will definitely not give you time, but yeah, because I will not know how much time you're taking or how many people are actually solving or not. So accordingly, we will straight away start the discussion now. Okay, so let us start discussion on income tax. So let us now start the discussion on our marathon with respect to income tax. Income tax, first we will start with income tax, then we'll continue and then we are going to do it for what, sir? Indirect taxes. So what do you mean by tax? What do you mean by tax? See, government needs money. Government needs money for undertaking various different work. Government is doing lot of different things. Education they are providing, free education they are providing. They are providing infrastructure facilities. You see highways, you see roads, bridge, etc., which is constructed. Government is giving us what, sir? Government is also giving us something called as defense. They are taking care of the population of India. Hospitals are there where free vaccination, free treatments are happening. For all these things to happen, no, government needs money. That money which government needs, that money government is collecting from us in the form of tax. So what is tax, sir? It is one of the important source of revenue to the government. One of the important source of revenue to the government. The money which government is requiring for undertaking all this different work, that money is collected by the government from us in the form of tax. So it is a compulsory payment extracted by legislative authority. Sir, is tax voluntary or is it compulsory, sir? Is it my should I pay it on voluntary basis, or is it compulsory that I should pay, sir? It is a compulsory payment. It is not a voluntary payment. Now, tax are basically divided into two categories: direct taxes and indirect taxes. Direct taxes are those taxes on which incident and impact is on same person, and indirect taxes are those taxes where the incident and impact is on two different person. Now, what do you mean by this, sir? Direct taxes are those taxes where incident and impact is on same person. Meaning what, sir? The person who is earning the income has he only has to pay the taxes to the government. Who's telling this? Direct taxes says, if I am earning the income, I have to pay the taxes to the government. It is a direct tax. Direct tax, what happens, sir? The incidence and the impact is on same person. I have earned 10 lakh rupees. Out of the 10 lakh rupees which I have earned, I am required to pay tax of rupees 1 lakh to the government. This is direct taxes. I only earn the income and I am only making the payment of taxes to the government. Whereas indirect taxes does not say that. Let us say you came to I have a sari business. So you came to my sari shop, Priya Sarees. So I sold a sari worth rupees 10,000 to you. I sold this sari worth rupees 10,000 to you. When I sold the sari worth rupees 10,000 to you, I will collect extra GST on this. So you are going to pay me a total of 11,000 rupees, wherein 10,000 I'll keep it for myself and 1,000 rupees I'll pay to the government. So what is happening over here? This is a form of indirect taxes, where the incidence of tax was on me, but the impact was on you. The tax incidence was on me, but the final person who paid the taxes is who, sir? It was you. The impact on the tax. I collected the money from you and I paid it to the government. Then direct taxes are progressive in nature, indirect taxes are regressive in nature. Sir, what do you mean by this point, sir? Direct taxes are progressive in nature, indirect taxes are regressive in nature. This means that in case of direct tax, no, this means that in case of direct tax, as and when your income is increasing, the amount of tax which you have to pay also increases. Sir, repeat. As and when your income is increasing, the amount of tax which you have to pay also increases. As you know, in direct tax we have something called a slab system. If your income is up to certain amount, then you don't have to pay taxes. Once income crosses some limit, 5%, then 20%, then you have to pay higher taxes, etc. As and when your income is increasing, the amount of taxes which you have to pay also increases. That is nature of income tax, because it is that means what, sir? It is progressive nature. What do you mean by regressive in nature, sir? Lawmaker says, I don't care how much you are earning. Irrespective of how much you are earning, the amount of tax which you have to pay will remain same. That is what, sir? Indirect taxes. Irrespective of how much you earn, the amount of tax which you have to pay will remain same. Regressive in nature. It does not care whether a person is a beggar or whether he is a rich fellow. It does not make a person may be earning 5,000 crore rupees, very rich fellow. If he is purchasing a Parle G biscuit, he will have to pay the same amount of taxes to government when compared to the beggar who is earning only 1 lakh rupees. Correct? So the indirect taxes are regressive in nature. Now, one more point I'll tell you. Direct taxes is governed by, or the board who is taking care of direct taxes is called as CBDT, and the board who is taking care of indirect taxes is called as CBIC. Sir, what do you mean by CBDT? CBDT means Central Board of Direct Taxes, and CBIC means what, sir? Central Board of Indirect Taxes and Customs. So the board who is taking care of direct taxes is called as CBDT. The board who is taking care of indirect taxes is called as CBIC. And I expect you all would have already done some revision. Sir, your voice is very low. Why is my voice very low? I'll do one thing then. Now just check and tell me now, is my voice clear? And if possible, turn your mic, or I mean, you please make sure that your phone or your laptop's audio is also very clear. Okay. Now, next point is what, sir? Constitutional provisions with respect to taxation. Sir, what is this constitutional provisions with respect to taxation, sir? Constitutional provisions with respect to taxation. So there are some provisions given in our Constitution of India. See, Constitution of India is our mother law. So if you want to make any law in India, then that means what, sir? First, you should take the permission from your Constitution. Now, if the Constitution of India, only if the Constitution of India is only if the Constitution of India is permitting you to make a law, only then you can make the law. Unless until the permission is given by Constitution, you cannot make any type of law in India. Okay, the law can be made in India only if the permission is taken from Constitution. So Article 265 says no tax can be levied or collected unless there is an authority of law. So what is this article telling, sir? If you want to levy or collect any taxes in India, first you will have to take permission. First you will have to take authority. Sir, who is that? Who will give that authority? The Constitution will give that authority. Thank you, Raja. Then Article 245 says central government has the power to make law for whole or any part of India. Similarly, the state government will have the power to make law for whole or any part of that state. Now, Article 265 said what, sir? If you want to levy any taxes in India, for levying the taxes in India, you will have to take permission from whom? You will have to take permission from Constitution of India. Correct? You will have to first have a permission. And now, who has the power to make a law for whole of India? The central government will have the power to make law for whole of India or any part of India. Similarly, the state government will have the power to make law for whole or any part of that particular state. Now, there is one important article called as Article 246. This Article 246 has a schedule called as Schedule number 7. There is an article called as Article 246 which has a schedule called as Schedule number 7. In this Schedule number 7, there are 3 lists: Union list, State list and Concurrent list. Now, what is this Schedule number 7 talking about? It talks about 3 lists: Union list, State list and Concurrent list. Now, whatever different points are there in Union list, whatever different activities, so Union list contains lot of different matters with respect to which only the central government has the power to make the law. Similarly, State list contains various different matters with respect of which the exclusive power is given only to state government to make the law. A Union list will contain list of different activities with respect to this only central government has the exclusive power. Exclusive means what, sir? Only they can do it. Only they can do it. No one else can do it. Okay. Similarly, state list contains list of different activities with respect to which only the state government can make the law. Similarly, concurrent list contains list of different activities with respect to which both central government and state government jointly can make the law. Now, concurrent list does not talk about any tax law. It talks only about general law. But state list and union list gives the list of different types of taxes which can be collected by state government as well as central government. Now, in the union list, there is an entry called as entry number 82. In the union list, there is an entry called as entry number 82, which gives the power to the central government to collect taxes on income excluding agricultural income. Hey, what is this point telling, sir? The union list is there, no? Union list. The union list has an entry called as entry number 82. This entry number 82 of union list is giving the power to whom, sir? This entry number 82 of union list is giving the power to the central government to collect the taxes on all types of incomes except on agricultural income. Similarly, we have something called as state list. In this state list, there is an entry called as entry number 46. Entry number 46 of the state list is giving the power to whom, sir? The state government to collect the taxes on agricultural income. Please note, as on today, there is no tax. As of now, there is no tax on agricultural income. But is any government having the power to collect taxes on agriculture income? Yes. Which is that government which has the power to collect taxes on agriculture income? It is your state government. Then there is something called as sources of sir, what are the different sources of income tax law, sir? Sir, when we say income tax law, no. Now, this is a theory-based question can be asked from this point. When we say, sir, income tax law, what do you mean by income tax law? What are the different sources of income tax law, sir? What are the different components of income tax law? Now, the different sources or components of income tax law are Income Tax Act 1971, Income Tax Rules 1962, then Finance Act 2024, Notification and Circulars, then Judicial Decisions and Case Laws. Sir, repeat, sir. The sources of income tax law are Income Tax Act 1961, Income Tax Rules 1962, Finance Act 2024. For your examination, it is 2024. Finance Act is the budget which happens every year. Notifications and circulars and judicial decisions. Sir, what do you mean by all these points, sir? See, Income Tax Act is the main law. It is the main act which gives the different provisions of the law. It says what you are supposed to do. Income tax rules is supporting to the main law. See, main law is there, Income Tax Act. To that, the supporting, what is the supporting to Income Tax Act, sir? To that, the supporting is your income tax rules. Now, income tax rules will tell you how to do something. See, Income Tax Act will tell you what are you supposed to do. Now I understood what I am supposed to do, sir. How should I do that? If you want to know that, you will have to go to income tax rules. Then we have Finance Act. What happens is every year on 1st of February, budget will be conducted. Every year in India on 1st of February, budget will be conducted. And if it is a year of election, two budgets will happen. One is before election, one is after election. So when the budget is happening, no, at that time, Finance Minister of India is presenting something called as Finance Bill. She comes with Finance Bill, she reads that Finance Bill, she presents that Finance Bill in upper and lower houses of Parliament. Once that upper and lower houses of Parliament approves that Finance Bill will go to whom, sir? The President of India. Once the President of India puts a signature on that Finance Bill, it will become a Finance Act. It will become what, sir? Finance Act. So what is this, sir? Finance Act. Finance Act is nothing but the budget which is taken by the Finance Minister of India. Now, for your examination, what is the Finance Act which is applicable to you? Finance Act 2024. This is the Finance Act which is applicable to you for your examination. Then notification. Please note, last year, anyways, that last year was an year of election. Therefore, last year two budgets had happened, before election and after budget election. We will see that point anyways. Yeah. So normally what happens, sir? Every year only one budget will happen. When will that budget happen, sir? On 1st of February. Sir, what if the 1st of February is an holiday, sir? What if it is a Sunday, sir? What if it is a holiday? If it is a holiday though, then it will happen on the next working day, which is 2nd of February. It will not happen before, it will happen on next working day. Normally only one budget will happen for a year. But in the year of election, two budgets will be conducted. One will be before election, one will be after election. Okay, in the year of election, how many budgets will happen? Two budgets will be happening. One is before election, one is after election. Okay, sir. Then, sir, what is this notification circulars? See, now what happens normally is, if the government has to give some information, if the government has to give some clarification, if the government wants to give some explanation to any point which is already discussed by them, government has already, the lawmakers have already made some law. Now to that law, no lawmaker wants to give an explanation. To that point which is already made by the lawmakers wants to give any clarification. How will they give that clarification? How will they give that explanation, sir? That explanation or clarification will be given by way of a notification. So notifications are what, sir? Notifications are issued by the government. These notifications are issued to public to make sure that, and they are issued in official gazette of India, to make sure that if there is any clarification, extra supporting which government has to give with respect to a law which is already made by the government, that clarification will be made by them using these notifications. And we have something called as circulars. Sir, what is this circular, sir? Sir, what do you mean by this circulars? Circulars means they are the document issued by the income tax department, not income tax department, that's board, CBDT. CBDT means what, sir? Central Board of Direct Taxes and Customs for internal circulation within the income tax department. What, sir? Repeat, sir. CBDT, the board who is taking care of direct taxes, that if it wants to give any document for internal circulation of this income tax department, they will issue or they will give that document in the form of circular. See, what happens is the income tax law, no, the entire India is entire India is covered under income tax law. Income tax law is something which is followed in entire India. So can I say the income tax department will be there all over India? So there will be income tax officer all over India. Every state will have income tax department. Every state will have income tax officers, etc. Correct. These all officers are governed by one single authority, which is CBDT. Correct. They are all working for Government of India, and they are all under one single organization called as CBDT. Now there may be a case wherein a person sitting in south of India and a person sitting in west of India, they may have some interpretation issues. Correct. These people, they may have some interpretation issues with respect to whatever law is made by the government. So to make sure that they all follow the same thing, the CBDT will give a circular. So that circular is basically an internal circulation document which is given to the income tax departments or the officers who are working in income tax department. It is only for internal circulations. Then we have something called as judicial decisions or case laws. Sir, what is this judicial decision, sir? What do you mean by this case laws? See, normally what happens is whenever a law is made, so this law can have many interpretation. This law can have many interpretation. For example, say there is a law made telling that educational services are exempt. I'm taking a case of GST over here. Okay, but the understanding will be same. Law is made that telling educational services are exempt. Now government has made the law. Now what interpretation will a government school person have? If you are a principal of government school, you will feel that yes, whatever education we are providing, government school is providing, that is exempt. What will a college principal have? A college principal will be of an interpretation that whatever education services they are providing, that is exempt. Similarly, the private coaching centers, what will they think, sir? They will think that whatever education they are providing, that is exempt. So there is a point with respect to which interpretation is made by different categories of people. Now they have just seen the upper part of the provision, and they have decided that yes, this exemption is applicable to me, yes, this provision is applicable to me. Now what may happen is there may be a dispute on this applicability. I have understood that yes, I being a private coaching center, my services are also educational services, therefore my services will be exempt from payment of tax. But the officer may be of the interpretation that no, only those people who are giving any qualification, their services are exempt, educational services are exempt. So now we both are fighting. Who both? Me and the officer are fighting. Now when me and the officer, we both are fighting, this matter will go to the court. We are going to go to some higher authority for getting the conclusion on this matter. So that higher authority who is going to give us the conclusion, no, that may be say income tax tribunal or GST tribunal, or it can be say NCLT, National Company Law Tribunal, or it can be our High Court, Supreme Court, etc. So now when the judgment is given by court, when the judgment is given by those authorities, then it will be called as case law or judicial decision. So these are also one of the source of income tax law. Because why, sir, this is a source of income tax law? Because many times what happens is interpretation problem may come. So when there is a problem with respect to interpretation of any provision, we should see what has the apex court or the Supreme Court told in that matter. If anyone has fought this case and went up to Supreme Court, what has the Supreme Court told on this particular point? We are supposed to see that. Correct? Yes, sir. So these are the different sources of income tax law. Now, sir, what do you mean by income, sir? Sir, everything which I am earning, is it my income, sir? Sir, my father gave me pocket money, sir, is it my income? Sir, I went and I started doing business, sir, is that my income? Sir, I qualified as a chartered accountant, I qualified as a company secretary, I qualified as a lawyer, I qualified as a cost accountant, I qualified as an professional, sir. So now because I'm a qualified professional, I'm starting my own practice, sir. Whatever income I'm going to get from my practice, is it an income, sir? Sir, I gave bribe to an police officer, sir. Sir, police officer is receiving salary from the government, but apart from that, I gave some bribe to the police officer, sir. Sir, is that bribe which I gave to the police officer, is that treated as income? So the question is, what do you mean by income, sir? Now, income tax law gives a simple, I mean, the definition is very big. In a simple format, I'll tell you what income tax law is trying to tell you. Income tax law says income means receipt. Income means what, sir? Receipt. Income tax law says income means receipts, but all receipts are not treated as income. Income means what, sir? Receipt, but all receipts are not treated as income. Receipts which are there, no, are divided into two categories. Receipts are divided into two categories: capital receipt and revenue receipts. Sir, what is the difference between capital receipts and revenue receipts? What do you mean by capital receipt? What do you mean by revenue receipts? See, what income tax law says, I'll tell that first, then we'll discuss about what is capital receipts and what is revenue receipts. Now, income tax law says revenue receipts which are there, no, they are normally treated as income. Normally, revenue receipts are treated as income unless they are specifically excluded. Whatever revenue receipts are there, normally they will be treated as income unless lawmakers are specifically excluding and telling, no, I don't want to call revenue receipts as income. Similarly, capital receipts are there, no. These capital receipts are normally not treated as income unless specifically included. All the capital receipts which are there, they will normally not be treated as income unless they are specifically included. Okay, not okay? Sir, what do you mean by capital receipts, sir? Is something which you are getting in one lump sum is capital receipts. What do you mean by revenue receipts, sir? Revenue receipts, what you are getting on recurring basis. For example, salary. I am working somewhere, I am getting a salary. What is that? Revenue receipts, because I am getting every month. And I sell my house. Selling house is not my normal business, or it is not my normal practice, but I sold my house. This house I had purchased 20 years back. Now I am selling this house. So now the money which I am going to get will be called as capital receipts. Normally, revenue receipts will be treated as your income, and capital receipts will be treated as your income only if it is specifically included. Okay, sir, this is also clear, sir. Now, one more difference you have to understand before we jump into the tax risk provisions or some important definitions. What is that, sir? Sources of income and heads of income. What do you mean by sources of income, and what is the meaning of heads of income? See, sources of income means what, sir? Sources of income means the place from where you are getting income. So it is the generation of income is source of income. And heads of income means what, sir? Heads of income means whatever income you have earned, whatever income you have generated from different places, these incomes are required to put in 5 different heads. Income tax law says whatever income you are earning from any number of places, these incomes are required to be put in these 5 different houses, these 5 different heads. So heads of income are the places where these incomes will go. Heads of income are what, sir? They are the places where the different income are going to go. Okay, so sources of income can be many. Sources sense from where I am getting the income. All these incomes which you are getting from different places, they are going. You are required to put those income at respective places. That places where you are going to put all these incomes are called as what, sir? Heads of income. Okay. For example, Dilip is getting a salary. So where will it go? So there are totally how many, sir? 5 heads of income. Which are these 5 heads of income? Income from salary, income from house property, from business or profession, capital gain, or income from other sources. For example, Dilip is earning salary. Which head it will go? Income from salary. I am earning dividend. Now dividend will go under which head? Income from other sources. Interest will go under income from other sources. I am earning salary from Tata Motors. Where will it go? Income from salary. I am selling a share. I earned capital gain. Where will it go? Income from capital gain. Similarly, I am doing my own business and profession. Where will it go, sir? In income from business and profession. I am having Priya Electronics, Priya Sarees, Priya Airlines. All these are different businesses which I am doing. Where will the income go, sir? Income from business or profession. I am having income from house property. Where will it go? It will go under the head house property. So sources of income can be many. Whatever income you are earning from different sources, these incomes are required to be put by you in 5 different heads. Now, sir, you said we are studying income tax. No, sir. Correct. Yes, we are studying income tax. Sir, what do we do under income tax law, sir? Can you please tell us? What is that thing which we are doing under income tax law? Under income tax law, no, under income tax law, you compute the total income of the assessee and you compute the tax liability on such total income. No, repeat. You are first supposed to compute the total income of that particular person. Whosever income tax you are supposed to, whosever income tax computation you are doing, no, that person's total income is required to be computed first. Now, once the total income is computed, no, on that, what is the tax amount he has to pay to the government, that is required to be computed. So what do we do under income tax law, sir? We do two things. We do computation of income and tax on that particular income. So income can be income from salary or income from house property, income from business or profession, income from capital gain, income from other sources. So all these 5 heads of income, do the adjustments of clubbing, do the adjustments of set off and carry forward. Then once you do these adjustments, the total now will be called as what, sir? Gross total income. This total which you have got now, that is called as what? Gross total income. From this gross total income which you have got, you should subtract the deductions under chapter 6A. Whatever deductions are there under chapter 6A, those are required to be subtracted by you. Once you subtract all the deductions under chapter 6A, now whatever is remaining, that is called as your total income. The total income is also called as net taxable income. It is on this total income you have to pay the taxes. You should first compute the total income. Whatever total income you have computed, on that you will apply the tax rates applicable for you and compute the tax. Okay, sir, this is something which is clear to me. Next point, sir. Let us go to the next point. There is a charging section of income tax. Section 4 is the charging section of income tax. Meaning, what do you mean by charging section? Charging section is going to tell you what is the reason because of which you are paying income tax, or how do you pay income tax, on what do you pay income tax, when should I pay income tax, etc. Section 4 talks about it is the charging section of income tax. What is section 4 telling? Income tax is charged for every assessment year on every person on the total income earned by such person in the previous year. What is this point telling? Income tax is charged for every assessment year on every person on the total income earned by such person in the previous year at the rate prescribed in Finance Act. What is this entire provision trying to tell you? It says you will have to pay income tax in assessment year. Who has to pay? Every person has to pay income tax. When he has to pay the income tax? In the assessment year. On what he has to pay the income tax? On the total income earned by such person. When should this total income be earned by me? The total income earned by you in the previous year. Okay, sir, at what rate should I pay? At such rates as may be given in your Finance Act. Income tax is charged for every assessment year on every person on his total income, on the rate on his total income which is earned by such person in the previous year, on the rate specified in Finance Act. Sir, repeat. Income tax you are supposed to pay in assessment year. Who has to pay? Person has to pay. What do you mean by person? We will see that. On what he has to pay? Total income. We just now saw what is total income, which is earned by him during previous year, and what rates are rate given in Finance Act. See, under income tax law, no, there are two types of years. One is called as previous year, another one is called as assessment year. One is called as what, sir? Previous year, another one is called as assessment year. Sir, what is this previous year? What is this assessment year, sir? Previous year is the year in which income is earned. So whichever year you are earning the income, no, that year is called as previous year. Then, okay, sir, what do you mean by assessment year? Assessment year means the year in which tax is paid. Sir, repeat. Previous year is the year in which income is earned. Assessment year is the year in which tax is paid. For your examination, the previous year is 24-25. Previous year is what, sir? 2024-25. Meaning whatever income is earned during the period 1st April 2024 to 31st March 2025, on this income you have to pay tax in which year, sir? Assessment year. What is the assessment year for your examination? 25-26. Yes, sir. Once again, sir. If for your examination, what is the previous year? Previous year is 24-25 and assessment year is what, sir? 25-26. Whatever income you have earned during previous year, on that income you have to pay the taxes to the government in assessment year. Okay, not okay? Now please note, irrespective of whether you are writing your examination in June month or in December month, it does not matter when you are writing your examination. For you, the previous year will be which year, sir? 24-25, and for you the assessment year will be 25-26. Meaning you are supposed to compute the income of a person for this period only. Which period? 1st April 2024 to 31st March 2025. Now, normally, previous year means what, sir? From 1st April till 31st of March. Correct? No, sir. Correct. Normally, this previous year which is there, no, that previous year, please note, lot of confusion will happen if you are first time reader. If you're a first time listener, first time reader, etc., lot of confusion will happen. What is the confusion which is going to happen, sir? What is the confusion which is going to happen, sir? The first time reader will have a confusion with respect to, sir, previous year means last year. No, sir. Sir, this year is current year. Last year is called as previous year. No, sir. No. Under income tax law, previous year means that year when you have earned the income. Assessment year means the year in which you are going to pay the tax to the government. Sir, repeat. Under income tax law, previous year means the year in which you are earning the income. Assessment year means the year in which you are paying the taxes. See, normally previous year is a period of 12 months. However, in following two cases, it can be a period less than 12 months also. See, normally it will be period of 12 months. Normally previous year will have 12 months period. But in some cases, it can be a period less than 12 months also. Which are the cases? Where a new business or profession, where a new business has been started or a profession is set up in the middle of the year. So in between the year, if you're starting a new business, then for that business, previous year will start from that time only. Where a new source of income is generated in the middle of the year. So if you are generating, if you started earning a new type of income from middle of the year, for that new type of income, the previous year will start from that time only. Now let us understand 2-3 definitions. Sir, what do you mean by a person? Person definition is an inclusive definition, meaning whatever you generally understand by the word person is a person. Whatever you normally understand by this word person is always a person. Apart from that, person shall include individual, HUF, firm including LLP, company, AOP, BOI, artificial judicial person and local authority. So they are all treated as persons in the eyes of income tax law. What do you mean by this, sir? Meaning all this person will have to pay income tax. Sir, what do you mean by individual? Individual means natural person like you and me. Sir, what is an HUF? Now, normally Hindus after marriage, they can form a separate entity for their family called as Hindu undivided family. What is firm, sir? Firm is a partnership firm. It can be a registered partnership firm or unregistered partnership firm. And firm always includes LLP. LLP means what, sir? Limited liability partnership. Then company. Company means what, sir? Company means a body corporate. Whether it can be a public company, private company, section 8 company, small company, big company, etc. It does not matter, 1% company. AOP or BOI, artificial judicial person or body of individuals are also treated as person. Then local authority. AOP and BOI means what, sir? If a group of people come together, happy evening. Those who are attending, happy evening. Yeah. AOP means what, sir? Association of person. What do you mean by association of person? If a group of individuals, come together, then it is body of individuals. If a group of persons, say individual, firm, body corporate, they are all coming together and they are forming a group, that is called as what, sir? AOP. Then local authority. Local authority means like BBMP, which we have over in our Bangalore, etc. In Chennai, they have Greater Chennai Corporation, etc. AJP means what, sir? Artificial judicial person. Basically your university. The university, that is also treated as person. Gods are also treated as person. Okay. Then What do you mean by assessee, sir? Assessee, section 2 clause 7 defines the gives the definition of assessee. Section 2 clause 7 says assessee means any person who is liable to pay tax or any other sum under this act. Who is an assessee? Assessee means any person who is liable to pay tax or any other sum under this act. Any person who is liable to pay tax or any other sum under this act, and includes representative assessee, deemed assessee, and assessee in default. Sir, repeat, sir. If you are a person who is liable to pay tax, if you are a person who is liable to pay tax or any other amount under income tax law, whether it is interest, penalty, late fees, etc., it does not matter. If you are liable to pay tax or any other amount, interest, penalty, late fee, under this act, under which act, sir? Income Tax Act, then you will be called as assessee. Apart from that, assessee will include representative assessee, deemed assessee, and assessee in default. Apart from that, assessee will include what, sir? Representative assessee, deemed assessee, and assessee in default. What do you mean by this, sir? Representative assessee. See, many times what may happen is, if any minor is earning an income, and if that on that income the tax is required to be paid, the minor may not be able to pay the taxes. So you may be acting as the representative assessee of the minor. Then deemed assessee. What do you mean by deemed assessee? Many times what may happen is, if the department has given a notice to you, and if you are not replying to the notice, you will be, even if you are not liable to pay taxes to the government, the department has given notice to you. Now you are called as you will be deemed as assessee. What is this assessee in default? Assessee in default means a person has filed his income tax return. He has paid all the tax dues properly, but he had to pay late fees. Because of late filing the return, he had to pay late fees. So he will be called as assessee in default. Or someone had to deduct TDS, but he has not deducted TDS. He will be called as assessee in default. Next. I hope these points are clear. Now let us jump into what's up. Let us jump into tax rates applicable for your examination. Tax rates for previous year 24-25 or assessment year 25-26. See, basically tax rates are divided into two categories. One is called as your general tax rates or slab rates. Another one is called as your special tax rates. These general tax rates or slab rates are there. No, these are given in Income Tax Act itself. Sir, repeat. General tax rates and slab rates are given in Finance Act, and special tax rates which are there, they are given in Income Tax Act. Tax rates are divided into two categories. One is called as general tax rates. Another one is called as special tax rates. Where are general tax rates given? They are given in Finance Act. And where are special tax rates given? They are given in our Income Tax Act itself. So every year, why are people interested in the budget, sir? Because every year the budget will be presented. Once that budget receives signature of the President of India, it will become Finance Act. So every year they look whether there is any change in the rate of tax or not. Because if there is any change in rate of tax, then it is going to accordingly impact the taxpayer. So that is the reason why many people are interested in knowing about budget. And special tax rates are given in Income Tax Act itself. Now, special tax rates are applicable for some special types of income. Which are the special types of income, sir? Like long-term capital gain, short-term capital gain, casual income, online money games income, undisclosed income, etc. Now we will see with respect to these points separately. We will discuss about what is the tax rates for special rate of income. First we will discuss about the tax rates applicable to whom, sir? First we will discuss about the tax rate applicable to slab rate, or what are the different general tax rates applicable, sir? General tax rates are applicable to whom, sir? All the income other than special income. So which are the other incomes left over then? Salary income, house property income, business or profession, capital gain in short-term capital gain under 111, and income from other sources. For them, what is applicable? Slab rates are applicable. Now, sir, what is the slab rate which is applicable to me for my examination, sir? For you guys, for your examination, the slab rates which are applicable is, if you are an individual HA of AOP BOI artificial judicial person, if you are an individual HA of AOP BOI artificial judicial person, up to 2.5 lakhs, no tax. Up to 2.5 lakhs, no tax. If your income is from 2.5 lakhs to 5 lakhs, it is 5%. If it is from 5 lakhs to 10 lakhs, it is 20%. And if it is more than 10 lakhs, what is it, sir? 30%. Sir, repeat. If you are an individual, HUF, AOP, BOI or artificial judicial person, for your income up to 2,50,000, you don't have to pay any tax at all. And from 2,50,000 to 5 lakh, if your income is somewhere between 2,50,000 to 5 lakhs, the tax rate applicable to you is 5%. If it is somewhere between 5 lakhs to 10 lakhs, then it is 20%. And if it is more than 10 lakhs, tax rate applicable to you will be 30%. Now, please note, over here, individual means what, sir? Individual means natural person like you and me, whose age is less than 60. A resident individual whose age is less than 60. And a non-resident individual irrespective of his age. They are covered over here. Sir, what if I am a senior citizen, sir? Sir, what if I am a senior citizen? Is some extra benefit given to me? Or the rate is same, sir? If you are a senior citizen, for senior, who is a senior citizen in the eyes of income tax law? In the eyes of income tax law, senior citizen means a resident individual whose age is 60 years or more. A resident individual aged 60 years or more. For those people, up to 3 lakh rupees, they don't have to pay any tax at all. Up to 3 lakh rupees, they don't have to pay any tax at all. If their income is from 3 lakhs to 5 lakhs, they'll have to pay 5%, 5 lakhs to 10 lakhs, 20%, more than 10 lakhs, 30%. Okay, so up to 3 lakhs, they don't have to pay taxes. If it is more than 3 lakhs up to 5 lakhs, 5%, 5 to 10, 20%, more than 10, 30% is the tax rate applicable to them. Sir, what if I am a super senior citizen, sir? I am a super senior citizen, sir. Now what will happen, sir? If you are a super senior citizen, no. Who is a super senior citizen? That person, a resident individual aged 80 years or more. If you are a resident individual whose age is 80 years or more, then you will be called as super senior citizen. For you, up to 5 lakh rupees, you don't have to pay any taxes. If your income is from 5 lakhs to 10 lakhs, you have to pay 20%. If it is from more than 10 lakhs, you have to pay 30%. So please note, there is one limit up to which no one has to pay the taxes. For normal people, it is 2.5 lakhs, senior citizen 3 lakhs and 5 lakhs for super senior citizen. So up to this amount, they don't have to pay any taxes, right? So this limit up to which they don't have to pay any taxes, that limit is called as basic exemption limit. The limit up to which they don't have to pay any taxes is called as what, sir? Basic exemption limit. Next, apart from whatever tax we saw now, you also have to pay an extra tax. That extra tax which you have to pay, that will be called as surcharge. Yeah, apart from the normal tax which you are paying, you will also have to pay something extra, tax on tax to the government. You will also have to pay extra tax to the government. That extra tax is called as what, sir? Surcharge. When is surcharge applicable? Surcharge is applicable only if your total income is more than 50 lakh rupees. Yeah, what lawmakers are telling, if you are earning more than 50 lakhs, then apart from this normal tax which you are paying now at slab rates, you will also have to pay me extra tax. And that tax I am going to collect on tax amount. So whatever normal tax you have got, on that extra tax you will have to pay, called as surcharge. And surcharge is applicable if your total income is more than 50 lakh rupees. Sir, how much is this surcharge, sir? Lawmaker says, if your income is more than 50 lakhs up to 1 crore, you will have to pay a surcharge of 10%. If your income is more than 50 lakhs up to 1 crore, how much is the surcharge applicable to you? 10% of tax is the surcharge applicable to you. If your income is more than 1 crore up to 2 crores, if it is more than 1 crore up to 2 crore rupees, you will have to pay a surcharge of 15%. More than 2 crores up to 5 crores, you will have to pay a surcharge of 25%. And if it is more than 5 crores, surcharge applicable to you is 37%. How much, sir? 37%. Hey, please note, if your income is more than 50 lakhs, surcharge will come. If it is more than 50 lakhs up to 1 crore, how much is the surcharge? 10% is the surcharge. If it is more than 1 crore up to 2 crores, how much is the surcharge? 15% is the surcharge. If it is more than 2 crores up to 5 crores, how much is the surcharge, sir? 25% is the surcharge. Sir, and if it is more than 5 crores, how much should I pay, sir? If it is more than 5 crores, you will have to pay a surcharge of 37%. 37% of tax. Now, apart from that, whenever there is a tax which is coming, if you are liable to pay income tax, along with that income tax, always you will have to pay something called as what, sir? health and education cess. Health and education cess, which will always follow the tax amount. Okay, if there is a tax which you are levying, whether it is normal tax, surcharge, etc., on the tax and amount, entire tax amount, you will have to levy 4% as health and education cess. 4% on tax. So 4% on tax means what, sir? Your tax amount including your surcharge amount. So whatever tax amount you have got now, including the surcharge, on that you will have to levy something called as health and education cess. Now, sir, shall we do one question, sir? Yeah, let us say Dilip, aged 21 years, has a total income of 15 lakhs. Compute the tax on this. Now, how do I compute, sir? This is specific best format. So we know the income is how much? 15 lakh rupees, correct? How much is the income? 15 lakh rupees. Now we know that up to 2.5 lakhs, you don't have to pay any taxes at all. And then after that, from 2.5 lakhs to 5 lakh rupees on that income of 2.5 lakhs. Sir, how 2.5 lakhs? If 5 lakhs minus 2.5 lakhs, how much is that? 2.5 lakhs. On that, you have to pay a tax of 5%. Then from your income from 5 lakh rupees to 10 lakh rupees, from income from 5 lakhs to 10 lakhs, you have to pay a tax of 20%. And more than 10 lakh, whatever amount is there, on that you'll have to pay a tax of 30%. So on first 2.5 lakhs, I will not pay anything. My tax amount will be 0. On the next 2.5 lakhs, I'll have to pay 5%, which will come to 12,500. On the next 5 lakh rupees, that is from 5 lakhs to 10 lakhs, I'll have to pay a tax rate of, the tax rate applicable to me is 20%. So I will have to pay a tax of 1 lakh rupees. And for income more than 10 lakh rupees, I'll have to pay a tax of 30%, which is how much, sir? 1.5 lakhs. So what is my total tax liability? On 15 lakhs, I'll have to pay a total tax of 2,62,000. Now, is surcharge applicable on this? Answer is no. Why, sir? Because my total income is not more than 50 lakhs. It is not more than 50 lakhs. Therefore, surcharge will not come. Okay, sir. So normal tax came, on that surcharge is not coming. Now, on this amount, what you have got, on that amount, you will apply health and education cess of 4%. You will get your final tax liability. Sir, yeah, sir. This I have understood, sir. Can you show the format, sir? Yes. Total income, tax rate, tax amount. This is a specific format for computation. So up to 2.5 lakhs, no tax. 2.5 lakhs to 5 lakhs, 5%. On 5 lakhs to 10 lakhs, 20%. More than 10 lakhs, 30%. Okay. Similarly, I have given some more question. Let us say my income is 26 lakhs. What will I do now? 26 lakhs, I'll divide up to 2.5 lakhs, no tax. Then from 2.5 lakhs to 5 lakhs, on 2.5 lakhs, I'll have to pay 5%. Then from 5 lakhs to 10 lakhs, I'll have to pay 20%. And for more than 10 lakhs, which is 16 lakh rupees is more, correct? I'll have to pay how much? 30%. So if you see over here, this is the tax which I'm going to get. Will I have any surcharge over here, sir? No, sir. Here also no surcharge will be there because of what reason? Because there is no, my total income is not exceeding 50 lakh rupees. So my health and education cess will come and my net tax liability will be 6,16,200 rupees. Now, of course, if you are a super senior citizen, for you up to 5 lakh rupees, there will be no tax. Correct? Now, if you are a non-resident person, what will happen, sir? If you are a non-resident person, even though it does not matter whether you are a senior citizen, normal individual, or a super senior citizen, for you, the basic exemption limit will be up to 2.5 lakhs only. You don't have to pay tax up to 2.5 lakhs. Anything more than 2.5 lakhs, you will have to pay tax on that. So normal, whatever individual is there, same limit is applicable to you. Sir, what if my income is more than 50 lakhs, sir? How do I do the computation? If my income is more than 50 lakhs, now we should compute the normal tax. We will get 23,17,500. This is the normal tax which I am going to get. So up to 10 lakhs, it is 1,12,500. And on the balance amount, 30% I'll apply. I'll get 22 lakhs something. So total tax which I have to pay is 23,17,500. Now on this normal tax which you have received, you should add surcharge. Why you should add surcharge, sir? Why you are adding surcharge over here? Last few cases you didn't add, because here my total income is more than 50 lakh rupees. So because my total income over here is more than 50 lakh rupees, I'll have to pay extra tax to the government called as surcharge. How much, sir? How much surcharge will I have to pay? I'll have to pay a surcharge of 10%. So whatever tax is coming now, on that I'll apply 10%. I'll get the surcharge amount. I got the surcharge amount over here. Now, once I calculate the surcharge on the total amount now, tax amount, add surcharge amount, whatever you have got, that total amount I will pay 4% health and education cess. Now please note, this working which is done in the bracket now, which I have done here, this working is important in the examination. This is something which the examiner expects from you. Many students, they do small mistakes in examination, not doing this kind of working, etc. Please make sure that you don't do such kind of mistake. Now, what lawmaker says is, so we understood how to compute the taxes, normal taxes, etc. We understood. Now what lawmaker says to you is, lawmaker says, I will give you some benefit. I'll give you some discount. I'll give you some concession. I will give you some discount. Hey, don't say no, don't say no, don't say no. I am going to give you some discount. I want to give you some relief. Lawmakers are telling, if your earnings are less, I will give you some benefit. Rebate under section 87A. Rebate under section 87A. I will give you something called as discount or rebate. Who will get this rebate, sir? If you are a resident individual and if your total income is up to 5 lakh rupees, then you will get a rebate under section 87A. How much will be the rebate? How much is the discount which will be given to you? How much is the relief which will be given to you? Whatever tax amount is coming, or 12,500, whichever is less, is the relief which is going to be given to you. Sir. Repeat. Rebate under section 87A. If you are a resident individual whose total income is up to 5 lakh rupees, if you are a resident individual whose total income is up to how much, sir? 5 lakh rupees, then you are going to get a rebate under section 87A. How much is the rebate? Whatever tax amount is coming, or 12,500 rupees, whichever is less. What is important to note over here is, if your total income is up to 5 lakhs, rebate will come. Now this rebate is given before surcharge and cess. Before levying surcharge and cess, this rebate is going to be given to you. So total income is 4 lakh. So can I say Mr. Dilip is a resident individual having a total income of 4 lakh? Because it is 4 lakh, can I say it is less than 5 lakhs? Yes, sir. This total income is less than 5 lakh rupees. Now, since my total income is less than 5 lakh rupees, can I say government is going to give some discount or concession to me? Yes. So I will have to compute the tax on my total income of 4 lakh rupees. How much is it? 2.5 up to 2.5 lakh 0, and 2.5 to 4 lakh it is 1.5 lakhs. On that 5%, which comes to 7,500. Now on this 7,500 I will get what, sir? Rebate. How much is the rebate? Whatever tax amount is there, or limit of 12,500, whichever is less. How much is that? 7,500. Therefore net tax liability will be how much, sir? 0. Why, sir, 0? Whatever tax I had to pay, I got full rebate of that. Because why government is giving this rebate? Government wants to give benefit to those people who are earning little less income. Government says, if you are earning only up to 5 lakh rupees, that means you are earning a less amount. I will not collect any taxes only from you. Sir, what if I earn more than 5 lakh rupees? Even 1 rupee more, full tax will be levied. Whatever normal tax is there, fully levied. For example, I have earned 5 lakh 10,000. Now will I get a rebate, sir? No, because my income is not more than, my income is not less than 5 lakh. Now, next, one of the important concept. Next concept for a discussion is what, sir? Concept of marginal relief. There is a concept of what, sir? Marginal relief. Sir, what do you mean by marginal relief? See, what happens is, normally, whenever your income is slightly more than the surcharge limit, little more than the surcharge limit, the lawmakers are going to levy something called as surcharge to you. When your income is slightly more than, if your income is slightly more than 50 lakhs, surcharge will come. When is surcharge coming, sir? If your income is more than 50 lakhs, surcharge will come. So when your income is slightly more than 50 lakhs, then also surcharge will come. No, surcharge will come because it is more than 50 lakhs. Now, because of applicability of the surcharge, the extra amount of tax which you have to pay in sometimes may be more than the income which you have earned. Sir, repeat. because of applicability of this surcharge, the extra tax which you have to pay to the government will be more than the extra income you have earned. So lawmakers are telling, if the extra tax which you have to pay is more than the extra income which you have earned, then the difference amount will be given to you as surcharge. It will be given to you as surcharge. I'll give the meaning, then we will do a question. See, that will be given to you as margin relief, not surcharge. Sorry, that relief will be given as called as margin relief. Marginal relief is applicable only when your income is slightly or marginally more than the surcharge, marginally more than the income on which surcharge is applicable. Concept of marginal relief will be applicable for all the taxpayers if the total income is slightly more than the surcharge limit. If the total income is little bit slightly more than the surcharge limit, the concept of marginal relief will come. Now, for example, I'll just take an example instead of directly discussing this. I will just take an example so you understand it even in a better manner. Let us say my income is 50 lakhs. If my income is 50 lakhs, how much will be the tax amount, sir? See, sir, up to 10 lakh rupees, it will be 1,12,500. And more than 10 lakh rupees. Sir, how did you directly get this, sir? Array, that up to 2.5 lakhs, nothing. 2.5 to 5, it is 12,500. And from 5 lakhs to 10 lakhs, it is 1 lakh rupees. So total of that is 1,12,500. And for more than 10 lakhs, which is 40 lakhs, I have to pay how much? 30%. 4 3s are 12 lakh rupees. Correct? So total of this is how much, sir? 13 lakh 12,500. Now, to this, should I add any surcharge? No, sir. Your income is not more than 50 lakhs. Therefore, there will be no surcharge. So, before cess, what is the tax which I have to pay on 50 lakh rupees? 13 lakh 12,500. Now, let us do one thing. Let us increase our income. Let me increase my income by how much, sir? 10,000 rupees. So, my income is increasing by 10,000. So, now what is my new income, sir? My new income comes to 50 lakh 10,000. So I have earned extra 10,000 rupees. So now my new income is 50 lakh 10,000 rupees. Now can I say same computation of tax on 50 lakh 10,000? Up to 10 lakhs, up to 10 lakh rupees, my tax amount will be what? 12,500 rupees. And if it is more than 10 lakh rupees, more than 10 lakhs, how much is more, sir? Sir, it is 40 lakh 10,000. On that, what is the tax rate applicable to me? 30%. On that, tax rate applicable to me is 30%. So 40 lakh 10,000 into 30% will give me 12 lakh 3,000. Now what is the total of this? Sorry, 1,12,500 I had to do. So plus 1,12,500. It will come to 13,15,500 rupees. Now on this, can I say, because my total income, what is my total income? Total income is this much. Because my total income is more than 50 lakhs, what will come? Surcharge will come. So I will have to add a surcharge of how much? I will have to add a surcharge of 10%. 10% of what? 10% of 13,15,500. So what is this? 131,550. So what is the total of this? Plus 131,550. 14,47,050 rupees. Correct? 14,47,050 rupees. Now just concentrate. Just concentrate. Concentrate. Inge par students. Yeah. See, my income increased from 50 lakh rupees to 50 lakh 10,000. The income was increased by how much? The income increased only by 10,000 rupees. My income increased by how much, sir? My income has been increased by only 10,000 rupees. But if you see the increase in tax, this is my income. Correct? Not correct? Now, if you see the tax on 50 lakh rupees, I had to pay 13 lakh 12,500, and on 50 lakh 10,000 I had to pay 14 lakh 47,050 rupees. My income increased only by 10,000, but tell me by how much did my tax increase? Sir, your tax increase, sir. See, sir, 14,47,050 minus 13,12,500. Sir, your tax increased by 1,34,550 rupees. Oh, students, what is happening over here? My income increased only by 10,000 rupees, but if you see on that how much tax increment has happened, the tax has been increased by 1,34,500 rupees. Hey, are you understanding what is happening over here? Can I say I am a fool? Hey, why are you calling yourself fool, sir? Hey, can I say I am a fool that I have earned 10,000 rupees extra? Just because I earned 10,000 rupees extra, I am paying so much extra tax to the government. How much extra am I paying? 1,34,550 rupees to the government. Now, government understood this problem which was faced by people. Because of this reason, no, people were hiding their income. People were not showing their complete income. People were hiding their income. They were not showing full income. Therefore, government told, okay. Wait. I'll do one thing. I'll give you something called as marginal relief. What will I give you? I'll give you something called as marginal relief. Now, what is this marginal relief? How much marginal relief will I give you? They are telling, see, because you have earned little extra amount, you are paying huge amount of extra taxes. No, the difference between, what is marginal relief, sir? The difference between the extra tax and extra income which is there, the difference between extra tax and extra income will be given to you as relief. How, sir? Extra tax which I have paid is 1,34,550 rupees. Extra income earned by me is 10,000. So 1,24,550 rupees will be given to you as relief. Enjoy, Panno. Lawmakers are telling, please enjoy. I will give you this much relief. Hey, tell me now. In our case, we have done this. Relief will be given in which case? Will relief be given here or will it be given here, sir? Relief will be given in case number, because surcharge is coming over here. Now lawmaker says less marginal relief, working note number 1. How much? 1,24,550 rupees. So difference will come to 050 minus 124,550. 13,22,500. To that I will have to add health and education cess. Now see, just because government gave the margin relief to me, my tax, can I say, drastically increased? See, I had to pay a tax of 13,12,000 if the income was how much? 50 lakh rupees. Now how much am I paying, sir? 13,22,500. Can I say I am paying only 10,000 rupees extra? Before I had to pay how much extra? 1,34,500. Now because I am getting this margin relief, I am paying only 10,000 rupees extra. Correct, not correct? So how much? 4% marginal relief is there. How much is this, sir? 4% health and education cess on into 4% is 52,900. So my net tax liability comes to 13,75,400 rupees. I hope this concept of margin relief is very clear to you. What is margin relief? If your increase in tax is more than increase in income, if your increase in tax is more than increase in income, the difference between increase in tax and increase in income will be given to you as marginal relief. I hope this point is clear to you all. Now please note, if you have any question, you can definitely ask your questions. Okay, you can ask your questions. Now margin relief, I think this concept of margin relief is very clear to you. Now you do your computation for what, sir? If the total income is 1 crore 2 lakhs, you do this computation, and you please note, you do your computation later. You do it by yourself. You can take a screenshot of this. The answer is what, sir? Margin relief will come to 9625. You'll get a margin relief of how much? 9625. You can take a screenshot of this. Don't see the answer while solving. This is the question which you are supposed to do. You take a screenshot of this answer. Correct? You take the screenshot of this answer, solve it by yourself. If you get stuck somewhere, you please check your answer again. Or anyways, you can come back and watch this video. It is anyways uploaded on YouTube. Now, this is also margin relief concept only. Now, yeah, one clarification has been issued by government. I told no, government, whenever government feels like issuing a clarification, they'll issue a clarification. So one of the clarification which was issued by them is, let us say a person is born on 1st of April 1965. I am born on 1st of April 1965, sir. Because I am born on 1st of April 1965, on the end of previous year, in the year 24-25, what is the last date, sir? 31st March 2025. Will I be called as a senior citizen or not? Because if I am called as a senior citizen, I will get the basic exemption limit of 3 lakhs, and if I am a normal person, I'll get a basic exemption of 2.5 lakhs. Correct? No. So if a person is completing 60 years on so if a person was born on 1st of April 1965, can I say he will be celebrating his birthday on 1st of April 2025 again? This birthday which he is going to celebrate will be his 60th birthday. He is going to celebrate his 60th birthday. Correct? Not correct? Correct? Not correct? So, sir, because he is celebrating 60th birthday on 31st of March, what is he, sir? Is he still 59 years only, or will he be considered to be 60 years? Lawmaker says, you are celebrating your 60th birthday. Why are you celebrating your 60th birthday? Or because you have completed 60 years. Correct? Not correct? Why will you celebrate your 60th birthday? Why will you celebrate your 60th birthday? Because you have completed 60 years. No. You are celebrating your 18th birthday. You are celebrating your 21st birthday. Why are you celebrating your 21st birthday? Sir, because I am eligible for marriage. No. Tarkuri. So why are you celebrating your birthday, sir? You are celebrating your birthday because what, sir? You have completed so many years. Correct? So lawmaker says you have completed 60 years on 31st of March of the previous year. Therefore, on 1st of April, you are celebrating your birthday. Therefore, on 1st of April, what are you doing, sir? You are celebrating your 60th birthday. I hope this point is clear to you all. This was a clarification given. Similarly, if your birthday is on 1st of April, if your birthday is when, sir? If your birthday is on 1st of April 1945, you will be treated as super senior citizen. I hope whatever we discussed till now is very clear to you all. Correct? Shall we continue? Now, please note. Lawmakers have introduced a new tax system. Lawmakers have introduced what, sir? A new tax regime or a new tax system. What is that, sir? That is called as default tax regime. Lawmakers have introduced a new tax system or a new tax regime, which is called as what, sir? Default tax regime. Lawmakers have introduced this system called new tax regime called as default tax regime, section 115 BAC. Now, till now, whatever slab rates we saw, no, this slab rate is called as what, sir? Optional tax regime. Whatever we saw till now, it is called as optional tax regime. I did not tell you this before. This is called as what, sir? Optional tax regime. Now, lawmakers have introduced something called as section 115 BAC, wherein they have introduced new slabs. Now, there are a lot of benefits which you will get by following this, and there are a lot of disadvantages also which you are going to get by following this. What are those benefit, disadvantages? We'll see, etc. But what is this default tax regime? Section 115 BAC talks about default tax regime. So this is a new tax, also called as what, sir? New tax regime. Whatever you have already studied till now, that is called as optional tax regime or old tax regime. This is your new tax regime. Okay, sir. Now, this section is applicable to an individual HUF, AOP, BOI, artificial judicial person. Basically, it is applicable to all those people to whom slab rate is applicable. Correct? Section 115 BAC is applicable to a resident as well as a non-resident. It will be applicable to whom, sir? Whether you are a resident or a non-resident, it does not make any difference to me. It will be applicable to both of them. It will be applicable to whom, sir? It will be applicable to a resident as well as a non-resident. Tax rates under 115 BAC for the previous year 24-25. What is the tax rate under 115 BAC, sir? Up to 3 lakh rupees, you don't have to pay any tax at all. Up to 3 lakh rupees, you don't have to pay any taxes. If your income is more than 3 lakhs, up to 7 lakhs, you will have to pay a tax of 15%. If your income is more than 7 lakhs up to 10 lakhs, you will have to pay a tax of 10%. Sir, what if my income is more than 10 lakhs? If your income is more than 10 lakhs up to 12 lakhs, it is 15%. If it is more than 12 lakhs up to 15 lakhs, 20%. Only if it is more than 15 lakh rupees, you will have to pay a tax of 30%. This is the new tax regime applicable for those people for whom slab rate is applicable. So now you can follow either old tax system or new tax system. Sir, this is more beneficial, no sir? See sir, here if it was more than 5 lakh rupees, I had to pay 20%, sir. Here the 20% will come only when it is more than 12 lakhs. Sir, this is more beneficial, no? Yeah. That will decide later. That will decide later whether this is beneficial or that is beneficial. So up to 3 lakh rupees, you don't have to pay any taxes in the new tax system or default tax regime. And if your income is from 3 lakhs to 7 lakhs, you have to pay how much? 5%. From 7 lakhs to 10 lakhs, 10%. 10 lakhs to 12 lakhs, 15%. 12 lakhs to 15 lakhs, 20%, and more than 50 lakhs, you will have to pay more than 15 lakhs. You will have to pay how much? 30%. 30% is the tax rate applicable to you. Now, of course, just like the previous case, here also, if your total income is more than 50 lakh rupees, if your total income is how much? More than 50 lakh rupees, you will also have to pay surcharge. How much is the surcharge which I have to pay, sir? The surcharge which you have to pay will be, if the income is more than 50 lakhs up to 1 crore, 10%. If it is more than 1 crore up to 2 crores, 15%. And more than 2 crores, you'll have to pay a surcharge of 25%. This is the surcharge which you have to pay. Sir, for them 37% surcharge is not there. For those people who are opting for 115 BAC, for them that higher surcharge limit is not applicable. Which higher surcharge limit, sir? That 37% surcharge is not applicable. So if their total income is more than 2 crores, how much surcharge they have to pay? 25% only. Sir, is health and education cess applicable to them also? Yes, health and education cess is applicable to everyone. Now for these people also there is a rebate given. How much is the rebate, sir? They have a good rebate. How much is the rebate, sir? See over there, the rebate was given to a resident individual if his total income was up to 5 lakhs, and the rebate was how much, sir? 12,500 rupees or tax amount whichever is less. Here, rebate will be given to same resident individual if the total income is up to 7 lakh rupees. Up to 7 lakh rupees. And how much will be the rebate given, sir? Rebate will be the tax amount or 12,000 or 25,000, not 12,500, or 25,000 whichever is less. Tax amount or 25,000 whichever is less will be given to you as rebate. Okay, sir. Now, here there is one more method of calculating rebate for them. There is an extra benefit which is given exclusively for them. It is not given for old tax regime people. Sir, what is this, sir? Now, what they say is, if your income is slightly more than, what, sir? 7 lakhs, then also I will give you a rebate. But this rebate I will tell you how to calculate. Extra benefit, where the total income is slightly more than 7 lakhs, rebate under section 87A will be, you first calculate that what is the extra income you have earned. See how much is the extra income you have earned. How will I know that, sir? From see what is your total income. From that total income, what is 7 lakh rupees? From the total income, what is subtract 7 lakh rupees? You will get what, sir? From total income subtract 7 lakh rupees, you will get your extra income. Now you compute the tax on your total income. Say whatever total income they have given in the question, on that you compute the tax. Now if the tax on the total income now compare the tax amount with the extra income which you are earning. If the difference of this is more than, so if the tax amount is more than your income amount, if the tax amount is more than the extra income which you have earned, then the difference between the tax and the income will be taken as rebate to you. That will be given to you as rebate under section 87A. Sir, can we get marathon notes? Yeah, see, right now, I mean, I cannot upload the marathon notes straight away. What you can do is, for CA students, I have already recorded a marathon. Okay, for CA students already I have recorded a marathon. So you can go to our normal YouTube channel, and then from there you can download it. So instead of watching, say if you guys are watching this on this particular channel, you can directly go to which channel, sir? Normal YouTube channel, and there is CA students marathon I have already recorded. There I have attached these notes. Okay, of course you will be having little extra when compared to CA students. So that little extra which is there, that you can just mark down whenever we are discussing that point. Okay, so you can download that notes, that is already available. You can download that notes. There are like topics like tax rates, etc. Topics like residential status, topics like TDS, TCS, topics like set off carry forward, topics like income from other sources, income from capital gain, income from salary, income from house property. They are all same, exactly same. Okay, there are only here or there business income little bit changes there. Okay, those changes you can definitely I mean, you can definitely go where, I mean, while discussing only, you can make sure that you note down those changes. Yeah. Sir, okay, sir, we understood this. Shall we compute the tax, sir? Yes, we'll compute the tax. Dilip, Mr. Dilip, age 32 years, has a total income of 20 lakhs. Compute his tax under 115 BSc. Compute his tax on what, sir? Under 115 BSc. Now, computation of tax on total income. Computation of tax on total income. How do I compute under 115 BSc or default tax regime? Hey, please note, in examination, if they ask you to compute tax under 115 BSc or under default tax regime or under old tax regime, your answer should be same. What should be your answer be, sir? Your answer should be same. You should compute it under 115 BSc or default tax regime. So up to 3 lakh rupees, I don't have to pay any taxes at all. Up to 3 lakh rupees, I don't have to pay any taxes. If my income is from 3 lakh rupees to 7 lakh rupees, on 4 lakhs, I'll have to pay 5%, which comes to 20,000. If it is from 7 lakhs to 10 lakhs, 10%. On 3 lakhs, 10% is 30,000. If it is from 10 lakhs to 12 lakhs, 15%. If it is from 12 lakhs to 15 lakhs, 20%. If it is from more than 15 lakhs, I'll have to pay 30%. So compute your tax. Add surcharge. Is surcharge applicable? No, sir, surcharge is not applicable. So then I'll add health and education cess, and I'll get my final answer 3,01,600. Now, so this one question you see 36 lakhs. Now compute. Let us do the computation together. Correct? We'll do the computation. Why to check over there, sir? Let us do it together only. No, sir. Now the income is how much, sir? They are telling the income, total income is how much? 36 lakhs. The total income is 36 lakhs. Now they have asked you to find the tax under old regime as well as under new regime. Compute the tax under old regime and new regime. Hey, please note, you are supposed to compute it faster than me. Correct? That is the task. Or you pause the video and compute. Sir, under old tax regime, up to 2.5 lakhs, no tax. If your income is more than 2.5 lakhs up to 5 lakhs, you will have to pay a tax of 12,500. Hey, how did you get 12,500, sir? Array, 5 lakhs minus 2.5 lakhs is 2,50,000 into 5% is the tax rate applicable. Correct? No. If it is more than 5 lakhs up to 10 lakhs, you will have to pay 1 lakh. And if it is more than 10 lakhs, sir, how, sir, 1 lakhs? On 5 lakh rupees, 20%. If it is more than 10 lakhs. More than 10 lakhs means what, sir? How much is more? 26 lakh is more. Sir, how did you get 26 lakhs? 36 lakh is my total income. From that, I'll subtract 10 lakhs. How much is left over? 26 lakhs. On that, I'll have to pay how much? 30%. So what is the tax amount coming, sir? The tax amount comes to ding ding 26 lakhs into 30%, 7,80,000. Total comes to how much? Total comes to 8,92,500. Aid, health and education cess of 4%. 4% of what, sir? 892,500 into 4%. So this into 4%. Sir, why have you not added surcharge? Because in this case, my total income is not crossing. Because my total income is not crossing how much? Why have I not added surcharge? Because my total income is not crossing 50 lakhs. 9,28,200 is my net tax liability. So this is the amount of tax which I have to pay under old tax regime. Sir, what is the tax which I have to pay under new tax regime? Because I am interested in new person, sir. Up to 3 lakh rupees, you don't have to pay anything. If your income is more than 3 lakhs, up to 7 lakhs, you will have to pay how much? 5%. So how much is that 5%, sir? Sir, 5% will be on 4 lakh rupees. I apply 5%. It will come to 4 5s are 20,000. More than 7 lakhs up to 10 lakhs, on 3 lakh rupees, you will have to pay 10%. 3 10s are 30,000. Then for more than 10 lakhs up to 12 lakhs, you will have to pay a tax of, on 2 lakh rupees, you will have to pay a tax of 15%. 15 2s are 30. So how much is this, sir? 30,000. And if it is more than 12 lakhs up to 15 lakhs, how much will you have to pay? Sir, on 3 lakh rupees, I'll have to pay 20%. 3 2s are 60,000. And for more than 15 lakhs, how much is more than 15 lakhs? 36 minus 15. So 36 lakhs minus 15 lakhs. On that, I'll apply 30%. 36 minus 15, 21 lakhs into 30% is 6,30,000. 6,30,000. Now what is the total tax which you have to pay? 36 lakhs minus 15 lakhs into 30% plus 60,000 plus 30,000 plus 30,000 plus 20,000. 7,70,000. This is the tax which I have to pay. How much, sir? 7,70,000 rupees. Correct. Add surcharge is not applicable. So can I directly add health and education cess? How much? 4%. So this amount into 4%, 30,800 plus 77 ding ding 800 is the tax liability. So this is the tax liability for this question under new regime as well as old regime. I hope this is very clear to you all, and I hope you have also got the right answer. I hope you have also got the right answer. Okay, shall we continue now? Yes, sir, we'll continue. So there are some more questions given. There are marginal lift concept applicable, etc. All those questions I have given. Now, rebate calculation, that is little important. You just check this carefully. If your income is slightly more than 7 lakh rupees, then also you'll get a rebate. See, if your income is less than 7 lakhs, then to definitely tax amount or 25,000, whichever is less, will be given to you as rebate. If it is slightly more than 7 lakhs, what do you have to do? You will have to see what is the extra income and what is the tax on the total income. Tax on 7,10,000 you calculate, and what is the extra income you have earned. Now the difference between tax amount and extra income will be given to you as rebate. Okay, that will be given to you as rebate. Now, sir, you said that there are some disadvantages also of following 115 BSE. Sir, you please tell us that those points also no, sir. Yes. I'll do what? I'll give a comparative analysis of old tax regime with new tax regime. Let us do a comparative analysis of old tax regime, normal provisions and 115 BSc, optional regime and default regime. See, tax rates though we just now saw, correct? Surcharge of 37% is there for old tax regime, and new tax regime it is only up to 25%. Then health and education says equally applicable. A rebate concept also we saw. Now this is the major differences which we saw, and we saw the tax computation also. What we found, sir, under old tax regime I am paying more tax when compared to new tax regime. Now we will see, if I follow the new tax regime, if I follow 115 BAC, if I follow default tax regime, or if I follow new tax regime, what are those things which government is going to take from you? What are those things which government is going to take from you? So from salaried people, so if you have any income from under the head salary, following benefits will not be available to you. Which are the benefit? You are not going to get a benefit of leave travel concession. Please note, I'll repeat once again. Whatever we are seeing now, these benefits will be taken away from you if you are following 115 BAC. Sir, repeat. Whatever we are seeing now, these benefits will be taken from that person who is following 115 BAC. 115 BAC. If you are following optional tax, if you are following default tax regime, if you are following new provision, they will take away from you. They will take away from you these benefits. What benefits, sir? They are going to take away leave travel concession exemption under section 10(5). There is something called as section 10 subsection 5. No? Under section 10 subsection 5, you get something called as leave travel concession. Under section 10 subsection 5, you get something called as leave travel concession. We will see under salary chapter what it is. That benefit will be taken away from you. Then HRA exemption under section 1013A will be taken away. Sir, HRA exemption. That means 40% or 50% of salary, actual HRA received, or rent paid minus 10% of salary, that will be taken away. Yes, if you follow 115 BSc, HRA exemption will not be given to you. Then you remember allowances. You cheat, duck hat HRA. There are some allowances. What is that, sir? Underground allowances, commutation allowances, then children hostel allowances, children education allowances, tribal area allowances, truck driver allowances. Correct. These allowances benefit will not be given to you. Similarly, duck hat means what, sir? Daily allowances, underground allowances, C for conveyance allowances, H for what, sir? Helper allowances, A for academy allowances, and T for tour or transfer allowances. These allowances benefits will not be given to you. Only 4 allowances benefits will be given. One is transport allowance, which will be given only for handicapped employee. Traveling and tour allowance will be given. Daily allowance and conveyance allowance also will be given, because these allowances are required for running the business. It is not an allowance given to the employee, but these are the allowances which are required for running the business. So these allowances will be given. Similarly, deductions under section 16 will not be given, except the standard deduction. Except standard deduction, you get a standard deduction, correct? You get a standard deduction. Under salary, under section 16 subsection 1 clause A, you get a standard deduction. For optional tax regime, standard deduction is 50,000. For default tax regime, they will get a standard deduction of 75,000. Apart from the standard deduction, no other type of deduction will be given. Deductions, what are the other types of deduction? Like professional tax, and which is the other type of deduction? Entertainment allowance. I am not going to give you. Okay, sir, understood, sir. What about income from house property, sir? Are they taking something from income from house property also? If I have a house property income, lawmaker says yes. If you have an income from house property, then for self-occupied property, normally you get a deduction of interest under section 24B. If you follow 115 BAC, if you follow default tax regime, no interest deduction will be given for under section 24B. Only for self-occupied property. Only for self-occupied property, they are not going to give interest benefit. They are not going to give interest benefit. However, if it is deemed to be let out property or let out property, no problem. You can continue following the same thing. Then income from business and profession. From business and profession also they have taken lot of benefits from you. Which are those benefits which is taken by them, sir? From business and profession they are telling, I will not give you, no additional depreciation will be given. From business and profession, what will they not give me, sir? From business and professions they are not going to give me additional depreciation. You remember that there is something called as additional depreciation. That additional depreciation will not be given to you. Similarly, no deduction for donation to scientific research. See, scientific research section 35 is there. You can either do in-house scientific research, or you can give money or donation to a scientific research association or an organization or an institution. That donation, if you are giving to someone, you will not get any benefit. No deduction for 35 AD, specified business. You remember list of 14 businesses are given. Honey business, sugar business, hospital business, hotel business. The list of 14 businesses, complete capital expenditure is allowed as deduction. That deduction, lawmakers are telling, I am not going to give you that deduction. In case of capital gains, sir, because capital gain is taxable at special rates, for this there is no benefit which is taken from you. Then income from other sources. For income from other sources also they have to remove something. Yes. You will not get exemption under section 1032. If you are clubbing minor income child, the parent in whose hands the income is clubbed, that parent will get 1500 deduction. No, lawmakers are telling, I will not give you. I will not give. No, I am not going to give you if you follow default tax system. And if you are an MLA MP, normally your daily allowance and constituency allowances are exempt. But if you follow 115 BS, it will be fully taxable. Then for family pension, you get a deduction under section 57. Correct? No. That deduction, normally it is whatever 1/3 of the pension or 15,000, whichever is less. But here they are giving you extra benefit of 1/3 of pension or 25,000, whichever is less. Then from gross total income, if you subtract deduction, then only you get total income. Correct? From the gross total income amount, if you are subtracting deduction, then only you will get your total income amount. Now whatever deductions are there under chapter 6A, they will take away from you. They are not going to give you those deductions, except 80JJAA, 80CCD, except this 80CCD, 80CCH2, 80CCD2, that will be given. 80JJAA will be given. Other than that, no other deductions will be given. Set off and carry forward of losses, not allowed. Setting off of losses, carry forwarding under setting off of losses, not completely not allowed. House property loss, normally what can you do, sir? Normally loss of house property of the current year can be adjusted with others. No, they are telling, if you follow 115 BSE, the house property loss of current year cannot be adjusted with income of any other head. Similarly, no set off of brought forward losses or depreciation losses if such loss is due to items in point number 1 to point number 5. Meaning, if you are getting any losses of last year because of these reasons, I will not give you, I will not allow you to set off those losses. Okay, so these are the different benefits which are taken away if you follow 115 BAC. And of course, special rate income, irrespective of which method you are following, the special rate income will always be taxable at special rates only. Okay, now let us continue our discussion with the next point. Sir, what is the tax rate applicable to a company, sir? If you are a domestic company, the tax rate applicable to you is 30%, and for foreign company, the tax rate applicable is 35%. Please note, there is an amendment over here. The tax rate for foreign company has been reduced. The tax rate for foreign company now is how much, sir? 35%. Now, for domestic company, what is the tax rate applicable? Sir, 30% is the tax rate applicable. For domestic company, how much is the tax rate applicable, sir? 30% is the tax rate applicable. However, if the turnover of domestic company, or if the gross receipts of the domestic company in the previous year 22-23, if the turnover or if the gross receipts of domestic company in the year 22-23 is up to 400 crores, then the tax rate applicable for the domestic company is what, sir? 25% in the current year. Hey, wait. Sir, just now you told for current year that tax rate will be 30%. No, sir, for domestic company. Yeah, correct. Tax rate for domestic company normally is how much? 30%. However, if the turnover of the domestic company in the year 22-23, in the previous year 22-23 is up to 400 crores, then this year instead of 30%, they will apply the tax rate of 25%. Okay, very important point this is. Sir, are companies also required to pay surcharge? Yes, companies also have to pay surcharge. Company will have to pay surcharge if their total income is more than 1 crore. So if their total income is more than 1 crore up to 10 crores, the surcharge for domestic company is 7% on tax amount, and for foreign company it is 2% on tax amount. Sir, what if the total income is more than 10 crores? Then for domestic company 12% on tax is surcharge, and for foreign company it is 5% on the tax amount will be taken as surcharge. And needless to say, health and education cess will compulsorily come, and concept of marginal relief will be applicable to them also. So there is, question computation for them is very easy, because straight away we know the tax rate, apply the tax rate. So if a domestic company has a turnover of 250 crores in 22-23 and is earning 5 crore rupees, what is the tax? So 5 crores into 25%, surcharge will be applicable on this tax amount. Then whatever total is there on that health and education says, you'll get your final answer. So computation of tax will be very easy for companies, because there is no slab concept, etc. Then, sir, what is the tax rate for a partnership firm? What is the tax rate for an LLP, sir? What is the tax rate for an local authority, sir? The tax rate for a partnership firm, LLP and a local authority are, if for them, the tax rate is flat 30%. Flat 30% tax they have to pay. Flat how much? Flat 30% they have to pay the tax, and surcharge is applicable to them if the total income is more than 1 crore. How much is surcharge applicable? 12% on the tax amount is called applicable as surcharge. Health and education cess is applicable how much, sir? 4% on the tax amount, and margin relief will be given. Margin relief also will be applicable to them. For a partnership firm or an LLP, what is the tax rate applicable? For a partnership firm or an LLP, the tax rate applicable is how much, sir? Flat 30%. Whatever your income is there, even 1 rupee income you earn, how much surcharge you will have to pay? You will have to pay a surcharge of you will have to pay a tax of 30%. Surcharge if the total income is more than 1 crore. How much surcharge? 12%. Health and education is normally applied, and the margin if concept is also applicable to them. Then tax rate for cooperative society. Sir, what is the tax rate for cooperative society, sir? Sir, for cooperative societies, what is the tax rate applicable? For cooperative societies, the tax rate is what, sir? If the total income is up to 10,000 rupees, tax rate is 10%. 10,000 to 20,000, 20%. More than 20,000, 30%. Surcharge is applicable just like company. If the turnover is more than 1 crore, 7%. More than 10 crores, 12% of taxes surcharge. Health and education cess of 4%, and margin relief concept is also applicable to cooperative societies. Now, we are coming to what, sir? Special tax rates. Under this capital gain chapter, most important, lot of changes have happened. So you can expect a question on this capital gain topic. Either here or anyways, capital gain chapter is something which we'll discuss in detail. Now, section nature of tax and what is the tax rate. Section 112 talks about long-term capital gain. Section 112 talks about what, sir? Long-term capital gain. For long-term capital gain, if the transfer, now please note, last year, which year? Last year, the year 2024 was the year of election. It was year of what, sir? Election. Because it was an year of election, last year there were two budgets which has happened. One was on 1st of February, another one was on 23rd of July. The budget which happened on 1st of February is called as interim budget, and the budget which happened on 23rd of July is called as final budget. Basically, it is pre-election budget and this is post-election budget. Now, because there are two budgets now, for this particular year, changes happened 2 times in the year. For this particular examination which you are writing in June and December, you will have to see whatever changes happened in the Feb budget as well as in July budget of 2024. Okay. Now, therefore, this date becomes very important. 23rd July 2024. Please don't ever forget this date. If someone is asking you when is your birthday, say them 23rd July. If they are asking you when is your uh, mother's birthday, say 23rd of July. If they ask you when is your father's birthday, say 23rd of July. If they ask you when is your sir's birthday, say 23rd of July. Well, if they ask you when is your sir's anniversary, you say 23rd July. If they ask you when did sir get his first girlfriend, say 20. Anything on this earth, if they ask you what is the date, you should remember 23rd of July. Okay. So section 112 talks about long-term capital gain. In case of long-term capital gain, if the transfer is made before 23rd of July 2024, the tax rate which was applied is 20%. And if the transfer is made on or after 23rd of July 2024, then the tax rate applicable is 12.5%, meaning they have reduced the tax on long-term capital gain. If the transfer is before 23rd July 2024, 20%. On or after 23rd July 2024, meaning after that date, if you are selling a capital asset, how much is the tax rate applicable to you? 12.5%. Similarly, long-term capital gain under section 112A. So there are three items taxable under 112A and 111A. For those three items, if it is a long-term capital gain and if the transfer is made before 23rd of July 2024, the tax rate will be 10%. And if the transfer is made on or after 23rd July 2024, tax rate will be 12.5%. Tax rate will be how much, sir? 12.5%. Now, this tax will be applied for income in excess of 1,25,000. Under 112, there is no limit. Directly 20%, 12.5% based on when the transfer is made. But under 112A, if you are making any long-term capital gain, then if it is before, tax rate is 10%, after, tax rate is 12.5%. After which, sir, after 23rd of July, tax rate will be 12.5%. Now, here the income in excess of 1,25,000 is only taxable. Not all the income is taxable, only the income more than 1,25,000 is taxable. 111A, section 111A talks about short-term capital gain. For short-term capital gain, if the transfer is before 23rd July 2024, it is 15%. On or after 23rd July 2024, it is 20%. Short-term capital gain, 111A. Sir, what about normal short-term capital gain, sir? Normal short-term capital gain is taxable under section 111. And for that short-term capital gain, what is the tax rate applicable? The tax rate applicable is your slab rates. Okay. So 111A short-term capital gain, tax rate will be, if it is before, 15%, after 20%. Sir, but you please, something is confusing me, sir. What is confusing you? Sir, can you please tell us what are those assets covered under 111A and 112A? See, normally for long-term capital gain, section which you are supposed to apply is 112, and for short-term capital gain, section which you are supposed to apply is 111. But if it is a long-term capital gain under 112A and 111A, then only you will come over here. Now, which are the items covered under 111A and 112A, sir? There are only three assets covered under, there are only three capital assets covered under 111A and 112A. Which are those three capital assets? Listed equity shares on which security transaction tax has been paid at the time of purchase and sales, or equity oriented mutual funds on which security transaction tax is paid at the time of sale, or units of Business Trust of India on which security transaction tax is paid at the time of sale. So on these three items, if the transfer is made, these three items are taxable under 111A for short term, 112A for long term. If the transfer is made before which date? If the transfer is made before 23rd of July 2024, tax rate will be different, and if it is afterwards, tax rate will be different. What is the tax rate we have just now seen? Okay, sir. Then, if you are having any casual income, what do you mean by casual income? Lottery, betting, gambling you're doing, or you're going to some TV show and performing over there, winning some money over there. So a horse race you are betting, etc. Now, in all these cases for you, they are covered over here, casual income. For that, tax rate is flat 30%. How much ever income you earn, flat 30% is tax rate. Section 115 BBJ, online money games. If you are participating in some online money games, Rummy Circle, Dream 11, come let us make team and win 3 crore rupees, something, and all advertisements are coming, correct? No, if you are doing all those activities, you are playing online money games, 30% flat tax rate is applicable to you. Section 115 BBE, section 115 BBE talks about undisclosed income or deemed income. It talks about what, sir? Undisclosed income or deemed income. Sir, what do you mean by undisclosed income? Undisclosed income is what, sir? Your black money. If you are not disclosing your income completely to the government, and if then government identifies that income, then that will be covered over here. For that, what is the tax rate which is required to be applied? 60%. 60%. Okay, not okay? Now, I'll just, instead of shall we solve it? We will solve it. We'll solve it. Okay, we'll solve it. Okay. I'll solve. Sir, when our total income, in the question sometimes it may happen that they may ask us to compute total income, and the total income may have your income taxable at normal rates as well as income taxable at special rates. Sir, if that is the case, how will I compute the tax, sir? Let us just do that now. Because one question, if we do know, the concept will be very clear right then and there itself. Dilip has following income for previous year 24-25. Compute his income tax liability under optional regime as well as under default regime. So you have salary income, it is taxable at slab rates. Your income from house property taxable at slab rates. Then long-term capital gain 112, short-term capital gain 111, long-term capital gain 112A, and lottery income. These are all taxable at special rates. So can I say my total income of 19,20,000 has income taxable at slab rates as well as at special rates? So in this case, sir, how should I do the computation? I'll tell you the simple procedure. Whenever such kind of activity is happening, when you have an income taxable at slab rates and at special rates, always first step number 1, compute the tax on special rate income. Whatever income is taxable at special rate, compute the tax on that. Okay, sir, I have computed. Then what is the step number 2? Step number 2 is to compute tax on the income taxable at slab rate. Sir, okay, sir, I will first compute the income taxable at special rates, then compute the tax on income taxable at slab rate. Then what should I do, sir? Total it. You will get your tax, and on this total you apply surcharge, you apply health and education cess, etc., whatever is applicable. Okay, sir, shall we do it, sir? Yes, we will do it now. Now please note. Answer. How should I present this in examination? Computation of tax on total income. I hope you have copied the question or taken a screenshot of the question, or if you have just understood the question. Now, first particulars. Income. I have first write down all the special rate income. This is special. Long-term capital gain under section 112. How much, sir? 2 lakh rupees. Long-term capital gain under section, short-term capital gain under section 111A, 2,50,000. Long-term capital gain under section 112A, 4 lakh rupees. And lottery income 7 lakh rupees. Correct? So we have got all the special, we have written all the special income, and whatever is left over is called as your balance total income. This balance total income is how much, sir? 10 lakh rupees. Sir, how did you get 10 lakh rupees? These two. The total is 10 lakh rupees. So balance total income. Now we have to compute the tax on this. What is the tax rate applicable? Sir, for 112, the tax rate is 12.5%. 112A, the tax rate is 12.5% for income in excess of 1.25 lakhs, meaning up to 1.25 lakhs, no tax will be collected. Then long-term capital gain. This is for long-term capital gain under 112A. For short-term capital gain, how much is the tax rate, sir? Tax rate is 20%. Please note, I am making an, this question is a case wherein all the transfer is made after 23rd of July. So you should see the question carefully when the transfer is made. That is also important. In your examination, they may give a case wherein, say first point, the transfer is afterwards, second point, transfer is before, third point, transfer is before. So you should be very careful with respect to that, okay? Then lottery income tax rate is 30% and balance total income tax rate is slab rate. Now shall we find the tax amount, sir? Yes, sir. Let us write the tax amount. So first is what, sir? 2 lakhs into 12.5%, 25,000. 2,50,000 into 20%, 50,000. 4 lakhs not fully taxable. I will get the benefit of 1,25,000. Now whatever is left over, 2,75,000 into, I'll apply what's that? 12.5%, 34,375. Then I have 70,000 taxable at flat, 30%, which is 21,000, and balance 10 lakh rupees is taxable at what's that? Slab rate. Now let us, so we have computed the tax on special rate income, no? Yes, sir, we have computed the tax on special rate income, sir. Now let us compute the tax on slab rate income. That is balance total income of 10 lakh rupees. I know that up to 2.5 lakhs, I don't have to pay any tax. If my income is more than 2.5 lakhs up to 5 lakhs, I'll have to pay 5%, which will come to 12,500. We have already done some computations. If it is more than 5 lakhs up to 10 lakhs, then I'll have to pay how much, sir? I'll have to pay 1 lakh rupees. Sir, how, sir? 1 lakh rupees. Array, 5 lakhs into 20%. This is 2.5 lakhs into 5%. So what is the total tax coming to? 1,12,500. So this 1,12,500 I'll write over here. Working note number 1. So the total of this is what, sir? 25,000 plus 50,000 plus 34375, 21,000, 1,12,500, 2,42,875. Add. What will you add? Surcharge. Sir, surcharge is added only when total income is more than. Surcharge is added only when total income is more than. Surcharge is added only when total income is more than 50 lakhs. Is my total income more than 50 lakhs? Answer is no. Since my total income is not more than 50 lakhs, can I say no surcharge? Add what, sir? Health and education cess. How much health and education cess? 4%. 4% of what? 2,42,500 into 4%. We have 4%. 9,715. So what is the total, sir? The total tax which I have to pay. 252,590. I have to pay total how much, sir? 2,52,590 rupees. I hope this is very clear to you all. Okay, so when your total income has a income which is taxable at slab rates and special rates, this is what you are supposed to do. This is what you are supposed to follow. Yes, sir. This is clear, sir. Shall we continue, sir? Yeah. Okay. Now let us go to what, sir? So there is one more question given over here. Oh sir, you told us to do under both the methods. No sir. Sir, this you have done under which method, sir? This is under optional tax regime. Now what is the answer in default tax regime, sir? Are under default tax regime also the answer will remain same, meaning little bit of your answer will change. Under default tax regime, what is going to change is only the income taxable at slab rate. Please note, under default regime, can I say special incomes are always taxable at special rates? Only this tax amount will change. Only the income taxable at slab rates will change. So I'll do that also. So I'm just copy pasting these things because it is same. Now 10 lakh rupees is taxable at slab rates. Can I say up to 3 lakhs no tax, 3 lakhs to 7 lakhs 5%, which is 4 lakhs into 5% is 20,000. 7 lakhs to 10 lakhs I'll have to pay 10%, 30,000. So how much, sir? 50,000 rupees. To this amount, how much is the total now? 25 plus 50 plus 34375 plus 21,000 plus 50,000. 1,80,375. Add surcharges are not applicable. 180,375. Add health and education cess of 4%. 7215. 187,590. So this is the answer. This is the answer for which regime? Default tax regime or new regime. So see, sir, 2,52,000, 1,87,500. Okay, let us. So 2,52,590, 1,87,590. Now, some important points with respect to tax rates which you have to keep in mind. What are those important points? Because these are some points wherein you may do mistakes in your life. Which are these points, sir? Total income and the tax amount should be rounded off to the nearest multiple of 10. Whatever total income you have now and whatever tax amount you have, that should be rounded off to the nearest multiple of 10. So who says this? Section 288A says that you should round off your total income to the nearest multiple of 10, and section 288B says you should round off your tax amount to the nearest multiple of 10. So for example, if it is up to 4, then round it off to the previous multiple of 10. If it is 5 or more, then round it off to the next multiple of 10. For example, last digit is what? Last 4 digit is 748. So 14,56,748. Now can I say it is 5 or more? Round it off to the next number. 48 will become 50. Sir, what if it is 732? 32, 2, last digit is 2. It is less than 5. That is 4 or less, correct? So it will be rounded off to the previous multiple of 10. Next, you remember rebate under section 87A under both default tax regime and optional tax regime. Lawmaker says this rebate under section 87A shall not be available against long-term capital gain under section 112A. It shall not be available against which income, sir? That long-term capital gain taxable under section 112A. Rebate under section 87A is not available against long-term capital gain taxable under section 112A. Because, why, sir? Because see, because for long-term capital gain taxable under 112A, you are already getting a benefit of 1,25,000. On that, again, if you are claiming rebate, that lawmaker says, no, you are taking a lot of benefits from me, I will not allow that to happen. Now, basic exemption limit point. This is also a beautiful important point. Normally, whatever basic exemption limit is there, no, that basic exemption limit is required to be adjusted against whom, sir? Normally, whatever basic exemption limit is there, that basic exemption limit is required to be adjusted against the income which are taxable at slab rate. We get that basic exemption limit, meaning up to 2.5 lakhs, you don't have to pay any tax now. Yeah, that 2.5 lakhs you are required to adjust against someone. No, whom should you adjust with? Income taxable at slab rates. Normally, basic exemption limit shall be adjusted with income taxable at slab rates. However, if the basic exemption limit is not fully adjusted or utilized, if the 2.5 lakhs is not fully adjusted, if my slab rate income is less than 2.5 lakhs, if the 2.5 lakhs is not fully adjusted, then that unadjusted basic exemption limit shall be adjusted with income taxable at special rates. It shall be adjusted with whom, sir? That income which is taxable at special rate except casual income and undisclosed income. Meaning that 2.5 lakhs, 3 lakhs or 5 lakhs basic exemption limit is there no under optional regime and under default regime. That should first be adjusted with whom, sir? That income which is taxable at slab rates. That income which is taxable at slab rates. Now, after adjusting it with those income which are taxable at slab rates, if something is left over, then you can adjust that with income taxable at special rates except undisclosed income and casual income. You can never adjust them with undisclosed income and casual income. And one more last point with respect to tax rate. The maximum amount of surcharge on below income shall be restricted to 15%. There are some income, okay, which are this income? Long-term capital gain under 112, long-term capital gain under 112A, short-term capital gain under section 111A, and dividend income. On all this income, the maximum amount of surcharge which you can levy is how much, sir? 15%. How much is the maximum amount of surcharge which you can collect on this? 15%. Now, for the time being, let us call this income as GUBE income. Let us call all these four income as what's GUBE income. Now, for example, I have 50 lakhs of GUBE income and other incomes is 100 lakhs. So, what is my total income now? 150 lakhs. Correct? 1.5 crores. So, can I say it is more than 1 crore? So, what is the surcharge applicable? 15%. So, on all the income, it will be 15% only. Now, my GUBE income is 1.5 crores. My other income is 2.5 crores. Now, can I say my total income is 4 crores? Now, since my total income is 4 crores, can I say the surcharge limit of 25% will come? When is 25% surcharge coming? If your total income is more than 2 crores, 25% will come. But still, on this income of 1.5 lakhs, which includes this GUBE income, 1.5 crores of this GUBE income, maximum surcharge which I can levy is how much? 15%. Similarly, I have only GUBE income worth rupees 3 crores. I have only these incomes worth rupees 3 crores. What is the surcharge applicable? 15%. Because on these incomes, maximum amount of surcharge is how much? 15%. Okay, that is all about that tax rate topic. Now we'll see agricultural income. We'll discuss this agricultural income also. A very small topic, very easy topic. We'll discuss agriculture income and residential status also. We'll try to cover in this particular lecture only, and then we'll wind up today's discussion. So every day we'll be meeting at the same time. You can definitely log in at that same time. Every day we'll be meeting at same time, and we'll try to complete this entire marathon in 1 week's time. Okay. Of course, those who are watching this, say once this recording is done, it will be uploaded on YouTube. If you are watching that YouTube recording right now, so it is going live, correct? Right now it is going live, but later the combined video, the full video will be uploaded on YouTube. That time, I mean, of course, the time is on you. You can watch it anytime. Hey, agriculture income. What is this agriculture income, sir? Agriculture income is exempt under section 10. No, so sorry, section 10 is there. No, there is a section called as section number 10, which gives a list of income which is exempt. So section 10 subsection 1 talks about agricultural income. What is section 10 subsection 1 telling? Section 10 subsection 1 says agricultural income is exempt from payment of tax. You will not have to pay any tax on agricultural income. What is section 10 subsection 1 telling, sir? Section 10 subsection 1 says on agricultural income you don't have to pay any tax if that agricultural income is from a agricultural land in India. On agricultural income you don't have to pay any tax. When, sir? If that agricultural income is from a land located in India. Sir, what if my agricultural income is from a land located outside India? Should I pay tax? Yes, you should definitely pay tax. Now, agricultural income is exempt from payment of tax if such agricultural income is from an agricultural land located in India. So, if you have an agricultural land, India means what, sir? Up to 12 nautical miles, it is called as territorial waters. Up to 200 nautical miles, it is called as continental shelf. For the purpose of this agricultural income, up to 12 nautical miles, the area will be called as India only. Meaning this, whatever land region is there, that is India. Up to 200 nautical miles area is also India only. Sir, what do you mean by agriculture income, sir? You told agriculture income is exempt, but what do you mean by agriculture income? Agriculture income means any rent or revenue derived from an agricultural land located in any rent or revenue derived from an agricultural land in India which is used for agriculture purpose. So if there is any rent or revenue which is derived, which you are getting from an agricultural land which is located where, sir? In India, and which is used for agriculture purpose, then that is called as agriculture income. And if it is an agriculture income, it is exempt from payment of tax. Then if you are getting any income by way of agricultural operations, income from agricultural operations are also covered over here. Income from farmland, dwelling unit on an agricultural land. So on an agricultural land, if there is any farmhouse or farm dwelling unit, from that whatever income you are earning, that will also be exempt, provided this farmhouse or dwelling unit should be located in an agricultural area which is located in rural area. Income from nursery, plantation and seedling. Income from nursery, plantation, seedling is also agricultural income, therefore it will be exempt. Now, sir, you said that farmhouse or dwelling unit should be located in rural area. What do you mean by rural area, sir? Rural area means any area which is not an urban area. Hey, sir, what joke you are doing, sir? Hey, seriously, rural area means what, sir? Any area which is not an urban area. Basically, income tax law, they have defined what is urban area. So whatever is not urban area will be called as rural area. Okay, sir, tell me what is urban area then? Urban area means that area whose population is 10,000 or more. If you are staying in an area whose population is 10,000 or more, as per the latest census, if you are staying in an area whose population is 10,000 or more, that means you are staying in urban area. So that population should be taken as per the cantonment board as at the beginning of the as per the latest census which has happened before the beginning of the financial year, before the beginning of the previous year. So if you are staying in an area whose population is 10,000 or more, that means you are staying in urban area. Similarly, if you are staying in an area whose population is more than 10,000 up to 1 lakh, that means you are definitely staying in urban area. From your area up to 2 kilometers area is there, no, that is also treated as urban area. Sir, what if I am staying in an area whose population is more than 1 lakh up to 10 lakhs? My area's population, sir, it is more than 1 lakhs up to 10 lakhs. Then you are definitely staying in urban area. From your area up to 6 kilometers of area is also called as urban area. And sir, I am from a metro city, sir. My city's population is more than 10 lakhs, sir. Now tell me, sir, what will happen? If your area's population is more than 10 lakhs, then definitely your area is an urban area. From your area up to 8 kilometers area is also called as urban area. Now, sir, how do I measure this distance, sir? Which road should I take, sir? Shortest road I should take, longest road I should take. How should I measure, sir? You should measure, the distance should be measured aerially as the bird flies. As the bird flies, you should measure it aerially. Now, sir, what do you mean by agricultural operations or agricultural purpose? See, any work undertaken. See, in Raja Binoy Kumar Sahas Roy, see, in our income tax law, they have not defined what is agricultural activity or agricultural operations. Supreme Court in Raja Binoy Kumar Sahas Roy case gave a criteria for deciding whether a particular activity will be called as agricultural activity or not. Sir, what is that criteria? The criteria was, if you're doing basic operation, that means you are doing agricultural operation, therefore it is exempt. If you are doing only subsequent operations, so after doing basic operation you are required to do subsequent operation. If you are doing only subsequent operations, that means you are not doing agricultural activities. Sir, what is this basic operation, subsequent operation? Up to the stage of germination of seed, whatever work is there, no, that is called as basic operation in agricultural activity. Up to the stage of germination, any process up to the stage of germination, like you are sowing the seeds, harvesting, harvesting, you are sowing the seeds, you are making the farmland ready, etc. All these are before germination of the seeds. After germination, cutting or your pesticide controls, etc. is after germination. So whatever operations you are doing, if it is a basic operation up to the stage of germination, that will be treated as basic operation and agricultural income. If you are doing only subsequent operation, not an agricultural activity, therefore not agricultural income. If I am doing both, sir, entire income will be treated as agricultural income. Now, what is important in this agricultural income topic is computation of income when they have given composite income to you. Sir, what do you mean by composite income? Sometimes what may happen is the question may give you a question may tell you that, say for example, Dilip is a person who is cultivating potatoes. This potatoes which I have cultivated potatoes. Now tell me, if I sell these potatoes in the market, what is the income which I am going to get? Sir, whatever income you are going to get by selling this potato in the market, that will be an agriculture income, sir, because you have cultivated the potato and you are selling the potato. Correct. You are absolutely right. Now, let us say I cultivated the potatoes. After cultivating the potatoes, I washed these potatoes properly, and then I put these potatoes in a machinery and I cut these potatoes into slices and I made potato chips and sold potato chips in the market. So repeat. I cultivated the potato, washed those potatoes, cut these potatoes, fried these potatoes, and final product potato chips came, and I started selling these potato chips in the market. So the question over here is, the final product which I sold in the market is the potato chips. Correct? No. What is the final product which I sold in the market? Potato chips. So these potato chips were made by the potato which I only cultivated. This potato chips was made by me, made from the potato which I only cultivated. So the question over here is whether the money which I am receiving at the end, whether that money will be treated as your agricultural income or it will be treated as your business income. Lawmaker says this amount which you have received at the end, no, this will have some portion which will be allocated for agricultural and some portion will be allocated for business income. How do I do that computation, sir? That is what is given in rule number 7. Rule number 7 talks about composite income from sale of agricultural produce. Composite income from sale of agricultural produce. Now, agricultural produce can be sold by you in raw form, or it can be sold after some processing. If you are selling the agricultural produce in a raw form, as it is, I have took out potatoes from the ground, and as it is I am selling it to someone, then then entire income will be called as agriculture income and it will be fully taxable. But if I am selling it after applying some process, then I am going to check whether that process was mandatory to be applied to sell that agriculture produce, or was it not a mandatory process? Was that process mandatorily required to sell that agriculture produce? If yes, then whatever income I am getting now will be agriculture income and therefore it will be exempt. For example, if I want to sell the potato, when I take the potatoes out from the ground, it may have a lot of mud. So when I am taking it out from the ground, I may have to wash it properly to sell it to people. So I am applying a process which is mandatorily required to be applied to sell the potatoes. Now, because this process is something which you should compulsorily do, whatever income you have got now is what, sir? Agricultural income. Sir, what if the process which is applied by me is not mandatory process? See, sir, I washed and sold. Okay. Now I washed, I cut them, I fried them and then sold them. Now the income which is there will be divided into two categories, agricultural income and business income. How much will be agricultural income? You should take, see, please note, because you did not sell it in the market, you used it for making potato chips. Lawmakers are telling, if you would have sold this agriculture produce in the market, if you would have sold this potato, whatever potato you are using for making potato chips, if you would have sold this potato in the market, how much money you would have earned? Take that. Take fair market value of agriculture produce used for further processing. Take what? Take fair market value of agriculture produce used for further processing. From that, subtract the cost of cultivation of agriculture produce. What is the cost which is incurred by you for cultivating this agriculture produce? Subtract that. Whatever you have got now is your agriculture income, which will be exempt. Whatever you have got now is agriculture income, therefore exempt. Sir, how much is my business income, sir? You take your sale value of processed product chips. What is the sale value of chips? Subtract from that value of the potato which you cultivated. If you would have purchased this potato from the market, you would have paid some money, no? Yes, sir. So subtract that. So take your sale value of processed product, sale value of chips, subtract fair market value of agriculture produce used for further processing, subtract cost of processing. Whatever is left over is your business income. Sir, it will be better if we do a question on this. Sir, please, sir. I have understood what you have thought, sir. But for better understanding, shall we do a question, sir? Definitely. Anything for you. Now, let us take a question. See this question. Mr. B is there, correct? Mr. B is there. Mr. B grows sugarcane and uses the same for the purpose of manufacturing sugar in his factory. So B is there, who is growing sugarcane, and he is using this sugar only to manufacture what, sir? He is using this sugar for manufacturing. He is using this sugarcane for manufacturing sugar. 30% of the sugarcane is sold in the market for 10 lakh rupees, and the cost of cultivation of this sugar is how much, sir? 5 lakh rupees. Now, what has happened over here is, let us say he is cultivating 100%. Out of this 100%, what is he doing, sir? 30% he is selling it as it is, sold in market. 30% what? 30% sugar cane. He has cultivated sugar cane. How much he sold it for? He sold it for 10 lakh rupees. And what is the cost of cultivating this? The cost of cultivating this is 5 lakh rupees. Can I say the difference of this is his agricultural income? Can I say this difference is agricultural income? Because he sold it as it is in the raw form. Correct, sir. True, sir. Now, what is the next point telling? The cost of cultivation of balance 70% sugar cane is 14 lakhs. Cost of cultivation of balance 70% is 14 lakhs. The market value of this is 22 lakhs. Now, balance which he used for further processing, 70% used for further processing. Correct, no? The cost of that 70% is how much, sir? Cost of cultivating that is how much, sir? 14 lakh rupees. The cost of cultivation is 14 lakh rupees. And the market value of this product is how much? 22 lakh rupees. Now, after incurring 1.5 lakhs, after incurring 1.5 lakhs as manufacturing expenses on the balance sugar cane, the sugar was sold for 25 lakhs. Now what has happened, sir? I have used 70% for further processing. Can I say on this 70% I have applied some process which was not mandatory? Therefore, on this I will have two types of income. One is my agricultural income and one is my non-agricultural income. Sir, how much will be your agricultural income? Can I say my agricultural income will be how much, sir? Fair market value of agriculture produce. What was the market value of this 70%? 22 lakhs. Less cost of cultivation. What was the cost of cultivation of this 70 lakhs, sir? Sorry, this 70%, 14 lakhs. So what is my agricultural income of this 70%? 7 lakh rupees. Similarly, non-agriculture income is how much? That is my business income is how much? Sir, sale price of my final product. I sold the final product sugar for 25 lakhs. Correct? No, I sold sugar for how many rupees? Rupees 25 lakhs less cost of conversion, of cost of processing. How much did I apply for processing? They say I applied for processing 1.5 lakhs. Then what is the market value of agricultural produce used for this, sir? I used my own sugarcane which is grown by me. What was the market value of that? 22 lakhs. What is left over is my business income. How much is my business income? 1.5 lakhs is my business income. How much, sir? 1.5. How much is my business income? 25 minus 22 minus 1.5 is 1.5. Okay, that is my business income. I hope this is very clear to you all. Yes, sir. Now, here, so there are some more questions given over here. There are 3 businesses for which lawmakers have told, I will only tell you how much is business income, how much is agriculture income. You don't have to do this computation, idli, vada, sambar, nothing you have to do. I will only tell you how much is business income, how much is your agricultural income. So for how many businesses? 3 businesses. What lawmakers are telling, if you are a person who is involved in growing as well as manufacturing, please note, not only growing, not only manufacturing. If you are a person who is involved in the business of growing and manufacturing tea, growing and manufacturing coffee, growing and manufacturing rubber. If you are a person who is involved in the business of growing and manufacturing tea, coffee and rubber, for you, I will only give you the percentage. How much is business, how much is agriculture. Correct? You don't have to break your head or whether it is used in further processing, how much is used in further processing, what is the market value. Nothing you have to worry. Directly, if you are involved in the business of growing and manufacturing tea, for example, I have tea plantation from where I take tea leaves. From that tea leaves, I'm going to make what, sir? From that tea leaves, I'm going to make tea powder. I'm applying some process and I'm making tea powder. Now this tea powder, the tea powder which is there, no, that I'm selling. How much, whatever amount I'm selling it for. Okay. Lawmaker says 60% of that amount which you have received is agriculture income and 40% of that amount which you have received is business income. Let us say I have grown a manufactured tea. I sold it for 5 lakhs in the market. The final tea I sold it for 5 lakhs. 5 lakhs into 60%. 3 lakh rupees is your agriculture income and 2 lakh rupees is your business income. Straight away, you don't apply any logic at all, apply this percentage. Sir, what if I'm involved in growing and manufacturing? Please note what is important over here. You should do both the things. You should grow and then manufacture. If you're growing and manufacturing coffee, now coffee, if it is only, coffees are of different types. If it is grown and cured by you, say coffee will have some layer, you can cure it, you can roast it, you can ground it, etc. So if you are growing and manufacturing coffee which is grown and cured by you, and if you are selling that, 75% of the amount which you received is your agriculture income, 25% will be your business income. If it is a coffee which is grown, cured, roasted, grounded, 60% is agricultural, 40% is business. If it is rubber grown and manufactured by you, 65% is your agriculture income and 35% will be your business income in case of rubber. Okay, I hope this is very clear to you all. Coffee 60-40. What is this, sir? Sorry, coffee 60-40 if it is grown, roasted, grounded by you. Tea 60-40. Coffee grown and cured by you 75-25, and rubber it is 65-35. Whatever is the highest rate, that will be your agricultural income. Now, whenever there is a agricultural income in your total income, the concept of partial integration will apply. Partial integration says what, sir? Partial integration is applicable to an individual HUF, AOP, BOI, artificial judicial person if their total income is more than 5 lakh rupees. If your total income is more than 5 lakh rupees, and if your total income, if you are an individual HUF, AOP, BOI, artificial judicial person, and if your agricultural income is more than 5,000 rupees, and if your non-agricultural income is more than 2.5 lakhs, that is basic exemption limit. It can be 2.5 lakhs, 3 lakhs or 5 lakh rupees. Then for you the concept of partial integration shall apply. Sir, what will happen if the concept of partial integration is applying? If the concept of partial integration is applying, the tax which you have to pay is required to be calculated by you. How will I calculate, sir? Step number 1, calculate the tax on agricultural income as well as non-agricultural income. Add agricultural income and non-agricultural income, you will get some amount. On that amount, compute the tax. Then compute the tax on agricultural income as well as basic exemption limit. Agricultural income is there, basic exemption limit is there, add, compute the tax. Step number 3, you will get your tax payable. What is tax payable? Difference between step 1 and step 2. That is the tax which you have to pay. That is the tax which you have to pay. Done, sir. This is your agriculture income. Some question on partial integration I have given. Partial, not that important, partial integration. We will see the last point now. Residential status. Very easy. Residential status. Please note. Residential status for individual is very important. What is residential status for individual? Please note. An individual will be treated as resident if he satisfies the condition given in section 6.1. Section 6 subsection 1 gives the basic condition which is required to be satisfied by an individual to be called as resident. Okay. If an individual satisfies the basic condition given in section 6 subsection 1, he will be called as resident. If he does not satisfy, he will be called as non-resident. He will be called as what, sir? Non-resident person. Once he satisfies the basic condition, I will have to check for his additional condition. Additional condition, two possibilities are there. Individual can satisfy additional condition or he may not satisfy additional condition. If he is satisfying additional condition, he will be called as resident and ordinary resident. If he does not satisfy additional condition, he will be called as resident but not ordinary resident. Therefore, an individual residential status can be divided into 3 categories: resident and ordinary resident, resident but not ordinary resident, and non-resident. When he is a resident and ordinary resident, if he satisfies basic condition, he will be resident. If he does not satisfy, he will be non-resident. Once he satisfies basic condition, I'll check for additional condition given in section 6.6. If he satisfies that also, he will be called as resident and ordinary resident. If not, he will be called as resident but not ordinary resident. What is the basic condition, sir? Basic condition says an individual will be treated as resident if he satisfies any one of the basic condition. So there are 2 conditions. If you satisfy any one among these 2, you will be called as resident. Which are these conditions, sir? To be called as resident for an individual, he should stay in India for a period of 182 days or more in the previous year. If he has stayed for 182 days or more in the previous year, he will be called as resident. Or he should stay in India for 60 days or more in the previous year and 365 days or more in 4 preceding previous year. Wait. To be called as resident, he should stay for 182 days or more in the previous year or 365 days or more in the 60 days or more in the previous year and 365 days or more in 4 preceding previous year. For example, our previous year is what, sir? 24-25. If you have stayed for 182 days or more in the previous year, you will be called as a resident. Or in the previous year, you have stayed for 60 days or more, and in last 4 years, you have stayed for 365 days or more, you will be called as resident. Now, please note. Date of coming to India and date of leaving India. Date of coming to India and date of going from India should also be counted for calculating number of days stay in India. Similarly, stay at one place is not mandatory. You can stay anywhere. Stay at one place is not mandatory. And some continuous stay is also not mandatory. Stay at one place, not mandatory. Continuous stay is also not mandatory. Then what are the additional conditions? Additional conditions to be called as a resident. So additional condition, what, sir? Additional condition will help once you are a resident. Once you satisfy the basic condition, I will see additional condition. There are 2 additional conditions. You should satisfy both of these additional conditions. If I satisfy resident, ordinary resident. If I don't satisfy resident but not ordinary resident. Okay, sir, please tell me what is this additional condition, sir? Additional condition. He should be resident for a period of 2 or more previous year in 10 preceding previous year. Meaning, in last 10 years, I should be resident for at least 2 years. In last 10 years, I should be resident for at least 2 years. Not in the previous year. In the previous year, I should satisfy first condition. in last 10 years, I should be resident for at least 2 years, meaning I should have satisfied any one of the basic condition for last 10 years. I should have satisfied any one of the basic condition for at least 2 years, and I should have stayed in India for 730 days or more in 7 preceding previous year. I should have stayed in India for 730 days or more in 7 preceding previous year. Sir. Once again, sir. In the previous year, I'll check for basic condition. Once I satisfy basic condition for last few years, I'll check additional condition. In last 10 years, I should be resident at least for 2 years, meaning I should be resident of India for 2 or more years, and I should have stayed for 730 days or more in last 7 years. Then I will be called as resident and ordinary resident. Now, normally this is the condition which we see, correct? But there are some exceptions. Okay, there is an exception to second basic condition. What is second basic condition talking about? 60 plus 365. In the following cases, you should not see 60 plus 365. Then what should you see, sir? In the following cases, second basic condition should not be checked. So what will you check? To be called as resident, these people, if they want to be called as resident, you should check 182 days condition. You should not check 60 plus 365. You should check only 182 days wala condition. If you are an Indian citizen who is leaving India during the previous year for employment outside India or as a crew member of Indian ship. If you are a person who is going out of India, why are you going out of India? Sir, because I am a crew member of Indian ship, sir. I am working for Indian ship. I am a crew member of Indian ship. Or if you are going outside India for the purpose of employment outside India, sir, I got a job in New York, sir. I got a job in US, sir. I got a job in London, sir. So I am going outside India. So in these two cases, if a Indian citizen is leaving India for employment outside India or as a crew member of Indian ship, then for him to be called as a resident, you should see which condition, sir? 182 days or more wala condition. You should not see second basic condition. Similarly, if you are an Indian citizen or a person of Indian origin coming to India, if you are an Indian citizen or a person of Indian origin who is visiting India, who is coming to India during the previous year, then for him also I will see what, sir? 182 days or more wala condition. But here he has some extra points also to be checked. If you are an Indian citizen or a person of Indian origin, who is a person of Indian origin? Either you or your parents or your grandparents are born in undivided India. Now, if you are coming to India, I will check what is the total income which you are having from Indian sources. If it is 0, if it is up to 15 lakhs, meaning if it is less than 15 lakh rupees, if your total income from Indian sources is less than 15 lakh rupees, then he will be treated as resident if he satisfies the first basic condition, which is 182 days condition. If he has a total income less than 15 lakh rupees, he will be treated as resident if he satisfies first basic condition. However, if your total income from Indian sources are more than 15 lakhs, lawmakers are telling, I will have to catch this kind of person. You will be called as resident if you satisfy the first basic condition, or you have stayed in India for 120 days or more in the previous year and 365 days or more in 4 preceding previous year. Meaning what, sir? In simple words, I'll tell you. See, if you are a person who is going from India for employment or as a crew member, 182 days. If you are a person who is coming to India, you are an Indian citizen or a person of Indian origin, 182 days. But if you have a total income more than 15 lakh rupees or equal to 15 lakh rupees, then I will add one more extra condition, meaning either 182 days condition or 120 plus 365 days condition also. If you are satisfying, you will be called as a resident. Now, if you are a person, if you are a individual who is a crew member of Indian ship, then the date which you mention in the continuous discharge certificate as the date of joining the ship and the date of signing of the ship, those dates and all the periods in between that should be excluded for calculating number of days of stay in India. For example, in simple words, for example, I have boarded this ship at Mumbai. Now this ship is crossing the territorial waters only after 30 days. Correct? I have joined this ship on 1st of July and this ship was roaming around everywhere. It crossed the territorial waters on 1st of August. So, sir, should it be treated that I was for this 30 days I was in India only? Lawmaker says no. On the date when you mention in your continuous discharge certificate as date of joining, till the date when you mention as date of signing off, whatever period is there, no, that should be excluded. Okay, let us take this example. Mr. X, 19 years, left India for the first time in his life on 31st of May 2024. Determine his residential status. If he is a person who left for employment purpose, or he left for a world tour. If he is leaving for employment purpose, can I say I will check 182 days condition? And if he is going for any other reason, I will check 60 plus 365. Now, if he is going for employment purpose, since Mr. X has left India for the first time, that means he stayed in India for all the periods before leaving the India. And during the previous year, he stayed in India for 61 days because he left on 31st of May. So 30 plus 31. Okay. If he left India for employment outside India, if an Indian citizen leaves India for employment outside India, he will be considered as a resident if he satisfies first basic condition. If he satisfies the first basic condition, he will be called as resident. In the present case, his stay in India in the previous year is only 61 days. Therefore, he is not a resident of India for the previous year 24-25 because 182 days or more he should stay. He has not stayed, correct? But however, if you are going for a world tour, either first condition or second basic condition. If he left for a world tour, if he leaves India for a world tour, he will be called as a resident if he satisfies any one of the basic condition given in section 6.1. In the present case, he satisfies the second basic condition, therefore he is a resident. Okay, further he is since he left India for the first time, he also satisfies both the additional condition, therefore he will be called as resident and ordinary resident. Now please note, these types of question, this question which we have solved, they are called as case study based question. They are called as what, sir? Case study based. Sir, question was only 2 lines, answer you have written almost 8 to 10 lines, sir. Yeah, this is how these case study based questions are there. You should write provision and give the conclusion. Now there was one more section newly added, section 6A, called as deemed resident. If you are not a resident of any other country and if you satisfy some condition, you will be deemed to be resident of India. Sir, when we deemed to be resident of India, sir? Individual who is an Indian citizen, if you are an individual who is an Indian citizen and who is living outside India, who stays or resides outside India and who comes to India for a visit during the previous year, and the total income is more than 15 lakh rupees from Indian sources, and he is not a resident of any other country, then he will be deemed to be resident of India. If you are Indian citizen living outside India or residing outside India, comes to India for a visit, and from Indian sources you have income more than 15 lakh rupees, and you are not a resident of any other country, 5 conditions satisfied, you will be deemed to be resident of India. Then for other people, for HUF, to check the residential status of an HUF, I will see the control and management of HUF. If the control and management of HUF is wholly or partially in India, then that HUF will be called as resident of India. If the control and management is wholly outside India, then it is not resident. What do you mean by control and management, sir? Where are the managerial decisions taken? That piece. Now, once HUF is a resident of India, we need to check for additional condition for Karta. So, once for HUF, I should see 6.2. Once HUF satisfies 6.2, it will be called as resident. If it is not satisfying, it is non-resident. Once HUF is a resident, I will call Karta now and I will check additional condition for Karta. If Karta satisfies additional condition, HUF will be called as resident and ordinary resident. If Karta is not satisfying, resident, HUF is resident but not ordinary resident. Okay, this point is written over here. So there is similarly question given over here. Sir, what is the residential status of a company, sir? A company to be called as a resident, if you are an Indian company or a domestic company, you are always resident of India. But what if I am not an Indian company or a domestic company? Then I will check your POEM. What is POEM, sir? Place of effective management. If your place of effective management is in India, you are a resident. If it is outside India, you are a non-resident person. Section 6.4. Residential status of other people like in firm, LLP, OPBI, etc. There also I'll check control and management. If it is wholly or partially in India, resident. If it is wholly outside India, it is a non-resident. Now we have one more topic called as scope of total income. What is the scope of total income telling, sir? Once we determine your residential status, now will you have to pay tax in India or not? That is required to be determined. How will I check that? By applying provisions of section 5. If you are a resident and ordinary resident, wherever you are earning income, you will have to pay tax in India. If you are a resident but not ordinary resident, you will have to pay tax only on Indian income, and non-resident also will have to pay tax only on Indian income. See, normally on Indian income, who has to pay tax? Sir, everyone has to pay the taxes, whether you are a resident, an ordinary resident, a resident but not ordinary resident, or a non-resident. And on foreign income, who will pay taxes? Sir, only resident and ordinary resident will pay the taxes. Basically, if you are a resident and ordinary resident, you will have to pay taxes on your global income. Okay, now what do you mean by foreign income? Foreign income, you just generally understand it to be any income other than Indian income. Then what is Indian income, sir? Four incomes are treated as Indian income. Whatever income is received in India is an Indian income. Whatever income is deemed to be received in India is an Indian income. Whatever income is accrued or arising in India, Indian income. Whatever income is accruing, deemed to be accruing or arising in India, whatever income is deemed to accrue or arise in India is also an Indian income. So these four incomes are specifically called as what, sir? Indian income. Okay. Now I'll directly go to the chart. Please note, very important point. Resident and ordinary resident has to pay tax on global income, and untaxed profit or income brought past untaxed profit. Last year's means 10-15 years back, 5 years back, 2 years back, 3 years back, whatever income I have earned that was not taxed in that year in India. Now if I bring that income to India, that is not taxable. Now directly I'll go to the chart. So if income accrued or deemed to be accrued, income received or deemed to be received in India, can I say this is an Indian income? Because if it is an Indian income, it will be taxable for all the people, whether you are resident, ordinary resident, non-ordinary, not ordinary resident, or non-resident. Income accrued outside India but received and deemed to be received in India, can I say this is also Indian income because it is received or deemed to be received in India, therefore taxable for everyone. Income accrued and deemed to be accrued in India but received outside India, because it is accrued or arising or deemed to accrue or arise in India, can I say it is an Indian income? Because it is an Indian income, it is taxable for everyone. Income accrued and received outside India, it is accrued outside India and received also outside India, but the business is controlled or profession is set up in India. This is basically a foreign income. Therefore taxable for resident and ordinary resident. But this is one foreign income which will also be taxable for resident but not ordinary resident. If there is a business outside India which you are controlling from India, it is taxable for resident and not ordinary resident also. For non-resident, it is not taxable. Income accrued or received outside India and business is also controlled from outside India. It is not an Indian income, it is a foreign income. So taxable only for resident and ordinary resident. For other two people, it is not taxable. Income accrued and received outside India in the previous year. Income is accrued outside India, received also outside India. It is a foreign income, taxable only for resident and ordinary resident, and for others it is not taxable. Income accrued and received outside India in any year preceding the previous year, meaning it is past untaxed income, later remitted to India. Whatever income you have earned in last 10-15 years, now if you are bringing into India, it is not taxable for any person. Okay. Yeah, so this is all about what, sir, your residential status. Let us do this one question. Short-term capital gain from sale of shares of Indian company. Can I say it is Indian income? Therefore taxable for everyone. Dividend received from Japanese company received in Japan. Foreign income, taxable only for resident and ordinary resident. For others, it is not taxable. Income from house property in London, deposited in London, later remitted to India through approved banking channels. So this is current year's house property income which you have earned in London, deposited in London, and then brought it to India. Is it taxable, sir? In current year only all these things happen. Is it taxable, sir? It is taxable only for resident and ordinary resident. Others, it is not taxable because it is a foreign income. Dividend from Indian company, taxable for everyone because it is accrue or arise in India, deemed to accrue or arise in India. Indian income. Agricultural income from a land in Gujarat, taxable for exempt for everyone. What if it was the land was outside India? Exempt. So this is how I am going to present this question. So write the name of the assessee, previous year assessment year, computation of total income, ding ding ding. So for basically for resident and non-resident, all the incomes are taxable unless that income is exempt. For resident, not non-resident, Indian income only is taxable. Non-resident, Indian income is only taxable. But for resident and non-resident, if there is an business controlled or set up from India, it is also taxable in India. This is all about our today's discussion. I hope you enjoyed this particular lecture. Okay, so let us meet again tomorrow, same time. Till then, tata, bye bye, take care. Please revise these provisions completely. Revise this provision, whatever we have discussed today, completely you revise it. Of course, we have done the discussion. From your material also you revise. Tomorrow we'll meet at the same time and discuss about the next topics. We will start what's heads of income. Okay, tada, bye bye, take care, enjoy. Meet you in my next class. Hello students, welcome back, welcome back, welcome back. I hope I'm audible and also the screen is visible to you all. So yeah, let us continue our discussion, and in our today's discussion, we will start our discussion with what's our heads of income topic. So we were discussing something called as heads of income. I hope I am live now. I'll just check once. Today they have put me on live or not, just a second. Okay, so yeah, I just got confirmation that yes, I am live now. So let us continue our discussion. So in our today's discussion, what we will start with, sir, we will start with what, sir? We will start with heads of income. So we are going to start with the first head of income. As you all know, there are totally how many heads of income? 5 heads of incomes are there. So now we are going to start the first head of income. Which are these 5 heads of income, sir? It is income from salary, income from house property, income from capital gain, income from business or profession, income from capital gain, and income from other sources. So this is all the different heads of income which we have. So we are starting our discussion with the first head of income, which is income from salary. Section 15, 16 and 17. These are the 3 different sections which are there in this chapter. Section 15, 16 and 17. Section 15 is the charging section of income from salary. You are paying salary because this section, you are paying tax on salary income because this section is telling you. This section is telling you that salary is also taxable. Section 16 talks about deductions which are allowed when you are computing the income under the head salary. What are the different deductions allowed to you? And then section 17 talks about what, sir? Section 17 talks about it gives the meaning of salary. Okay, so now we'll start the discussion. Now this chapter says, if you want any income to be taxed under the head salary, the most important thing over there is relationship. You should check for what, sir? Relationship. There should be a relationship. And what type of relationship it should be there, sir? It should be a employer-employee relationship, master-servant relationship. If you want to tax any item under this head called as income from salary, then you should see the relationship. There should be an employer-employee relationship or master-servant relationship, and whatever payment is made, no, that payment should be made in the capacity of the employer. There should be a relationship, and the payment should be made under that relationship as in the capacity of employer. What should be the relationship called, sir? Employer-employee relationship, and whatever payment the master is making, he should make in the capacity of the employer. Now please note. So for example, normally practical what happens is you are asking me to file your income tax return. So we also have a relationship over here. What type of relationship we have? Service provider, service recipient relationship. I am giving services to you. You are I am giving service. I am filing your income tax return. That means I am giving services to you. So I am the service provider. You are the service recipient. But here, are we talking about that relationship? Answer is no. Here we are talking about which type of relationships are employer-employee relationship. What relationship? Employer-employee relationship. Many times people get confused with principal agent relationship and employer-employee relationship. Principal agent and employer-employee are not same. Principal and agent relationship, here commission involved. Commission is involved, and employer-employee relationship, here salary is involved. Now salary you may get from different ways or different scenarios. Salary if you are getting, because if you are a sole proprietorship concern, and if that sole proprietorship concern is giving salary to whom, if it is giving salary to the proprietor, then that salary will not be taxable under the head income from salary. If the sole proprietorship concern is giving salary to whom, sir, the proprietor, it will not be taxable under the head salary. Similarly, if a partnership firm, why sir it is not taxable under salary, sir? You said sole proprietor is not. Because sole proprietor, tell me, if you are doing your own business, if you are starting your own business as an individual, you will be called as a sole proprietor. Now whether you will be interested in earning profits, or will you be interested in making money, meaning will you be interested in earning profits, or will you be interested in earning the money in the form of salary? Of course you will be interested in what, sir? You should be interested in making money, because for you, if you are making money, if you are making profit, that will help you a lot. So lawmakers are telling, if you are an sole proprietorship concern, I'm not going to allow salary to you, for you, whatever, because the owner as well as the this employer as well as the employee is the same person, salary should not be given. In case of a partnership firm, whatever salary partner is receiving, no, that salary will not be taxable under this head. Whatever salary partners are receiving under partnership firm, they will not be taxable under the head salary. It will be taxable under which head, sir? Under profits and gains from business and profession. Similarly, if you're a company and the company is giving salary to the director of the company, if you are an employee director, it is taxable under salary. If you are a non-employee director, then you are going to receive something called as sitting fees. That sitting fees is not taxable under which head, sir? That sitting fees which you are receiving is not taxable under the head salary. Okay, we are live. Then MLA, MP, MLC, etc., they are not employee of any company, correct? MLA, MP, they are not employees. They are not employees. Since they are not employees, whatever they are receiving is not a salary. Therefore, it is not taxable under the head salary. Now, judge of Supreme Court, High Court, they are considered as government employee. Though they are considered as government employee, whatever amount they receive is not taxable under the head salary. Okay, then where it is taxable, sir? It is taxable under income from other sources. Then there is one more point which we have to know. What is that one more point, sir, which we have to know? There is something called as contract of service, and there is something called as contract for service. Contract of service and contract for service. Sir, what do you mean by contract of service? Contract of service is your employment contract, and contract for services is your service contract. Sir, no. Didn't understand, sir. We have entered into a contract for giving you educational services, correct? Our institute has entered into a contract to give you educational services. This is contract of service. Then what is this contract for service, sir? This is contract for service. Then what is this contract of service, sir? If you work in a company, if you join a company and start doing work in that company, that means you have entered into a contract of service with them. Now, the charging section. Now we'll start our discussion with salary. Section 15 is the charging section of salary, which says these were the all basic points which was required for you to understand this chapter better. So now we'll start our discussion. Section 15 is the charging section for income from salary. What is section 15 telling us? Section 15 says salary is taxable on due basis or on receipt basis, whichever is earlier. How is salary taxable? Salary is taxable on due basis or on receipt basis, whichever is earlier. So whenever you are receiving it or whenever it becomes due, salary is taxable on due basis or on receipt basis, whichever is earlier. Salary can be in cash or it can be in kind. So it does not matter whether the company is giving you physical money as salary or they are giving you a house or car, etc. Even if a company is giving you a house, a car, that also will be treated as your salary. Salary forgone is also taxable. Salary forgone means what, sir? Salary forgone is also taxable. What do you mean by salary forgone? Sometimes what happens is many people, they may tell the employer that they have worked for a particular month, but still they may tell the employer that they don't want the money for that particular month. So they forgo their salary. Lawmaker says this salary which you are forgoing, that will also be taxable. Whatever salary you are forgoing, that will be taxable until you are forgoing the salary for central government or state government. Now there are different components of salary. We should study all these different components of salary. Once we complete the discussion on all these components, our chapter of this topic of income from salary will be over. What are the components? Are basic pay, dearness allowance, bonus, commission, fees, advance salary, arrears of salary. Then we have retirement benefits of gratuity, pension, leave, salary, retrenchment, compensation, VRS compensation. We have allowances, provident fund, superannuation fund, ATCCD, pension fund. Then we have perquisites. We have deductions under section 16, which is standard deduction, entertainment allowance, and professional tax. And we have our final salary, which is your net salary. Okay, so now let us start our discussion. Now actual discussion on salary is starting. I hope you are all ready with me. I hope you have all studied this. If you have not studied this, you please study it now along with me. Okay, basic salary. What is basic salary, sir? This is your base salary. What is basic salary? It is your base salary. So salary will have different components. Salary is going to have different components. One of the base or the most important component is your base salary. So basics salary which is there, no, that is a taxable component of salary. So if the company is giving you, let us say the company says that your CTC is rupees 5 lakh per annum. That means what, sir? The CTC, cost to company, will have different components in it. One of the component will be your basic pay. This is the base component of your salary, and all the other things will be depending on the basic pay. Correct? So basic pay which is there, no, this is a taxable component of salary, meaning when you're computing your salary, you should also include your basic pay. This is the base salary, that is a taxable component of salary. Now, okay, sir, I understand that this is a taxable component of salary, but tell me, sir, how much is taxable? Lawmaker says basic salary is fully taxable. Basic salary is a taxable component of salary, and how much is taxable, sir? It is fully taxable. Sir, fully taxable? Yes, lawmaker says the basic salary, or it is a basic component of salary, and it is a taxable component of salary. How much is taxable? It is fully taxable. Sir, how much, sir? Fully? Yeah, yes, it is fully taxable. Now, whenever you are computing any income under the head salary, you should be very careful. Sir, we should be careful with respect to what? You should be very careful with respect to the information which they have given in the question. Sir, what do you mean by the information given in the question, sir? You should be very careful with the date of joining given in the question, because salary should be calculated from which date? From the date when you are joining. Then you should be very careful with the date of resignation. You should be very careful with the date of joining, date of resignation, date of retirement, or date of increment, because your salary amount will differ based on this information. If your joining date, resignation date, retirement date, etc., if they are all different, then your salary amount will differ based on this. Now, sometimes the salary is given on grade scale basis, or grade scale pay they will give, or grade pay they will give you. What do you mean by this grade scale pay or grade pay, sir? Grade scale pay, say your basic salary, in the question they are telling 20,000, 2,000, 30,000. That is the salary given to you. They say that basic pay is how much? 20,000, 2,000, 30,000. Now what does this mean, sir? This means at the time when, this is called as grade scale pay or grade pay. This means at the time when you have joined the company, your salary will be 20,000 rupees. At the time when you are joining the company, your salary will be how much? 20,000 rupees. Now, every year you complete in the company, your salary will be increased by 2,000 rupees. Every year you are completing in the company, your salary will be increased by how much? 2,000 rupees. This increment they are going to do until your salary is how much, sir? 30,000 rupees. This increment they are going to do till what time? Till the time when your salary is 2,000 rupees. Okay, so this is called as grade scale pay or grade pay. Now I have given one example over here. Let us say I joined a company. I have joined a company on 1st of July 2021, and they say that my grade scale pay is 20,000, 2,500, 25,000, 5,000 and 30,000. Meaning when I joined the company, my salary was 20,000. For every year I am going to complete in company, they will increase. Sir, how should I calculate the year? The year will be calculated from the date of joining. From here, 1 year. 1 year will be completed on 30th June 2022. Correct. So from 1st July 2022 till 30th June 2023. So first year salary is 20,000. Then it will be increased by 2,500. Then again it will be increased by 2,500. This increment will happen till what time, sir? Till your salary reaches what amount? It reaches 30,000 rupees. So, 50,000 rupees in this case. Now, Mr. Dilip has joined Priya Sarees on 1st of July 2021 with a grade pay of 20,000, 2,500, 25,000, 5,000 and 50,000. Compute his salary for the previous year 24-25. So previous year 24-25 means they are asking you salary from 1st of April 2024 to 31st of March 2025. So when I complete, so I should see what is the salary for this period, correct? They have not given the salary for this period, they have just given the grade scale. Now I should see what will be the salary during that period. So from 1st July 21 till 30th June 22, my salary was 20,000. Then from 1st July 22 till 30th June 23, my salary became 22,500. 1st July 23 to 30 June 24, 25,000. 1st July 24 to 30 June 25, 30,000. Now my salary is falling somewhere in this bracket, meaning from 1st of April 24 till 31st of March 25, it falls on this particular bracket. So I should take from 1st of April, my salary was how much, sir? 25,000. Till what time? Till 30th of June. My salary was 25,000 per month till 30th of June, and thereafter till 31st of May, my salary was how much? 30,000 rupees. Now 25,000 I am receiving for 3 months and 30,000 I am receiving for 9 months. My total salary will become how much, sir? 3,45,000 for that particular year. Okay, sir. Now next is what? Dearness allowances. Sir, what is dearness allowance, sir? Dearness allowance is a taxable component of salary and it is fully taxable. Dearness allowances is DA. DA is a taxable component of salary, and how much is taxable, sir? It is fully taxable. Sir, what do you mean by fully taxable? Whatever dearness allowance you get, that dearness allowance is fully taxable. Sir, what is dearness allowance? See, normally what happens is whenever you are you are working in a place where the cost of living is little high when compared to other places, then to meet that cost of living, cost of inflation, they will give you something called as DA or dearness allowance. And if you receive this DA, that DA is taxable component of salary. Now DA can be in terms or it can be not in terms. If DA can be in terms or it can be not in terms. If DA is in whether DA is in terms or not in terms, it does not matter. Entire DA should be taken while computing your salary because both are taxable. Then sir, why is this division there? Why do we have this division called as DA in terms, DA not in terms? This division is there because there are a lot of formulas which we are going to study about salary. There are a lot of points which you are going to study in future. In that, no, they take some portion of the DA and they don't take some portion of the DA. For that purpose, DA is divided into two arrow marks called as DA in terms and DA not in terms. DA in terms means what, sir? DA which is forming part of your salary or forming part of your retirement. DA not in terms means DA not forming part of your retirement. Now, sometimes DA they will give in percentage form. Whenever they are giving DA in percentage form, what should I assume, sir? If DA is given in a percentage form, assume assume what, sir? Assume that the DA, whenever DA is given in percentage form, you should take that DA as a percentage of your basic pay or basic salary. Now, what if the question is silent about DA, sir? Question just says DA. The question has not told whether it is in terms or not in terms. Then what assumption am I going to make, sir? Tell me, sir, what if the question is silent? What is the assumption which I am going to make? You should assume that DA is in terms. You should make an assumption that DA is what, sir? If the question is if the DA is in percentage form, you should take it as a percentage of basic pay, and the question is silent, assume it to be DA in terms. Now bonus, what, sir? Bonus. Bonus is a taxable component of salary. Bonus is a taxable component of salary and it is fully taxable. But the beauty of bonus is, see, normally salary is taxable on due basis or on receipt basis, whichever is earlier. This is how you are required to pay tax on salary, on due basis or on receipt basis, whichever is earlier. But this bonus is there, no, that is taxable on receipt basis. Bonus will be taxable on what basis, sir? Bonus will be taxable on receipt basis, meaning only if you have received a bonus, it will be taxable. Only if you have received a bonus, it will be taxable. Now, in the question, what is that thing which I have to check, sir? Check whether they have given bonus paid or bonus, only bonus, nothing else is given. If they have given bonus paid and only bonus, that means that is already paid and therefore you take it for your salary computation. But if they have given bonus payable, then please ignore it, don't take it for your salary computation. Then commission. commission will be given. Now commission can be of two types. One is turnover commission, or it can be profit. Commission can be of many types: turnover commission, profit based commission, product based commission, etc. Whatever type of commission is there, you please add it, because it is fully taxable. It is fully taxable. Now commission, sometimes they give the commission in the percentage form. If they are giving the commission as a percentage of a turnover, then assume it to be a turnover commission, and therefore accordingly take it for your computation purpose. When the question is silent, what will I make an assumption, sir? Unless until they have given in a percentage form, you should, or unless until the question says that it is a turnover commission, you should not assume it to be turnover commission. Assume it not to be a turnover commission. Then we have something called as advance salary. Sir, advance salary means what? So advance salary means the salary which you are receiving in advance. Future month salary, if I am receiving it now, that means it is advance salary. It is a salary received in advance. It is a taxable component of salary, and it is fully taxable. Salary received in advance is called as advance salary. It is a taxable component of salary. And how much is taxable, sir? It is fully taxable. However, advance salary is taxable on receipt basis. Whenever you receive it, only then that time you have to pay the taxes on this advance salary. Then arrears. Now one more thing is there. There is something called as advance salary, and there is something called as advance against salary. Sir, what is this advance salary? What is this advance against salary? Advance salary is your salary. Advance salary is your salary. Advance against salary is the loan which you have taken against your salary. So advance salary will be included in your salary computation. Advance against salary is a loan, and it is not your salary. Arrears of salary. Arrears of salary means what, sir? Arrears of salary means any increment in the salary with a retrospective effect. Repeat, sir. Any increment in the salary with retrospective effect. Any increment in the salary with retrospective effect which has not been taxed in earlier years, on which you have not paid any tax before, that is called as your arrears of salary. This arrears of salary is a taxable component of salary, and it is fully taxable. It is taxable on receipt basis. Whenever you receive this amount, that time only it will be taxable. Sometimes it may happen that the company had the company had not paid you some amount for last 3-4 years, and now they are paying that amount, and you have not paid tax on that amount during that period. Now because it is paid to you, you are paying the tax on that amount, because whatever arrears was there of future last years, you are receiving it now. Now it will become taxable for you at the time when you are receiving it. Now see, about all these points, no, whatever we have seen now, question will come when the full-fledged salary question is coming. Let us now see what, sir, retirement benefit, because retirement benefit, as and when we are discussing topic, question will come. So we will see each and every retirement benefit solve a related question also. Retirement benefit, we are starting. The first retirement benefit which we are discussing is called as what, sir? Gratuity. Gratuity means what? See, because you have spent time in that company for almost 20 years, 30 years, 40 years, etc. Company wants to company wants to say you thank you. So the form of saying thank you is in monetary terms, meaning the company is feels gratitude towards you, that you have given your life 10 years, 20 years, 30 years to the company. Therefore company will give you some money for that time which you have spent as a token of love. Now this gratuity which is there, if you have received it during your employment, when you are working in a company, at that time if you have received the gratuity, then that gratuity will be fully taxable. Gratuity received at the time of your employment is fully taxable, irrespective of whether you are a government employee or non-government employee. However, if you receive any gratuity at the time of your retirement, then you will get some exemption. Wait. If I receive the gratuity when I am still working in the company, lawmaker says it is fully taxable, irrespective of whether you are a government employee or non-government employee. If legal heirs receive the gratuity because of death of the employee, then in the hands of legal heirs it is fully exempt. Now, if the gratuity is received by the employee on his retirement, then it is exempt under which section, sir? It is exempt under section 10(10). It is exempt under section 1010. How much is exempt? If you are a government employee, it is fully exempt. If you are a non-government employee, exemption is based on some formula. Sir, once again, please repeat, sir. Gratuity is received by you. When have you received the gratuity? Sir, gratuity is received by me during the employment. I am still working in the company. I am receiving the gratuity, sir. Lawmaker says it is fully taxable. Sir, no, sir. Gratuity is received by the legal heirs upon death of the employee. Lawmaker says it is fully exempt in the hands of legal heirs. But if you receive the gratuity while you are at the time of your retirement, if you receive a gratuity at the time of your retirement, it is exempt under section 1010. How much is exempt, sir? If you are a government employee, it is fully exempt, and if you're a non-government employee, then exemption will depend on whether you are an employee covered under Payment of Gratuity Act or you are an employee who is not covered under Payment of Gratuity Act. If you are an employee covered under Payment of Gratuity Act, exemption will be 15/26 into salary per month into completed years of service, or actual gratuity received by you, or limit of 20 lakhs, whichever is less. No, repeat it, sir. If you are an employee who is covered under POGA, please note, if you are receiving any gratuity at the time of your retirement, it is exempt under section 1010. If you are a government employee, how much is exempt? Fully exempt. If you are a non-government employee, exemption will depend on whether you are an employee covered under Payment of Gratuity Act or you are not covered under Payment of Gratuity Act. Sir, what if I am covered under Payment of Gratuity Act? If you are an employee covered under Payment of Gratuity Act, then the exemption to you will be 15/26 into salary per month into completed years of service, or actual gratuity received, or limit of 20 lakh rupees, whichever is less. Similarly, what if I am covered under Payment of Gratuity Act, sir? Then for you, it is half of average salary per month into completed years of service, or actual amount of gratuity received, or limit of 20 lakh rupees, whichever is less. Now, sir, what do you mean by salary per month over here, and what do you mean by average salary per month over here? Salary per month in case of POGA employee means the last drawn salary. Last drawn salary will include what, sir? Your basic pay plus DA in terms and not in terms. You will take your complete DA. Basic pay plus DA will be taken by you. That will be your salary. Sir, what is this average salary per month? You are required to take average of basic pay plus DA in terms plus turnover commission. Here when you are taking, you should take only DA in terms, but in case of POGA employee, you will take DA in terms as well as not in terms. Now you should take average salary. When I say average salary, you should take last 10 month ka average. What should you take, sir? You should take average of last 10 months. Now, sir, you said completed years of service. What do you mean by completed years of service? Both the places you said completed years of service. What do you mean by completed years of service, sir? Completed years of service means how many years you have completed in that company. How many years of service as an employee you have completed in that company. Now, sometimes what happens is question may tell you that he has completed 26 years, 4 months. Now, sir, this fraction is there, the 4 months. Should I take that into consideration or not? Lawmaker says if you are a person who is covered under Payment of Gratuity Act and if the fraction is more than 6 months, if you are covered under Payment of Gratuity Act and if the fraction is more than 6 months, consider it to be a full year. If you are covered under Payment of Gratuity Act and if the fraction is more than 6 months, assume that to be a full year. So 26 years 9 months, that means 27 years. 26 years 3 months, again 26. 26 years 6 months will be taken as 26 only. Why, sir? Because it is not more than 6 months. If it is more than 6 months, I will consider it to be one full year. But in case you are a employee who is not covered under Payment of Gratuity Act, then whatever type of fraction it is, it should be completely ignored. Yeah, the fraction which you have now in completed years of service should be fully ignored. Sir, can we repeat once again, sir? Yes, we'll repeat once again. Please note. Gratuity. If you are receiving a gratuity at the time of your employment, when you are working, fully taxable at that by legal heirs, if it is received, fully exempt. If you are receiving at the time of your retirement, if you are a government employee, fully exempt. If you are a non-government employee, I am going to check whether you are covered under Payment of Gratuity Act or not. If you are covered under Payment of Gratuity Act, 15/26 into average into salary per month into completed years of service or actual amount received or 20 lakhs, whichever is less, is exempt. Now, what is salary per month? Your last drawn salary. Last drawn salary means basic plus DA, whether it is in terms or not in terms, that is your salary. Then what, sir, what about fraction in completed years of service? That fraction in completed years of service, if it is more than 6 months, you should take into consideration. Then, sir, if I am a non-POGA employee, what will I do, sir? You take average of half. Average means average salary per month into half of average salary per month into completed years of service as actual amount received, or 20 lakhs, whichever is less. Now average salary per month means what, sir? Average salary per month means last 10 month ka average. You take last month ka basic pay plus DA terms plus turnover commission. Fraction in completed years of service for in case of non-POGA employees should be completely ignored. Now please note, the month of retirement should be ignored while calculating average salary per month and salary per month. For calculating salary per month and average salary per month, the month of retirement should be ignored. Similarly, the statutory limit of 20 lakh rupees is applicable to an individual as an employee throughout his lifetime, irrespective of how many number of employers he has. Meaning the limit of 20 lakh rupees is there, no, it is to a person as an employee. If he is changing the job every now and then, every time he gets gratuity, that amount of 20 lakh will reduce. It will keep on reducing. If the question is silent, what should I assume, sir? Assume it to be a non-POGA employee and write a note about your assumption. Now, shall we do this question? What is this question telling? Mr. Ravi retired on 15th of June 2024 after completing 6 years 8 months of service and received a gratuity of 15 lakh rupees. At the time of his retirement, his salary was 50,000 per month. Dearness allowance is 10,000 and 60% forms part of retirement. 1% is turnover commission. Last 12 months turnover is 1,20,000 and bonus is 25,000. Now you are required to calculate his taxable gratuity if he is a private employee covered under POGA, private employee not covered under POGA, and he is a government employee. Now you are required to do the computation. Shall we do the computation? Now we will first calculate under, so computation of, how should I present this question, sir? I'll show the presentation for one question and the presentation format will remain same. First you should write name of the assessee. What is the name of the assessee? Mr. Ravi. Then you should write previous year, which is the previous year for our examination 25-26, 24-25, and assessment year is 25-26. Now what are you supposed to do? Computation of taxable gratuity. Particulars: if you are a POGA employee, non-POGA employee, or if you are a government employee. How much have you received? First you should write that. Gratuity received. How much gratuity is received, sir? Gratuity received is how much, sir? Gratuity received is 15 lakh rupees. So can I say 15 lakhs? We'll write in all the cases. From this I'll subtract gratuity exempt. And under which section it is exempt, sir? Under section 10. Can I say for government employee I'll write fully exempt? So taxable amount will be 0. Now for non-government employee covered under POGA. What is POGA employee exemption? For POGA employee exemption is A, B or C, whichever is less. What is A? Sir, 15/26 into salary per month into completed years of service. Now what is the salary per month for POGA employee? Sir, for POGA employee salary per month is basic pay plus dearness allowance of 10,000 rupees. So how much is that? 60,000 rupees. So I'll take 15/26 into 60,000 rupees into completed years of service. How many years he has completed? 26 years 8 months. And for POGA we know If there is any fraction more than 6 months, I will take it to be 1 year. So how much will I take, sir? 26 years, 8 months means 27 years. Or I should take actual amount. How much is actual amount? 15 lakhs. Or I'll take what, sir? A limit. How much is the limit? 20 lakhs. So how much is that? 15 by 26. So I'll take 60,000 into 27 years into 15 divided by 26. 934,615. Whichever is less is exempt. So how much is exempt for POGA? 9,34,615 rupees is exempt. Correct. So 15 lakhs. From 15 lakhs subtract 934,615. You will get 5,65,385 rupees. Sir, for non-POGA employee, what is exempt, sir? For a non-POGA employee, see here the complete rule depends on your formula. How well you remember the formula. Correct? For non-POGA employees, it is half into average salary per month into completed years of service, or actual, or limit. What is half? Half is half. Average salary per month is how much, sir? Average salary per month will be your basic plus DA. I should take only in terms portion, and I should take turnover commission. I should take it for how many months, sir? 10 months. Now basic salary per month is 10,000. Sorry, 50,000 into 10 months. Dearness allowances is how much, sir? 10,000. I should take in terms, which is 60%. So 10,000 into 60% is in terms. This I should take for 10 months. And turnover commission is how much, sir? They say turnover commission is 1% of turnover. So turnover for 12 months is 1.2 crores multiplied by 10 divided by 12. Why, sir? If I divide it by 12, I'll get it per month. Into 10, I'll get it for 10 months. Into how much is the commission? 1%. So I will get 5 lakhs 60,000, and I'll get this, I think, 10,000 rupees. One crore 20 lakh divided by 12 into 10 into 1% is 1 lakh. So total is 6 lakh 60,000. Now this is salary for 10 months. I want average salary per month. How much is my average divided by 10? So if I divide this by 10, 66,000 is the amount which I am getting. Please note, students, I am doing a very full-fledged discussion. I am doing correct detailed discussion. Please note, normally marathons, they don't solve questions and all, but I am solving it so that you can take maximum advantage of this. So yeah, where is this? Yeah, half into 66,000 into completed years of service is 20 years. Fraction should be ignored. 20 years, 8 months was there. No, fraction should be ignored. Now, what is the amount, sir? 66,000 into 26 divided by 2, 8,58,000. Actual is 15 lakhs. Limit is 20 lakhs, whichever is less. How much is exempt? 8,58,000 is exempt. So 15 lakhs, from that subtract 8,58,000. Taxable component will be how much, sir? 6,24,000. So this is your taxable gratuity. So this is the answer for this beautiful question. Okay. Now let us continue our discussion. I hope you have understood this. Nothing is there in this. This is just what, sir? There is a formula. You should put the figures in that formula. You will get the answer. You should just know basic multiplication, addition, division, and subtraction. Tax is only of 4 things. addition, subtraction, multiplication, division. If you know these 4 things, then that means you are pro in tax. Okay, so is our answer correct, sir? Of course it will be correct. Next, so there are few more questions which you can definitely have a look into. Now next is what's our pension. Pension, what is pension, sir? Pension means what, sir? So once you retire, no, at the time of your retirement or after retirement, you will start getting on monthly basis, you will start getting something. And if you want you to take it on lump sum basis, you can take it on lump sum basis also. That amount which you get at the after your retirement, that amount is called as your pension. Now pension can be of 2 types: uncommuted pension and commuted pension. Uncommuted pension means the pension which you are receiving after your retirement on monthly basis. Lawmaker says that is a taxable component. That is taxable, and it is always taxable irrespective of whether you are a government employee or non-government employee. Whatever pension you receive every month after your retirement is fully taxable, always taxable. Then we have your commuted pension. Commuted pension means what, sir? The lump sum pension which you are receiving. Whatever lump sum amount of pension you receive, that amount. That is exempt under section 1010A. How much is exempt? If you are a government employee, fully exempt. If you are a non-government employee, then exemption will depend whether you are also receiving gratuity. Have you also received gratuity at the time of your retirement or not? Have you also received gratuity or not? If you have also received gratuity, then exempt amount will be your total pension into 1/3. 1/3 of total pension will be exempt. Sir, what if I have not received gratuity, sir? Then half of your total pension will be exempt. Total pension into 1/2. Half of your total pension will be exempt. I'll repeat. Pension, if it is a commuted pension, monthly pension, whatever you receive on monthly basis after your retirement, fully taxable irrespective of who you are. But if it is a commuted pension, one lump sum if you are taking, then the exemption will depend on whether you are a government employee or non-government employee. If you are a government employee, fully exempt. If you are a non-government employee, I am going to check whether you are also receiving gratuity or not. If you are receiving gratuity also, then half of your total amount of pension. Total pension means what, sir? Commuted plus uncommuted, total amount of pension divided by half will be in case of you are not receiving gratuity, and 1/3 of total pension if you are receiving gratuity. Now let us take up this question. I'll do one thing. I'll copy this question. Now here you please understand this carefully. Calculation is involved over there. Here you are required to understand the calculation part. Now what is the question telling? Mr. Sagar has retired on. Mr. Sagar has retired on which date? Mr. Sagar, who retired on 1st of October 2024, is receiving 5,000 rupees per month as pension. On 1st of February 2025, so this is the date of his retirement. On 1st of February 2025, he commuted 60% of his pension and received 3 lakh rupees as commuted pension. So what is the commuted pension, sir? The commuted pension received by him is 3 lakh rupees. And how much did he commute, sir? He commuted only 60%. So if I ask you what is the total pension, what will your answer be? Sir, total pension will be 3 lakh divided by 60%, which is 5 lakh rupees. Okay, so this is the total pension. You are required to compute the taxable pension assuming he is a government employee, private employee receiving gratuity, private employee not receiving gratuity. Same format. What is the name of the assessee? So Mr. Sagar, previous year, assessment year, computation of pension. Now particulars. If he is a government employee, non-government employee and receiving gratuity, non-government employee not receiving gratuity. Now we have 2 types of pensions over here. One is called as your monthly pension, another one is called as your commuted pension. Monthly pension is your uncommuted pension. What is the monthly pension involved? Sir, monthly pension is I am receiving 5,000 per month. Please note, after retirement, when did I retire? On 1st of October I retired. After retirement, how much pensions did I start getting, sir? I started getting 5,000 rupees per month. Now when I commuted 60%, that means what, sir? 60% of the total pension is commuted by me, how much is still remaining which is not yet commuted? 40%. Meaning, so I was receiving 5,000 rupees per month, but because I commuted 60% of pension from 1st of February, I will have how much, sir? 5,000 into 40% only will be receiving. Why, sir? Because 60% got commuted, no? So what will I write over here? Monthly pension will be 5,000 rupees for October, November, December, January, February, 5 months. Plus, how much is 5,000 into 4? 5 4s are 20. 2,000 into how much, sir? 2 months. Correct? No. 5,000 into 40%. Yeah. So how much is this, sir? 20,000 into 2 months and 4,000. 24,000. This commuted pension, monthly pension which is there, can I say monthly pension, uncommuted pension is taxable for everyone. Uncommuted pension is taxable for everyone. Now I have received commuted pension. How much is received? My commuted pension received is, they have given how much, sir? 3 lakh rupees I have commuted. So 3 lakh rupees I have commuted. So I'll write 3 lakh rupees is what amount I have received as commuted pension. Now in this 3 lakh rupees I have subtracted something, subtracted in the sense in this 3 lakh rupees I have I will get exemption. Where will I get exemption, sir? Under section 1010A. How much will be exempt? If you are a government employee, can I say fully exempt? If you are a non-government employee and receiving gratuity, your total pension ka 1/3 is exempt. If you are a non-government employee not receiving gratuity, your total pension ka 1/2 is exempt. So how much, sir? 1/3 of total pension will give me 5 lakh divided by 3, 1,66,667, and here 2,50,000 will be exempt. So what is your taxable pension, sir? Taxable pension in case of government it will be 24,000, and in case of non-government 30,000 minus 1 7 plus 24,000 157,333. Here it will be 74,000 rupees. Okay, so this is about my pension provision. This is what, sir? This is related to your pension concept. Sir, are we right, sir? So of course here I detailedly explain all those concepts, how to get this. So this is the amount. Okay, similarly there are some more questions. You can just have a look into these questions later. Next concept for our discussion is called as leave salary or leave encashment or leave credit encashment. Leave salary means what, sir? Many times what happens is the company will give you salary for that period for which you have taken leave. Many companies have this policy that you can take 1 month leave in a year. In a year you can take 30 days leave, I will not disturb you. In a year you can take a leave for 2 months period, I will not disturb you. I will pay you for I will not disturb you means what, sir? I will pay you salary even for that period for which you have taken the leave. Now because the company is going to pay you the salary even for the period for which you have taken the leave, that salary which you get for the period for which you have taken the leave is called as leave salary. I hope this point is very clear to you. What is leave salary, sir? Leave salary is the salary which the company is giving you for that period for which you had taken leave. Lawmaker says leave salary which is there, no, that leave salary will be exempt. It will be exempt under section 1010A. How much is exempt? What is exempt? We'll see now. Okay, now let me explain you a few words. Let us say a company says in a month I will give you 2 days leave, meaning even if you take leave for 2 days in a month, I will still pay the salary for those 2 days. Okay, so now here company says this. So company says this. So in a year how many days leave can I take? 24 days leave I can take. So 24 days I can take leave, no? So that number for which I can take the leave is called as leave allowed. So over here leave is allowed for 24 months. Now out of this leave allowed, I have taken leave for 4 days. So this is the leave which is allowed by the company. out of which I have taken leave for 4 days. So can I say whatever leftover is my leave credit, which is 20 days? See, company told you can take leave for 24 days. I took leave only for 4 days. So whatever is left over 20 days, that is my leave available, that is my leave credit, that is also called as leave balance or unutilized leave, correct? So that leave credit, unutilized leave balance is there over here. Now leave credit is what, sir? Leave credit is leave allowed minus leave taken. What is leave credit? Leave allowed minus leave taken is leave credit. This is very important formula for our calculation purpose. Now let us say leave salary means encashment of leave credit. So whatever leave credit you have, whatever unutilized leave you have, if you're taking money from the company for that unutilized leave, that means that you have encashed the leave credit. Note, as per the income tax law, only 1 month leave is allowed for every completed year of service. For every year you complete, in service, how many days leave you will get? As per income tax law says company may give 5 months, 10 months, 20 months, company may tell you don't come at all. But as per income tax law, only 1 month will be allowed for a completed year of service. So leave salary, when have you received it? Leave salary is received during the employment or received at the time of retirement. If you are receiving the leave salary during your employment, then it is fully taxable, irrespective of whether you are a government employee or non-government employee. If you are receiving during your employment, you are still working in the company. At that time, whether you are a government employee or non-government employee, it is fully taxable. But if it is received by you at the time of your retirement, if you are receiving leave salary at what time? When you are retiring from the company, then it is exempt under section called as 1010 AA. If you are receiving that leave salary at the time of your retirement, it will be exempt under which section, sir? Under section called as 1010 AA. How much is exempt? If you are a government employee, fully exempt. If you are a non-government employee, then the exemption will be how much? If you are a non-government employee, exemption will be based on this formula. What is the formula telling? Leave credit into average salary per month, 10 months into average salary per month, actual amount received, or limit of 25 lakhs. Please note, there is an increase in limit. The limit was 5 lakhs. Now it is increased to 25 lakhs. The limit was 3 lakhs, sorry. Now it is increased to 25 lakhs. So what is exempt, sir? Leave credit into average salary per month, 10 months into average salary per month, actual amount or limit of 25 lakhs. Now, sir, what is this average salary per month? You should take last 10 months ka average salary. What last 10 months ka average salary? Same as before. Basic pay plus DA in terms plus turnover commission. Now, leave credit when you are taking, you should take that leave credit as per income tax law. The month of retirement should also be considered. Whichever month you are retiring, that month also should be considered. Fraction in completed year of service should be ignored. Any fraction in completed year of services, what will you do, sir? I will just ignore it. Now, this is a question. What is this question telling? Mr. Gupta retired on 1st of December 2024 after completing 20 years in service and received a leave salary of 5 lakh rupees. Other details of his salary are given below. Basic pay, dearness allowance, commission. Now they have just given commission. So when the question is silent whether it is turnover commission or not, what are you going to assume? You are going to assume that it is not a turnover commission. And bonus they have given. Okay. They have given that leave availed by it is 480 days. Leave entitled is 30 days in a year. So 1 month he can take in a year, and calculate the leave salary. Now first we should see what is the leave allowed by the company. How much leave company allowed? 30 days in a year. So how many days he works, sir? 20 years he works. So 20 years into 1 month is 20 months is the total leave allowed. So I will take leave allowed is equal to 20 months. And leave availed. Availed means what, sir? Leave taken by him is how many months, sir? 480 days. Sir, 480 divided by 30. How much will it come to? 16 months. So 20 months is allowed by the company. 16 months he has taken. Whatever is left over, can I say is leave credit? How much? 4 months. How much is the leave credit, sir? Leave credit is 4 months over here. How much is the leave credit, sir? Leave credit is 4 months. Now for this 4 months, I'm going to get 4 months of this leave, whatever salary is there, that will be exempt. Correct? Leave salary is there, that will be exempt. How much leave salary I have received? 5 lakh rupees. Let us see how much is exempt. Now, in case of government employee, can I say completely fully exempt 5 lakh rupees? Now, in case of non-government employee, since we know the formula, what is the formula? Leave credit into average salary per month. How much is leave credit? 4 months. Sir, how did you get 4 months? Are just now we calculated, no, 20 months into 16 months is equal to 4 months. Correct. 4 months into 6,600. Why, sir, 6,600? Salary per month. What is salary? You should take your basic pay plus you should take dearness allowance in terms. 6,000 rupees is total DA. I should take which DA, sir? I should take only in terms. 3,000 into 60%. 3 6 how much? 3 6 18. And they also say that the salary was increased from this particular date. So at the time of retirement, your salary was 5,000 and it was increased by 1,000 rupees. Oh, then I'll have to calculate this. Basic pay is what, sir? 5,000 into 8 months and 4,000 into 2 months. Now, when did I retire? I retired on which date? On 1st of December. So can I say I will have to go back 10 months? 10 months if I go November, October, September, August, July, June, then May, April and February. So yeah, so for 10 months, for 8 months my salary was 5,000 and for 4 months my salary was 2,000 rupees. I'll take this as my basic pay. Dearness allowances is what, sir? 3,000 rupees is my total DA into 10 months into 60%. Turnover commission is 0. So total salary for 10 months will be 66,000 divided by 10. I'll get 6,600 per month. Now 6,600 I have got as my salary per month. So multiply it by my leave credit, then 6,600 into 10 months and whatever actually I have received, and limit of 25 lakhs. Whichever is less will be exempt. What is less, sir? Whatever is less is exempt, which is 26,400. So here 5 lakhs I have received, 26,400 is exempt. So taxable component is 4,73,600 rupees. Next, Mr. Das. Now, Mr. Das, okay, two more questions are there which you can anyway see. Retrenchment component compensation and VRS compensation. This is something which is very easy. Retrenchment compensation, it is exempt under section 1010B. For government employee, fully exempt. For government employee it is fully exempt, and for non-government employee 15/26 into average salary per month into completed years of service or actual amount received or limit of 5 lakhs, whichever is less will be exempt. 15/26 into average salary per month. When you are taking average salary, you should take basic pay plus DA in terms plus turnover commission, and you should take it for how many months, sir? You should take it for last 3 months. Sir, what if there is a fraction in completed year of service? That fraction in completed year of service, if it is more than 6 months, you should take it to be 1 full year. Okay, any fraction, it should not be ignored. If more than 6 months, then it is required to be taken as 1 year. So, I mean, this is all very easy question. Mr. Gar got a retrenchment compensation of 10 lakh rupees for. By the way, what do you mean by retrenchment compensation? Sometimes what may happen is, company itself may tell you, please, sir, it may fold their hands and tell you that, sir, please leave the job and go, sir. Now, at that time, whatever money you are getting, whatever money you are going to give, no, that is called as, whatever money you are going to get from the company, that is called as retrenchment compensation. So whatever calculation is there, I mean, this is one of the easiest calculation, as well as VRS calculation. Normally, because they are very easy, normally they don't ask, but if they are asked, they'll ask it for 4 marks. When compared to 5 different types of retirement benefits which are there, no, gratuity, pension, very important. Next important is your leave salary, then your VRS compensation, and not at all important is your retrenchment compensation. VRS compensation, voluntary retirement scheme, company has this. So if you want to retire before the age of 60 years, normally say in India 60 years or depending upon how many years you work in that particular industry, the retirement, the retirement age will be there or limit will be there. So if you take retirement before your actual retirement age, that is called as VRS, voluntary retirement compensation scheme compensation, company will pay you. That is exempt under section 1010C. For both government and non-government employees, it is exempt. So how much is exempt? Salary per month into 3 months into completed years of service, salary per month into remaining months in service, actual amount received, or limit of 5 lakh rupees, whichever is less. Here salary per month is what, sir? Basic plus DA interns plus turnover commission, and here completed year of service fraction should be ignored. Now please note here, second point is very you should be very careful. You should take how many months are remaining in service. How many months are remaining in service? So VRS is ... So salary per month into 3 months into completed years of services, salary per month into remaining months actual or limit. So over here, Mr. Dutt received a voluntary retirement compensation of 3 lakhs for 7 lakhs for rendering services of for 30 years and 4 months. He still has 6 years left over in service. At the time of voluntary retirement, he was drawing a salary of 20,000 rupees per month. Dearness allowances, which was forming part of retirement, was 5,000 rupees per month. On computing his taxable salary, compute his taxable voluntary retirement compensation, assuming that he's not getting any relief. So salary per month is what, sir? 25,000, whatever, basic plus DA in terms, and into 3 months into 3 months. Why, sir, into 3 months? Because I should take 3 months salary into 30 years he has completed in services. 25,000 into remaining months in service is 72. So whatever amount you are getting, take whichever is less. Next comes our allowances. Allowances. What is allowances? So there is something called as allowances and there is something called as perquisites. So normally people will get confused with between these two things, perquisites and allowances. What is perquisites and what is allowances, sir? Allowances are monetary benefits which are given by the company. Sir, can you please explain? Okay, see that 5,000 into 5 and 2,000 into 2, 5,000 rupees from October till February month, okay, till 31st of March. And for 2 months, see, 5,000 was monthly pension which I was supposed to receive. Now in that 60% got commuted, so what is left over? 40% is left over. So whatever I was receiving, 5,000 rupees, that was when it was 100%. No, now because I have commuted 60%, now how much will I receive? Only 40% I will receive. So 5,000 into 40% I am going to receive now. I'm sorry that I saw this question now. Allowances. Chat. Okay. Allowances means what, sir? Sometimes what happens, there are two different things. One is called as allowances, one is called as perquisites. Sometimes what happens is company will give you money. Got it, sir? Thank you. Okay, enjoy. Now sometimes what will happen is company will give you money to meet a particular expenditure. If company is giving you a money to meet a particular expenditure, that means what, sir? It is an allowances. But if the company is giving you that particular thing, it is a perquisites. Sir, illa. Repeat, sir. Company gives you a house to stay. Company is giving a house to you to stay. That means it is an allowances. Company is giving you a house to stay. It is what, sir? Allowances. Company is giving you money of say 10,000 rupees per month so that you can take whichever house you want. That is perquisites. Sorry, that is allowances. Hey, wait. No, sir. Ulta I told. Company is giving you a house to stay. Company is giving you a house to stay. It is perquisites. Company is giving a car for your transportation purpose. That is perquisites. Company is giving you money of 10,000 rupees per month so that you can take whichever house you want on rent. That is allowances. Company is giving you 5,000 rupees for your travel purpose. That is allowances. What is allowances, sir? Allowances means what, sir? Allowances means the money which is given by the company to meet a particular type of expenditure. And what is perquisites? Perquisites are the actual thing which is given by the company, that actual particular thing. Now, allowances. Allowances are monetary benefits given by the company to meet a particular type of expenditure. Now, we will see what are the different types of allowances. You just learn this allowances concept as I teach you, because if you start seeing from the material, there are around 20-30 items which are given. It is practically not possible for you to remember everything, correct? So now there are some allowances which are exempt based on limit, and there are some allowances which are exempt based on what you are actually spending. Now, commutation allowances. What is commutation allowances? Allowances for you to travel, for your travel between office to home and home to office, that also called as transport allowances. This allowances, if you are receiving, it is fully taxable. However, if this allowances is received by a handicapped employee, then it will be exempt. How much will be exempt? 3,200 per month will be exempt in his hands if it is received by whom, sir? Handicapped employee. Next, we have children hostel allowances. Now, what is this allowances, sir? Children hostel allowances. So maximum rupees 300 rupees per month is exempt per child. For how many children the exemption will be given? For a maximum of 2 children. For a maximum of 2 children. A, children hostel allowances. Maximum rupees 300 per month per child is exempt. For a maximum of how many children? 2 children. Children education allowances. For children's education, how much is exempt, sir? Maximum rupees 100 rupees is exempt per month and per child. For how many children can I take this exemption, sir? 2 children. Now please note, sir, company has given me 600 rupees per child. How much exemption is there? Children hostel allowance 300 rupees per child is exempt. Sir, company has given me 200 rupees per child as children hostel allowance. How much exempt, sir? 200 or 300, whichever is less, is exempt. Okay, so this is very important over here. Next, tribal area allowances. What do you mean by tribal area allowances? Sometimes, no, for your employment purpose, you may be working at a place which is a tribal area. In that case, you will get something called as tribal area allowances. For maximum 200 rupees per month is exempt. Then, if you are employee of any transport company, you will get something called as truck driver allowance. How much is exempt truck driver allowance? Whatever you are actually receiving into 70% or 10,000 rupees per month, whichever is less, will be exempt. Amount actually received into 70% or 10,000 rupees per month, whichever is less, will be exempt. And we have underground allowance. How much is exempt, sir? 800 rupees per month will be exempt. Underground allowance means what, sir? You are working somewhere under the ground. Meaning, you would have seen KGF. You are working in coal industry. You are working in gold industry. So you are working somewhere under the earth. Because you are working somewhere under the earth, company will give you something called as underground allowance, which is exempt. How much is exempt, sir? 800 rupees per month will be exempt. Okay. Now, these are the different allowances which we just now saw. These are the different allowances are based on limit. So how much will be exempt? They have given the limit. How much is exempt? That limit is given over here. These are the exemption which is based on limit. Now these are the exemption for which these are the exemption which are based on these are the allowances for which exemption is based on limit. Which are these allowances, sir? You cheat. What do you mean by you cheat, sir? U for underground allowance, C for commutation allowance, H for hostel allowance, E for education allowance, A for tribal area allowance, entry for truck driver allowance. These are the allowances which are exempt based on how much you whatever limit they have given. Hostel allowance 300, education allowance 100 rupees, underground allowance 800 rupees. So based on limit. Then we have duck hat. Duck hat means what, sir? There are some allowances. Which are these allowances? Like daily allowances, and we have your daily allowances, we have your uniform allowances, conveyance allowances, helper allowances. Helper. You have appointed any person as your helper for your office work, or academy allowances, or traveling or tour allowances. These are the allowances which are exempt based on what you are actually spending. Sir, what do you mean by this? For example, company is giving you a daily allowance of rupees 500 per day. You are spending 300 rupees per day. How much will be exempt? Whatever you are actually spending. Company gives you an uniform allowances. Company gave me 2000 rupees as uniform allowance. I am purchasing uniform worth rupees 1200. Whichever is less will be exempt. So daily allowance, uniform allowance, conveyance allowance, helper allowance, academy allowance and traveling allowance are exempt on based on what you are actually spending. Actual amount spent or amount given by the company, whichever is less will be exempt. Now, one of the important allowance about which normally they ask question in the examination is your house rent allowances. Sir, what do you mean by this house rent allowance, sir? Sir, house rent allowances means company is giving a money to you so that you can go to a place and stay for your house rental purpose. Now, house rent allowance is what, sir? House rent allowance is exempt under section 1013A. How much is exempt? 40% or 50% of salary, or actual HRA received, or rent paid minus 10% of salary. 40% or 50% of salary, or actual HRA received, or rent paid minus 10% of salary. Whichever is less will be exempt. Whichever is less. Now, sir, what do you mean by salary over here? What is 40% of salary? What is 50% of salary? What do you mean by salary? Salary means same, your basic pay plus DA incomes plus turnover commission. Okay, that is your salary. But sir, when should I take 40% and when should I take 50%? 50% is required to be taken only 4 cases. If you are residing in these 4 metro cities. Which are these 4 metro cities? Delhi, Mumbai, Chennai and Kolkata. Please note, place of residence is important, not place of your employment. Now, it may happen that you are working in Chennai but staying in Kathpadi or Velur. You are working in Mumbai and you are staying in some area like Pune. Now, in that case, what is important? Location where you are working is important, or location where you are residing is important? Location where you are residing is important. And any other type of allowances is fully taxable. All other types of allowances or any other type of allowances is fully taxable. Okay, so how many allowances are there? You cheat, duck hat, HRA. You cheat, duck hat, HRA. You cheat is exempt based on limit. Duck hat is exempt based on what you are actually spending, and HRA is exempt based on whatever that formula is there. Any type of allowance other than these allowances, you cheat, duck hat, HRA, any type of allowances you see is fully taxable. Now, shall we start doing question? Shall we start doing question? Yes, sir. We'll take a good question. Now, see this question. See this question in a past tense. Mughal joined what, sir? S Limited on 1st of April 2024. The details regarding his salary are given to you. Basic pay 5,000 per month. Can I say fully taxable? Dearness allowance 2,000 per month. Can I say fully taxable? Because they are all taxable components of salary. Education allowance. Of course, education allowance means what, sir? It is going to be children education allowances. 1,000 per month he is receiving. He has 1 son and 3 daughters. So, sir, this 1,000 rupees which I am receiving, no, sir, is this for all the 4 children, sir? Because they have not given anything. Is it for all the 4 children? Of course, yes. The company is giving you 1,000 rupees. Now, the company is least bothered whether you have 1 children, 10 children, 4 children, how many children you are having. Correct. Hostel allowance is 2,000 rupees per month, and none of the children are going to hostel. Now, the beauty of allowances is, if the company is giving you an allowance, whether that allowances is actually utilized by you or not, you can claim it as deduction because they are limit based. Now, you tell me, in this case, children hostel allowance, 1,000 rupees I am receiving per month, divided by 4. Per child, how much am I receiving? 2,500. Education allowance, how much will be exempt? 100 rupees only will be exempt. So, taxable will be 10,000 into 12 months. Sorry, 1,000 into 12 months. Exempt will be 100 into 2 children's into 12 months. 2,400 will be exempt and 12,000 will be taxable. Hostel allowance 2,000 you are receiving per month into 12 months minus 300 rupees is exempt. For 2 children you can claim exemption for 12 months. So that whatever is left over is taxable amount. Medical allowance, have you studied anything called as medical allowance? You cheat, duck hat, HRA. Have you studied anything about medical allowance? No, sir. Therefore, it is fully taxable. Transport allowance. Have you studied about transport allowance, sir, from office to home to office? Yes, sir. It is exempt only for handicapped employees. Easy and handicapped employee. No, therefore fully taxable. Then servant allowance. Have you studied anything called a servant allowance? Sir, we studied helper allowance, sir. Yes, sir, sir. Somewhere we studied helper allowance. Somewhere we studied helper allowance. Helper is not servant. Helper is not servant. Therefore, can I say this will be fully taxable again? Yes. City compensatory allowance. Have you studied anything about that? No, sir. Fully taxable. Entertainment allowance. Have you studied anything about that? Fully taxable. Assistant allowance. Now he is receiving 3,000 rupees. He is paying 2,000 rupees. What is taxable? Whatever is left over for 12 months. Academy allowance. Academy allowance. You are receiving 2,000 rupees. You are spending 8,000 rupees. Can I say fully exempt? Bonus fully taxable. Commission and fees also fully taxable. So if you see over here, how do I present this question in the examination? Mughal, previous year, name of the SSC, previous year assessment year, computation of whatever they have asked you to compute, gross salary over here, particulars and rupees. Basic pay, dearness allowance, children education allowance. Now basic pay is fully taxable, dearness allowance is fully taxable. Children education allowance, what I have received minus exemption will be 100 into 12 months for 2 children's. Hostel allowance 2,000 into 12, 300 into 2 into 12 months. Medical allowance, transport allowance, servant allowance, fully taxable. All these are fully taxable. Assistant allowance and academy allowance are exempt based on what you are actually spending. So that exemption I have taken. So your gross salary will come to 2 lakh, whatever amount is there over here, 42,000. Now we will do a question on HRA because HRA is something which is important. Let us take this Rajkumar question. Mr. Rajkumar has the following receipts from his employer. He is receiving basic pay, plus he is receiving dearness allowance, plus he is receiving commission. Now the question is silent whether it is what type of commission it is. If the question is silent, what am I going to assume? But it is some commission. We are least bothered about what type of commission it is. Unless until they give it is a turnover commission, we should not assume it to be turnover commission. Then motor car expenses, motor car for personal use, and rent allowances, and they have given something called as rent allowances. Now so find out the HRA exempt in the hands of Mr. Rajkumar. He has paid a rent of 16,000 and his accommodation is in Kanpur. So if it is in Kanpur, I'll take 40% of salary. DA forms part of retirement benefit. So this DA which they have given, that is what, sir, it is a DA in terms. Rajkumar exercised the option of shifting out of default tax regime. Shall we do it now? Yes, sir. Now, what is HRA exempt under section 10, 13A? A, B or C, whichever is less. What is A? Sir, because he is staying in Kanpur, 40% of salary. What is B? Sir, actual HRA received. And what is C? Sir, rent paid minus 10% of salary. Now, what is salary for this purpose? Salary is basic pay plus DA in terms plus turnover commission. What is my basic pay in this case? 40,000 rupees. What is my DA in terms? 6,000 rupees. Turnover commission they have not given. So 46,000 rupees is my, what's that? 46,000 rupees is my basic, is my salary, correct? So 46,000. So 40% of salary, 46,000 is per month. So have they asked us to compute it for the financial year? So anything we can do. 46,000 into how much, sir? 40%. Then actual HRA is how much, sir? 16,000 rupees. He has paid a rent of 16,000. Actual HRA received is 15,000 per month. Actual HR is 15,000 per month, and rent paid is how much? 16,000 minus 10% of salary 4600, which will give me how much? 11400, whichever is less is exempt. 46,000 into 40%, 18,400 or 15,000 or 11,400. What is exempt, sir? 11,400 per month is exempt into 12 months. 136,800 is the exempt HR. Okay, students. Exempt HRA, okay. We have they have asked us to find the taxable HRA. What will be taxable HRA? How much am I receiving? I am receiving 15,000 per month into 12 months minus 136,800. 15,000 into 12 is 1,80,000. 15,000 into 12. Yeah, 1,80,000 minus 136,800. 43,200 is my where is that? 43,200 is my taxable HR. Correct? Okay, so this is how you are supposed to present is name of the SSC, taxable HRA, formula you should write, etc. Since the question is silent, it is assumed that commission is not a turnover commission. Always write a note like this. Now, next is what, sir? Before studying the other parts, let us discuss about deductions first. What is deduction, sir? Deduction means from your salary. Now, when you compute your all the parts of your salary, you will get something called as gross salary. From that gross salary, you do subtraction. What you subtract, sir? You subtract deduction. Once you subtract deduction, what you get is called as net salary. So deductions are given under section 16. What are these different types of deductions? Very important. Let us start now. First is what, sir? Our standard deduction. So this is from your gross salary, compulsorily you will get this deduction. It is available for all types of employees irrespective of who you are. How much is the amount of deduction, sir? If you are a employee who is opting for old tax regime or optional tax regime, the deduction will be whatever your gross salary is there or 50,000 rupees, whichever is less. Over here, you should take 50,000 rupees as per month. And if you are an employee who is opting for new tax regime or default tax regime, for you, your salary amount or 75,000, whichever is less will be exempt. Whichever is less will be what, sir? Exempt. Which is less is exempt in the sense whichever is less will be allowed as deduction. I'll repeat once again. Standard deduction is available for all types of employee. In optional regime, salary amount or 50,000, whichever is less, 50,000 is per annum. And in case of default regime, salary amount or 75,000, whichever is less. Now, if you are if the employee has received salary from more than one employer, then what will happen, sir? I don't care. Even then, deduction of 50,000 or 75,000 will be allowed. Now, entertainment allowances. Entertainment allowances, entertainment allowance is required if first added to the gross salary. Then deduction is allowed only if you are a government employee. If first it will be added to your gross salary, and deduction will be allowed only if you are a government employee. How much will be the deduction, sir? 20% of salary or 1/5 of salary, 20% of salary or actual amount received or statutory limit of 5,000 rupees per annum, whichever is less. 20% of basic pay, actual amount received, limit of 5,000 per annum, whichever is less. If you are a person who is opting for default tax regime, you will not get this benefit. Then professional taxes. Professional taxes, it is a tax on employment which is collected by your state government. It is allowed as deduction only if it is paid by the employee. Professional tax is allowed as deduction only if it is paid by the employee. Professional tax, what if it is paid by the employer, sir? What if the company or the employer is paying that? If the employer is paying that, first added to the salary, then deduction will be allowed under section 16. First, if the company is paying on your behalf, first add it to your salary. and then take it as deduction. How much is the amount of deduction? 2,500 rupees per month will be allowed as deduction. However, if you are following default tax regime, then I'm not going to give you any professional tax deduction. Further, professional tax is allowed as deduction on payment basis. If you have paid, it will be allowed. If it is not paid, it will not be allowed as deduction. Now this question, Mr. Goel receives salary, etc. This is a simple question. Mr. Goel receives the following emoluments during previous year ended 31st of March 2025. Basic pay 4 lakh rupees, dearness allowance 1.5 lakhs, commission, entertainment allowance, medical reimbursement, professional tax 1000 rupees is paid by the employer. Mr. Goel contributes 5,000 rupees towards recognized provident fund. He has no other income. Determine his income from salary. He is a state government employee. Who is he, sir? He is a state government employee. So this question is basically about deduction. First, you will take basic salary is taxable. This is taxable. Commission is taxable. Entertainment allowance and medical reimbursement is taxable. Professional tax paid by the employer will form part of salary. Correct? So I'll add everything. Then own contribution to provident fund is something which you'll study right after this. We'll see that he contributes 5,000 rupees to provident fund. We should just ignore that. Okay, now your gross salary came to 7,16,000 in both the cases. Now standard deduction, can I say, will be allowed to both. For one person it is 50,000, for another person it is 75,000, meaning default tax regime 75,000, optional tax regime 50,000. Entertainment allowance 20% of basic pay, actual amount or limit of 5,000 rupees, whichever is less. Then professional tax of 2,000 rupees. Now income from salary will be what, sir? 6,59,000 for old tax regime. Under new tax regime it will be 6,41,000 rupees. Now let us discuss about the provident funds. Now two parts are left over. Provident fund, meaning that provident fund or superannuation fund, etc. And other part which is left over is perquisites. Perquisites are also very important. Sir, what is this provident fund? Now what happens is companies do is they will create a fund for the welfare or for the benefit of employees. For the benefit or welfare of employees, they create some fund. That fund is called as provident fund. Okay, one such fund is called as provident fund. So there may be different types of provident fund. One is called as statutory provident fund, recognized provident fund, and unrecognized provident fund. Now statutory provident fund, normally they will not ask any question on statutory provident fund. Sir, why do you say like that, sir? Because whatever contribution you make in statutory provident fund, that is exempt. Whatever contribution is made by you, the employer in the statutory provident fund, that is also exempt. Whatever interest you receive on the employees ka contribution, please note, whatever contribution you yourself make to the statutory provident fund, exempt. Whatever contribution is made by your employer in statutory provident fund, that is also exempt. Interest which you receive on your contribution, exempt. Interest which you receive on your employer's contribution is also exempt. And at the time of retirement, when you withdraw the lump sum amount, that lump sum amount is also exempt. Time pass. Your contribution is exempt. You and your employer contribution, interest on those contribution is also exempt. Lump sum amount received is also exempt. What is there to remember? Can I directly read it as statutory provident fund, everything is exempt? Correct? No. So will they ask this kind of questions in the examination? No, you are a professional student. They will ask professional question. You are not in BCom level. Correct? No. Recognized provident fund, very important. Recognized provident fund. Now recognized provident fund, employee contribute to this fund. So employee's contribution to this fund should be ignored. Basically employee's contribution means if I am working somewhere and if I contribute money in that particular fund, which is for my own benefit, how will I contribute? I will contribute from my salary only. No, on that salary I would have already paid the taxes. Since I have already paid the taxes on salary, lawmaker says I will not tax you again on the contribution which you are making. Employer, if he is making the contribution in this fund, then up to 12% of the salary will be exempt. Up to 12% of the salary will be exempt. What is salary over here? Basic plus DA in terms plus turnover commission. Okay, up to, so you take this into 12%, up to that it is exempt. Anything more than that is fully taxable. Now you are receiving interest on your compensation, correct? No, on the money which you have deposited in this fund, you are going to receive interest. Interest on employee ka contribution is exempt up to 9.5% per annum. once you put money in this fund is going to give you interest. On your own contribution, interest is exempt up to 9.5%. On your employer ka contribution, interest is exempt up to 9.5%. Meaning interest is exempt whether it is own contribution or employer contribution, it is exempt up to 9.5% per annum. Now you will receive lump sum amount at the time of retirement. This lump sum amount which you receive at the time of retirement will be exempt if you complete minimum 5 years in service. If you leave the job after completing minimum how many years, sir? 5 years in service, then this lump sum amount which you are receiving will be exempt. However, there are 3 exceptions, meaning in the following 3 cases, even if you withdraw before 5 years, then also exemption will be given. Which are the cases, sir? If you are leaving the company within 5 years because of your ill health, or you are leaving the company because your company only has got closed, if the employer has discontinued his business, or you are joining a new firm, new company, and you have transferred whatever balance was there from this company's recognized provident fund to another company's recognized provident fund or to ATCCD pension fund, then also lawmaker says no problem, maja panno, I will exempt it. Now interest on recognized provident fund, can I say up to 9.5% it is exempt? Whether it is employer contribution or employee contribution, up to 9.5% of salary is exempt. However, for employee ka contribution, there is one additional point. What is that additional point? However, if employee has contributed more than 2,50,000 rupees per annum, then the interest earned on such extra contribution is fully taxable in the hands of employee. Whatever interest you are earning in that extra contribution, that will be what, sir? Fully taxable. Unrecognized provident fund, another important thing. Unrecognized provident fund, the beauty is whatever contribution employee as well as employer is making is exempt. Whatever interest they are getting on the employer as well as employee's contribution is exempt. Meaning, in case of unrecognized provident fund, your contribution and interest on your contribution is exempt. It is exempt. However, taxability will come when you receive the lump sum amount at the time of retirement. So when I'm receiving the lump sum amount at the time of retirement, can we say it will have 4 things in it? What is that 4 things? My contribution, interest on my contribution, my employer's contribution, interest on my employer ka contribution. Whatever contribution is made by the employee, because it was his own money which he deposited over there, it is not treated as his income. That is, you are depositing money in your bank account. When you withdraw back, will you pay tax on that amount? No, because at the time when you earn that money, you would have already paid the taxes. So employee ka contribution is not treated as, whatever employee has contributed, it is not treated as income, therefore not taxable. Interest on employee contribution is taxable under income from other sources. Employee ka contribution and employer ka, please note, interest on assuming I am employer, you are employee. Whatever contribution you have made in unrecognized provident fund, that is ignore. Whatever interest you are receiving on your contribution, that interest amount will be taxable. Then employer, whatever contribution I am making in this fund and whatever interest is given by the fund on my contribution, that will be taxable under the head salary. Sir, where can I find the revision notes? As I told you in the previous class, whatever last class I told you, please note, since this is live discussion which is happening over here, notes will not, will not be able to, upload any notes anywhere. I don't know how, even if it is done, I should ask the team. You can do one thing, go to our normal YouTube channel, correct? You can go to our normal ArivuPro YouTube channel, correct? You go to this channel. Over there, you see, search for CA Inter Marathon. In that CA Inter Marathon, there are 2 separate marathon. One is for direct taxes, one is for indirect taxes. You don't have to see that marathon. You have to see this marathon only. But in that marathon, no, you will find, in that marathon video, you will find that link. And in that link, that material has been attached. So you can directly go over there and download the material if you want. Okay. So same material is there. Of course, there are some extra points for you guys. When compared to CA students, there are some extra points for you guys. Whatever extra is there, no, that we will study. That we will just discuss. Anyways, we are discussing, no, that extra points you make a note of that. Okay. Those extra points which we are going to study, Please make note of those extra things. Okay, not okay. Leaky. Yes, sir. Now, I hope this point is very clear to you all. Now let us do questions on this. Okay, superannuation fund. Superannuation fund. Approved superannuation fund is like your statutory provident fund. Unapproved superannuation fund is like your unrecognized provident fund. Unrecognized provident fund. So approved superannuation fund, your contribution, employer contribution, interest on your contribution, interest on employer's contribution, everything is exempt. And lump sum amount which you withdraw at the time of retirement, that is also exempt. One thing which you have to keep in mind over here is your contribution is exempt only if the amount is, employer ka contribution is exempt only if the amount is up to 7.5 lakh rupees. Unapproved superannuation fund, your contribution, your employer ka contribution, interest on your contribution, interest on your employer ka contribution, everything is exempt. Lump sum amount which you withdraw at the time of your retirement will be taxable. How it will be taxable, sir? That lump sum amount will have four things. Your own contribution, which you should ignore because it is not treated as your income. Interest on your contribution, that interest will be taxable under the head income from other sources. Employer ka contribution and interest for employers ka contribution is taxable under the head salary. Yeah. Mr. A ... The story is there. They say lump sum amount received from unrecognized provident fund is 6 lakh rupees. Okay, they say how much amount I have received from unrecognized provident fund. A total of 6 lakh rupees I have received, and they have given the breakup of that over here. Let us directly concentrate on what question is asking us to do. Correct? Out of the amount received from unrecognized provident fund, employer ka contribution was 2,20,000. Interest thereon was 50,000. Then employee ka contribution is 2.7 lakhs. Interest on employee ka contribution is 60,000. Can I say employee ka contribution is not taxable? Interest on employee contribution is taxable as under income from other sources, and employer ka contribution as well as interest on employer ka contribution is taxable as salary. That is the answer for this question. Okay, that is the answer over here. Some more questions are there. Now we'll discuss one of the most important point or concept under salary, which is perquisites. As I told you, what is perquisites? Perquisites are extra benefits given by the company. I'll speak in mic.
Hello. What is perquisites, sir? Perquisites are extra benefits which is given by you to the company. Given by company to you. It is an extra benefit which is given by the company. Normally, now please note, if my voice is echoing, please let me know so that I'll take this out. Perquisites are extra benefits given by the company. Normally, it is a non-taxable. It is non-monetary benefit. Normally, perquisite which is given by the company, that is not monetary, not in monetary terms, that will be in non-monetary terms. Meaning, the company will give a house to stay, company will give a car, company will give furniture, company will give you sofa, etc. Further, reimbursement of expenses or any expenses incurred by the company on behalf of employee is also treated as perquisites. Many times it will happen that company may incur expenses on your behalf. That also will be treated as company. For example, you are going on a travel, company will pay the money for that. Or you have paid the money, now company is giving you that money back. That is also taxable as perquisites. Leave travel concession. Now we are starting the perquisites. Leave travel concession. What is leave travel concession? It is the travel benefit given by the company for travel anywhere in India. What is leave travel concession, sir? It is the travel benefit which is given by the company for travel anywhere in India. Leave travel concession is exempt under section 10(5). If how much is exempt, sir? If you are traveling by air, if you are going on a vacation by air, then whatever your actual expenses are there for traveling or economy class fare, So there are different class in aeroplane. So economic class fare, whichever is less, will be exempt. Actual expenses, your actual expenses or your economy class fare, whichever is less. What if I'm traveling by any other mode? Meaning what, sir? I'm not traveling by air, sir. I'm traveling by bike or car, train, any other mode. If you are traveling by any other mode, then see, please note, if you can travel by any mode, what am I going to check first? Whether railway facility is available at that location. Meaning, wherever you are going to that location, is train also going? Yes, sir, railway facilities available. If railway facilities available at that location where you are going, then actual amount of expenses which is incurred by you, or first class AC rail fare for that location, from your location to that location, what is the first class AC rail fare, that amount I'll take, whichever is less will be exempt. For example, I went from Bangalore to Mysore, or I went from Bangalore to Chennai. How did I go? I went in car. Now lawmaker says how you are going, I don't care. Now I will check whether railway facility is there or not there. Is any train going from Bangalore to Mysore? Is there any train going from Bangalore to Chennai? Yes. Now I have gone in a car, but they are going to check whether train is there or not there. If train is there, in this train there is a class called as first class. That first class AC rail fare, first class AC whatever the train fare is there, that I will take. First class AC rail fare, I'll compare with whatever actual expenses you have incurred, take whichever is less. Similarly, sir, what if the place where I am going, the location where I am going, there is no railway facility available, sir? Railway facility is not available at that location. Yes, sir, railway facility is not available. Then, is any public transport facility available at that location where you are going? At the place where you are going, is there any public transport facility available? Yes, sir, public transport facility is available. Then I'll take your actual expenses or your deluxe class bus fare, whichever is less. So I am going by car. Okay, I am going to Ooty. Now to Ooty, there is no train going directly from Bangalore. There is no train directly going to Ooty. So at the place where I am going, is any train facility available, sir? No. So, but is there any recognized transport facility, bus facility available? Yes, sir, bus facility is there. I'll take deluxe class bus fare or your actual expenses. Though I am going in car, I'll compare it with deluxe class bus fare, whichever is less will be taken by me. Next, sir, what if no recognized public transport facility is also not available? Where are you going, Tarkuri? Where are you going? Sir, if you're going by air, we saw. If you're going to a location by whatever mode, train we saw. If train is not available, public transport we saw. If public transport is also not available, lawmakers are telling, if public transport facility is also not available, then I will take actual expenses or first class AC rail fare for similar distance. For similar distance, whichever is less will be exempt. Now, sir, no, sir. Whenever we go out somewhere in our life, going alone does not give maja in life, no, sir. So, can I take someone with me? Lawmaker says, yes, you can take someone with you. Sir, whom and all can I take, sir? Lawmaker says, you can take your employee, can travel himself. He can take his spouse, okay. He can take his children's and any of his dependent relative. Dependent relative means what, sir? Mother, father, brother, sister, if they are dependent on him. Leave travel concession is available for 2 children who are born on or after 1/10/1998. If children are born after 1/10/1998, then maximum how many children's benefit can you take? 2 children. You can take how many ever children you want, but benefit will be given only for 2 children. Sir, what if they were born before 1/10/1998? Then whatever number of children's, full benefits will be given to you. Now, two journey exemption can be claimed in a block of 4 years. So one block will consist of 4 years. In a block of 4 years, how many exemption can you claim, sir? 2 journey exemption you can claim. Okay. So this is your leave travel concession. Now see over here this question. Mr. D went on a holiday on 25th of December 2024 to Delhi with his wife and 3 children, one son aged 5 years and 2 daughters aged 3 years. They went by flight economy class. Total ticket reimbursed by the company was 60,000 rupees, 45,000 for adults, 15,000 for minor childs. Compute the leave travel concession exempt. Can I say it is fully exempt because he has gone in economy class? And please note, If multiple birth is happening, sir, 3 children went, no sir. If multiple birth is happening during second pregnancy, they will be considered as one. So even if it is a twin at the time of your second pregnancy, then it will be considered as one single person only. So exemption will be given for all the children. Sir, what if first twins happen and then one single child happens, sir? In that case, exemption will be given only for 2 children. Next, medical facility. Medical facility means what, sir? Company is giving you medical facility. Medical facility, treatment in India. Treatment is happening in government hospital, government approved hospital, employer owned hospital. If treatment is happening in government hospital or government approved hospital or employer owned hospital, then it will be exempt. If treatment is happening in India, if it is happening in any government hospital in India, any government approved hospital or any hospital which is owned by the company employer himself, then exemption will be given to you. But however, if the treatment is happening in any other type of hospital, any other place the treatment is happening, any other person is coming and giving you the treatment, it is fully taxable. Sir, what if treatment is happening outside India? If the treatment is happening outside India, then expenses related to your treatment and stay will be exempt based on the limit which is given by Reserve Bank of India. Expenses related to your treatment and stay will be exempt based on the limit given by Reserve Bank of India, and expenses for travel will be exempt. Expenses for travel will normally be taxable. It will be exempt only if the employee's gross total income is less than or up to 2 lakh rupees. 2 lakh rupees per annum. Okay, gross total income is computed per annum. Now, exemption will be given for treatment of employee himself or spouse or children's and any dependent relative, and mediclaim or health insurance, that is always exempt, and life insurance will be always taxable. For example, this question, some person has gone from treatment, medical, who is this person name? Mr. G. Okay, medical premium, medical insurance exemption is allowed. Treatment of G from family doctor is not covered, therefore taxable. Government hospital, exempt. Treatment of Mr. G's grandfather in private clinic, is it exempt, sir? Not exempt, it will be taxable. Treatment of Mr. G's mother, family doctor, taxable. Nursing home, taxable. Brother, can I do the treatment but he's not dependent, therefore taxable. Father who is a dependent, treatment happened in abroad, I'll take RBI limit. Okay, treatment happening abroad, 80,000 I'm spending. RBI limit is 75,000. How much will be exempt, sir? Only whatever is given by RBI will be exempt. Limit of RBI. Now, company is giving you gift. What gift company is giving you, sir? Company is giving you money, 5,000 rupees gift they have given. If the company is giving you gift in cash, it is fully taxable. If the company is giving you gift in kind, if the gift value is more than 5,000 rupees, equal to 5,000 rupees, fully taxable. Less than 5,000 rupees, then it will be exempt. Loan given by the employer. If the company is giving you a loan without charging any interest, or if the company is giving you loan at a concessional rate of interest, then for what purpose is the loan given, sir? Loan is given for medical treatment purpose, and if that medical treatment is for specified diseases, then whatever amount of loan is given by you, whatever interest on that is there, whatever amount is there, it is fully exempt. If the loan is given for any other purpose, then if it is up to 20,000 rupees, no problem, enjoy, exemption will be given. If the loan amount is more than 20,000 rupees, it will be taxable. Please note, in case of loan, what will be taxable? Interest amount will be taxable. What is the taxable perquisite, sir? Because company has given you the money without any interest or at concessional rate of interest, only that interest will be taxable. How much will be taxable? The taxable perquisites will be loan amount outstanding at the end of the month into, I should take State Bank of India interest rate as on first day of the previous year. As on first day of the previous year, what is the rate of interest given by State Bank of India? Subtract the interest charged by employer. Subtract the interest charged by employer, multiplied by whatever amount is outstanding at the end of particular month. That will be the taxable interest. So for example, loan given is 1 lakh, interest is 4%, interest is 0%. If it is 0%, can I say RBI interest is how much, sir? RBI interest is 10%. So can I say if RBI interest is 10%, if the company is giving me loan at 4%, I'm getting a benefit of 6%. Correct. So this 6% benefit which is there, that is my perquisites. What if company is not charging interest at all? Entire 10% is my benefit. Many companies also give something called as perquisites. Sir, what is this perquisite, sir? Many companies give you, many companies give their employees something called as perquisites. Sir, what is this perquisites? Something called as ESOP. Sir, what is this ESOP, sir? ESOP means the shares of the company are given by the company to you at a concessional rate. Sir, repeat. Company is giving the shares of the company to the employee at a concessional rate, at a lesser rate. ESOP means shares of the company are offered to the employee at a concessional rate. Now, if the company is giving you shares of the company at a concessional rate, market value of the shares of the company is 100 rupees. They are giving the shares to you at only 40 rupees. Can I say 60 rupees is the benefit? That benefit is perquisites. So taxable perquisites will be fair market value of shares at the time of exercising the option less issue price of those shares into number of shares issued to you will be the taxable perquisite. So whatever market value is there minus issue price of the company into how many shares they have issued will be the perquisites. Now there are some points with respect to this topic for related to your capital gain also. Note for capital gain in case of ESOP. Now the cost of acquisition of shares, whatever shares you have got through ESOP, the cost of acquisition of those shares for your capital gain computation will be fair market value of shares as on the date of exercising the option. On the date when you are exercising the option, what is the market value of these shares? The period of holding shall be taken from the date of allotment of shares, and gift of shares acquired through ESOP. If the company is if the company has given you shares via ESOP, and if you are gifting these shares to someone, that gifting also will be treated as transfer and capital gain will be applicable. Then company is giving you an education facility. Education facility means what, sir? Education facility. Company is giving education facility to whom, sir? The company is giving education facility to the employee. If the company is giving education facility to you, that means company may get some benefit out of that, lawmaker says. Therefore, there is no perquisites and therefore it is exempt. If the company is giving education facility to the employee himself, no perquisites, fully exempt. If educational facility is given to employee ka children, then where is the education facility happening, sir? Employer ka own institute or employer ka tie-up institute? If it is happening in employer ka own institute, and if the value is less than 1000 rupees for that education, monthly value fees is less than 10,000, then it will be exempt. If it is more than 10,000 rupees, then it will be taxable. Sir, what if the education is happening in any other institute? It will be taxable. Sir, what if the education facility is given to any other person? It is not given to me, not my children's, but any other person, my relative's child, my spouse, etc. In that case, it will be taxable. Company is giving you what, sir? Movable assets. Movable assets means AC, washing machine, TV, refrigerator, all these things are given by company to you. If company is giving you any movable assets except car, then I am going to check the asset which is given by the company to me. Is it an asset which is owned by the company, or is it an asset which is rented by the company, which is taken on rent by the company and then they are giving it to me? If the company is giving any asset to me, and that asset which is given by the company to me, if it is owned by the company, lawmaker says perquisites will be 10% of cost. Perquisites will be how much, sir? 10% of cost. If it is owned by company, it will be 10% of cost. Sir, what if the company has taken that item on rent and then they are giving it to me? Then the value of perquisites will be rent or higher charges paid by the company. Whatever rent charges or higher charges company is paying for that asset, no, that will be taken as perquisites for the employee. Now, whatever amount company is recovering from the employee should be reduced. For example, company gave me an AC. Value of that AC is 25,000 rupees. That AC is owned by the company. Now, what will be the perquisites in my hand? 25,000 into 10%, 2,500 rupees. Now, this is the value of perquisites in my hand. Company is recovering from me 600 rupees. Subtract 600 rupees. Because I got the benefit only of 1,900 rupees. No. Correct, no, 2,500 rupees was the value, but company took 600 rupees. So how much benefit did I get? 1,900 rupees. That 1,900 rupees will be taxable in the hands of me as perquisites. Sale or transfer of movable assets by employer to employee. Now, yeah, if laptop and computer are given by the company, then it is exempt. Yeah. Now, sir, if the company is giving any movable assets to me for my use, then we saw. Now, what if company is selling any movable assets, sir? Company is selling any asset. Sale or transfer of any movable assets by the employer to the employee. Now, that movable assets which is given by the company, what is that movable asset? I'm going to see. If it is a laptop or a computer, then the value of perquisites will be the WDV of that laptop or computer computed by using WDV method of depreciation and giving depreciation on that particular computer at 50% per annum. So you take the WDV of that particular item, subtract from that consideration paid by the employee. What do you mean by consideration paid by the employee? Take the WDV minus consideration. What is consideration, sir? Consideration means the amount which the company is recovering from me. For example, company gave me a laptop for 5,000 rupees. Now the WDV of that laptop is 15,000. I give 5,000. Perquisite is 10,000. If the company is giving you a car, please note here transfer means what, sir? Company is selling it to me. And in the above case, the company gave it to me for my use. It did not sell it to me. Now, if the movable asset given by the company is a car, then perquisites will be WDV minus consideration paid by the employee. What is WDV? WDV is depreciation calculated at 20% per annum using WDV method. And what is consideration paid? Whatever amount the company is paying. Any other asset. If company is giving you any other asset, perquisites will be WDV minus consideration. Depreciation, here WDV means depreciation calculated at 10% per annum using straight line method. Now, note, depreciation should be computed for completed years, meaning for every year you complete in services, depreciation should be calculated. If there is any part of year, please ignore that part of year. Completed year should be calculated from the date of acquisition till the date of transfer, from the date when that asset was acquired by the company till the date of transfer. For example, Priya Sadis acquired a car for 6 lakh rupees on 10th of December 2020. The car was transferred by Priya Sadis for 30,000 rupees on 28th July 2024 to one of its employee. What is the value of perquisites in the hand of employee? Value of perquisites will be WDV minus consideration. Because it is a car, WDV will be calculated under WDV method by giving depreciation under WDV method at 20% per annum. Year means completed year. Year will be calculated from 10th of December. 10th of December till 9th of December 1 year. 10th of December till 9th of December 2 year. Till which date, sir? Till the date of transfer, I should see. Now see over here. 1 year, 2 year, 3 year. Sir, you have calculated only till 2023, no sir. From 10th of December 2023 to 9th of December 2024, you will not take a no. I should take it only for completed year. Now here you have transferred it on 28th of July 2024. This year is not yet completed. Because it is not yet completed, I will not take it for that year. Depreciation should be given only for completed year in case of transfer of asset. So depreciation will be given. I will get some amount. This is the WDV minus how much company is recovering from me? 30,000. So therefore perquisites value is how much, sir? 2,77,200 rupees. Now company is giving lunch facility or meal facility is provided at the office or through vouchers. Company is giving me something called as lunch facility or meal facility. Meal. Okay, if the value of the meal is up to 50 rupees, then lawmaker says it is fully exempt. If the value of the meal is more than 50 rupees, lawmaker says amount in excess of 50 rupees will be taxable. If they have given you snacks, refreshments, non-alcoholic beverages like tea, coffee, etc., then it will be fully exempt. And if you are an offshore duty and therefore they are giving you something, it will be fully exempt. Transport facility is given by the company. What facilities are? Transport facility is given by the company. Now, transport facility, when the company is giving you a transport facility, then check whether you are an employee of transport company or you're not the employee of transport company. If you're an employee of transport company and if a railway and airline company employee, then it will be exempt. If you're not an employee of transport company, if you're employee of any other type of transport company, then it will be fully taxable. If it is giving to any other employees, not employee of any transport company, employee of any IT company, private limited company, manufacturing company, etc., it will be fully taxable. Note, transport facility from office to home and to home to office will be exempt for all kinds of employees. It will be exempt for whom, sir? All the type of employees. From office to home and home to office. Now, free accommodation or house facility. Accommodation facility or house facility is given to government employee. It is taxable as per the license fee. If it is given to a non-government employee, then check whether that accommodation facility, that house which is given by the company, is owned by the company or it is taken on rent by the company. If it is owned by the company, value of perquisites will be 5% of salary, 7.5% of salary, or 10% of salary. If it is taken on rent, then 10% of salary or rent paid, whichever is less. In all the above cases, if accommodation is given with furniture, then you should add value of furniture also. How much will I add? If the furniture is owned, 10% of cost. If the furniture is taken on rent by the company, then whatever rent charges they are paying. Of course, whatever amount the company is recovering from the employee, that amount should be reduced. Then, sir, how will I come to know 5%, 7.5% or 10%? That is based on the population of the place, the place where the house is given to you. If the population is more than 15 lakhs, up to 15 lakhs, 5% of salary, 15 lakhs to 40 lakhs, 7.5%, and more than 40 lakhs, 10% of salary. Now, sir, what do you mean by salary over here? Over here, salary means BD Bumsi. What is BD Bumsi, sir? Basic pay, dearness allowances, bonus, DA bonus, then allowances, only taxable amounts, monetary benefits which is given by the company, and commission given by the company. While calculating this salary, please take the salary on due basis and do not consider retirement benefit perquisites contribution to any fund and advance salary and arrears of salary. Now, very important for a few of important points. Perquisite value should be calculated from the date of occupying the house and not from the date of allotment. Exemption for 90 days in case of two houses are allotted. If two houses are allotted, okay, if two houses are allotted, then if for a period of 90 days you take the value of only one house for exemption, and all other houses which are there, they will be anyways not considered. For a period more than 90 days also, if you have two houses, both the houses which you have will be taxable, or all the houses which you have will be taxable. Where an employee has been transferred from one place to another place, if he has been provided with an accommodation at such new place also, then value of perquisite shall be taken on only for one of such house having a lower value for a period of 90 days. And after 90 days, I will take value of both the houses to be taxable value. Hotel benefit is given. Sometimes it may happen that you are going to a new place, company may give you hotel benefit. Value of perquisites will be 12% of salary or rent charges paid, whichever is less. If hotel is given for a period up to 15 days, then it is fully exempt. Now, if the same house is given for more than 1 year, then there is a new method of computation. If the same house is given for more than 1 year, where an employer provides for residential accommodation owned or rented to his employee for more than 1 year, then the value of perquisites for the current year will be not more than value of the perquisites for the first year into index for the current year divided by index for the first year in which the house was given. So one question is given over here. Now we will see a question. Mr. C is a finance manager of ABC Limited. The company has provided him with a rent-free accommodation at Mumbai. He gives the following information: basic salary is there, DA is there, and 30% is forming part of retirement. 1,500 rupees is bonus. Even though the company allotted the house on 1st of April 24, he occupied the same on 1st of November 24. So perquisites will be calculated from 1st of November. Compute the taxable perquisites. Basic plus DA in terms plus bonus, meaning BDMC you should take. So this comes to salary 8,100. Value of perquisites will be salary 8,100 into 5 months into 10%. Why is it 10%? Because it is in Mumbai, having population more than 40 lakhs. So what will be the value of perquisites, sir? 4,500 per annum. What if accommodation is taken on rent? Then actual rent, whatever they are paying, or 10% of salary. 10% of salary will come to 4050. Rent is 1,200 into 5 months, 6,000, whichever is less is perquisites. Subtract whatever amount is recovered. What if it is given with furniture? Then take the value of house and add the value of furniture based on whether it is owned or rented by the company, and subtract whatever amount they are recovering. That will give you the value of perquisites. Most important, car facility is given by the company. What, sir? Company is giving you car facility.
Now this car facility which is given by the company, the car facility which is given by the company is giving you car facility. Now the car facility which is given by the company, are you using the car which is given by the company only for office purpose? Yes, sir. Then there is no benefit which employee is getting, therefore no perquisites in the hands of employee. If the car is used by you only for your personal purpose, then lawmaker says if you are using the car only for your personal purpose, that means you are getting a benefit. So in such cases, how much will be the value of perquisite, sir? In such cases, I will check whether the car is owned by the employer or it is taken on rent. If it is owned by the employer, 10% perquisites will be what, sir? 10% of cost. What if it is taken on rent? Perquisites will be whatever rent they are paying. Now, once along with the car, if they are also giving running and maintenance charges, petrol, diesel, etc., add the value of that also. And if they are also providing a driver or driver salary, add the value of that also. That will give you the total value of car. This is a case where the car is used by you for your personal purpose. Now, what is most important is when there is a car, and car you are using for personal as well as office purpose, partly for personal purpose and partly for office purpose. Lawmaker says what, sir? In this case, the value of perquisites will be, in this case, what will be the value of perquisites? Lawmaker says if you are using the car for your personal as well as, if you are using the car for your personal purpose as well as office purpose, then the perquisites value, this is something which is very important. If it is owned by the employee, if the car is owned by the employee and running and maintenance charges are also paid by the employee, what is happening over here? Let us say I am working, I am the employer, you are the employee. Car is owned by you. You are only incurring the running and maintenance charges. What benefit are you getting? You are using the car for my purpose also, your purpose also, but it is your car and you are only filling the petrol, diesel, everything. What is the benefit which you are getting? Nothing you are getting, correct? No. But if the car is owned by you and if I give you petrol, diesel charges, then can I say you are getting a benefit of petrol, diesel charges? Yes, sir. So if the car is owned by the employee and then running and maintenance charges are paid by the employer, then what is the value of perquisite, sir? Whatever running and maintenance charges are paid by me, subtract 1,800 rupees if the car is up to 1,600 cc, and if car is more than 1,600 cc, subtract 2,400 per month. Whatever difference is there, that is the value of perquisites. Next, what if car is partly used for personal purpose, partly used for office purpose, and it is owned by the employer? If the car is owned by the employer, check who is incurring running and maintenance charges. I am it is my car, you are incurring running and maintenance charges, employee is incurring running and maintenance charges, then if the car is up to 1600 cc, 600 per month will be value of perquisites in your hand. If it is more than 1600 cc, 900 rupees per month will be value of perquisites. Sir, what if you are if the car is owned by the employer, running and maintenance charges is also paid by the employer, then value of perquisites will be 1800 if it is up to 1600 cc, and 1000 more than 1600 cc, value of perquisites will be 2400 rupees per month. Now please, if company also provides driver, then along with whatever amount you have got over here, add rupees 900 per month should be added for driver. Now over here, no, if the company is giving you driver, also subtract 900 rupees per month for driver. If more than one car are given for partly, one car only you can claim exemption, all other car will be taxable. A month over here means completed month, part of month should be ignored. Any amount recovered by the employer from the employee, definitely you should subtract that. Now you see over here, Sonam has been provided a car 1.7 liters by the employer Vikas Limited. The cost of the car for the employer was 35 lakhs and maintenance charges was 30,000 rupees per month. Chauffeur salary is 3,000 rupees per month. Find the value of perquisites for the previous year 24-25. If it is used for office purpose, personal purpose, both purpose, and in B and C it is 15,000 is recovered. Car is owned by the employer, running and maintenance charges also paid by the employer. If it is used only for office purpose, can I say employee is not getting benefit, therefore no perquisites in the hands of employee. If car is used only for personal purpose, then because it is owned by the company, 3.5 lakhs into 10% will be taken as value of car. Add running and maintenance charges of 30,000, add driver salary of 36,000. Whatever is left over is your value of perquisites. Now whatever amount is recovered by the company, that should be subtracted. Taxable perquisites will be 86,000. What if car is used for both purpose? Then for car, because it is more than 1600 cc, I will take what, sir? 2400 into 12, whatever amount is coming. Driver salary 900 into 12, value of perquisites will be 39,600 rupees. 15,000 is recovered, you subtract that 15,000. Almost on a verge of completing this salary topic, then we'll take a small break, much needed for me. Other perquisites, if you are getting gas facility, electricity facility, water facility, it is fully taxable. Servant, gardener, watchman, personal assistant, fully taxable. Credit card facility, credit card is used for office purpose, then exempt. If it is used for personal purpose, fully taxable. Club facility you are getting fully taxable. If it is a corporate club, sports club, fitness club, health club, exemption will be given. Employee obligation met by the employer, fully taxable. Then contribution to ATCC to these funds, recognized provident fund, approved superannuation fund, or ATCCD pension fund in more than rupees 7,50,000, that excess amount will be taxable as perquisites. And following perquisites are always exempt. If company is giving you a laptop or a computer, mobile phone, tea, coffee, snacks, goods at concessional rates, health insurance, mediclaim, personal accident insurance, etc. Now under salary, there is one more concept called as relief under 89A. Sometimes what may happen is company has promised you to pay some amount this year, but because of some reason they could not pay it this year, they paid it to you on a future date along with that future year's salary. So can I say something which I was supposed to receive this year, I am receiving in a future year. So because I was supposed to receive it this year and I have not received in this year, my tax of this year would have been reduced. Please note, I told you that I will give you a total salary of 7,90,000 this year, but I did not, which included a bonus of 1,20,000. But I did not give you the bonus. And therefore you got salary of only 6,70,000. So can I say this year your salary, you were supposed to receive 7.9 lakhs, you received only 6.7 lakhs. Can I say you received less salary? Because you received less salary, your tax on salary also will reduce because you did not receive that 1.2 lakhs. Yes sir, correct, true. Now this 1.2 lakhs I gave you in a future year. In a future year, I gave you this 1.2 lakhs. So can I say in that future year, actually you were supposed to receive only 9.5 lakhs because that unpaid amount you received this year, you received 10,70,000. Now due to this reason, what is going to happen, sir? Your tax for the current year is going to be less and tax for future year is going to be more. Why is it more, sir? Because that unpaid amount is received now. Unpaid amounts means that whatever unpaid bonus was there, that is paid now. Now lawmakers are telling, due to this, no, because of this, see, you were actually supposed to pay, actually, if you take the actual figures, I should have received 7,90,000, but I received only 6,70,000. So if my salary was 7,60,000 in this year, I would have paid a tax of 73,320. Now because I received only 6,70,000, I am paying a salary tax of 48,360. Then sir, you should be happy, no sir? Yeah, I paid how much less this year? 24,960 rupees less I paid. Almost I paid less of 25,000. In future year, if you see, I paid an extra of 32,000. Because I received that amount in future year, I paid extra of 32,000. Now lawmakers are telling, whatever you paid less now, whatever you paid extra now, I'll see the difference of this. This difference will be allowed to you as relief under section 89. This is what relief which an employee will get. Okay. Now we'll discuss income from house property, but before discussing that, I will take a small break of 10 minutes. I'll meet you at what time, sir? I'll meet you back after 10 minutes. Break time. One photo. So there is a break time for 10 minutes. Meet you in 10 minutes, students. Yeah, welcome back, students. Welcome back. Let us discuss the next topic. Which topic shall we discuss? The next head of income from house property. Yes, sir, we'll discuss income from house property. What is there in income from house property? Very simple chapter. Income from house property. Section 22 to section 50. These are the different sections. Section 22 to section 27. These are the different sections which are there under this chapter called as income from house property. Now basically from an house property you can have two types of income. If you give this house property on rent, you will get rental income. If you sell this house property, you will get an income under capital gain. So these are basically the two types of income which you can have from a house property. Rental income, or which are the two types of income, sir? Either rental income or a capital gain income. Section 22 is the charging section which says rental income or an annual value of a house property will be taxable under the head income from house property if two conditions are satisfied. Which are these two conditions? There should be a house property and assessee should be
Owner of such house property. What is this point telling, sir? if you satisfy these two conditions, then whatever rental income you are earning, that rental income will be taxable under that income from house property. There should be a house property and assessee should be owner of that house property. Now, what do you mean by house property? House property means building and land appertaining to that building. So if there is a house, if I am the owner of the house, I give this house on rent to someone, that income will be coming and taxable under income from house property. If that someone gives this house property on rent, now because this person is not owner, that person's income will not be taxable under their house property. Now please note one very good clarification they have given. If an assessee is in the business of renting of house property, if assessee's business is only giving house property on rent, and if that property is a commercial house property, then that income will be taxable under business. If that rent property which he is giving on rent is a residential house property, then that income which he is earning will be taxable under the head income from house property, though it is the business of the assessee to give house property on rent. Types of house property. For our computation taxation purpose, house properties are divided into two categories. One is called as let out property, another one is called as self-occupied property. Let out property is always taxable because you are earning rent out of that. It will be a taxable property and it will be taxable under their income from house property. However, if it is a self-occupied property, then what lawmakers are telling, sir, if it is a self-occupied property, lawmaker says if it is a self-occupied property, I am going to check whether it is self-occupied for residence purpose or for business purpose. If you are self-occupying it for your business purpose, lawmaker says please ignore it. If you are self-occupying it for your business purpose, lawmaker says please ignore it. If you are self-occupying it for your residence purpose, lawmaker says what, sir? If you are self-occupying for your residence purpose, lawmaker says I'll check how many properties you have. If you have up to 2 self-occupied properties, then it is exempt. If you have more than 2 self-occupied properties, then for 2 properties you can claim the benefit of exemption, and for remaining properties they will be treated as deemed to be let out properties. Remaining properties which are there, they will be treated as deemed to be let out. Sir, what do you mean by deemed to be let out? You have actually not given those property on rent, but they are going to assume that these properties are given on rent, then accordingly they are going to compute the income from house property. Now please note, any property which is not occupied by you is also treated as self-occupied property. Unoccupied property is also treated as self-occupied property unless until that is available for rent. Now sir, how do I do computation of income from house property? What you are supposed to do is, whatever actual rent you are receiving, that should be compared with your expected rent, and you should take whichever is higher. That whichever is higher will be your gross annual value of the property. Sir, what is this actual expected rent? I know what is actual rent, sir, but what is this expected rent? Expected rent is basically your municipal value of the property. That municipal value you should compare with your fair rent and take whichever is higher. Now this whichever is higher you should compare with standard rent, take whichever is lower. Now that lower amount is called as your expected rent. This expected rent is required to be compared with actual rent, and you are required to take whichever is higher. That whichever is higher will be your gross annual value. From this you subtract your municipal taxes, you will get your net annual value. From this net annual value subtract deductions under section 24A and 24B, you will get your net income from house property, or that income from house property. Okay, yes sir. Next, now please note, for self-occupied property which you are if there is any property which you are self-occupying it for your residence, for them there is no computation up to 2 properties. Therefore directly you can start with NAV, taking NAV as 0, and standard deduction will not be allowed. But however, interest on loan will be allowed if you have taken any loan, and if you are paying interest on such loan, and income from such house property will be taken accordingly. And for let out property and deemed to be let out property, you will have all the informations. However, for deemed to be let out property will not have the information of actual rent. Anyways, this we'll see under our computation. But sir, please explain the terms. No sir. Municipal value is the value of the property as per municipal. Municipal value is what, sir? Value of the property as per municipal records. Municipal value means the value of the property as per municipal records. Fair rent means what, sir? Reasonable amount of rent charged for similar kind of property at the same quality. Standard rent is the rent as per Rent Control Act. Actual rent is rent received plus rent receivable minus unrealized rent. What is municipal taxes? Municipal taxes is the taxes which you are paying on your house property. That municipal taxes, taxes levied by the house property, on the house property by the municipal authority or the local authority. It is also known as house tax, property tax, CVS tax, or local tax. Municipal tax is allowed on payment basis. If you have actually paid, it is allowed. If it is not paid, then it is ignored. Then it is allowed as deduction only if it is paid by the owner. Municipal taxes, if it is paid by the tenant, is it allowed as deduction? Lawmaker says, illa, illa, illa. No, 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 no. If it is paid by the owner, only then it will be allowed as deduction. Then, if some cases, question may give the municipal taxes in percentage form. They may tell municipal taxes is 10%, 15%. Then what should I take, sir? I should take 10% as what? 10% of municipal value. Meaning, if it is given in percentage form, you should be taken as a percentage of municipal value. Now let us do one question. Now see over here, Mr. Dilip has a house property whose municipal value is 1,30,000. Fair rent is 1,10,000. Rent as per Rent Control Act is 1,20,000. So what is expected rent? Municipal value or fair rent, whichever is higher. Who is higher? 1,30,000. 1,30,000. That you should compare with actual rent. That you should compare with your standard rent. Take whichever is less. Who is lesser? Your standard rent is there. Therefore, your expected rent is how much? 1,20,000. Okay, expected rent is 1,20,000. The property was let out for 11,000 rupees per month. 11,000 into 12 months will give you 1,32,000. This 1,32,000 you should compare with your expected rent and take whichever is higher. 1,32,000 is your what, sir? This is your gross annual value. From that, subtract municipal taxes, you will get net annual value. Subtract standard deduction. So my gross annual value is 1,32,000. Subtract municipal taxes, 10% of municipal value, you will get your net annual value. From that, you subtract standard deduction and interest on loan, you will get your income from house property. Actual rent. Actual rent is what, sir? Actual rent is rent received plus rent receivable minus unrealized rent. What is actual rent? Rent received plus rent receivable minus unrealized rent. Rent received is whatever rent you are actually receiving. Rent receivable is the rent which you are supposed to receive. Unpaid rent, receivable rent. Unrealized rent is that portion of rent receivable which you are never going to receive. This unrealized rent can be subtracted if you satisfy four conditions. Which are these four conditions, sir? Tenancy should be bona fide. Tenant should have vacated the property. Tenant should have not occupied any other property of the same assessee, and reasonable steps should have been taken to recover such unrealized rent. If these four conditions are satisfied, then whatever unrealized rent is there, you can subtract. Now, deductions. Then you are required to subtract what's a deduction. Actual rent we understood. Now we are required to subtract deductions. Deductions are given under section 24. 24A talks about standard deduction, which is flat 30% of NAV. If you have an NAV, take 30% of NAV, that will be given to you as standard deduction. Normally for self-occupied property, we will not have NAV. Therefore, for them, no standard deduction will be given. And for let out property or deemed to be let out property, since we will be having NAV, you can take flat 30% of that as standard deduction. Then we have what, sir? Then we have interest on loan. If you have taken any loan for the purpose of construction, purchase, repairs and renovation of house property, that loan will be allowed as reduction under section 24B. That loan can be taken from any person, your family members, bank, family members, financial institution, etc. It will be allowed as reduction. Important points to be noted. Interest on loan will be allowed as reduction under section 24B if the loan is taken for the purpose of house property. If the loan is taken from any person, then it does not matter, interest will be allowed as deduction. If a loan is interest is allowed as deduction, whether it is paid or not, actual payment is not mandatory over here. Interest on interest, which is penal interest, is not allowed as deduction. Interest paid on fresh loan for repayment of existing house property loan, allowed as deduction. Any interest paid to a non-resident outside India will also be allowed as deduction, only if such TDS is deducted while paying that interest. Now, how much interest is allowed, sir? Oh, sir, how much interest is allowed as deduction, sir? How much interest is allowed as deduction? The limit for interest which is allowed as deduction under section 24B is what, sir? It is, if it is a let out property or deemed to be let out property, then there is no limit. Any amount of interest which you are paying, any amount of interest which you are paying is allowed as deduction. In case of self-occupied property, normal cases 30% will be given, and in case of special scenario, you will get interest of 2 lakh rupees per annum as deduction. When will I get 2 lakh rupees, sir? I want 2 lakh rupees. If the loan is taken by you on or after 1/4/1999, loan is taken for construction or purchase of house property. If the loan is taken for construction, the construction should be completed within 5 years from the 5 years from what, sir? Within 5 years from the date from the end of the financial year in which loan was taken. Now please note, for self-occupied properties, maximum amount of interest which you can claim as deduction for all the properties combined together, self-occupied properties, how much, sir? 2 lakh rupees. Now, very important. If the assessee is opting for please, once again, I'll tell you one thing. If it is a let out property or deemed to be let out property, there is no limit. Full amount of interest can be claimed as deduction. Now, if an assessee is opting for 115 BAC and if he has a self-occupied property, for that self-occupied property, he cannot claim deduction under section 24B. Interest on loan deduction cannot be claimed by him. So if assessee opts for optional tax regime or old tax regime, let out, deemed to be let out, any amount of interest allowed, self-occupied 30,000 or 2 lakhs, whichever is allowed based on whatever loan it is. And in case of default tax regime, let out, deemed to be let out, fully allowed as deduction, self-occupied, no deduction is allowed. Ding, 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 ding. So there is one question. In this question, they have to pay a total interest of 3,55,000, but allowable interest is 2,30,000. In that also there is a restriction of section 24B, which is 2 lakh rupees. And in case of default tax regime, there is no interest allowed for self-occupied. Then there is a concept called as pre-construction period interest. What is pre-construction period interest? Pre-construction period means, what is pre-construction period, sir? Pre-construction period means the year before the year in which construction was completed. What is pre-construction period? The years before the year in which construction was completed is called as pre-construction period. Pre-construction period interest is allowed a reduction in 5 equal installment from the year in which the construction was completed. Okay. Quantum of reduction. How much deduction will be allowed, sir? Whatever interest is there for that year plus share of pre-construction period for that year, that will be allowed as deduction. If it is a self-occupied property, maximum 2 lakh rupees is allowed. For a let out property, any amount will be allowed as fully deduction. Then we have a concept called as concept of vacancy. Now, vacancy means what, sir? The house property was not occupied or it was empty for some period, or it was available for rent. Basically, there was a house property which I had to rent, but no one had occupied that property, therefore that house property is still there, like that only. Now in that case, normally what do I do, sir? Normally my expected rent, my gross annual value is expected rent or actual rent, whichever is higher. Now whenever there is a vacancy, while calculating gross annual value, I'll take expected rent and compare that with actual rent and vacancy period rent. Now there are three possibilities. Your expected rent can be more than actual plus vacancy period rent. In such cases, your expected rent will be gross annual value. Your expected rent can be less than actual rent plus vacancy period rent. In such cases, you should take actual rent. Please note, add to that actual rent, whatever actual rent is there, add vacancy period rent, do the comparison with expected rent. If this total is coming more than expected rent, then your gross annual value will be your actual rent. Similarly, if your actual rent plus vacancy period rent is equal to expected rent, then whatever actual rent is there, that will be taken as gross annual value. So for example, say I had given a property on rent, 3 lakh rupees was the expected rent, 30,000 rupees was monthly rent. Property was vacate means not occupied by anyone for a period of 3 months. Now here expected rent is expected rent is less than actual plus vacancy period rent. Actual plus vacancy period rent is coming to 3,60,000 and expected rent is coming to 3 lakhs. So can I say it is less? So when expected rent is less than actual plus vacancy, then I should take actual rent as my gross annual value. Expected rent is 3 lakhs, actual rent is 20,000, vacancy period rent is when vacancy is 1 month. So I'll compare expected rent with actual place vacancy period. Actual rent is 2,20,000. Vacancy period rent is 20,000. So total of this is how much? 2.4 lakhs. That you should compare with your expected rent. Who is higher? Expected is higher. Therefore, gross annual value will be your expected rent. So basically there is one, question with respect to this which I have done over here. See, till the time of calculation of actual rent, you should do the same thing. Now for calculation of gross annual value, you should give a working note. Because there is a concept of vacancy involved, I should compare expected rent with actual place vacancy period rent. Since here the expected plus actual rent is higher, your actual rent will be taken as gross annual value. So now here when you are taking gross annual value, you should not take whichever is higher over here. You should do a computation working, and based on that you should take the value. What if I have a property which is partly let out and partly self-occupied? If it is a partly let out and partly self-occupied property, lawmaker says then check whether the property is partly let out, partly self-occupied, area-wise or time-wise. If it is partly let out, partly self-occupied, area-wise, then area-wise means what, sir? 60% is self-occupied, 40% is let out. First floor is self-occupied, ground floor is let out. In such cases, then your municipal value, fair rent, standard rent, municipal taxes, interest, everything you should divide in the proportion of let out and self-occupied. For example, in our case, 60% was self-occupied, 40% was let out. Divide it in that proportion. Okay. Now compute your income from house property for let out and self-occupied portion. By dividing everything, compute the income from house property by taking municipal value of air rent, municipal taxes proportionately for let out and self-occupied. Interest deduction will be allowed for self-occupied. How much, sir? 2 lakh rupees, and for let out, interest will be fully allowed as deduction. Please note, for example, my total interest for that entire property is 6 lakh rupees. Self-occupied is how much, sir? 60%. Let out is how much? 40%. 3,60,000 comes to self-occupied. 2,40,000 will come to let out. Maximum for self-occupied is 2 lakhs. For let out is how much, sir? Any amount, it will be fully allowed. Now, sir, what if it is time-wise let out? Time-wise let out means what, sir? 8 months let out, 4 months self-occupied. Okay, in such cases, 8 months let out, 4 months self-occupied property, it is time-wise let out, correct? So for some period of the month it was for some period of the year it was let out, and for some period of the year it was self-occupied. Lawmaker says compute your income from house property, assume that the property was rented for the whole year. However, while taking the actual rent, take the actual rent only for let out period. Actual rent, of course, you'll take it only for let out period. You should do the computation, ignoring what is municipal value, fair rent, etc. You should take municipal value, fair rent, municipal taxes for entire year, assuming the property was let out for full year. But when you're taking actual rent, take it only for let out period. Interest will fully be allowed as deduction. Now there is something called as co-ownership and joint ownership also. What happens in co-ownership, sir? Co-ownership means what, sir? Co-ownership or joint ownership means what, sir? A single property has more than one owner. In such cases, compute the income from house property as if there is no co-ownership. Meaning just compute your income from house property normally. Whatever final answer you are getting, divide that between the co-owners in the ratio of their ownership. So here you don't have to break your head much. Whenever there is a co-ownership or joint ownership, compute your income from house property, ignoring everything, whether co-ownership is there, not there, etc. Ignore everything and just compute your income from house property. Now the final answer which you have got, that you divide between the co-owners in the ratio of ownership. Interest. For self-occupied, each co-owner will get the limit of 3 lakh and 2 lakh respectively, 30,000 or 2 lakh respectively. See, where a house property is jointly owned by 2 or more persons, such house property is called as co-owned property or jointly owned property. The owners of such house property are called as co-owners. Computation of income from house property in case of co-ownership. Step 1, compute the income from house property as if there is no co-ownership. Divide the income from house property in step 1 between co-owners in the ratio of their ownership. If self-occupied property is co-owned, then each co-owner will get interest of 30,000 or 2 lakh rupees separately. Ratio of co-ownership, if it is not given, assume it to be equal. Now, let us do, just go through one question with respect to your partly self-occupied, partly let out. Prem owns a house property in Madras. During the previous year 24-25, two-third of the house property was self-occupied and one-third of the property was let out for residential purpose. At what, sir? Let out for residential purpose for 8,000 rupees per month. Municipal value is 3 lakhs. Fair rent is 2,70,000. Standard rent is 3,30,000. Municipal taxes is 10%. A loan of 25 lakh was taken by him during 2020 for acquiring the house properties. Interest on loan paid is 1,20,000. Compute the income from house property. Now what will you do, sir? Computation of income from house property. Divide everything in the proportion. Correct? For self-occupied property, directly I can start with NAV. Correct? So I'll give 2/3 to self-occupied, 1/3 to let out purpose. For self-occupied, can I say there is no up to two properties I can claim the exemption? So directly you can start with NAV by taking NAV as 0, subtract standard deduction, you will get some amount, subtract standard deduction and interest. Now interest, how much they have paid? 1,20,000. 2/3 is self-occupied, 1/3 is let out. 120 into 2/3 is 80,000. 40,000 is for let out. 80,000 will be allowed as deduction over here. Income from self-occupied property in this case is a loss. Let out property, 3 lakh is the total municipal value into 1/3. 1 lakh is municipal value for let out portion. 2.7 lakhs is the municipal fair rent for the entire property into 1/3. 90,000 is the fair rent for this. So accordingly you should do the computation. You will get your gross annual value, subtract municipal taxes, you will get your net annual value, subtract standard deduction and interest, you will get your income. Now you combine both the incomes, whatever is you are getting now is called as your net income from your house property. When the computation part is same, you just have to divide everything and compute. Similarly, let us see what if it is time wise let out. Srimati Rajalakshmi was having a house property at Adyar, Chennai. Municipal value of the property is 5 lakh rupees. Fair rent is 4,20,000. Standard rent is 4,80,000. The property was let out for 50,000 rupees per month till December 2024. Thereafter, the tenant vacated the property and Srimati Rajalakshmi self-occupied the property. Rent for the month of November and December could not be realized. All conditions of rule number 4 was satisfied, and she paid a municipal taxes of 12% per annum. So unrealized rent is there for 2 months. She paid an interest of 35,000 which was borrowed for repair purpose. Compute the income from house property. Srimati Rajalakshmi 24-25. Now please note, this is time wise. Till December it was let out. After that it was self-occupied. No, so this is time wise let out property. You should compute as if the property was let out for the full year. However, the actual rent will be taken only for let out portion. Municipal value of fair rent, whichever is higher, compare that with standard rent, you will get expected rent. Expected rent you compare with actual rent, you will get what, sir? Expected rent you compare with actual rent, you will get gross annual value. When you are taking actual rent, please subtract unrealized rent. From gross annual value, subtract your municipal taxes, you will get net annual value. From that, you subtract your standard deduction and interest, you will get your income from house property. There are some more questions given over here. Beautiful question. This is a very nice question. Now, sir, what if I have more than 2 self-occupied property? You said if I have more than 2 self-occupied property, I can take exemption only for 2 properties. No, sir. Correct? No, sir. If I have more than 2 self-occupied property, I can take exemption for only 2 properties. So, sir, which are the 2 properties for whom I should take exemption? Assuming I have 5 houses, sir. All 5 houses are self-occupied only. Now you said for 2 houses I can claim exemptions and all other properties will be treated as deemed to be let out property. Correct? No, sir. Now, sir, tell me which house I should treat it as self-occupied, which house I should treat it as deemed to be let out. Very simple. Whichever house is giving you the least, whichever combination basically is giving you the least income, that is the best option for you. For example, if I have 3 houses, and all the 3 houses are self-occupied by me. While computing the income from house property, what will I do, sir? I can take exemption only for 2 houses. So I will have 3 different combinations. What are these 3 different combinations? House 1, house 2, I will take as self-occupied in case number 1, and I will treat my house 3 as deemed to be let out property and do the computation of income. Similarly, step number 2, I will take house number 1 and house number 3 as self-occupied. House number 2, I will take it to be deemed to be let out. Case number 3, I'll take house 2 and house 3 as self-occupied. House 1 has deemed to be let out. So in each of the cases, I'm going to do the computation of income from house property. After doing computation of income from house property, whatever amount I get now at the end, that I should compare. Whichever place I get the amount as least, that will be my income from house property. Step 3, calculate income from house property. In step number 1, just the steps I have written, etc. You just calculate whichever cases I am getting. For example, I have done the computation over here. Option 1, option 2, option 3. I should do the comparison and find net income. Wherever the net income is least, where is it least? 8140. That is my answer. Section 25B talks about taxability of arrears of rent and unrealized rent. Arrears of rent means what, sir? Rent under dispute. Unrealized rent means what, sir? Rent which you are supposed to receive, which you have never received. Now, this arrears of rent which is under dispute, and unrealized rent, if it is received in a future year, then whichever year you receive it, it will be taxable in that year. Arrears of rent means rent under dispute. Unrealized rent means the rent which we are supposed to receive but which we have never received. Arrears of rent and unrealized rent both are taxable in the year of receipt. How much is taxable? Actual amount, whatever amount you have received, into 90%. Arrears of rent and unrealized rent will be taxable in the year of receipt, even if the assessee is not the owner of such house property in the year of receipt. Even if I am not the owner of the property, in the year when I am receiving the rent, it will be taxable in my hands. Now, some theoretical point with respect to this chapter. All the computational part is done. Theoretical point, for example, composite rent is there. Composite rent means what, sir? If you are getting for a house property, if you are renting house property along with other assets, then the rent which you get is called as composite rent. Now, if you can separate the composite rent, then whatever is allocated to house property will be taxable under the head house property. Whatever is allocated to other assets will be taxable under income from PGBP, business or professional, or other sources. What if the composite rents are not separable? Then the entire amount of rent which you are receiving, that entire amount of rent will be taxable under the head income from business or profession or other sources. Let out property. Now, if let out of house property is not at all possible without other assets, then entire income will go to PGP or other sources. What if house property is held as stock in trade? If you are a builder, for you house property will be the stock in trade. You are involved in the business of construction, purchase and sale of building. Whatever income you get by sale of building will be taxable under the head PGBP. Whatever income you get by renting of the building will be taxable under the head income from house property. Where the house property is held as a stock in trade and it has not been let out during the previous year. If you are holding the house property as your stock in trade, and lawmakers are telling, if the house property is a stock in trade for you, then whatever income you get by renting that house property is rental income. Whatever your income you get by selling that house property is taxable under income from PGBP. Now, if you don't give it on rent, then, and if you don't sell also for a maximum period of 2 years, I will take the NAV of that property to be equal to 0, and after that I'm going to deem is that it is let out. Meaning, lawmakers are telling is, if a builder is neither selling the property nor giving it on rent for a period of maximum 2 years, you can claim the benefit of self-occupied exemption, and after that it will be treated as deemed to be let out property. Sir, what if property is located outside India? If the house property is located outside India, lawmaker says, if the house property is located outside India, if the house property is located in India, irrespective of who you are, whether resident or non-resident, it is always taxable in India because income will accrue or arise in India. If the house property is located outside India, then if you are a resident and ordinary resident, it will always be taxable irrespective of where it is received. But if you are a non-resident or resident but not ordinary resident, it will be taxable in India only if the rent is received in India. Now, last point, owner. What do you mean by owner, sir? Owner includes legal owner, beneficial owner and deemed owner. Deemed owner meaning is given under section 27. Who is a deemed owner, sir? Transfer of an house property by an individual to his or her spouse without consideration or for inadequate consideration. Who is a deemed owner? If I transfer my house property to my spouse without consideration or for inadequate consideration, then I will be deemed as owner. Though the property is with my spouse, I will be deemed as the owner of that property. Further, transfer of a house property by an individual to his or her minor child except minor married daughter without consideration or for inadequate consideration. In such cases, individual will be treated as deemed owner. Whoever is transferring the property, that person will be deemed as owner. Then holder of impartable estate. So if there is any estate which cannot be divided, then whoever is the holder, the trustee, the holder of that impartable estate will be deemed as owner of that property. If you are a member of cooperative society, meaning in case of apartment etc., that entire building will not belong to you, only your flat will belong to you, only your house, that flat will belong to you. So you will be treated as member of that entire building, correct? So you will be having membership certificate. The person who has that membership certificate, that person will be deemed as owner. Then if you are transferring the property as per Transfer of Property Act, TOPA, then that transferee, the person to whom you have transferred the property, he will be deemed as owner. And if you give any property on a long-term lease for a period of 20 years or more, to whomever you are giving the property, that person will be deemed as owner. Now, extra notes for this income from house property: self-occupied property exemption can be claimed only by whom, sir? Individual and HUF. Municipal taxes paid in foreign country is also allowed as deduction if you are computing any income for property located outside India. Roof is not necessary for being called as house property. In case of non-residential house property, stadium and swimming pool can also be treated as house property, though there is no roof. If building consists of different flats, each flat will be treated as one house property. Refund of municipal taxes is not taxable under house property, it is taxable under other sources. If house property is acquired by a person by paying amount in installment, then each and every installment when he is also paying interest. That interest can be claimed as deduction by him. If assessee lets out the house property to his employee, where letting out supports the business. So for example, if I am the employer, you are my employee. If I give my house to you on rent, and because of that reason, if my business is running smoothly, then that income will that whatever rent I am receiving from you will be taxable under PGBP. And if a partnership firm is there, if partner rents the property to his firm, ignore, because it is used by his business. Self-occupied property for business purpose, ignore. Okay, now let us stop our today's discussion over here only. Okay, today we have completed two beautiful topics. One is income from salary, one is income from house property. Beautiful topics, interesting topics. Now what we'll do, sir, we will meet in next video tomorrow. Tomorrow we are going to meet, and tomorrow we are going to discuss about other topics which are there, and accordingly we'll continue our discussion day by day. Let me meet you tomorrow. I hope you are enjoying. If you are enjoying, please let me know in your in the comment section. You can please send me a text message, etc., whatever message you want to put. Bye bye, take care, enjoy.
Hello friends, welcome back. Welcome to the day 3 of marathon. So in our today's class, we'll be discussing about a topic called as income from capital gain. So till now we have covered our basics, we have covered tax rates, then we have covered what else? We have covered our income from salary and income from house property. So let us continue our discussion. I hope you are all ready. One of the most important topic for your examination, very important, lot of amendments are there in this chapter. Definitely you can expect one question almost of 6 to 8 marks from this chapter. Due to what, sir? Due to the amendment which are involved in this chapter. Okay, let us start. Now what is this income from capital gain? Now what is this chapter telling is, this chapter says if you have any capital asset, if you have what, sir? If you have any capital asset, and if you transfer that capital asset, by transferring that capital asset, if you get any gain, that gain will be taxable under income from capital gain, or it will be taxable under this particular head. Okay, section 45(1). Now what are the different sections covered in this chapter? Section 45 to section 55, these are the different sections which are covered in this chapter. Section 45 subsection 1 says is the charging section, which says any profit or gain arising from transfer of a capital asset shall be taxable under the head income from capital gain in the year in which transfer took place. What is this point telling, sir? If you are transferring any capital asset, and by transferring that capital asset, if you are getting any gain, that gain will be taxable under the head income from cap gain. When, sir? It will be taxable in the year in which transfer took place. So whenever, in whichever year you are making the transfer, that year it will be taxable. Sir, what do you mean by capital asset? Capital asset means what, sir? Capital asset means property of any kind held by the assessee. Property of any kind which is held by the assessee, whether it is connected to his business or not, it does not matter. So property of any kind held by the assessee, whether connected to the business or not. However, it shall exclude stock in trade. When I say property of any kind, that means every type of property has come into picture. Correct. So specifically they are telling that if that property of any kind which I am talking about, if it is a stock in trade for you, then I am not going to consider it to be capital asset. If it is gold deposit certificates, gold bonds, or gold deposit certificates, etc., then they will also not be treated as capital asset. If it is a movable personal effects, if it is something which is movable and which you are using it for your personal purpose, if it is something which is movable and which is used by you for your personal purpose, then I will not call them also as capital asset, except DJ Paso BV. Except what, sir? DJ Paso BV. Meaning this DJ Paso BV, though they are movable, I will call them to be a capital asset. If it is DJ Paso BV, it will be treated as capital asset even though they are movable. What do you mean by DJ Paso BV, sir? Drawing, jewelry, painting, archaeological collections, sculptures, shares and securities, any other work of art, bullion and virtual digital asset. These items, though they are movable, they will be treated as capital asset. And what else, sir? Rural agricultural land. What do you mean by rural agricultural land? Agricultural land located in rural area. Sir, what is rural area, sir? Rural area means the area which is not an urban area. Sir, but what is urban area? Urban area is an area whose population is 10,000 or more. If you are staying in an area whose population is 10,000 or more, that means you are staying in urban area. Now, if your area's population is more than 10,000 up to 1 lakh, then definitely your area is an urban area. But from your area up to 2 kilometers area is there, no, that also will be treated as urban area. If you are staying in an area whose population is more than 1 lakh up to 10 lakhs, then definitely you are staying in urban area. From your area up to 6 kilometer area is also called as urban area. If you are staying in an area whose population is more than 10 lakhs, then of course your area is an urban area. From your area up to 8 kilometers area will be treated as urban area. Sir, how do I measure this distance, sir? This distance is required to be measured aerially as the bird flies. Now, what is capital asset? Capital asset means property of any kind held by the assessee, whether connected to the business or not, but excludes stock in trade, gold bonds and certificates, movable personal effects, except DJ Paso BV, and it excludes rural agricultural land. Then what else is capital asset? Any securities held by foreign institutional investor. If you are a foreign institutional investor, whatever type of securities you are holding, okay, whatever type of securities, whether it is long term, short term, whether though you are dealing in that on daily basis, lawmakers are telling it will be always treated as your capital asset. Then unit linked insurance policies, which is not exempt under section 1010D. Unit linked insurance policies are the insurance policies which are linked to the markets actually. Correct. There are some insurance policies which are not exempt under section 1010D. When is it not exempt? If the premium amount paid by you is more than the limit specified under section 80C. Section 80C we will study. If the premium on that policy which you have taken, if you are paying a premium more than that limit which is given over there under 80C, then that maturity amount whatever you received for that policy is taxable under section 1010D. So it is taxable as what, sir? It is taxable, it is treated as capital asset and therefore taxable under this head. Next, section 2 clause 47. Section 2 clause 40, we understood the meaning of capital asset. Now you'll understand the meaning of transfer. Sir, what do you mean by transfer? Transfer means what, sir? Transfer is an inclusive definition, meaning whatever you generally understand by the word transfer is a transfer. Apart from that, transfer shall include sale of a capital asset, exchange of a capital asset, relinquishment of a capital asset, extinguishment of capital asset. Sir, what do you mean by sale, sir? Sale means I am selling the good capital asset to you for a consideration. Exchange means the consideration can be in the form of money or it can be otherwise also. Relinquishment means what, sir? Capital asset, the right in that capital asset is transferred by me to someone else. And extinguishment of capital asset means what, sir? Extinguishment means the capital asset is destroyed. Then conversion of capital asset into stock in trade. So if you are converting any capital asset which you had into stock in trade, then that also I had a capital asset. Now that I had say 50 kgs jewelry I had. Now I'm transferring it. These were capital assets for me. Now I'm starting business of this selling jewelry. Conversion of capital asset into stock in trade. Then compulsory acquisition of any capital asset. Okay, if your capital asset is compulsory acquired under any law, or allowing possession of immovable property under Transfer of Property Act. If you are allowing possession of your immovable property as per the Transfer of Property Act, etc., then also it will be treated as transfer of shares in cooperative society. Both these points we have discussed yesterday in our income from house property point in concept called as deemed owner. And redemption of zero coupon bonds. So zero coupon bonds are those bonds which are issued at a discount and redeemed at par. So those bonds are also called as capital assets. If you redeem any zero coupon bonds, then that also will be treated as transfer. And all these are the different cases of transfer. Meaning in all these cases, if you have a capital asset and this if transfer is attracting, then any gain you are getting, that will be taxable under the head income from capital gain. Now, capital asset, basically for your computation purpose, what they have done is capital asset is divided into two categories. One is called as long-term capital asset. Another one is called as short-term capital asset. Sir, what is long-term capital asset, sir? Any capital asset which is held by you for more than 12 months, 24 months or 36 months is a long-term capital asset. And any capital asset which is held by you for less than or equal to 12 months, 24 months or 36 months is called as short-term capital asset. So in simple words, if you hold any capital asset for more than 1 year, 2 year, 3 year, then it is long-term capital asset. If you hold it for less than 1 year, 2 year, 3 year or equal to 1 year, 2 year, 3 year, it is a short-term capital asset. Okay, sir, I got this point. But sir, how will I check the period of holding, sir? How will I check it whether it is long-term or short-term? See, you should see the period of holding of that capital asset. To check whether a capital asset is a long-term capital asset or a short-term capital asset, you should see what, sir? You should see its period of holding. If the period of holding is more than 1 year, 2 year, 3 year, it is long term. If it is less than equal to 1 year, 2 year, 3 year, it is short term. So period of holding means what, sir? The period from date of purchase till the date of transfer. What is period of holding? The period from the date of purchase of that particular capital asset till the date of transfer of that capital asset. Now please understand this carefully. If you transfer a long-term capital asset, by transferring that long-term capital asset, whatever gain you are going to get is called as long-term capital gain. If you transfer a long-term capital asset, by transferring that long-term capital asset, the gain which you get is called as long-term capital gain. If you transfer a short-term capital asset, by transferring that short-term capital asset, whatever gain you are going to get is called as short-term capital gain. Now, sir, for which assets it is 1 year, for which assets it is 2 year, for who is it 3 years, sir? 1 year or 24 months will be for any securities other than units which are listed in recognized stock exchange of India. So if there are any securities which are listed in recognized stock exchange of India, then for them I will see the period of holding of 1 year. Units of equity oriented mutual fund, units of business trust of India, and zero coupon bonds. For all these items I will see what, sir? 1 year. I will see a period of 2 years in case of immovable property and in case of unlisted shares. Unlisted shares means what, sir? Those shares which are not covered above. Correct? Those shares which are not listed in Indian Stock Exchange or private limited company shares or shares of foreign company, etc. And 36 months is for all other type of capital asset. Okay, any other type of capital asset such as jewelry, painting, DJ pass, unlisted bonds, debentures, slum sale you are doing. For all those things are what time limit is 3 years. However, there is an amendment, major amendment in this chapter. What is that amendment, sir? If the transfer is after 23rd July 2024, if you are making a transfer of a capital asset on or after, if the transfer is on or after, if it is on or after 23rd of July 2024, now for all types of capital asset except this 4 capital asset, for all other types of capital asset, the period of holding will be taken as what, sir? 2 years. Meaning the concept of 3 years has been removed now. If the capital asset is held for more than, if the capital asset is transferred on or after 23rd July 2024, I will see a period of holding of what, sir? I will see a period of holding of 2 years only. I will see a period of holding of 2 years. To be called as long term, I will see period of holding of 3 years. 2 years. This 3 years condition has been removed now. If, sir, if the capital asset is transferred before 23rd July 2024, then what will I do, sir? Then this 3 years condition will be applicable. Now, next is section 48. Section 48 talks about what? Section 48 talks about computation of capital gain. How do I do the computation of capital gain? Lawmaker says, in case of short-term capital asset and in case of long-term capital asset. How do you do the computation of capital gain? Let us see. If it is a short-term capital asset, how to do the computation. If it is a long-term capital asset, how to do computation. Computation format is more or less same. Only one thing is going to change. First, you should take full value of consideration. From that, you subtract expenses incidental to transfer. You will get your net sale consideration. Full value of consideration, that is the price at which you have sold the capital asset, less expenses incidental to transfer. So for transferring this, for selling this, have you incurred any expenses? Expenses incidental to transfer. If you subtract, whatever is left over now will be called as your net sale consideration. It will be called as what, sir? Net sale consideration. From that, you subtract your cost of acquisition. You subtract your cost of improvement. Cost of acquisition means the purchase price, at the price at which you have acquired the capital asset. Less also subtract cost of improvement. Have you done any addition in the capital asset? If you have done any addition or any improvement, any renovation, add that cost also. Now, whatever amount you are getting is called as your gross capital gain. This is called as what's your gross capital gain. From this, you subtract your exemptions under section 54 series, section 54, 54B, E, C, etc. Under 54 series, whatever exemption, if you have taken that exemption, please subtract that exemption. Now, what is left over is called as your capital gain. This capital gain is short-term capital gain. Sir, how do I compute the long-term capital gain? Under long-term capital gain, also computation mechanism is same. Take full value of consideration, subtract expenses incidental to transfer, you will get net sale consideration. Subtract indexed cost of acquisition, subtract indexed cost of improvement. So here what is happening, sir? Instead of subtracting cost of acquisition, you are required to subtract indexed cost of acquisition. What lawmakers are telling is, because you have holded the capital asset for more than a certain period, I am going to give you the benefit of indexation. Because you have holded the capital asset for more than a certain period, I will give the benefit of indexation to you. Sir, what do you mean by benefit of indexation will be given, sir? Benefit of indexation means I will give you the benefit of inflation. See, whatever item you would have purchased 10 years back, if you go and purchase the same item today, you will not get it for the same amount. Meaning 10 years back, if you went 10 years back, if you go if you had been to any shop to have 2 idlis, the price of that 2 idlis at that time, and when compared to the price of those 2 idlis today, is completely different. It has increased now. It has increased now. Why, sir? Because of inflation. So lawmakers are telling, I will give that benefit of inflation to you here also. So I will take index cost of acquisition or index cost of improvement. Then whatever is left over here is your long-term capital gain. Exemption under section 54 series, if it is there, whatever is left over now after subtracting exemption is called as your taxable long-term capital gain. Sir, how do I take indexation, sir? Sir, you have told us that full value of consideration less expenses will give you net sale consideration, subtract cost, index cost of acquisition, cost or index cost of improvement, you will get your capital gain. But how do I take indexation, sir? Or what is my cost of acquisition, sir? Now, basically, indexed cost of acquisition means you should take the benefit of inflation. So you take your actual cost of acquisition, whatever is there, actual cost of acquisition of that capital asset, multiplied by cost of inflation index as on the year of transfer. What is the index for the year of transfer? The year in which you have transferred, they will give you cost of inflation index. So the year in which the transfer is made, the sale of capital asset is happening, in that year, what is the inflation index cost? Divided by cost of inflation index as on the date of acquisition. On the date when you purchase that property, what was the inflation index cost value? What was the cost of inflation index? You take that. You divide that. Now whatever you get is called as what, sir? Index cost of acquisition. Sir, repeat. Take the cost, multiplied by what, sir? Multiplied by index for the year of transfer, divided by index for the year of acquisition. That will give you index cost of acquisition. Then what is this index cost of improvement, sir? You take your normal cost of improvement. For that cost of improvement, multiply the index for the year of transfer, divided by index for the year of improvement. Sir, what is this index for the year of transfer and index for the year of improvement? I'm not getting this point, sir. Normally, they have taken year 2001-2 as the base year. They have taken which year, sir? They have taken 2001-2 as the base year. Cost of inflation index. If you see over here, they have taken a particular year as a base year. Which year, sir? The base year is 2001 and 2. So in the 2001-2, if you had 100 rupees, what is the value of that 2,100 rupees as on today? In the year 24-25, the value of the 100 rupees which you had in the year 2001-2, the value of that 100 rupees would be 363 rupees. So that is what, sir? This is your cost of inflation index. This is what, sir? Cost of inflation index, meaning in the year of transfer, what is the index? 363 divided by, for the base year, what was the index, or whenever you acquired it. So they will give in the question. You don't have to worry about that. They will give that information in the question. Now, sir, what if the capital, you said the base year is 2001-2, no sir? You said base year is 2001-2, and therefore from base year I should find the inflation. What if I had purchased the property before 2001-2? Will I not get the benefit of indexation? Lawmaker says you will get the benefit of indexation, but if the property is purchased before 2001-2, while taking the cost of acquisition, the cost of acquisition should be taken differently by you. If a capital asset is acquired before 1/4/2001, the cost of acquisition will be actual cost of that capital asset or fair market value of that capital asset as on 1/4/2001, whichever is higher. Sir, repeat, sir. If a capital asset is acquired before 1/4/2001, then the cost of acquisition of that capital asset will be what, sir? Actual cost of that capital asset or fair market value of that capital asset as on 1/4/2001, whichever is higher, or fair market value as on 1/4/2001, whichever is higher. Meaning you take the actual cost of that asset, or what was the market value of that asset as on 1/4/2001. Compare both of them. Now check who is higher. Take that whichever is higher portion. That will be your cost of acquisition. Now to this cost of acquisition, I'll apply this index for the year of transfer divided by index for the base year. Because it was purchased before 2001, you should take index for which year, sir? Base year. Now, very important point to be noted. If you have done any improvement before 1/4/2001, if there is any improvement done before 1/4/2001, that improvement should be completely ignored. Sir, improvement done after 1/4/2001, you can take the index cost of improvement for that. But any improvement done before 1/4/2001 should be completely ignored. Now comes the most important amendment. Hey, now comes what, sir? Now comes the most important amendment. What is that amendment, sir? What is that amendment, sir? Please tell us, sir. Amendment applicable for transfer of capital asset on or after 23rd of July 2024. What is this point telling, sir? No indexation benefit will be given. No indexation. Hey, no indexation benefit will be given. What will not be given, sir? Indexation benefit will not be given to you. No indexation benefit will be given if there is any transfer of a capital asset on or after
what, sir? No indexation benefit will be given to you if you have transferred any capital asset on or after 23rd of July 2024. Most important date. If any capital asset has been transferred on 23rd July 2024 or any time after 23rd July 2024, while computing the capital gain, even though it is a long-term capital gain, I will not give the benefit of indexation. Okay, very important point to be noted. Now let us continue. Now, what is the important amendment which is applicable with effect from 23rd on or after for transfer on or after 23rd July 2024? If there is a long-term capital asset, and if that long-term capital asset is any capital asset other than immobile property, if that long-term capital asset is any capital asset other than immobile property, if you transfer that, no, you will have to pay a tax at 12.5%, and there will be no indexation benefit given to you. Meaning, while computing the cap gain, the indexation benefit will not be given to you. And what is the tax rate you have to apply for that? 12.5%. Sir, what if I have you said any capital asset other than immobile property? Then what is the procedure which I have to follow for immobile property? For immobile property, what you are supposed to do is, for immobile property, check who is transferring that immobile property. Is it an individual or an HUF, or is it any other person? If that immobile property is transferred by an individual or HUF, then please note, whoever it is, whichever type of asset it is, for computation of capital gain, what you should keep in mind, for computation of capital gain, there is no indexation given to you. there is no indexation given to you. But however, if it is an immobile property which is transferred by individual and HUF, for computing capital gain there will be no indexation given, but for the purpose of payment of tax, the tax is required to be paid at the capital gain amount calculated, the tax amount calculated at 12.5% on the capital gain which was calculated without taking the benefit of indexation, or the tax calculated at 20% with the benefit of indexation. Compute the capital gain with the benefit of indexation and apply the tax rate of 20%, or apply the tax rate of 12.5% without taking the benefit of indexation. Now whoever is less in this will be the capital gain, which this is the whichever is less is the amount of tax which you have to pay. Please note that is only if it is an individual and HUF. Only if individual and HUF are transferring any immobile property, being land or building. Then for computation of capital gain, is there any change, sir? Sir, for computation of capital gain, is there any change? No. Then the change is for what, sir? The change is for payment of tax. When you are paying the tax, you should calculate the capital gain by taking indexation benefit, and tax rate will be 20%. If you are not taking indexation benefit, tax rate will be 12.5%. Now please note, above is only for computation of tax liability. Computation of tax liability. Computation of tax liability on capital gain, and not for computation of capital gain amount. Okay, not okay? This is very important, very critical. This is a place where mistakes will happen in life. Of course, we will do questions. I'm just going through some basic provisions before starting the question. Now, tax rates for capital gain, we will see this first before we start solving questions. Now, this is the major amendment which is there. You see this beautiful chart I have prepared only with respect to tax rates for capital gain. Tax rates for capital gain. Now, capital gain can be of two types: long-term capital gain or short-term capital gain. Now, let us talk about short-term capital gain because it is very simple. Now, if it is a short-term capital gain, if it is what? If it is a short-term capital gain and if the transfer is made before 23rd of July 2024, short-term capital gain transfer is made before 23rd July 2024, check whether it is taxable under 111 or 111A. If it is taxable under 111, tax rate is slab rate. If it is taxable under 111A, tax rate will be 15%. Sir, how will I come to know whether it is 111 or 111A? Normally, for any type of capital gain which is short term, tax rate is 111 tax. It is taxable at what rate, sir? 111. But there are only few items. There are these three items for which you are required to compute the capital gain. If you are getting these three items as capital gain, and if it is a short term capital gain, for that three items you will have to pay tax at what rate, sir? At 15%. Under which section? 111A. Which are these three items? Listed equity shares or units of listed equity shares on which security transaction tax has been paid, or units of equity oriented mutual funds, and units of business trust of India. Units of business trust of India. Only these three items: listed equity shares, units of business trust of India, units of equity oriented mutual fund. If you transfer these three items, instead of 111, the section applicable for you will be 111A, and instead of 112, the section applicable to you will be 112A. Similarly, if the transfer is on or after 23rd July 2024, short-term capital gain will be taxable at slab rates under 111, and if it is a short-term capital gain of 111A, it will be taxable at 20%. Sir, in simple words, I'll repeat. Short-term capital gain, if it is taxable under 111, irrespective of when the transfer is made, if it is taxable at 111, irrespective of when the transfer is made, the tax rate applicable to you will be what, sir? Slab rate. If it is taxable under 111A, then check when the transfer is made. If the transfer is before 1/4/2001, before 23rd of July 2024, then the tax rate will be 15%. If it is on or after 23rd July, then the tax rate will be 20%. Okay, sir, got it, sir. Similarly, if it is a long-term capital gain, Again, check the same thing. When was the transfer made? Is it before or is it after? If the transfer is made before 23rd July 2024, if it is a long-term capital gain taxable under 112, tax rate to be applied is 20%. If it is a long-term capital gain taxable under section 112A, tax rate will be 10% in excess of 1,25,000, and there will be no indexation benefit given for that. However, 20% indexation benefit will be given. Please note, I'm talking about transfer made before 23rd July. Indexation benefit is available. If the transfer is made by you on or after 23rd July 2024, if it is a long-term cap gain taxable under 111A, I will check whether it is immovable property of other assets. If it is other assets, tax rate is flat 12.5% and no indexation benefit will be given. If it is immovable property, if it is transferred by any person other than individual, then tax rate is 12.5% without giving indexation benefit. If it is transferred by individual or HUF, tax rate will be 20% with indexation, 12.5% without indexation, whichever is less. Sir, what if it is taxable under 112A? Tax rate will be 12.5% for income in excess of 1,25,000. No indexation benefit will be given. Now, what are the items covered under 112A, sir? Same items which are covered under 111A. Now, let me just explain this question to you, or let us just solve this question and accordingly get the answer. How to present in the examination, everything we'll learn. Mr. Champak purchases a house property for 3 lakh on 26th of May 1989. So can I say the property is purchased before 1/4/2001? The following expenses are incurred by him while making the addition and alteration of the house property. So some extra expenses he has incurred: construction of first floor, construction of second floor, and reconstruction of building. Fair market value of the property as on 1/4/2001 is 9.5 lakhs. The property is sold by Mr. Champak on December 10th, 2024 for 85 lakhs. And expenses incidental to transfer is 60,000. Compute the capital gain and tax payable thereon. Shall we compute it? I will explain you the entire format also, and let us also learn how to compute the capital gain. Please understand this carefully. Now this is how a question will be given in the examination. Now they have asked us to compute the capital gain. First of all, whenever now question on capital gain is coming, what are you supposed to do? First thing which you are supposed to do, you see what is the date of transfer. What is the date of transfer? He sold this capital asset on 10th of December 2024. On which date, sir? 10th of December 2024. Now what is 10th of December? 10th of December is what, sir? Can I say it is on or after 23rd of July 2024? Yes, sir. Shall we start the computation? We all know, we know if it is a transferred after 23rd, on or after 23rd July, then there is no indexation benefit given for computation of capital gain. Please note, my humble request, concentrate carefully. I am going to teach you how to solve this question in the examination. They have asked us to do both the things, compute capital gain as well as tax liability, correct? So very important question. Now, Ingepar students, please concentrate. Now, how will I answer this? I will first write name of the assessee compulsorily, Mr. Champak, previous year 24-25, assessment year 25-26. Then what are you doing? I am doing computation of income from capital gain, particulars rupees. First I will take full value of sale consideration or full value of sale consideration. Full value of consideration, what is the price at which I sold this asset? I sold it for 85 lakh rupees. From this I'll subtract expenses incidental to transfer. How much are the expenses incurred by me for transferring this capital asset? Sir, I incurred an expenses of 60,000 rupees. I'll subtract whatever expenses is incurred by me. Now whatever is left over is called as my net sale consideration, 84 lakh 40,000. What is net sale consideration, sir? 84 lakh 40,000. Now from this net sale consideration I should subtract my cost of acquisition, correct? Sir, no sir, index cost of acquisition, sir. No sir, it was purchased in 1989, you sold it in 2425, that is 10th of December 2024. So sir, it is more than 3 years sir, more than 2 years sir, it is a long term capital asset. Yes, but because the transfer is after 23rd July 2024, I will not get any indexation benefit. Now cost of acquisition, when I am taking, I should take cost of acquisition by writing a working note number 1. What will be my working note number 1? Working note number 1, since the asset is acquired before 1/4/2001, the cost of acquisition shall be equal to actual cost or fair market value as on 1/4/2001, whichever is higher. So what is my actual cost over here? 3 lakh rupees. And what is my fair market value as on 1/4/2001? As on 1/4/2001, the value of this item asset is 9,50,000, whichever is higher. So what is the answer over here? What is the answer, sir? So the answer is equal to actual cost will be, cost of acquisition will be equal to 9,50,000. Correct? So write over here 9,50,000. Then I'll subtract what, sir? Expenses is subtracted. Cost of construction of first floor. Will I take this first floor cost? Sir, because it was done in 92, 93, it was done before 1/4/2001, I will not take it. You will have to write a note for that. Note, improvement before 1/4/2001 is ignored. Correct. So cost of improvement in 92, 93, I will not take. Cost of improvement. Next, when did I do the improvement? In the year 2003-4. How much is the improvement done in 2003-4? In the year 2003 and 4, I have done an improvement of 5,30,000. Then cost of improvement is done. Reconstruction. I have done reconstruction. When did I do reconstruction? 2009-10. How much is the reconstruction cost? 2,90,000. So whatever is left over is my capital gain. Minus 9,50,000 minus 5,30,000 minus 2,90,000. 66,70,000. This is my capital gain. This is what? This is my capital gain. This is my income from capital gain. Is this clear to you all? This is what, sir? This is my income from capital gain. This is my income from capital gain. This is my income from capital gain. Any question? Any doubt? Any question? Any doubt? No. Now, if the question is only with respect to income from capital gain, this is your answer. In this question, they have also asked us to compute the tax liability. Correct, not correct? They have also asked us to find what, sir? Tax liability. Now, what is the tax which he has to pay? Computation of tax on capital gain. Since the transferred, this note you should write compulsorily. Since the transferred capital asset, is an immovable property, compulsory you should write this point. Since the transferred capital asset is what? It is an immovable property, comma, the tax payable shall be A or B, whichever is less. Tax at 12.5% on capital gain without indexation, or tax at 20% on capital gain with indexation. Now if anyone asks you what is the capital gain amount, it will be same. Now for computation of tax liability, I'll take without indexation, the capital gain is 66 lakhs 70,000 into 12.5%. Whatever amount is getting, whatever amount you are getting, that amount you will take. 66 lakhs 70,000 into 12.5%, 833 750. Next, now you should compute the capital gain amount by taking indexation benefit. Why, sir? To know the tax amount at 20%. Correct? No. Now you should compute the capital gain amount with indexation. So here, this is the major amendment. If it is an immovable property, if you are an individual and HUF, this is one major amendment. So now what am I doing, sir? I'm going to do the working again. What am I writing? See this carefully. Computation of capital gain with indexation only for tax purpose. This is not actual capital gain. This is calculated. This working I'm doing only for the purpose of computation of tax. Only for what purpose, sir? Only for tax purpose. So my full value of sale consideration, can I say it will remain same? My expenses incidental to transfer will also be same. Therefore, my net sale consideration will be 84 lakh 40,000. Now, I will not take indexed cost of, I will not take cost of acquisition. I will take index cost of acquisition. My cost of acquisition will remain same, 9,50,000. Now, I will multiply it by index for the year of transfer. What is the index for the year of transfer? 363. I got some amount. Divided by index for base year. Why base year, sir? Because asset was purchased before 1/4/2001. How much will I get? 34,48,500. Improvement done before 1/4/2001, ignore. Then improvement done in 2003, I'll take 5,30,000 into 363. Why, sir, 363? Index for the year of transfer divided by index for the year of improvement, 2003 4. How much is the index? 109 divided by 10. So this will come to how much? 5,30,000 into 363 divided by 109. 17,65,406. I'm just rounding off to the next number because it is 8.7. Then I will take what, sir? Reconstruction, 2,90,000 into 363 divided by index for the year of reconstruction 2009-10, it is 148. How much is the amount, sir? 7,11,284. Now what is the amount? Capital gain amount will be 84,40,000 minus 34,48,500 minus 17,65,046 minus 7,11,284, 25,15,170 is my capital gain amount along with indexation. 25,15,170 rupees. This is capital gain amount. What, sir? After taking indexation. Now, is this capital gain amount important for our? Is this my capital gain amount, sir? Taxable capital gain amount? No. This is the amount which I have taken only for the purpose of finding tax liability. How much is my tax liability? Let us do now. I'll take what, sir? 25 lakhs, 15,170 into, with indexation, tax rate applicable is how much? 20%. So this into 20%, 503,034, whichever is less is the tax payable. Therefore, capital gain tax is equal to 503,034. This is my capital gain tax. I hope this point is very clear to you all. Very important. One of the major amendment. I hope you have understood how to do the computation. Very simple question, but trust me, mistakes may happen if you are not confident with this. So this is what you are supposed to do. This is how you are required to calculate. Now notes are very important. Okay, notes are very important over here. Now we'll go to the next point for our discussion. Exception to section 45(1). Normally, what is section 45 subsection 1 telling, sir? Section 45 subsection 1 says capital gain tax you have to pay in the year when transfer is taking place. Correct? No. Section 45 subsection 1 talks about capital gain taxation. It says whenever you are earning any capital gain, on that capital gain you will have to pay tax in the year in which transfer took place. Normally capital gain is taxed in the year in which transfer took place. However, in the below cases are exception to this general rule. It is an exception. Exception means what, sir? In the below cases, capital gain will not be taxable in the year in which transfer took place. Capital gain will be taxable in the year when whatever this point is telling. Okay. Section 45(2). These 3 points are important. There are, of course, there are 3 more points, but not that important. These are the 3 points which they are going to test in examination on repeated basis. They test on this point only. Okay, section 45 subsection 2, conversion of capital asset into stock in trade. If you are converting capital asset into stock in trade, how do I do the computation? So conversion of capital asset into stock in trade. What is happening over here? Now I had a capital asset which I converted into stock in trade. Now we have studied somewhere that if you convert a capital asset into stock in trade, then that will be called as transfer. If there is any conversion of capital asset into stock in trade, that will be treated as transfer, and transfer will take place in which year? In whichever year the conversion is happening. Transfer will take place in the year in which conversion is happening. However, capital gain tax you will have to pay in the year when stock in trade is sold. I'll repeat once again. Whenever you are converting a capital asset into stock in trade, transfer will take place in the year in which conversion took place, and capital gain tax you have to pay in the year when stock in trade is sold. So can I say in the year when stock in trade is sold, there will be 2 types of income? In the year when stock in trade is sold, there will be 2 types of income. One is your capital gain income, another one is your business income. Okay, how will I calculate capital gain, sir? For calculating capital gain, you need full value of consideration. Correct? You will need full value of consideration. What is this full value of consideration, sir? This full value of consideration will be the fair market value of that capital asset on the date of conversion. On the date when you have converted this capital asset into stock in trade, what was the market value of this capital asset that you will take? From that you subtract any expenses incidental to transfer. You will get your net sale consideration. Subtract your cost or indexed cost of acquisition. Now please note, since the transfer has taken place in the year 1718, can I say indexation benefit will be given? Why, sir? Because the conversion took place before 23rd of July 2024. So will I get the benefit of indexation? Answer is yes, you will get the benefit of indexation in this particular case. Now what if the transfer happened after 23rd July, sir? I will not get indexation benefit. So I am going to take index value of I will take index cost of acquisition, and if cost of improvement is there, accordingly I will take cost of improvement or index cost of improvement, and I'll find my capital gain. And for business income, I'll take the sale price of stock in trade. I sold the stock in trade for 90 lakh rupees. Then what is the expenses incidental to sale? Have I any selling expenses are there? Nothing is there, sir. Then what will be the cost of acquisition of this business asset? Now, because it became my business asset, what will be cost of acquisition of this business asset? Lawmaker says the cost of acquisition of this business asset will be the market value of this capital asset on the date of transfer. On the date when you transferred this, what was the market value that will be taken as cost of acquisition? So if you subtract everything, you'll get your amount. So in the year of transfer, there will be two types of income. One is capital gain income, one is called as business income. Now, sir, what if? So, how do let us discuss the provision. I hope you have understood this explanation. Section 2 clause 47, which gives the meaning of transfer, it says conversion of capital asset into stock in trade is regarded as transfer, and transfer will take place in the year in which conversion is happening. However, capital gain tax is payable in the year when stock in trade is sold. When will transfer happen, sir? Transfer will happen in that year when conversion is happening, and capital gain tax you will have to pay when stock in trade is sold. So in the year when stock in trade is sold, you will have two types of income. One is your capital gain income, another one is your business income. Okay, sir, what if the stock which is there? No, sir, I sold, say I converted 100-acre land. What if I sell this 100-acre land in installment? First 20 acre, then 30 acre, then 40 acre. What if I sell it in installment? Lawmaker says, if the stock in trade is sold in installment or parts, capital gain shall also be taxable as and when the installment is sold. Meaning, if you have converted a capital asset into stock in trade, and at the time of conversion, as and when you are converting, as and when you are selling that capital asset, converted capital asset, as in that at that time you'll have to pay the taxes also on that capital asset. Next, okay, this question, anyways, question 2 is fine, important topic, but it is. Next, what, sir? Compulsory acquisition of capital asset under any law. Let us say this house belongs to me. Now government came and told me, Dilip, I want to construct an metro, or I want to construct some bullet train project on this particular land. Therefore, Dilip, I will have to take up your land. Therefore, I will have to take up your house. Whatever house is there, this is coming in between, I will take up this. So government has compulsorily acquired my capital asset. Lawmaker says, if compulsory acquisition of capital asset is happening under any law, then it is called as transfer. It is regarded as transfer. Transfer will take place in the year when compulsory acquisition happened, and capital gain tax is required to be paid by me. Please note, government will take the property from me now and pay me after 3 years. So will I be able to pay tax now when the government acquired the property? No, because I did not receive the money only. Money I am going to receive after 3 years. I will have to pay tax also after 3 years. Okay, in case of compulsory acquisition of capital asset under any law. Transfer will take place in the year in which compulsory acquisition has happened. However, capital gain tax will be payable in the year in which compensation has been received. Now, how will I pay the capital gain tax, sir? Let us say they transfer the compulsory acquired in the year 17-18, and they paid the compensation of 50 lakh rupees in the year 24-25. Now, whatever amount they paid is full value of consideration less any expenses if you have incurred for transferring this. You will get your net sale consideration, subtract index cost of improvement, index cost of acquisition, and index cost of improvement, if any. You will get your capital gain, long-term capital gain or short-term capital gain. Now, sometimes what may happen is government would have agreed to pay me 50 lakh rupees, but because I put a court case, government is giving me some extra compensation. Now, sir, whenever there is an extra compensation given to me, what will happen? Additional compensation of 15 lakh rupees is given. So the new compensation agreed by them was 65 lakhs. They have already paid 50 lakhs. 65 is new compensation. 15 lakhs is the extra compensation. So whenever you receive additional compensation, you take your additional compensation, subtract expenses incidental to transfer. Whatever you get now will be your long-term capital gain. Let us see the provision with respect to that. Compulsory acquisition of a capital asset into stock in trade is regarded as transfer. Transfer shall take place in the year in which compulsory acquisition happened. However, capital gain tax is payable in the year when compensation is received. If the capital gain tax will be paid when, sir? In the year when compensation is received. If the compensation is received in installment, what will happen, sir? If I receive the compensation in installment. If the compensation is received in installment, then capital gain shall also be if compensation is received in installment. If initial compensation is received in installment, total capital gain tax shall be payable when the first installment is received. Full entire amount of capital gain you will on capital gain tax you will have to pay completely whenever you receive the first installment. If additional compensation has been received in installment, the capital gain shall be payable. The capital gain tax shall be payable as and when you are receiving the amount. Sir, no, I didn't get this point. See, if I am selling the stock in trade in installment, I should pay capital gain tax as and when the stock in trade is sold. Correct? No. Previously we discussed. Now this point is telling, since government has already agreed for to pay you money and government has already acquired your property, here if you are receiving the compensation in installment, now the compensation are of two types. The first compensation or initial compensation or additional compensation. What are you receiving in installment? Sir, I am receiving initial compensation in installment. Lawmaker says, okay, I don't care whether you receive in installment or not. You will have to pay entire capital gain tax when you receive the first installment itself. Sir, what if I receive the additional compensation in installment? If you receive the additional compensation in installment, because there is no chance that you are going to receive this money, you pay the tax to me as and when this additional compensation is received. Now, normally what happens is government, how do I do the computation, sir? How do I do the computation? In case of initial compensation, how do I do the computation, sir? In case of initial compensation, computation is done like this. You take full value of consideration, subtract incidental to expenses incidental to transfer, you will get your net sale consideration. From that net sale consideration, subtract cost or index cost of acquisition, cost or index cost of improvement, you will get your capital gain. And when you are receiving additional compensation, from this additional compensation, you can subtract only one thing, which is legal charges or litigation expenses. That will give you capital gain. Now, what happens is government may delay in paying this money to you. Correct? No. Government may delay in paying this money to you. Because government is doing a delay in paying this money to you, government will give you also interest amount. Apart from the compensation, say government agreed to, say government took the compulsory acquisition in the year 2017-18, but it paid the compensation to me in the year 2025-26. Almost 7-8 years government has taken to pay the compensation to me. Lawmakers are telling, because there is a delay in payment of compensation, government will pay you interest. That interest also will be taxable. That interest will be taxable under which head, sir? That interest will be taxable under the head income from other sources. How much will be taxable? Whatever amount you are receiving into 50%. How much is taxable? Whatever amount is received by you into 50% will be taxable. Okay. Next, section 45(1) capital A. Insurance claim for damage or destruction of capital asset. If there is any damage or destruction of capital asset, and for damage and destruction of that capital asset, if you are receiving any insurance claim, if there is any damage or destruction of capital asset, and for that damage or destruction of capital asset, if you have received any insurance claim, then it will be treated as transfer. It will be treated as transfer. For example, I had a property. Now, this property is destroyed because of tsunami. This property is destroyed because of fire explosion, or some enemy has put a bomb, etc. Enemy attack has happened over here. So, lawmakers are telling this, by this, what will happen, sir? Your property will be damaged or destructed. Because your property is damaged or destructed, because your capital asset is damaged or destructed, I will treat it as transfer. Now, because it is a transfer, capital gain will come into existence. Now, capital gain tax, when you have to pay, sir, in the, if on this property, on this capital asset, if you have taken any insurance claim, whenever insurance claim is received by you, in that year you have to pay capital gain tax. Now, if there is any damage or destruction of capital asset, due to four reasons. Which are these four reasons? If there is any damage and destruction of capital asset because of natural calamities, enemy attack, riots and fire explosion, and insurance claim is received. And what, sir? You have received insurance claim for this damage and destruction. You have received insurance claim for this damage and destruction. Lawmakers are telling it will be treated as transfer. You will have to pay capital gain tax. Full value of consideration less expenses, you will get your net sale consideration, cost index cost of acquisition, cost index cost of improvement, you will get your capital gain amount. Now, one of the most important concept in your capital gain topic. What is that most important concept in my capital gain topic, sir? The most important concept in your capital gain chapter is 50C, section 50C, concept of stamp duty value. Concept of what, sir? Concept of stamp duty value. Concept of stamp duty value. Now, what is this concept of stamp duty value, sir? Now, normally what may happen is the person who is selling the property, he may show less sale price. Correct. He may show his sales price to be less. Why, sir? If he shows his sales price less, then his capital gain also will be less. So many people may do this cheating by reducing their capital gain. By reducing their selling price, they will reduce their capital gain. Lawmakers are telling. So we are introducing a new section called as section 50C. What is this section 50C telling? Concept of stamp duty value. What is this concept telling, sir? Concept of stamp duty value. Normally, full value of sale consideration is your sale price. However, if the stamp duty value is more than 110% of sale price, then the full value of consideration will be stamp duty value. Normally, what is my full value of sale consideration? Normally, what is my full value of sale consideration? Normally, my full value of sale consideration. What is my full value of sale consideration or full value of consideration, sir? The price at which I sold the asset. Correct? No. At whatever price I am selling the asset, that will be taken as my full value of consideration. However, if the stamp duty value of the property is more than 110% of sale price, you take sale price, multiply it by 110%, you will get some amount. If the stamp duty value is more than that amount which you have got, then the stamp duty value will be taken as full value of consideration. Okay. Now, sir, why is this concept even coming, sir? Because many people know they may hide their sale value or reduce their sale value purposefully so that they have to pay capital gain tax on lesser amount. So to catch those kind of people, lawmakers has got this provision. Okay. Concept of stamp duty value. Full value of consideration is equal to sale price normally. If stamp duty value is more than 110% of sale price, then stamp duty value will be taken. Sir, who is going to give the stamp duty value? The state government normally, or in our question, though, they will definitely give the stamp duty value. If they have given, then only this comparison you have to do. This, if they have not given, sir, you should not do comparison. Now, this section 50C concept is there. No, that is applicable only for immovable property and not any other type of capital asset. Okay. Now, let us see the provision with respect to that. Section 50C, it is applicable only for immovable property. Normally, the full value of consideration is the price at which the capital asset is sold. However, if the stamp duty value, is more than 110% of sale price, then the stamp duty value shall be taken as full value of consideration. If the stamp duty value is more than 110% of the sale price, what will be taken as stamp duty value? What will be taken as full value of sale consideration? The stamp duty value will be taken as full value of sale consideration for purpose of computation of capital gain. Now, the question which arises is, sir, what if genuinely I have sold the property at a price less than stamp duty value? Whatever stamp duty value is there, what if I genuinely sold the property at a price less than stamp duty value? Then you can go to the valuation officer. You can go to the assessing officer. Assessing officer will send you to whom, sir? Assessing officer will send you to the valuation officer. Now, valuation officer is giving his value to you. If the valuation officer's value is more than stamp duty value, then stamp duty value is full value of consideration. If the valuation officer's value is less than stamp duty value, then valuation officer's value will be taken as full value of consideration. Sir, wait. Now, I sold a property at a price less than the stamp duty value. Therefore, I went to the income tax officer. I requested him. Income tax officer went and asked me to meet whom, sir? Valuation officer. Now, the valuation officer gives his value. This value given by valuation officer is more than stamp duty value. Then I will take stamp duty value, no, because stamp duty value is less. The valuation officer's value is less than stamp duty value, then I will definitely take valuation officer's value because that is more beneficial to me. Sir, what if valuation officer's value is less than my sale price only, the price at which I sold? When I am only telling that I sold at this price, why will I take valuation officer's value if he is quoting less price? Now, sir, next point for me is, sir, which stamp duty value should I take, sir? Stamp duty value as on the date of agreement I should take, or the stamp duty value as on the date of transfer? See, normally you are supposed to take stamp duty value as on the date of transfer, which is the date on which you are going to sell the property, or that date you are going to register the property in that other person's name. No, so normally stamp duty values on the date of transfer should be taken. However, if on the date of agreement, if any amount has been paid by account pay check, account pay demand draft, or any other electronic clearing system, then the stamp duty value as on the date of agreement shall be taken. Okay, please note, it should be account pay check, account pay demand draft, or any other electronic clearing system. It should not be cash, bearer check, cross check. Cash, bearer check, cross check, if it is given in this, no, you should please ignore that. If it is given in cash, bearer check, cross check, etc., you please ignore it for your calculation. Now, one very important point wherein lot of students make mistake is, see, because this is a chapter which is a big chapter, lengthy chapter, as and when you are going to study this chapter, some extra points are going to come. Okay, so if you have not studied this chapter or revised this chapter throughout 2 or 3 times, you will feel difficulty. So it is better you read this chapter 2 or 3 times. It is even more better if it is even more better if you can watch this again and again 2 3 times. Okay, what is this? Fair market value as on 1st of April 2001 cannot be more than stamp duty value as on 1st of April 2001. Meaning what, sir? Normally, if a capital asset is acquired, if a capital asset is acquired before 1/4/2001, I take what, sir? If a capital asset is acquired before 1/4/2001, I will take the stamp duty value of that capital asset as its full value of consideration. Correct? No? Yes, sir. Correct. Absolutely correct. However, what they are telling is, however, when you are taking that fair market value as on 1/4/2001, you compare that fair market value with the stamp duty value as on 1/4/2001. Sir, why should I compare, sir? Lawmakers are telling you to compare. If the asset is an immobile property, you just take your fair market value as on 1/4/2001, compare it with your stamp duty value as on 1/4/2001, because the stamp duty value as on 1/4, the fair market value as on 1/4/2001 should not be more than the stamp duty value. If it is more, then take stamp duty value as your cost of acquisition. Therefore, what is the final impact of this, sir? What will be my cost of acquisition if any asset is purchased before 1/4/2001? It will be actual cost. That actual cost you should compare. First, you should compare fair market value as on 1/4/2001 with stamp duty value and take whichever is less. Whatever amount you have got now, that you compare with your actual cost and take whichever is higher. That will be your full value of consideration. That will be your cost of acquisition. Now, advance money forfeited. What is this advance money forfeited? I am giving you, say you came to purchase my property, you gave some advance to me. You came to purchase my property and you gave some advance to me. After giving the advance, you never came back. So what will I do, sir? I will keep that money for myself. That is called as advance money forfeited. So if any sale transaction for capital asset is happening, and because of that sale transaction, if any amount has come, if you have received any amount as an advance, and if that sale transaction does not take place, if you are refunding that advance which is received by you, at that time this concept of advance money forfeited, if you are not refunding that advance, then that time advance money forfeited concept will come. So advance money forfeited, if the advance money is forfeited before 1/4/2001, if you have received any advance and that advance is forfeited by you before 1/4/2001, reduce it from the cost of acquisition before giving the indexation benefit. Reduce that from the cost of acquisition before giving the indexation benefit. If the advance money is forfeited by you on or after 1/4/2001, then if you have received the advance on or after 1/4/2001 and therefore you have forfeited that, that will be directly taxable under section 56 to 10. Okay, advance money forfeited before, reduced from cost of acquisition before claiming indexation. Let us do one thing. We'll solve a question which has all the adjustment. This is a beautiful question which will cover all the adjustments which you have studied till now. Okay, very nice question. Now I don't have a pen. I'll do one thing. I will mark it for my reference. Now see over here. X purchases a house property in December 1993 for 5,25,000. The amount of 1,75,000 was spent on improvement and repairs, which was done in March 2020, 1997. I will ignore this because it is before 1/4/2001. Property was proposed to be sold to Mr. Z in the month of May 2006 and an advance of 40,000 was received. I was supposed to sell this property to Mr. Z, from whom I received an advance of 40,000 rupees. As the entire money was not paid by him, X forfeited the advance money and subsequently sold the property to Y in March 2025 for 58 lakhs. The fair market value of the property as on 1/4/2001 is 11,90,000. Stamp duty value as on 1/4/2001 is 12,90,000. And the stamp duty value at the time of sale also they have given, it is 64 lakhs. What is the capital gain? We are supposed to compute that, correct? Now, computation of capital gain, Mr. X, previous year 24-25, assessment year 25-26. Please understand this question carefully. This has all the adjustment which we have just now discussed, and it is a very good question. I'll tell you also how to write this answer, how to write the notes for this answer, because writing notes is very important in the examination more than the answer itself. Particulars, rupees. First, I'll take my full value of consideration. Now, what is my full value of consideration? My sale price is 58 lakhs and my stamp duty value on the date of sale is 64 lakhs. I will have to check whether section 50C is applicable or not. What is section 50C telling? If the stamp duty value is more than 110% of sale price, then the stamp duty value shall be taken as full value of consideration. What is my stamp duty value in this case, sir? What is my stamp duty value? My stamp duty value is 64 lakhs. What is 110% of sale price? It is equal to 58 lakhs into 110%. 58 lakhs into 110%. 63.8 lakhs. Correct. Can I say stamp duty value, which is 64 lakhs, is more than 63.8 lakhs? So what will be the full value of consideration, sir? It will be 64 lakhs. It will be what? 64 lakhs. So what is full value of consideration? 64 lakhs. Have you understood why we have written note number 1? Okay, you should write that note compulsory. That entire discussion which you have done, you should write that. Then from this I'll subtract expenses incidental to transfer. Have you incurred any expenses? Property was sold for this much. They have not given any expenses incidental to transfer, so we'll write it nil. Now please note, though the sale price is 58 lakhs, I have taken 64 lakhs. Why, sir? Because of section 50C. That is very important. Next, I'll get my net sale consideration. In examination, because you are going to get the question only once, you should write it completely. You should not write NSC, BSC, nothing like that. Okay, 64 lakhs. Next, what is the next point? Next is my cost of acquisition. Lest my cost of acquisition or index cost of acquisition. The property was sold in March 2025. So my note number 1, I'll tell you what notes you are required to write. I'll just give here. Note number 1 is for section 50C. stamp duty value. Note number 2 is for whom, sir? Note number 2, you are required to write note number 2 for your no indexation point. Since transfer is after 23rd of July 2024, no indexation benefit is available. No indexation benefit is available because the transfer is after this particular date. Indexation benefit is not given to them. Okay, yes sir. So let us do the computation. What is my cost of acquisition? That is note number 3. Cost of acquisition is equal to A, actual cost, B, in that B, because they have given even the stamp duty as value as on 1/4/2001, I will take stamp duty value also. So what is that, sir? I'll take fair market value as on 1/4/2001, compare that with stamp duty value as on 1/4/2001. What is the fair market value as on 1/4/2000? Actual cost is 5,25,000. Your 5,25,000, sir. 5,25,000. My fair market value as on 1/4/2001 is what, sir? 11,90,000. Stamp duty value is 12,90,000. So 11,90,000. 12,90,000. Whichever is less. How much, sir? 11,90,000. Compare with actual cost. Whichever is higher, what's our cost of acquisition is equal to 11,90,000. So this is note number 3, 11,90,000. Then I'll take my cost of improvement. There is an improvement done before 1/4/2001. I will ignore that. So cost of improvement, when was that improvement done, sir? 1997, note 4. What will be that note 4, sir? La 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 la. Any improvement done before 1/4/2001 should be ignored. Any improvement done by you before 1/4/2001 should be ignored. So I have ignored that. Then is there any improvement? Oh sir, there is a mistake in your answer, sir. What is the mistake? In the he proposed to sell the property to Mr. Z for in the year 2006 and he received 40,000 as advance money, which was forfeited by him. Advance money forfeited. Note number 5. Advance money forfeited before 1/4/2014 should be reduced from whom? Cost of acquisition. So here can I say my cost of acquisition will be different now? It should be less by 40,000. How much will I write, sir? 11.9 lakhs minus 40,000. I think all the points I have covered over here. Let us see the final answer. Therefore, my long-term capital gain is equal to 64 lakhs 11,000, 11 lakh 50,000, 52 lakh 50,000 is the answer. That is the answer for this question. 52 lakhs 50,000 rupees. Okay, see, if you see the answer, now the beauty of this type of question is they will come for 8 marks or 6 marks question. Okay, students will write only this much. No doubt their answer is absolutely right. and they'll feel very happy also. Students will feel very happy that, oh my god, I have got the right answer, I have got the correct answer in my examination. But how many marks do you think the student is going to get for this? 2 marks. I have written 5 notes. Each and every note will carry half mark, 1 mark, correct? So notes are very important in your examination. See full value of consideration, then note number 2 for cost of acquisition, note number 3, note number 4, note number 5, etc. Some stories we have to write. Then I added extra point telling what if it is a what is the minimum tax liability. For that you will have to compute the capital gain along with indexation and accordingly compute the capital gain. So see this, if I compute it with indexation, this will be the answer, 64 lakhs. So for whatever 11 lakh 50,000 I'll give indexation benefit, I'll get my capital gain amount to be equal to 22 lakhs 25,000. Now I'll take capital gain amount with indexation, without indexation, some amount, correct? Tax which is there is whichever is less. Now next one more chota simple concept of capital gain is what, sir? Transactions which are not regarded as transfer. So there are some transactions, these transactions are not at all treated as transfer. These transactions are what, sir? Not regarded as transfer, or they are not treated as transfer. Sir, which are these transactions which are not regarded as transfer? The transactions which are not regarded as transfer: any distribution of asset on total or partial partition of HUF. If HUF is getting partitioned, or the time of partition of HUF, if any assets are distributed to the members of HUF, then that is not regarded as transfer. Any asset is transferred by way of gift or will by an individual. If any individual is transferring the asset by way of gift or by way of will, that will not be regarded as transfer. Any succession, inheritance, devolution, etc. So by succession, inheritance, you are inheriting parents' property, not regarded as transfer. Distribution of any asset on liquidation of a company. There is a company which is getting liquidated. Because the company is getting liquidated, the company is distributing its assets to you. That is not regarded as transfer. Transfer upon revocable or irrevocable trust. Meaning, if you are transferring any asset to someone with a condition that you are going to take back this asset on a future date, that is revocable trust. If you are transferring any asset with a condition that I am not going to take this asset from you anytime in future, that is irrevocable trust. Or transfer of asset by holding company to the subsidiary company, or transfer of asset by subsidiary company to holding company, amalgamating company to amalgamated company, or demerged company to the resulting company, etc. Or an individual is transferring his own property to the HUF. These all transactions will not be regarded as transfer. They will all not be regarded as transfer. Now please understand this carefully. What happens in this situation, sir? In this kind of situation, what should I do, sir? In this kind of situation, what are you supposed to do? Let us say Rakshit transferred his property to Rashmika. He gave his property as a gift to Rashmika. Can I say because he gifted the property for Rakshit, there is no transfer? Since there is no transfer for Rakshit, there is no capital gain in his hand. Now Rakshit had sold this property to whom, sir? Vijay. Rashmika sold this property to Vijay. Now when she sold the property to Vijay, there is a transfer. She sold it for 75 lakhs. Now the question over here is, since Rashmika got this property for free, what will be the cost of acquisition for Rakshita? Will it be 0 or will it be any other amount? Further, when I am going to check whether it is a long-term capital asset or short-term capital asset, should I see it from the date when Rashmika became the owner, or should I see it from any other date? Then, if any improvement is done by Rashmika as well as the last owner, should I take both the improvements while calculating capital gain, or should I take improvement only done by one person? So for all these questions, the answer is given by whom, sir? The answer is given by a section called as section 49(1). So in no transfer cases, there are two persons now. Who are these two persons? One is called as previous owner, and the person to whom the property is transferred by way of gift, etc. In no transfer cases, whomever I am giving this property, that person will be called as what, sir? Present owner. Now, what is the provision telling? The cost of acquisition for the present owner, meaning for Rashmika, what will be the cost of acquisition? The cost of acquisition for Rashmika shall be cost to previous owner. Cost of acquisition to Rashmika will be what, sir? Cost to previous owner. The period of holding to Rashmika will be the period of holding of present as well as previous owner. Cost of improvement to Rashmika will be cost of improvement done by present as well as previous owner. Meaning, what they are telling is, if you want to see the acquisition cost for the present owner who got the asset by way of gift for free, the cost for that person will be whatever was the cost of asset for the last owner. Then the period of holding for this asset will be whatever the period of holding was there for the last owner. Then the cost of improvement will be whatever cost of improvement was there for the previous owner. And now comes the question with respect to indexation. Sir, from which date can I take the indexation? Indexation, only with respect to indexation, this provision says I will not give you indexation from previous owner. I will give the indexation benefit from you to you from the date when the asset was first held by the assessee. I will give indexation benefit from which date, sir? From the date when the asset was first held by the assessee. However, there is one case law called as Manjula Jeshaw case law. What is this Manjula Jeshaw case law telling, sir? Indexation benefit will be given from the date of previous owner. But then in examination, which should I follow this or the normal point, sir? You should normally follow this point because this is given in the law. This is given in the law. Indexation benefit will be given from the date when capital asset was first held by the previous owner. However, CA inter students are there, no CA inter students. For them, you can either follow this or you can follow Manjula Jesha. There is no problem because in CA Institute, what they do is they give alternative question for each answer. Anyways, I mean that is with respect to CA inter students, but what you are supposed to follow, sir? You are required to do what, sir? You are required to take indexation benefit from the date when the asset was first held by the assessee, meaning to check whether it is long term or short term, I will take the period of holding from the last owner, but to take the benefit of indexation inflated cost, I will take it from the date when Rashmika became the owner. And similarly, if the property was purchased by the previous owner before 1/4/2001, can Rashmika take the fair market value as on 1/4/2001 benefit, sir? Lawmaker says yes, she can take. Benefit of fair market value as on 1/4/2001 is available. Now, so these types of questions are the question. If we start discussing, normally it takes around 15-20 minutes. I mean, we'll just take one chota simple question. Mr. Dinesh received a vacant land as gift from his brother in the year 2006. The site was acquired by the brother in the for 7 lakh rupees in April 2002. Dinesh constructed the residential house. Dinesh constructed. I'll take up this question. This is a good question, big question. And I have done this question under both the methods, following Manjula also as well as normal also. So Rakesh purchased a house property on 14th of April 1999 for 1,05,000. So it is before 1/4/1999. He entered into a contract to sell this property and received an advance of 25,000 rupees. However, he did not remit the balance amount. The Rakesh forfeited the advances. So Rakesh forfeited the advances. Okay, and it was before 1/4/2014. Later, he gifted the property to Mr. A. Now please note, whenever there is a property gifted to someone, if the advance money is forfeited by the previous owner, that advance money forfeited by the previous owner should be ignored. Following renovations were taken by Rakesh and A. Fair market value of the property as on 1/4/2001 is this much. Stamp duty value as on 1/4/2001 is this much. What will I take? Whichever is less, I'll take this one. This 1,40,000. Compare that with my actual cost of acquisition, which is 1,05,000. Whichever is higher is 1,40,000. This will be my cost of acquisition of the property. Mr. A entered into an agreement with Mr. C to sell the house on 1st of June 2022 and received an advance of 80,000 rupees. The said amount was forfeited by Mr. A since he could not fulfill the terms of the contract. Now this person himself, who the new owner, he also forfeited some advance, but this advance money was forfeited after 1/4/2014. What will I do to this, sir? You should tax it under income from other sources in the year of receipt. The said amount was forfeited, etc. Finally, the house was sold by Mr. A to Mr. Sanjay on 2nd July for 25 lakhs. Compute the capital gain. When did he sell, sir? 2nd of July. Can I say it was sold before 23rd of July 2024? If it is sold before 23rd July 2024, you should be very happy because indexation benefit will be available. Now, Mr. A, previous year assessment year, computation of capital gain, full value of consideration 25 lakhs, expenses incidental to transfer, nothing is there. Therefore, net sale consideration is 25 lakhs. From that, I'll subtract cost of acquisition. Cost of acquisition will be actual cost or fair market value, stamp duty value, whichever is less, that will be compared with actual cost, whichever is higher. I'll take index cost of acquisition. Why say index cost of acquisition? Because transfer is before 23rd of July. Then I'll take cost of index cost of improvement in 2001 2 because it was before 2001 ignore. 2003-4 I'll take index cost. 2013-14 also I'll take index cost of improvement. So I'll get some answer which is 16,21,773. So these are the different notes which you have to write for this question. Which notes, sir? One is with respect to cost of acquisition because it was acquired before 1/4/2001. Advance money forfeited by the previous owner. One note you should write that it should be ignored for new owner. Then advance money forfeited by present owner that is required to be taxed under income from other sources in the year of receipt. That should be a note. Improvement done before 1/4/2001 ignored. Computation of capital gain is done by following. So this note you should write. Computation of capital gain is done by following section 49(1). So if Manjula is followed, you should write that Manjula case law. But what is important over here is 49(1). Now, there is one more concept called as concept of slum sale. Sir, what is slum sale, sir? Slum sale means transfer of a undertaking without assigning values to individual assets and liabilities. Meaning, you're transferring one undertaking. You're transferring an undertaking. You're transferring a unit of the business without assigning values to individual assets and liabilities of that business. Slum sale means transfer of an undertaking without assigning values to individual assets and liabilities. Computation of capital gain in case of slum sale. Particulars rupees, full value of consideration. What is full value of consideration in case of slum sale? It is fair market value as per Rule 11 UAE. From that, subtract expenses incidental to transfer. You will get your net sale consideration. Subtract cost of acquisition. You will get your cost of acquisition is nothing but net worth. You will get your what, sir? You will get your capital gain long term or short term. To check whether capital gain is long term or short term, you should see the period of holding of undertaking transferred. If the period of holding of undertaking transferred is more than 3 years or 2 years, it will be long term. If it is less than 2 or 3 years, it will be short term. Therefore, short term and long term cap gain will come as it is. Now, what is full value of consideration? Full value of consideration is fair market value as per Rule 11 UAE. What is Rule 11 UAE telling? That you learn in your final level, but here two fair market values will be given, fair market value 1 and fair market value 2. You should do the comparison and take whichever is higher. Then what is my cost of acquisition? Your cost of acquisition is nothing but net worth of the company. What is net worth, sir? Assets minus liabilities of the company. Assets means what, sir? All the assets you should take. If it is depreciable assets, take the WDV of that asset as per the income tax law, and if it is any other asset, you take the book value of that asset, and you should subtract from it what, sir? You should subtract from it what you should subtract, sir? Value of liabilities, external liabilities, whatever is payable by you to outsiders. All liabilities should be taken at book value except shareholders funds because it belongs to the shareholders, and that difference will give you net worth of the company. What is the capital gain? Take cost of acquisition, subtract incidental expenses incidental to transfer. You will get your net sale consideration. Subtract net worth. You will get your long-term capital gain. Now, some important points to be noted. Slum sale is transfer of entire business. Therefore, even stock will get transferred. The stock which is getting transferred that under slum sale will also be taxable under the head capital gain. Revaluation of assets should be completely ignored. No indexation benefit is available in case of slump sale. Whenever there is a slump sale happening, indexation benefit will never be given. Section 35, if any asset for which you have taken benefit under section 35 AD of PGBP topic, then the value of that asset should be taken as nil in computation of slump sale. Then in case any intangible assets is also transferred in slump sale, meaning if you have any intangible assets, the cost of that intangible assets, if it is self-generated, take it to be nil. If it is purchased by you, then take it, the cost of acquisition of that item to be purchase price. Meaning when you are taking over here value of asset, no, if you have an intangible assets which is self-generated by you, take the cost to be nil. If the intangible asset is purchased by you, take its cost of acquisition to be purchase price. Now revaluation should be ignored. One question I'll do better for one easy calculation for your easy understanding, because this slump sale is a very beautiful and simple concept. Now Mr. A is a proprietor of Akash Enterprises having 2 units. He transferred on 1/4/2024 his unit 1 by way of slump sale for a consideration of 25 lakh. The fair market value of the capital asset of unit 1 as on 1/4/2001 is 30 lakhs. Now what is happening over here? See, they have given you full value of consideration. What they have given, sir? Fair market value of unit transferred and fair market value of capital asset. Whichever is higher I should take, 25 lakhs or 30 lakhs, whichever is higher. Who is higher? 30 lakhs is higher. Then expenses incidental to transfer is 28 lakhs. I have taken 28 lakhs. Now there are 2 units. He has transferred only one of the unit, correct? So here information you should be very careful whether you should take unit the information of unit number 1 or unit number 2, because only unit number 1 information is required to be taken by you. So own capital, revaluation reserves, bank loan they have given, credit bank loan they have given, unit 1 is only 70%, trade creditors they have given, unit 1 is only 25%, building of unit 1, machinery of unit 1, debtors of unit 1, other assets of unit 1 includes patent also. Revaluation reserve is created by upward revaluing building of unit 1. So whatever revaluation reserve you are seeing, this building of unit 1, what is recorded at 12 lakh rupees was increased by 3 lakh rupees. Revaluation should be ignored. So when I am taking the value of building, I will take 12 lakh minus 3 lakh. How much, sir? 9 lakh rupees. No individual assets of no individual value of asset is considered for transfer D, meaning they have not assigned values to any individual assets and liabilities. They have not assigned any values. Other assets of unit 1 include patent acquired on 1/7/2022 for 50,000 rupees, on which depreciation is charged, on which no depreciation is charged. Meaning normally patent are depreciable assets. We know in slump sale when we are transferring depreciable assets, we should take what value, sir? We should take their WDV as per income tax law. Now because they have not depreciated it at all, we will now depreciate it and find the value. Take 50,000 which is the cost of acquisition, subtract previous year 22-23 whatever depreciation is there, 25% is the rate of depreciation, and for the next year also whatever depreciation is there, you will get your cost of that asset as on the date of transfer. Now let us do the computation. So we have read the question. How will I take, sir? I will take full value of consideration. As I told you, what is full value of consideration? 25 lakhs or 30 lakhs, whichever is higher. What is higher, sir? 30 lakh rupees. Less expenses incidental to transfer. The question says the expenses incidental to transfer is 28 lakhs. Let us subtract that. I will get my net sale consideration. How much is that, sir? 30 lakhs minus 28 lakhs, 28,000, 29 lakhs 72,000. Now I will have to subtract cost of acquisition, which is nothing but net worth of the company. What is net worth? Assets minus liabilities. What is the assets, sir? I'll take building. How much will I take, sir? 12 lakh minus 3 lakhs, 9 lakh rupees. How much building value will I take? 9 lakh rupees. Okay, building value I have taken. Machinery, how much will I take, sir? Book value 3 lakhs. Debtors, book value 1 lakh. Other assets, I will take 1.5 lakhs minus 50,000 of patent, because patent I will have to take depreciable value. I'll subtract. I'll take that patent separately. So how much is this amount? This amount comes to 1 lakh rupees. Then patent, I'll take depreciable amount 28,125 rupees. Correct? Yes, sir. Correct. So I'll do the total of this. The total of this is how much? 9 lakh plus 3 lakhs plus 2 lakh plus 28,125. 14 lakh 28,125. Less what will I do? Bank loan. 2 lakhs is a loan. 70% is for what, sir? 2 lakh is the loan. 70% is for unit 1. 2 lakh into 70% is 1,40,000. And then trade creditors. How much? 1,50,000 into 25%. 37,500. 14,28,125 minus 1,40,000 minus 37,500. 12,50,000. 12,50,625 is my cost of acquisition. Subtract that. 17,21,375. So this is what, sir? This is my long-term capital gain. Sir, indexation you have not given, no, sir. You will not get any indexation. So this is the answer for this question, etc. Now, there are some intangible assets. What is the cost of that intangible assets? Goodwill of business or profession, trademark, brand name, patent, copyright, or right to carry on business, tenancy right, LUMARs, or for route permits. In case of all the above intangible assets, the cost of acquisition, if it is purchased, it will be purchase price. If it is self-generated, the cost will be nil. Why, sir? Nil, because it is self-generated. You would have not incurred any cost to generate something. If the above capital assets are acquired before 1/4/2001, then the fair market value as on 1/4/2000 benefit will not be available, because it will not be there only. No, it will be individually separate for every businesses. Now there are some assets for which indexation benefit will not be given to you. Never. Which are those assets, sir? Devgans, debentures, equity shares which are listed in recognized stock exchange of India, virtual digital assets, global depository receipts, non-resident for which you are computing capital gain in foreign currency and in case of slump sale. Then note. Now we know that if any asset is transferred on or after 23rd July 2024, indexation benefit will not at all be available for that asset. Indexation benefit will not be available for any type of asset. Next, capital gain for shares and securities. Sir, how do I compute capital gain for shares and securities? Now, if it, see, for computation of capital gain for shares and securities, if it is unlisted shares, no, then nothing is changed. Unlisted shares are taxable under 111A and 112A. What? Nothing is changed, sir. Whatever your cost is there, whatever your sale price is there, you check that. If the transfer is made before 23rd July, you will get indexation benefit. Transfer made after 23rd July, you will not get any indexation benefit. Take your full value of consideration, which is your sale price. less your expenses incidental to transfer, if any, you will get your net sale consideration. From that, subtract cost of acquisition or indexed cost of acquisition. You will get your capital gain. Now you will subtract index cost of acquisition if the transfer is before 1/4/2000, before 23rd July 2024. If it is on or after 23rd July 2024, you will not take index cost of acquisition, you will directly take cost of acquisition. Sir, what if it is a listed share, sir? If it is a listed share, then you will not get indexation benefit, and security transaction tax which is paid by you for sale of that particular item will not be taken as expenses, and this item will be taxable under 111A or 112A. So you will not get any indexation benefit. Okay. So whenever you have transfer, whether it is before or after, it does not matter. You will have to take your sale price, subtract the cost, you will get your capital gain. No indexation benefit. What about debentures, sir? Debentures also, in case of debentures also, computation is very simple. Same computation. Sale price minus purchase price into number of unit transferred will give you capital gain. No indexation benefit is available for debentures. Now, the important point is what, sir? The important point is bonus shares and right shares. Bonus shares or right shares. Bonus is issued before 1/4/2001 or bonus is issued on or after 1/4/2001. If bonus is before 1/4/2001, lawmaker says the cost of acquisition of those bonus shares. If the bonus is when, sir? Bonus is before 1/4/2001, cost of acquisition will be actual cost or fair market value as on 1/4/2001, whichever is higher. If the bonus is issued on or after 1/4/2001, the cost of acquisition will be nil. Cost of acquisition will be nil. Why, sir? Bonus is something which you are getting for free. Bonus shares are something which you are getting for free. The cost of acquisition of that will be taken as nil if it is issued by the company to you after 1/4/2001. If it is issued before, then the cost of acquisition will be taken as what, sir? Actual cost. Shareholders exercise. Now there is something called as right issue also. Now here also two things can happen. The shareholder may exercise the right or the shareholder may not exercise the right. If the shareholder is exercising the right issue means what, sir? Company is issuing its shares at a price less than. The company is issuing its shares at a price before giving the shares of the company to the open market. The company will give before giving the shares by the company to the open market. What will the company do, sir? The company will ask their shareholder that whether you want the shares of my company, whether you want the shares of the company, they will give the right to the shareholder. So if the shareholder has an option to either accept the right or they can reject the right. If they are accepting the right, very good. If they are rejecting the right, then also very good. Right shares. In case of right shares, what is the cost of acquisition for the shareholders? What is the cost of acquisition? The cost of acquisition for the shareholders, shareholder has exercised the right. The cost of acquisition will be whatever right issue price shareholder has paid to the company for those shares. The right issue price paid by him to the company, that will be taken as cost of acquisition. Then what if the shareholder is not exercising the right, but he is transferring his right to someone else? If you are transferring your right to someone else, lawmaker says in such cases, then it will be treated as a relinquishment of capital asset. If it is a relinquishment of capital asset, it is treated as transferred. Whatever amount you have got to know from the person to whom you have transferred the right, that amount will be fully taxable in your hands as short-term capital gain. And the person who is purchasing the right from you, for him cost of acquisition will be whatever right issue price he has paid company and whatever renouncement price he has paid to you. Now, let us say there is a proviso to section 48. Section 48 is there. Section 48 has a proviso. What is this proviso to section 48, sir? Sometimes it may happen that non-resident may invest the money in the Indian stock market. So when they are investing the money in their Indian stock market, due to fluctuation in foreign currency, what may happen, sir? Due to fluctuation in foreign currency, the capital gain amount may be there in Indian rupees, but in foreign currency amount, if you calculate the capital gain, there will be no capital gain. So what is lawmaker telling in this regard, sir? Lawmaker says there is a proviso to section 41, section 48. First proviso to section 48. For example, there is this lady who gave me $1 lakh and she told me to invest in some company shares. I invested that money in the shares of Priya Sarees Private Limited. So at the time when she gave the money to me, the price of price of $1 was 60 rupees. Therefore, how much money I got in total, sir? 60 lakh rupees. I invested 60 lakh rupees in shares of Priya Sarees and I got 20,000 shares. I sold 20,000 shares at rupees 3. I sold all these 20,000 shares for 360 rupees, and I got 72 lakhs. 72 lakhs minus my cost is 60 lakhs. I gained 12 lakhs in Indian rupees. But when I gave the money to her, at that time the exchange rate was 75 rupees per dollar. Therefore, I could give only $96 to her. She gave me $1 lakh. I gave her $96. But if you see in Indian rupees, I have made a profit of 12 lakhs. But if you see in foreign currency, I have made a loss of 4 lakh rupees. So in such cases, what should I do, sir? Should she pay tax in India or not? Lawmaker says, in such scenarios, section 48 has a proviso which says computation of capital gain in case of non-resident where buying and selling of shares is happening in foreign currency. Computation of capital gain, you will have to compute the capital gain in foreign currency. Only if she is earning a capital gain, if she is making any income while computing the capital gain in foreign currency, then only it will be taxable, or else it will not be taxable. Okay, sir. I will take full value of consideration by taking average exchange rate as on the date of transfer. On the date when I have transferred these shares for 72 lakhs. Now, will I take 72 lakhs as my full value of consideration? Answer is no. This 72 lakhs I'll convert in that foreign currency in which she has invested. So it can be dollars, pounds, euros, whatever foreign currency is there. How will I transfer? How will I convert this, sir? While converting this, I will take average exchange rate as on the date of transfer. Any expenses related to transfer, if I am taking, for expenses also I will take average exchange rate as on the date of transfer. I'll get my net sale consideration. Now I got my cost of acquisition. What is my cost of acquisition, sir? Cost of acquisition which when you are taking, no indexation benefit will not be given to you. You should take average exchange rate at the date of acquisition. So whatever cost of acquisition is there, divided by average exchange rate at the time of acquisition, you will get some amount. So what is this average exchange rate? Average exchange rate is TT buying rate, TT selling rate divided by 2. TTBR, TTSR divided by Q. Sir, can you please explain with an example? Sakira, a non-resident, acquired shares of Priya Sarees at 75,000 on 15th of July 2017. She transferred all the shares on 31st of December 24 for 5 lakh rupees and expenses incident to transfer was 2 lakh rupees. They have given exchange rate as on the date of purchase and exchange rate as on the date of sale. I should take average exchange rate. So average exchange is what, sir? 50 plus 52 divided by 2. 63 plus 65 divided by 2. Now we know that the sale price is how much? 5 lakhs. When the sale price is 5 lakh, I should convert it into Indian rupees. Full value of consideration, I should convert into foreign currency. They have given in Indian rupees, I should convert in foreign currency. I'll take 5 lakh rupees divided by exchange rate as on the date of transfer, 64. I'll get some amount. Similarly, there is some expenses incidental to transfer, that also I should convert in Indian rupees, which will be 312,50, meaning 312.50 paisa. I'll get net sale consideration. From that, subtract cost of acquisition. Once I subtract cost of acquisition, I will get what, sir? My long-term or short-term capital. If it is a gain in foreign currency, then only I have to pay taxes in India. Now section 50 CA is there, which says in case of unlisted shares, the full value of sale consideration will normally be sale price, but if the full value of consideration, if the fair market value of those shares is more than 110% of sale price, then the fair market value will be taken as full value of consideration, just similar to your concept of stamp duty value. 50D says if the consideration is not determinable, then the consideration will be the market value of the asset which is transferred. Then section 50AA says in case of some assets, in case of these assets, indexation benefit will not be available. Specified mutual funds, market linked debentures and unlisted shares. And in case of these three assets, very important, the capital gain will always be short term capital gain irrespective of the period of holding. Irrespective of how much period you have holded the asset, the capital gain amount will always be short term capital gain. Okay, sir. Now exemptions, in capital gain there are exemptions. Most important exemptions I'll cover. Okay, there are a lot of exemptions, but all the exemptions are not important. Important exemptions I'm covering over here. Section 54, very important exemption. Section most important is 54, 54 EC, 54 F. Very important. Section 54 talks about what, sir? Exemption for residential house property. What is this exemption telling? This exemption says if you are an individual or an HUF, if you have a residential house property, if you transfer that residential house property, by transferring that residential house property, if you get any gain, that long-term capital gain will be exempt if you acquire another one residential house property in India. Now, how much will be, when should I acquire that another one residential house property in India, sir? Within 2 years from the date of transfer you should purchase, or within 1 year before the date of transfer you should purchase. And if you are constructing that, then within 3 years from the date of transfer you should construct. Then this new asset which you have purchased, new property which you have purchased will have a lock-in period of 3 years. Lock-in period of 3 years means what, sir? If the new residential house property is transferred within a period of 3 years, then the capital gain exempted earlier shall be reduced from cost of acquisition of the new house property. Meaning, if this new house which you have purchased, if you sell within 3 years, then whatever purchase price is there, while taking that purchase price for computation of capital gain, you should take cost of acquisition. While taking that cost of acquisition, please subtract whatever exemption I had given you earlier. Sir, how much will be amount of exemption? Amount of exemption will be your capital gain amount or your amount invested by you in new property or in capital gain account scheme, or a limit of 10 crore rupees, whichever is less. Now please note, normally you can purchase only one residential house property, but once in a lifetime offer is there. Once in a lifetime you can, if your capital gain amount is up to 2 crore rupees, you can purchase 2 residential houses instead of 1. But this is available only once in your lifetime. Now see over here. Ravi owns a residential house which was purchased in 1975 for 80,000. Fair market value is 2 lakhs. Stamp duty value is 1.9 lakhs as on 1/4/2001. The house was sold by him on 16th of July 24. Indexation will be available for 27 lakhs. Brokerage was 15,000. Now what has happened? Full value of consideration 27 lakhs 15,000. Net sale consideration is 26 lakhs 85,000. Index cost of acquisition will be 6,89,700. Gross long-term capital gain is this amount. Exemption will be capital gain amount or amount invested. How much he has invested? 5 lakh rupees or limit of 10 crores, whichever is less, which is 5 lakh rupees. Long-term capital gain will be 14,95,300 rupees. Tax rate they have not asked, but if they ask that amount. Now what they have told is this asset which was purchased by them, new asset, is sold for 9 lakh rupees. Now what will happen? 9 lakh is my sale price, less expenses will give me net sale consideration of 9 lakh. From this subtract cost of acquisition. 5 lakhs minus 5 lakhs is cost of acquisition. 5 lakhs minus 5 lakhs, why sir? Why? Because actual cost is 5 lakhs. Exemption, because it is sold within 3 years, exemption which is given earlier to you is withdrawn. So your cost of acquisition will be 9 lakh rupees. Now, since the new residential house property is sold within a lock-in period of 3 years, exemption given earlier will be withdrawn. Next. Section 54B, not that important. Exemption for urban agricultural land. If you are an individual and HUF and if you have an urban agricultural land, if you transfer that urban agricultural land, by transferring that urban agricultural land, any type of capital gain, it is long term or short term, that long term or short term capital gain will be exempt. How much will be exemption, sir? Capital gain amount or amount invested by you in capital gain account scheme or in new property, whichever is less. That exemption will be available if you purchase within 2 years from the date of transfer. You purchase one more residential house property. This new agricultural land which you have purchased, no, not residential house property, if this new agricultural land which is purchased by you should not be transferred over a period of 3 years from the date of acquisition. If you transfer, then whatever capital gain was exempted earlier will be reduced from cost of acquisition. Sir, how will I come to know whether it is an urban agricultural land or not? Urban agricultural land means the land should be used for the purpose of agriculture 2 years before the date of transfer. Section 54D, not that important. Sale of industrial land or building or both. Any type of assessee, all type of assessees having industrial land or building or both, if it is compulsorily acquired, then it will be treated as transfer, and that will be treated as transfer. That's whatever capital gain you have got, short term or long term, that short term or long term capital gain will be exempt if you acquire within 3 years from the date of receipt of compensation another industrial land or building or both. Now 54 EC, very important. Section 54 EC says, if you transfer any immobile property and invest in government bonds, then I will give you exemption. It is applicable to all type of assessees for if they transfer any immobile property. If any type of assessee is transferring an immobile property, and by transferring that immobile property, if they are getting any gain, any type of all type of assessees, if they are transferring immobile property, by transferring immobile property, if they are getting any gain, that capital gain will be exempt if they invest their money in government bonds. How many bonds are specified? 4 bonds are specified. Which are those 4 bonds? For NHAI, RECL, PFCL, IRFCL. If you invest your money in these 4 bonds, then your capital gain amount will be exempted. Here capital gain account scheme account is not applicable. How much is the exemption available, sir? Very important. Capital gain amount or amount invested by you or 50 lakh rupees, whichever is less. Now here the new bond, government bonds which you have purchased, now on this government bond there is a lock-in period of 5 years. What is this lock-in period of 5 years is telling, sir? You should not sell these bonds within a period of 5 years, or you should not convert them into money within a period of 5 years. What if I do that? Whatever capital gain was exempted earlier will be taxable. Another one important section is section 54F. What is section 54F telling, sir? Section 54F says exemption for transfer of any type of long-term capital asset. If you are an individual or HUF, if you have any type of long-term capital asset except a residential house property, and if you transfer that long-term capital asset, by transferring that long-term capital asset, if you acquire one residential house property in India, then that will be exempt. If you that will be exempt. When will I get the exemption, sir? How much will be the exemption? If you purchase within 2 years or purchase 1 year before the date of transfer, and for construction it is within 3 years from the date of transfer. Now please note, how much will be the amount of exemption? Amount of exemption will be, if the amount invested by you in the new residential house property is equal to net sale consideration or more than net sale consideration amount, then whatever capital gain amount is there, it is fully exempt. If the amount invested by you in new residential house property is less than net sale consideration amount, then it will be exempt proportionately. So exemption will be your capital gain amount. How is it calculated proportionately, sir? Your capital gain amount into amount invested divided by net sale consideration amount. Now this new property which is there, that should not be transferred by you within a period of 3 years. If I transfer, sir, what will happen? Whatever exemption was given to you earlier will be reduced from cost of acquisition of new asset which is transferred by you. Now the maximum amount of exemption which you can claim in this section is 10 crore rupees. Okay, and you should not have more than one residential house property at the time of purchasing that new houses. 1037 talks about exemption. If government is if your urban agricultural land is compulsorily acquired under any law, then whatever capital gain you are getting, that will be fully exempt irrespective of whether it is long term or short term. Now capital gain tax rates, so before 23rd July 20%, on or after 23rd July 20.5%. If it is short term, then it is lab rates, etc. All the stories to you is something which you already know. Yeah, one point is there. In case of listed shares, the cost of acquisition of these shares, if these shares were purchased by you before 1st of February 2018, then the cost of acquisition will be actual cost, and that actual cost should be compared with fair market value as on 31st of January 2018. Compare that with sale value. Take whichever is less. Take your fair market value as on 1/4/2001. Compare that with sale value. Take whichever is less. Now that whichever is less, you should compare with actual cost. Take whichever is higher as its cost of acquisition. So there is this is only applicable for listed shares. Yeah, I think this is all about your capital gain chapter. So there are some questions which I have solved, which you can anyways have a look into later. Now we'll discuss what, sir, income from other sources after a short break. We'll take a break for 15 minutes break. We'll take 10-15 minutes break. We'll take, okay. We'll meet after a short break of 10-15 minutes. I'll disappear in 2 minutes. 1 second.
Okay, so welcome back, friends. Let us do the next topic. What is the next topic for us, sir? Income from other sources. Income from other sources, section 56 to section 58. These are the different sections which are covered under this chapter or this particular topic called as income from other sources. Yes, sir.
Very easy chapter. Now what is this topic telling? Sir, we have missed income from business. No, sir. Business we'll do tomorrow. We'll do in our next class. Okay, we'll complete this now. Now what is this point telling, sir? Any income if you have, if that income is not taxable under any of the following heads. Which head? Salary, house property, PGBP or capital gain. If there is any income which is not taxable under these heads, then that income will be taxable under other sources. As simple as that. Now normally taxation of gift is one of the major concept in this chapter. We'll study about that. Now you have received gift because of what reason? I have received gift because of my employment. Then it is taxable under salary. Because you are working somewhere, therefore you received gift, taxable under salary. If the gift is received because of your business and profession, then it is taxable under PGBP. If you are receiving the gift because of any other reason, not because of my business, not from my employer, then that gift will be taxable under income from other sources. How much is taxable, how it is taxable, we'll see that now. Section 56 to 10 talks about taxation of gift. Taxable if in the hands of the recipient. Gift is taxable in whose hands, sir? In the hands of the recipient, the person who is receiving the gift. Section 56 to 10 says, when have you received the gift? The gift is received by any person. Any person means what, sir? Individual, HF, firm, AOP, BOI, artificial, judicial person, company, etc. Anyone. If you have acquired any asset for inadequate consideration, meaning either you are receiving something for free or you have acquired something for an inadequate consideration. Inadequate consideration means not giving the full value for that item. Then this provision shall apply. Now they say, if you receive any gift at the time of your marriage from your relative, in contemplation of anybody's death, inheritance or will, or from local authority or a trust, university or in hospital or during COVID time, then that gift is completely exempt. Maja panno. You just do maja in your life, that gift is completely what, sir? Exempt. Sir, repeat, sir. If you are receiving the gift at the time of your marriage, if you are receiving the gift from your relative, or someone is dying, therefore he is giving gift to you because of inheritance or will, or some local authority is giving, trust is giving, university is giving, hospital is giving the gift, or at the time of COVID if you have received the gift, then that gift will be completely exempt. Okay. Now what do you mean by relative, sir? Sir, marriage means marriage, no sir. Yes, marriage anniversary is not covered over here. Wedding anniversary is not covered. Actual wedding is covered. Sir, engagement not covered. Only marriage is covered over here. If you are getting any gift at the time of your marriage. Sir, if I get married 5-6 times, What will you do? Ask people who have got married. You talk to those people. They are suffering by getting married once only. You want to get married 5, 6 times. Hey, Tarkuri. Huh? So now what is happening over here? Yeah, sir, please answer me, sir. I want to get married, sir. Yeah. So if you get married 5, 6 times with the same person, not allowed. With different person, definitely allowed. Marriage, if you are doing, if you are receiving it from relative. Relative means what, sir? For example, for me, who is the relative, sir? For me, for Dilip, Dilip's brother, sister are relative. Dilip's spouse, wife is relative. My parents, father and mother are relative. My children's son and daughter are relative. My parents, brother and sister are my relative. My spouse's brother and sister and my spouse's parents are my relative. Now please note, all those people whom we have seen here above, their spouses are also my relative. Meaning, my son daughter's children's, my brother and sisters, sorry, not children's, my son daughter's spouse. Okay, my brother and sister's spouse, my brother-in-law's and sister-in-law's spouse, all those people are also my relative. My parents, brother and sister, spouse, they are all my relative. Further, lenient decedent and lenient antecedent, meaning my father, his father, my mother, etc. My all four fathers, plus my children's, their children's, they are all treated as my relative. And in case of HUF, who is treated as relative, sir? In case of HUF, the members of HUF are treated as relative. In all other cases, if you are receiving money, aggregate money received by you is more than 50,000 rupees per annum, it is taxable. If I am receiving movable property, what is movable property? If I am receiving DJ, PASO, PV. If you are receiving movable property, what is movable property, sir? If you are receiving DJ Paso BV. If you are receiving what, sir? Any movable property over here means DJ Paso BV. DJ Paso BV, just now we studied. D for drawings, J for jewelry, B for painting, A for archaeological collection, S for sculptures, S for shares and securities, O for any other work of art, BV for bullion and virtual digital asset. If you are receiving money more than 50,000 in aggregate, money more than 50,000 in aggregate means what, sir? In a year, in total, if you receive more than 50,000 rupees, then it is fully taxable. Then in a year, from one person, no. In total, from 5 different people, if 5 different people are giving you 5,000 rupees, it is 50,000. If 5 different people are giving you 6,000 rupees, 60,000, more than 50,000, fully taxable. Full amount 60,000 rupees will be taxable. If you are receiving movable property, what do you mean by movable property, sir? DJ Paso BV. If you receive DJ Paso BV without consideration, then, and if its aggregate value is more than 50,000, it will be taxable. If you receive DJ Paso BV for a inadequate consideration, if you receive what, sir? DJ Paso BV for what, sir? Inadequate consideration, then I am going to see what, sir? If you receive it for an inadequate consideration means I am purchasing a jewelry for a lesser price. Lawmaker says, if you are purchasing, see, if you are getting jewelry free of cost, if the value of jewelry is more than 50,000, taxable. If you are getting the jewelry for a lesser price, if you are getting a jewelry for a lesser price means what, sir? Value of the jewelry is say 2 lakh rupees, you got it for 10,000 rupees. So can I say you paid 1.9 lakh rupees less? 1.9 lakh rupees is treated as gift to you, therefore it will be taxable. So if it is for inadequate consideration, the aggregate difference between market value of consideration, if it is more than 50,000, such difference is taxable. Then what about immobile property, sir? In case of immobile property, have you received without consideration or is it for inadequate consideration? Sir, I have received it for without consideration. If it is without consideration, if you are receiving any immobile property without consideration, if the value, stamp duty value, if the stamp duty value of that immobile property is more than 50,000, it will be fully taxable in your hands. But if it is received for an inadequate consideration, then the difference between stamp duty value and consideration is more than 50,000 and stamp duty value is more than 110% of consideration, then such difference will be fully taxable. If you receive it for inadequate consideration, 2 conditions. What is 2 conditions, sir? Difference between stamp duty value and consideration is less than 50,000 and stamp duty value is more than, difference between stamp duty value and consideration, whatever the stamp duty value is there and whatever amount you have paid, the difference is more than 50,000 and the stamp duty value is more than 110% of consideration. In such cases, the difference amount is there, the difference amount will be fully taxable. Section 56 to Section 56 to 10 will be applicable only if the movable property or immobile property is held as capital asset for the recipient. If that movable property or immobile property is a stock in trade for the recipient, then 56 to 7 is not applicable. 56 to 10 is not applicable. I mean, the questions are very easy. I mean, what to discuss on those questions? Let me just discuss one question. On the occasion of the marriage, Mrs. Rashmi, on the occasion of her marriage on 14th of August 24, she received 90,000 rupees gift, out of which 70,000 rupees was from relative and balance from friends. Anyways, it does not matter because it was during her marriage. On 12th of September 24, she received gift worth 18,000 from his cousin of her mother. Cousin of mother is not a relative. Okay. A cell phone is not covered. DJ Pasu BB does not cover cell phone. She gets a gift of 25,000 from elder brother of her husband's grandfather, not a relative, therefore taxable. She received cash gift of 12,000 from her friend, taxable. Now I received few gifts. Let us see what happens to that. I received 25,000 each from 3 of my friends, so totally 75,000, therefore can I say taxable. I received gold bracelet from my sister's friend. How much? 30,000 rupees. 30,000 rupees gold bracelet. So in a year, I should see whether there is any other item also which I have received, which is movable for free. If the total value is more than 50,000, it will be taxable. So as of now, keep in mind 30,000 rupees is there. And this item, is it taxable, sir? Yes. I have received 3 BHK flat from my mother's brother worth rupees 2 crores. 3 BHK flat from mother's brother. Mother's brother is my relative, therefore ignore this. Received gold ring from ex-girlfriend 75,000. Oh, free of cost. Now 75,000 plus 30,000, can I say now it has exceeded 50,000 rupees? So now both combined together will be taxable. He received Mercedes car from his girlfriend. Can I say Mercedes car from girlfriend? Mercedes car is not DJ Paso BV. Car is not covered over here. He received a gift of 49,000 from his mother. Mother is not, anyways, mother is relative, therefore ignore. Purchased a 2 BHK flat from Nora Builders for 2 crores. I purchased a flat for 2 crores. The value of this flat was 2.3 crores. A 2.3 crores property I purchased for 2 crores. That means I paid 30 lakh rupees less. So stamp duty value is more than 50,000, and the difference is also the stamp duty value is more than 110% of consideration, and difference is also more than 50,000. Therefore, this will be fully taxable. 30 lakh rupees will be taxable. I purchased a jewelry from Kalyan Jewelers for my wife. Value of jewelry was 1,10,000. I purchased it only for 8,000. Is it taxable, sir? Difference is less than 50,000, therefore not taxable. I received a mop from wife, not taxable. I received iPhone 16 Pro from my friend, not taxable. Why, sir? Because it is not a DJ Paso BV. Very important. Students will make mistake with this car, Mercedes car or iPhone, etc. Only DJ Paso BV is taxable as movable item. Now, as we all know, we just now studied under our capital gain chapter, where in section 49(1) we discussed if someone is gifting an asset to other person, the person who has given the gift, for him it is not a transfer, but for the recipient, can I say section 56 to 10 will apply. So normally we take cost of acquisition for the present owner as cost of previous owner, correct? But if the present owner has paid the taxes under 56 to 10, for her, the cost of acquisition will be the fair market value as on the date of receipt of gift. In simple words, what does this mean, sir? Normally what happens, if I get anything by way of gift, then I will take the cost of previous owner. Who is telling? 49(1) is telling. However, because I got it for free, for me 56 to 10 is applicable. I will have to pay taxes under income from other sources. No, if I have paid taxes under income from other sources, on whatever amount I have paid the taxes, that amount will be taken as my cost of acquisition for this asset. If any capital asset is received as a gift or for inadequate consideration, and if the recipient has paid the taxes under 56 to 10, the stamp duty value of such capital asset will be taken as cost of acquisition of the capital asset for the recipient asset. Now section 50C is applicable for immobile property if it is held as stock in trade. Similar section is there, 43CA, which is also applicable to immobile property if it is held as stock in trade. Now taxation of dividend, very important. there is one new section added over here. There is some amendments with respect to this provision. Let us see. Taxation of dividend. What is dividend, sir? What happens is whenever company is earning any profit, that profit company may feel like distributing it to their shareholders. If the company is distributing the profit to its shareholders, it is called as what's a dividend. That if the company keeps that profit with themselves, then it is called as undistributed profit. It will be called as what's a retained earnings. This amount they will use it for expansion or reinvestment, etc., etc., etc. Now, dividend, whether it is given by a domestic company or a foreign company, it will always be taxable in the hands of shareholders under income from other sources. Then there is a concept called as deemed dividend. What is deemed dividend, sir? Actually, this is not a dividend, but government says I'm going to assume that it is dividend, and accordingly I will go to tax it under income from other sources in the hands of recipient. What is that, sir? Deemed dividend under section 222A, B, C, D, E, F. F is newly added. Section 222A says, if there is a domestic company which is distributing any asset to its shareholders, if domestic company is distributing any asset to its shareholders, then it will be deemed as dividend. How much will be deemed as dividend? To the extent of accumulated profit. Meaning, if the domestic company gives any asset to its shareholders, why is the domestic company giving asset to the shareholders? What is the reason, sir? Lawmaker says if the domestic company is giving asset to its shareholders, then I don't care what is the reason why they are giving that asset. I'm going to assume that it is dividend, and to the extent of accumulated profit, how much will be assumed as dividend, sir? To the extent of accumulated profit, whether capitalized or not. To the extent of accumulated profit, whether capitalized or not, will be deemed as dividend. For example, whatever accumulated profit I have in my reserves plus whatever accumulated profit I have capitalized, both will be taken together. To that extent, whatever asset is given by the company will be taken as deemed dividend. Similarly, if domestic company is distributing any debenture stock or debenture certificate to any of its shareholders or bonus shares to its preference shareholders, then it will be deemed as dividend to the extent of accumulated profit, whether capitalized or not. Section 222C, very important section. Many times they have asked this in examination. Distribution of asset by the company upon liquidation. Distribution of asset by the company upon its liquidation. If there is a domestic company which is if a domestic company is distributing any asset to its shareholders at the time of liquidation of that domestic company, then it will be deemed as dividend. How much will be deemed as dividend? To the extent of accumulated profit, whether capitalized or not. So what is happening over here? Domestic company is getting liquidated, meaning the company is getting closed. At the time when company is getting closed, the company may have some assets along with it. First, they will repay all their liabilities, whatever outsiders liabilities there. Now, whatever amount is left over after paying all their outsiders liabilities, that money, what will the company do, sir? That money the company will give it to their shareholders, because they are the actual owners of the company, correct? It will give that money to the shareholders. Lawmaker says that money, whatever shareholders are getting now, that will be deemed as dividend. How much will be deemed as dividend? To the extent of accumulated profit. To the extent of accumulated profit, I'm going to deem it as dividend. For example, there is a company called as Q & Fishers Private Limited, which started its business, and the balance sheet of this company is given as on the date of liquidation. Share capital of the company is this much. There are 5 shareholders holding 1 lakh rupees each. Reserves and surplus liabilities is given, etc. Year is 2000. In the year 2008, the company started it with 5 shareholders, A, B, C, D. These are the 5 shareholders. The company went into liquidation on 14th of December 2024. On 12th of December 2024, after repaying all the external liabilities, the company distributed assets to its shareholders worth rupees 7 lakh rupees each. Now, lawmaker says because they have distributed assets worth rupees 7 lakh rupees to shareholders, it will be deemed as dividend. How much will be deemed as dividend? Now, taxation in the hands of company and the shareholders. In the hands of company, we studied in our previous chapter, capital gain. Assets sold in the market will be taxable if the sale price is more than book value, but whatever assets are distributed to the shareholders is not a transfer, therefore no capital gain will come in the hands of company. However, in the hands of shareholders, he will have a capital gain income as well as business other source income. What is that other source income? Deemed dividend under section 222C. How much will be deemed dividend, sir? To the extent of accumulated profit. Now I'll see what is the total accumulated profit of the company. What is the total accumulated profit of the company? 15 lakh rupees. Now share of one shareholder will be 1/5. Why, sir? 5 shareholders are there. So 1/5 will be 1 shareholder's share. So 15 lakh rupees is the total accumulated profit. A share in accumulated profit is 1 by 5, which is 3 lakh rupees. This is deemed as dividend. The company has given how much, sir? 7 lakh rupees to each shareholder. 3 lakh rupees is deemed as dividend. Whatever is left over is the value which you are going to take for the shares which is given. Full value of sale consideration 4 lakhs. Expenses you subtract, you will get net sale consideration. Cost of acquisition is 1 lakh. You will get your long-term capital gain. Now, this provision is little important, taxation of buyback of sale share, because it is changed in the middle of the year. They have made a change. Buyback is done before 1/4/2024 or after 1/4/2024. Buyback is done Buyback is done before 1/4/2024. In the hands of company, it is taxable in the hands of company. If the buyback is done before 1/4/2001, it is taxable in the hands of company. How much is taxable, sir? Buyback price minus issue price. That amount is taxable at what rate, sir? 23.296 percentage, which is nothing but 20% tax rate, 12% surcharge, and 4% health and education cess. And in the hands of shareholders, that is exempt under section 1034A, if the buyback was done before 1/4/2024. If the buyback is done on or after 1/4/2024, then in the hands of the company, it will be no tax treatment, meaning you can ignore in the hands of company, and it will be taxable in the hands of shareholders. How much will be taxable, sir? Income from other sources, it will be taxable. The buyback price will be taxable in the hands of shareholders. What is the total buyback price? Number of shares bought back by the company into buyback price per share. So that will be taxable as deemed dividend under 222F, and it will be taxable in the hands of shareholders in the year of buyback. And capital gain also will come in the hands of shareholders. How much? What will be that capital gain, sir? Capital gain lawmaker says here you will not have any capital gain. What? Because entire buyback price is taxable under income from other sources. So here you will not have any full value of consideration at all. So if there is any expenses incidental to transfer or whatever cost of acquisition is there, that entire cost of acquisition will be treated as loss to you. That will be your short-term or long-term loss depending upon the period of holding of the shareholders. Full value of sale consideration will always be taken as nil in case of buyback of shares by the company if it is done on or after 1/10/2024. What is this point telling, sir? If company is doing buyback of shares on or after 1/10/2024, then the cost of acquisition of those shares in the hand of shareholders will always be taken as the full value of sale consideration of those shares will always be taken as 0. Therefore, entire amount will be taxable as what, sir? Entire amount will be taxable as short-term capital loss. Now, Mr. Dilip, let us see one question because it is a new point which is added. Therefore, it is little important. Mr. Dilip acquired 1000 shares of Priya Sarees Limited for 75 rupees in the previous year 17-18. Priya Sarees bought back 300 shares on 15th August 2024 for 120 rupees. Further, it brought back 400 shares at 180 rupees on 15th of January. Remaining shares were sold. Now, buyback is happening, see, before 1st of October and after 1st of October, correct? Now, what will be the tax implication? In the hands of company, total number of shares bought back is 700. 300 were bought back before 1/10/2024. It will be taxable in the hands of company. Buyback price is 120. Issue price is 75 into number of shares bought back before 1/10/2024. That amount is taxable in the hands of company. What is the tax rate, sir? 23.296 percentage. Whatever shares were bought back after on or after 1st of October 2024, no tax implication in the hands of company. Now, tax implication in the hands of Mr. Dilip. Shares bought back before 1/4/2001 are completely exempt in the hands of Dilip. Shares bought back after on or after 1/4/2001, income from other sources, which is total buyback price, will be deemed as dividend under section 222F. 400 shares were bought back after that date into 180 per share. That is the amount taxable. Then full value of consideration is how much, sir? Your full income from capital gain will come, where you will take full value of consideration to be equal to 0, and whatever cost was there, that will be treated as your long-term capital loss or short-term capital loss. Ding. Then we have one more section, section 222E, which we did not see. If a closely held company is giving loan to any shareholder who is having 10% or more equity shareholding, then that shareholder, whatever loan company is giving, that will be deemed as dividend. But if the company is giving loan to any concern where the shareholder is having substantial interest, then also it will be deemed as dividend. If the loan is given by the company to one of his friend, any other person, for the benefit of the shareholder, then also it will be deemed as dividend. Now please note, it will be deemed as dividend irrespective of whether the loan is called off in the same year or not, meaning even if you repay the loan in the same year, then also it will be deemed as dividend. But if the company's business is only giving loan, this section is not applicable. If it is a business advance given by the company for the purpose of their business, then also this section is not applicable. Now this section will apply even if interest is charged at market rates. Now other points with respect to income from other sources. What are the other points with respect to income from other sources? Now there are some income which will always be taxable only under income from other sources. Which are those incomes? Are dividend income, always taxable under income from other sources. Casual income, always taxable. Casual income means lottery, betting, gambling, etc. They are always taxable under income from other sources. Gift income, share premium. If private limited company is issuing a share at a price less than its market value, then whatever extra amount is share premium. Interest on compensation or enhanced compensation of compulsory acquisition of a capital asset. That interest, whatever you are getting, that is taxable under other sources. Advance money forfeited on or after 1/4/2014 and owning and maintaining racehorse business income will always be taxable under this head. There are some income which will be taxable under capital gain if they are not taxed under PGBP, meaning normally you should see PGBP for this. If you have not paid tax under PGBP, it will come under capital gain. Employees' contribution to PF, ESIs, etc. Interest on securities, income from letting out of plant machinery and composite rent, they will normally go under PGBP. If it has not gone under PGBP, it will come to capital gain. Following income shall be taxable under income from other sources, even if they are not taxed under salary or PGBP. So this income can either go under salary or PGBP, but if it is not going over there, it will come under other sources. Some received under key man insurance policy or compensation received due to termination of employment or modification of terms of employment. Now, what are the other incomes taxable under this head, sir? The other income which are taxable under income from other sources are income from subletting of house property, interest from bank deposit, remuneration which I am getting for paper checking, renting of vacant land, insurance commission, undisclosed income, private tuition coaching, etc. I am doing, interest of IT refund, family pension I am getting, sitting fees which director is getting, stipend which a article is getting, etc. Then agriculture income from a land outside India, royalty, income which a MLA, MP, MLC is getting, sir. Then what is this? Family pension which is which any person is getting. Exemption will be given 1/3 of family pension or 15,000 rupees, and any type of awards. If it is government award, it is exempt. If it is a non-government award, taxable under section under income from other sources. Interest income under income from other sources. Interest on compensation or delayed compensation, or interest income if you are getting because of compensation or delayed compensation of for compulsory acquisition of capital asset, only 50% of the interest amount is taxable. Interest from post office saving account is exempt up to 3,500 and balance amount will be taxable. If it is a joint account, 7,000 rupees is exempt. Following interest are always exempt: government gold bonds, deposit certificate, Sukanya Samriddhi account, PPF interest, etc. Any other type of interest is fully taxable. Now section 57, 56, only one section we have seen from all these times from last half an hour. Now we'll take only 2-3 minutes to complete the rest of sections. Deductions from income from other sources. If the income is taxable, whatever expenses you are incurring with respect to that income will also be allowed as deduction. If the income is exempt, expenditure will not be allowed as deduction. If the income is a casual income, lottery, betting, gambling, horses, TV shows, etc., any expenditure incurred for that is not allowed as deduction. Interest on compensation or enhanced compensation, 50% of the interest will be allowed as expenditure. Dividend or income from unit trust of India or mutual fund, only interest expenses is allowed as deduction for that. If you are earning any dividend income, for that, if you have taken loan, only interest expenses will be allowed, and that also only to the extent of 20% of income earned will be allowed as deduction. Then following expenses are never allowed as deduction while computing the income under the head income from other sources. Personal expenses, expenses related to casual income, payment made in cash more than 10,000 rupees, unreasonable amount paid to relative, and any payment made to non-resident without deducting TDS. And section 59 says if expenditure is allowed as deduction in any earlier year, now it will be deemed as income if it is ceased. Meaning if you have claimed expenses in some previous years, and now if the person to whom you are supposed to pay the money is telling I don't want the money, now in this year, because you are not liable to pay that money anymore, that will be treated as your income. Now there is also a concept of grossing up, which you should make sure you should remember this. Normally lottery income, the say I won a lottery of 10 lakh rupees. Normally what that company will do, whoever is issuing lottery will deduct TDS at 30% and pay me only 7 lakh rupees. Now the question is whether my income is 7 lakh rupees or 10 lakh rupees. Answer is my income is 10 lakh rupees. Why, sir, my income is 10 lakh rupees over here? Though I have received only 7 lakh rupees, why are you telling 10 lakh rupees? Because this is after deduction of TDS. TDS is belonging to me only. So this TDS amount plus this amount is taxable in my hands. Lottery income 7 lakh. You should take your gross income while computing income, which is 10 lakh. While computing your income, you need to take while computing your income, you need to take 10 lakh rupees. Dilip earned new net income of 21 lakhs after deduction of 30% TDS. Income to be considered is 21 lakh divided by 70%, 30 lakh rupees. This is all about this beautiful, fantastic chapter called as income from other sources. We will stop our today's discussion over here only. We will continue our discussion tomorrow, and we'll complete, of course, the another one head of income is there, and remaining provisions we will see together tomorrow. We'll see and we'll try to complete them tomorrow. Okay, let me meet you in my next class. Till then, tada, bye bye, take care, enjoy, students. I hope you're enjoying these marathons. All the very best for your examination. Please study well, keep enjoying, keep studying. Happy learning. Bye.
Hello friends, welcome back. Welcome to day 4, and today we will be discussing the last head of income which we have in our discussion, which is that head of income which we are going to discuss today, sir. It is profits and gains from business or profession. So this is one head which is pending. So once we complete this, our heads of income will be over, and then accordingly we can discuss the other topics remaining in this income tax law. Correct? So let us straight away start the discussion on this heads of income. Now, let us start the discussion on profits and gains from business or profession. One of the important head of income. Almost around 10 marks question will come in the examination from this topic, and your total income question which is there, no, the major chunk of that will be from profits and gains from business and profession. So section 28 to section 44, these are the different sections which are covered under this provision. Okay, now normally if you are familiar with accounts, if you know what accounting is, if you are familiar with accounts, in our accounts what do? We prepare something called as profit and loss account. Correct? So wherein on the credit side we write income, on the debit side we write expenses. So from income, if I subtract expenses, I will get my profit, net profit. Correct? So the same thing, whatever you have done under accounts, no, same thing you have to do in income tax law also. But here what you are supposed to do is you should compute your net profit as per income tax law. Income tax law says all the incomes which you have recorded in your accounting profit and loss accounts, they are not related to business. There may be some income related to some other items. There may be some income related to your capital gains or house property, etc. So, but if you want to find the business income, you should take only the income as per the PGBP, and you should take only the expenses which are allowed under PGBP. Whatever expenses are there, will I be able to take all those things, sir? Lawmaker says no. Expenses, if you want to take it as per section 30 to 37. These are the different sections which are going to talk about the expenses. And if you want to take the income, you take as per section 28 or 28 and 24. So these are the only two heads which talks about the income under PGBP. Okay, so any other type of income which is there under income from in your profit and loss account which you have prepared as per accounting, they will not form part. Similarly, any expenses other than those covered over here 30 to 37, if they are there in your books of accounts, then you will have to please remove to get your final answer, which is business income as per income tax law. Okay, now what do you mean by business, sir? Business includes trade, commerce, manufacture. What is the business definition telling? Business definition says I am an inclusive definition. What do you mean by inclusive definition? Meaning whatever you generally understand by the word business is a business. As per your normal understanding, what do you understand by the word business? As per you, what is business? For example, we are doing something, correct? We are doing some activities over here. We are running a coaching institute. So are we doing business? Lawmaker says yes. I'm having a sari shop. I'm having a sari shop, Priya Saris. Am I doing a business, sir? Yes. So we have different types of restaurant. A to B restaurant is there. Is that A to B restaurant doing a business? Lawmaker says yes. Business means what, sir? Business means whatever you normally understand by the word business is a business. Apart from that, business will include trade, commerce, manufacture. So if a person is involved in trading some activities, I'm a person who is not manufacturing mobile phones. I purchase mobile phone from someone and I sell it. That means what, sir? I'm doing business. Then business includes commerce. What do you mean by commerce, sir? Those people who are helping in facilitation or helping in doing the business, they are involved in commercial activity. Then what is manufacture, sir? Manufacture means what, sir? I am making something. Manufacture means I am manufacturing this mobile phone, I am manufacturing this microphone, etc. I am manufacturing a calculator. So that is what, sir? That is manufacture, wherein raw materials will be required for making this, correct? All the different raw materials which are required for making this, they will be purchased by me. I will assemble that, and finally this calculator will be ready. So business includes trade, commerce, and manufacture, as well as what, sir? Business includes profession. What do they say? Business includes profession is also included over here only. So profession includes what, sir? Vocation. What do you mean by profession, sir? Anything which you are doing because of the qualification which you have obtained in your life, or because of any degree which you have obtained. So profession means what, sir? You are doing a particular activity because of the qualification which is obtained by you. Profession will include vocation. So what is this? Profession will include vocation. Yeah. Profession means, for example, a chartered accountant is a professional. I am a professional, correct? You as a company secretary, you as a cost accountant, you as a chartered accountant, you as a lawyer, you as an engineer, you are all treated as what, sir? Professionals. Apart from this, profession includes vocation. Sometimes what may happen is a person may not be having a particular qualification to do some activity, but he has very good skill and talent to do that work. For example, Shah Rukh Khan is a very good actor. Now he is not certified by any institution telling that he is a very good actor. Because of his own skill and talent, he is doing acting. Whereas there are some actors who are going to National School of Drama, they are getting educated over there, they are pursuing their acting course over there, and then they are getting their acting, whatever work they are doing. Correct. So profession includes vocation. Vocation is something which you are doing because of your own skill and talent. Methods of accounting. Under income tax law, section 145 says method of accounting is required to be adopted for finding two types of income. So there are two methods of accounting. One is called as cash system of accounting and accrual system of accounting. This method of accounting you should select while filing income under two different heads. Which are these two different heads? Income under other sources and income under PGBP. So when you are finding the income under the head income from other sources and PGBP, you should adopt for one of the method of accounting. Okay, accrual system of accounting or cash system of accounting. And there is something called as income computation and disclosure standards. Sir, what is this income computation and disclosure standards? Income computation and disclosure standards are just like your accounting standards. But these accounting standards, these are not actually accounting standards. It is just like your accounting standards which are issued by income tax department. They say for computing income, you will have to follow this income computation and disclosure standards. Next, charging section. Section 28 is the charging section of income tax law. Section 28 talks about different income on which you have to pay the taxes under income tax law. Which are those different incomes, sir? Any profit or gain from business or profession in the previous year. If you have got any type of profit, if you have got any type of gain, how did I earn this profit? How did I earn this gain? Because of any business which you have done or because of any profession you have done, then that profit or gain will be taxable in the previous year. If you have done this business or profession in the previous year, that profit or gain will be taxable under which head, sir? Under income from business or profession. Similarly, you have received any amount. You have received what, sir? Amount is received by any person for termination of his office or for modification of terms of his office. Meaning what, sir? I had entered into an agreement with someone telling that I will give some services to you. Now I have modified that agreement because of which some amount is received. That is what, sir? That is related to my business. So lawmakers are telling that is your business income. Then services rendered by an association to its members. Next point says what, sir? Services rendered by association to its member. So if there is an association of person, if there is an AOP group of, if there is an association which is giving services to whom, sir? Its own members. Then that AOP is giving services to its own members. No, that is treated as business. It is treated as business for them, and therefore that income also will be taxable under business or profession. Sir, can you give an example? Like for example, you have something called as resident welfare association. Sir, what is this resident welfare association? Resident welfare association means your apartments are there. This apartment will form their association. So there will be 100, 200, 300 flats will be there, correct, in the apartment. So these people who are occupied in these different flats, they are using all these facilities given by the apartment, like swimming pool is there, or they are using the lift, they are using, etc. Security guards are there for their safety purpose, etc. Now all these facilities which are given, no, for this an association is formed which is going to take money called as maintenance charges from these people. Now this maintenance charges which they are collecting, that will be treated as income, and therefore it will be treated as business income. Income from services rendered by an association to its own members. Then if you are involved in export related business, then whatever duty entitled passbook you are getting from government, whatever duty drawback you are getting from government, any type of cash compensatory support you are getting from government, they will all be treated as your business income. It will be taxable under this particular head. Any perquisites or benefit which is arising from business or profession. So because of your business or profession you are getting. Hi, very good morning. Very good afternoon, those who are watching me over there. Very good afternoons. Now, what is this? Any benefit or perquisites arising from business or profession. What do you mean by this? Any benefit or perquisites arising from business or profession? For example, there is a doctor who did the operation very well because the doctor came out and he told, sir, operation was successful and the person is now perfectly all right. Now that relative of that person was very happy by this news and he gave his gold chain to the doctor. Doctor is getting a perquisites, or he's getting a benefit. Why is he getting in this benefit, sir? Because he's doing that particular business. Any benefit or perquisites arising from your business or profession also is taxable under PGBP. Then any interest, salary, bonus, remuneration or commission which is received by partners of a partnership firm. Any interest, salary, bonus, remuneration, commission received by partners of a partnership firm. For the partners, it will be treated as business income. Sir, salary is treated as business income. Yes. In case you are a partner of a partnership firm, that partnership firm is paying you interest or salary or bonus or commission, no, that will be treated as business income for partners. However, subject to the limit given on 40B. We will see what is the limit given in 40B. Only to the extent of the amount which is allowable under 40B, that much only will be treated as business income in the hands of partners. Similarly, amount received for not carrying on business or not sharing technical know-how or patent. So if you are receiving any money for not doing any particular type of business or not sharing any technical know-how or patent, then
Sir, what do you mean by this amount received for not carrying on business, not sharing technical know-how or patent? For example, there is a competitor. So I am running my Priya Sarees. Okay, right next to Priya Sarees, someone wants to start his own saree shop called as Karina Sarees. Now I told this fellow, hey, you do one thing, please don't start a saree shop over here. If you don't start saree shop over here, I will give you 50 lakh rupees. So that person is going to receive money for not carrying on the business. No? So for him, that income will be what, sir? Business income. Similarly, amount received under key man insurance policy. So if the key man insurance policy money is received by the employer, that will be taxable under business or profession. Fair market value of stock in trade in case of conversion of stock in trade into capital asset. For example, I am a person who is dealing in jewelry. Okay, so I am a dealer of jewelry, therefore jewelry is what, sir? Stock in trade for me. One of the jewelry I liked very much, therefore I took it for myself. Now what is happening? There is a stock in trade which is converted into capital asset. On the date of conversion, whatever is the market value of this jewelry, that will be treated as my business income. That will be taken as what, sir? That will be taken as my business income. Next. Now, for the purpose of set off and carry forward chapter, business are divided into two categories. One is called as normal business, one is called as speculation business. What is this normal business, sir? Whatever type of business you are doing, that is normal business only. However, if you are involved in the business of buying and selling of shares and securities without taking its actual delivery, if you are involved in what activity? If you are involved in the activity of buying and selling of shares and securities without taking actual delivery of those shares and security, that means you are doing what, sir? Speculation business. You are doing a speculation activity. Then section 29, how to compute income under income business. How to compute your business income? Section 29 says, while computing your business income, make sure that you see all the sections from section 30 to section 43D. Meaning, while computing your income under the head PGBP, you should always consider all the sections. Check whether you have followed all the sections. Check whether you have seen what are the different points as applicable to you. Have you fulfilled all the conditions given in all these sections? Only then you compute your own. I mean, after considering that, only that final amount which you get will be taken as your business income. Section 30, rent, rates and taxes, repairs and insurance of building. Now section 30, now we are starting, please note, now we are starting with what's our actual discussion. Okay, section, if you see over here, what have we written over here? Section 28 talks about business income. We have seen what are the different incomes taxable under this head. Now we are going to see different kind of expenses allowed. Sir, there is one more thing, no, section 41. Yeah, that we'll see later. Now we are going to see what? Section 30, which talks about section 30 to 37, which talks about different expenses which are allowed under this particular head. Section 30 is the first section. Section 30 says rent, rates and taxes, repairs and insurance of building. Now the building where I am doing my business, the place where I am doing my business, this place can either be owned by me or it can be taken by me on rent. If it is a owned place, definitely I'll not be paying rent to anyone. So while preparing my profit and loss account, will I show rental expenses, sir? Will I show rental expenses? Answer is no, because I'm not paying anyone the rent because it is my own building. Will I pay rent to someone? No. So rent deduction you cannot claim. Sir, but what if it is my own building, but for that building I am paying rates and taxes, municipal taxes or different types of taxes which are applicable? What if I am paying insurance? What if I am incurring repair expenditure? Lawmaker says everything is allowed as deduction. If it is a, say, whatever building in which you are doing business, no, if it is owned by you, I will not allow rent, but however, any types of rates and taxes are there, any type of insurance you have paid, any type of repair expenses are incurred by you, they will all be allowed as deduction. They will all be allowed as deduction. However, you should make sure one important thing. Repairs are divided into two categories. One is called as revenue repair, another one is called as capital repair. Sir, what is this revenue repair and what is this capital repair, sir? Revenue repair means those repairs. Revenue repair and capital repair means what, sir? Revenue repairs are those repairs which are done by you on recurring basis. some expenses will be there, no, which will be incurred on building for on regular basis, like chota mota patchwork is involved, so you are repairing that patchwork, etc. Then what is capital repair? You are constructing a new floor, that is a capital repair. So they say revenue repair is always allowed to be taken to profit and loss account, and you can directly claim it as a deduction. However, if it is a capital repair, no, I will not give the deduction directly, but this capital repair shall be added to the cost of the building, and you can claim depreciation on this capital repair. And you can claim what, sir? Depreciation on this capital repair. Then now, sir, what if the building in which I am doing business is a rented building? Now, sir, I am paying rent to someone. Is it allowed while when I prepare my profit and loss account? Can I show rental expenses? Lawmaker says yes. Sir, I am paying rates and taxes. Is it allowed? Yes. Sir, I am paying insurance. Is it allowed? Yes. All these expenses are allowed. Sir, what about repairs, sir? Revenue repairs allowed, sir? Yes, it is allowed. Capital repairs are also allowed, sir? Yes, capital repairs are also allowed. Now, because this property is not your own property, this is a rented property. In rented property, if I'm incurring capital expenditure, sir, how will I show it in my balance sheet, sir? Lawmaker says, if you are incurring any capital expenditure for your rented building, then that capital expenditure should be shown by you as your, it should be shown by you as your what, sir? As your deemed building. It should be shown by you as your deemed building, or it should be shown by you as a deemed asset, because you have incurred a capital expenditure. No, sometimes what happens is, like for example, we guys, when we take a classroom, we take it on rent for a period of 5 years, 10 years, etc. Now this classroom, when we are taking, no, it will be given as a single hall, but later we are partitioning it, and we are making different blocks, no. So what are we doing over here? We are converting them into different blocks. So here that expenditure incurred by us is called as what, sir? Capital expenditure. Now though this place is taken on rent by us, this will be shown in the balance sheet as deemed building, and we can claim it as deduction over there, depreciation. Now, what about section 31? Section 31 talks about insurance and repairs of plant, machinery and furniture. So if you have any plant and machinery in your business, if you have furnitures in your business, and for that, if you are taken insurance, many plant and machineries, big plant and machineries will be there, for which you will be taking insurance, no. So if you are taken any such insurance, that will be allowed as reduction. Similarly, any type of repair you are incurring for your plant and machinery or your furniture, that also will be allowed as deduction. Sir, what if it is a revenue repair? If it is a revenue repair, lawmaker says no problem, enjoy. It is fully allowed as deduction. Sir, what if it is a capital repair, sir? Sir, if it is a capital repair, lawmaker says what, sir? If it is a capital repair, I will not allow it as a deduction, but I will show it in the cost, and I will give you depreciation. Sir, what do you mean by allowing deduction, sir? Deduction is allowed means while preparing your profit and loss account, you can claim that expenditure. So in our entire discussion, whenever I say deduction is allowed, deduction is allowed, deduction is allowed, what does that mean, sir? While preparing your profit and loss account, you can claim that particular expenditure. Next is section 32, most important section in your business. What is that, sir? Section 32, depreciation. Now, the calculation of your depreciation as per income tax law and as per accounts is completely different. Many people get confused with this depreciation calculation as per income tax law and as per accounts. Sir, in accounts, you give depreciation from the date when the asset is purchased. If it is used for 6 months, you will give it only for 6 months. If you use it for 10 months, you will give the depreciation for 10 months. But under income tax law, it is little different. Okay, so whenever they give in your question depreciation as per books of accounts, that depreciation should be ignored by you. Ignored by you means if it is already subtracted by you, then you add it back. Actual depreciation which is allowed as deduction while computing business income is the depreciation as per section 32. Shall we discuss now? Yes, sir. Depreciation will be allowed as deduction if two conditions are satisfied. If you are satisfying these two conditions, you can claim depreciation as deductions. Which are these two conditions, sir? Assessee should be owner of such asset, and asset should be used for business or profession. Very important condition, two condition. What are these two conditions? The assessee who wants to take depreciation, he should be owner of that asset for which he wants to take depreciation, and that asset is required to be used by him for his business or profession. Associate should be what, sir? Owner of such asset, and that asset should be used by him for his business or profession. If you satisfy these two conditions, you can claim what, sir? Deduction of depreciation expenditure. Now, if I have a plant and machinery which is taken on rent, can I claim depreciation? No. If it is owned by me, can I claim depreciation? Yes. Now, plant and machinery I am using for my personal purpose, can I take depreciation? Answer is no. If I am using it for business purpose, I can claim depreciation. Now, then, sir, what in case of hire purchase system or installment purchase system, from which date can I take the depreciation, sir? You can take the depreciation from the date when possession has been taken. Okay, in case of co-ownership and joint ownership, you can take depreciation proportionately. Each of the co-owner can take the depreciation. Now, very important point, very important point. Under income tax law, depreciation is allowed under income tax law. Depreciation under income tax law is allowed from the date when asset is put to use. Depreciation under income tax law is allowed from the date when the asset is put to use and not from the date when it is purchased. A depreciation under income tax law is allowed on the asset from the date when that asset is put to use and not from the date of the purchase of the asset. I'll repeat once again. You can take depreciation from the date when you are putting the asset to use, not from the date of using it. From the date when you put to use. Once the asset is ready to use, once you put the asset to use, from that date you can claim the depreciation and not from the date of purchase. For example, there is an AC which I purchased in the month of December. In the December month, it was very cold, so I never used it. I started using that AC from when, sir? From March month or from May month, April month. Lawmaker says there is a 6 months delay. I purchased it on 10th of December. I started using on 1st of March. Lawmaker says you can claim depreciation from 1st of March. On the date, depreciation is allowed from the date when asset is put to use. Then, classification of assets. For income tax law, for depreciation purpose under income tax law, assets are classified into two categories. One is tangible assets, another one is intangible assets. Tangible assets will include building, furniture and plant and machinery. Intangible assets will include patent, copyright, trademark, excluding goodwill. Yes, please note, under income tax law, you cannot claim depreciation on goodwill. Then, sir, how many methods of depreciation are there? There are two methods of depreciation. Sir, which are these two methods of depreciation? One is your SLM method of depreciation. Another one is your WDV method of depreciation. Sir, what is this SLM method of depreciation, WDV method? SLM method means straight line method. WDV method means written down value method. Correct. Under income tax law, normally which method should I follow, sir? All the associates should follow WDV method of depreciation. For computing depreciation, which method a person has to follow? They should follow WDV method of depreciation. And under WDV method of depreciation, there is a system which is followed for giving depreciation. That system is called as block of asset system. Under WDV method, they follow which system, sir? Block of asset system for computation of depreciation. And it is required to be followed by all the assessees. We'll come to that point. And under SLM method, they follow a system of depreciation called as individual asset system. And this SLM method can be opted for by only power generation and distribution utility, meaning those who are involved in the business of generation of power or those who are involved in the business of generation and distribution of power. These people only can follow which method? SLM method of depreciation. Now, sir, you said that there is something called as individual asset system and something called as block of asset system. What is the difference between this, sir? Under SLM method, they say that the depreciation is given for each and every asset separately, individually. Under SLM method, depreciation is given for each and every asset individually and separately. Therefore, under SLM method, what system do we follow? We follow individual asset system. So, if I have 10 plant and machineries, though all those items are plant and machineries only, lawmakers are telling I will calculate depreciation for each of this plant and machinery separately. This system is called as individual asset system. Then we have WDV method. Under WDV, and everyone has to follow which method, sir? In our income tax law, if you want to claim depreciation, which method are you supposed to follow? You should follow WDV method of depreciation. And what WDV says, sir? We follow something called as block of asset system. What is this block of asset system, sir? Block of asset means you are doing grouping of assets. Grouping of assets means what, sir? You are arranging the assets. You are combining the assets which are having same rate of depreciation and which are falling under same class. Block of asset system means what, sir? Grouping of asset into one block which has same rate of depreciation, sorry, and which are falling under same class. Sir, can you please explain it? For example, I have 4 plant and machineries. Under individual asset system, what will I do? And they are all taxable at the rate of 15%. Under individual asset, what will I do, sir? I will calculate depreciation on each of this plant and machinery separately. But block of asset system does not say this. Block of asset system says all these 4 plant and machinery you merge. You merge them as one. On the entire value you claim depreciation at this 15%. So block of asset system says what, sir? You are grouping the assets in a block. How are you grouping this? You are grouping those assets which has same rates of depreciation and which are falling under same class. You are grouping the assets which has same rate of depreciation and which falls under same class into one, and you give depreciation on that. Okay, for example, say there are different assets and I have given the rate of depreciation. Now building is taxable at 10%, furniture is at 10%, car is at 15%, book is at 40%, etc. So these are the different types of asset. But sir, how will I know which block it is falling under? Under income tax law, first we will see the blocks. There are totally 4 blocks. Which are these 4 blocks, sir? There are a classification of asset is done under 4 different heads. One is called as building, another is called as furniture, next is intangible assets, next is plant and machinery. Now those who are falling under building will all come under building, and those who are falling under 5% rate of building will go under 5% rate of building accordingly. So building, we'll see the tax rates first and then we'll come back to the block of asset system. Now what is the depreciation, not tax rate, sorry, what is the rate of depreciation applicable, sir, for different products? So if it is a building, buildings are classified into 3 types. Normally you should remember the rate to be equal to 10%. If it is a residential building, 5%. If it is a temporary structure, 40%. Normally for all types of building, what is the rate, sir? 10%. So if nothing is given in the question, what is the rate which you are going to take for building? You are going to take 10%. Okay, sir. Then for furniture, what is the rate of rate, sir? For furniture, including electrical fittings, the rate is 10%. Sir, repeat. For furnitures including electrical fittings, what is the rate, sir? The rate is 10%. The rate is what? Rate of depreciation is 10%. So building rate of depreciation is 10%. Furniture, the rate of depreciation is 10%. For intangible assets, excluding goodwill. For intangible assets excluding goodwill, what is the rate of depreciation, sir? 25%. What is the rate of depreciation for intangible assets? 25% is the rate of depreciation for intangible assets except goodwill, because goodwill cannot be depreciated under income tax law. Then we have the next class is plant and machinery. Plant and machinery, if it is a motor vehicle, rate of depreciation will be 15%. And if it is if you are in the business of running the motor vehicle on hire, meaning I am Ola, Uber, etc., for me the rate of depreciation will be 30%. My business, one of the important component is what's a motor vehicle. So if you are involved in the business of running the motor vehicle on hire, you can claim depreciation at 30%. Then in case of ship, vessel, boat, rate of depreciation will be 20%. Aircraft, 40%. Pollution control equipment, 40%. Computer including computer peripherals, 40%. Windmills, 40%. Oil wells, 15%. Books including annual publications, 40%. And all other types of plant and machinery, rate of depreciation will be what, sir? 15%. Okay, so this is the rate of depreciation applicable for plant and machinery. This is the rate of depreciation. Now see, first what are you supposed to do? Whenever the list of asset is given, you should see under which how will you classify them? Like building is there. This will be classified under which head? Building head. Furniture will go under furniture and electrical fittings. A car will go under plant and machinery. Books will go under plant and machinery. Plant and machinery will go under plant and machinery. Laptop is plant and machinery. TV is plant and machinery. Mobile is plant and machinery. Patent is intangible assets. Computer, plant and machinery. Printer, plant and machinery. Now once you classify, so can I say all the 4 classification is there? Now you see what are those items taxable at same rates, you create that block. For example, we have a building. Do we have 2-3 types of building? No, only one building is there. This building is taxable at 10%, so one block is created for building. So I'll create a block number 1 for building taxable at 10%. Then how many furnitures do we have? Do we have 2-3 types of furniture? No sir, only one furniture is there, taxable at 10% and value is 3 lakh rupees. So second block will be created by me for furniture. A rate of the depreciation will be 10% and the total furniture which I have is 3 lakhs. Then intangible assets will take intangible assets we have only one intangible assets we have for which the rate of tax is 25%. What is the value sir? 4 lakh. So I am creating a block for intangible asset which is patent. What is the value sir? 4 lakhs. Apart from that, all the other things which is there, no, that is what? Plant and machinery. If you see over here, all these items, if you are seeing over here, all these items which are highlighted, they are all plant and machinery, correct? But if you see, there are some plant and machinery taxable at 15%, correct? And there are some plant and machinery taxable at 40%. So though they are falling in the same class of plant and machinery, there are some plant and machinery which are taxable at 15% and there are some plant and machinery taxable at 40%. Now what lawmaker says, sir? What lawmaker says? Now lawmaker says you will have to group all the assets falling under same class and having same rate into one. So now they are all falling under plant and machinery. Correct. Now I will create one block. For plant and machinery is taxable at 15%. I will create another block for plant and machinery taxable under at what rate, sir? 40%. So these 2 blocks will be created. Okay, so this is so how many blocks are created? Totally 5 blocks are created. So rate of depreciation we have seen. Now very important part, we are now coming to what, sir? Computation of depreciation. How do I compute the depreciation? Now for computation of depreciation, you should take opening WDV. You take opening WDV. To that opening WDV, add assets which are purchased by you, acquired by you during the previous year. Whichever assets, whatever type of asset you have purchased during the previous year, block wise, whatever block you have created, block wise you please add all those assets. Then so assets acquired during the previous year. Now this, when you are adding, see opening WDV, which is nothing but opening value of the block, add assets purchased by you. When you are adding the asset purchased by you, you should categorize these assets which is purchased by you during the year into 3 different categories. Whatever assets you have purchased during the year, no, you should categorize them into 3 different categories. One is asset which is acquired by you during the previous year and put to use for 180 days or more. Next is asset acquired during the previous year and put to use for less than 180 days. Asset acquired by you during the previous year and not at all put to use. Sir, repeat. Opening WDV. Take asset purchased by you during the previous year and put to use for 180 days or more. Asset purchased by you during the previous year and put to use for less than 180 days. Asset purchased by you during the previous year and not at all put to use. So do this division. You will get some total. From this you subtract sale proceeds of assets sold during the year. Whatever assets you have sold, no, for that how much money you have received. Sale proceeds of asset sold during the year. That you subtract. Now whatever you get will be WDV for depreciation. This is the amount on which depreciation is required to be given by you. This is called as what, sir? WDV for depreciation. Can you please repeat once, sir? Yes. Take opening WDV. To that opening WDV, add assets which are acquired by you, purchased by you during the previous year. Subtract sale proceeds of assets sold by you during the year. Now whatever is left over is, see, opening you have taken, purchases you have added, you have subtracted whatever is sold by you. Now whatever is left over is what, sir? Now whatever is left over is called as what, sir? Now whatever is left over is the asset, is the amount on which you are required to provide depreciation. Then you give the depreciation, whatever is, once you subtract the depreciation amount, you will get your closing WDV. Now, important and critical part is giving depreciation. Depreciation under section 32. That is one of the important point. WDV for depreciation shall be divided into three categories. What is WDV for depreciation? This amount shall be divided into three categories. How will I do the division? Based on your division of asset purchased by you during the year. Meaning, you see, whatever WDV you have, no, that WDV you should divide into three categories. Which are these three categories, sir? One, asset which is not put to use by you. Two, asset put to use by you for less than 180 days. Three, asset put to use for more than 180 days. Sir, what are you doing, sir? Please tell me. Repeat again, sir. Whatever WDV for depreciation is there, I will divide that into three categories. Three categories. Which are these three categories? Asset which is not put to use. Asset, because this asset I have purchased but I have not used at all. Then asset which is put to use for less than 180 days. This assets I have purchased but I have used for less than 180 days. Then whatever is left over, these are what, sir? These are the assets which I used for the entire year. Correct? So this three division you should do. So whatever WDV for depreciation is there, no, out of that first portion you will give it to asset which is not put to use. Then once you give it to that, then you will give it to whom, sir? Asset which is put to use for less than 180 days, and balance you will give it to asset which is put to use for 180 days or more. Now, whatever assets you have purchased during the year but not put to use, for them no depreciation will be provided. Whatever assets you have purchased during the year and used for less than 180 days, for them 50% depreciation will be allowed. Meaning what, sir? Whatever normal rate is there, half of that will be allowed. For example, if the normal rate of depreciation is 15%, how much will you give if it is used for less than 180 days? 7.5%. And for the asset which is put to use for 180 days or more, you will allow how much, sir? Full depreciation will be allowed. Okay. Now, one very important point. If any asset is purchased during the previous year and is put to use for less than 180 days in that previous year, if any asset is purchased during the previous year and put to use for less than 1 days in that previous year, 50% depreciation will be allowed for that previous year. What do you mean by this, sir? If you are purchasing any asset in a year, and in the year of purchase, if it is used for less than 180 days, then for that year when it is purchased and used for less than 180 days, you will give only 50% depreciation. Meaning what, sir? If it is purchased in this year and used in next year, it does not matter for how many days you are using in next year. Next year full depreciation will be allowed. Now let us do a question for calculation of depreciation. Correct? Because see, just going through or reading the provision will not help at all. Somewhere wherever is required, let us also solve questions. Now compute the depreciation on depreciation of Priya sarees. Compute depreciation for Priya sarees using the following information. Opening WDV they have given 10 lakhs. Asset acquired by them during the previous year they have given. Sale proceeds they have given. Rate of depreciation they have given. Now what is the format, sir? Now please note, format is something which is very important under income tax law. Income tax law, what is the most important thing, sir? The formats are most important thing. What is the format over here? You should first write Mr. No, name of the company Priya's Sarees. You are calculating depreciation for 24-25, previous year assessment year 25-26. This is something which you should compulsorily write. Then what are you doing? Computation of depreciation. Particulars and rupees. Computation of depreciation, particulars and what, sir? Rupees. Now first I'll take what? My opening WDV. What is my opening WDV? 10 lakh rupees. Add assets purchased during previous year and put to use for less than and put to use for less than 180 days, put to use for 180 days or more. So for example, see this I purchased on 15th of December. So if I have purchased on 15th of December means, sorry, 25th of December, that means I would have used for 6 days of December, then January, February, March. So almost around 100 days I would have used. So can I say I have used it for less than 180 days? So I'll put 4 lakh rupees over here. Then what is this 15.9? 15.9 is what, sir? That means I have purchased it in the month of September. So September 15 days, then almost 6 more months. So almost, can I say it is more than 180 days? I have used it for more than 180 days. Yes. So I'll put it for more than 180 days category. This will give me the total value of assets which I have during the previous year, less what is the sales which I made during the year. I have sold assets, no? Assets worth rupees 3 lakh is sold by me. Now, whatever is left over, that is what, sir? My WDV for depreciation. Sir, what do you mean by WDV for depreciation? WDV for depreciation means what, sir? WDV for depreciation means this is the amount on which depreciation is required to be given by me, which is the amount 12 lakh rupees. Now comes the very important point. This 12 lakh rupees, what rate should I apply? Directly shall I apply 15% on 12 lakhs? No. What is that important thing you should note over here is calculation of depreciation. This WDV for depreciation is there, no? Which is 12 lakh. This you have to give to 3 people. First, you will give it to whom, sir? First, you will give it to that person whom you have not put to use at all, because this will have that person, that item which is not at all put to use, that item which is used for less than 180 days, and that item which is put to use for 180 days or more. Now, in our question, no, is there any item which is not at all put to use, which you have purchased but not put to use? Do we have any item which is purchased but not put to use? No, sir, we don't have any such thing. So what will I do over here, sir? Asset which is not put to use. Not put to use is how much, sir? 0. Correct, no? Or nil. Asset which is put to use for less than 180 days. How much is less than 180 days? Sir, over here, no, sir. My total value of assets which I have is 12 lakhs. Out of these, 4 lakh is less than 180 days. Correct. 4 lakh is less than 180 days. So I will give 4 lakhs over here. And can I say balancing figure is put to use for 180 days or more? Yes, sir. So how much is this balancing figure? Sir, out of 12 lakhs, if 0 is gone and 4 lakh is gone, what is remaining is 8 lakh rupees, sir. Correct. Now let us do the depreciation. How much is the depreciation? Sir, here I will apply the rate of, here because there is no depreciation given at all. Here I'll apply 15% is the rate of depreciation. But because it is put to use for less than 8 days, I will give only 50% of that. And here I will give 15% into 100% because I have used it for full year. So what is the total depreciation, sir? I'll get, in first case, I'll get 4 lakh into 15% into 50%, which is 30,000. And in second case, 8 lakh into 15%, which is 1 lakh 20,000. So total is 1 lakh 50,000. I hope this is clear to you all. So how much is the depreciation, sir? WDV for depreciation less depreciation 1 lakh 50,000. That will give me my closing WDV which is 10 lakh 50,000, 10 lakh 50,000 rupees. I hope this point is clear to you all. Is this clear, students? Is this clear? Yes, sir. Now you don't have to, I mean, in examination, you don't have to do this arrow mark system and all. Directly you can do one like this. WDV for depreciation, whatever amount you get, you here only divide into 3 categories: not put to use for less than 180 days, put to use for 180 days or more. And whatever not put to use, nothing is there. Put to use for less than 180 days, 50% depreciation, and okay, so you divide it in that manner. Now, next under depreciation, the next concept which we have is called as additional depreciation. What is that called as? What, sir? Additional depreciation. What is this additional depreciation? Lawmakers are telling, I'm going to give you extra benefit, extra depreciation called as additional depreciation. Sir, when am I going to get additional depreciation? If you are an assessee who is involved in the business of generation of power, if you are involved in the business of distribution of power, or if you are involved in the business of transmission of power, then you will get this additional depreciation. How much is the additional or you are in the business of manufacturing. So only two types of people will get additional depreciation. Who are these? Powerful people and manufacturing people. Power people and manufacturing people will get additional depreciation. Sir, how much extra depreciation will I get, sir? If I am power people or I am a manufacturer, you will get an additional depreciation of 20%. How much? 20% additional depreciation will be given to you. Additional depreciation will be given to you only if you have opted for WDV method of depreciation. Sir, you said additional depreciation is given to power people and manufacturing people. No, sir. Yes. Now, to them also, if they want additional depreciation, no, they should follow which method of depreciation? Which method of depreciation they should follow, sir? They should follow WDV method of depreciation. Which method? WDV method of depreciation. Okay, sir. I understood that they should follow WDV method of depreciation. Then, additional depreciation is available only for plant and machinery, meaning you cannot take that additional depreciation for furniture, building, intangible assets. No. Additional depreciation will be allowed only for those people who are following WDV method of depreciation. And additional depreciation will be allowed for whom, sir? Additional depreciation will be allowed only if you are only for plant and machinery. Then additional depreciation will not be available in following cases, meaning in these scenarios you will not get additional depreciation. Which scenarios? In case of used or second hand plant and machinery. So if you are purchasing a plant and machinery which is a used plant and machinery, lawmaker says no. Used plant and machinery will not give additional depreciation. You will not get additional depreciation for vessel, vehicle, aircraft. You will not get it for what, sir? Vessels, vehicles and aircraft. You will not get additional depreciation for those plant and machinery which you are using in residential accommodations. You will not get additional depreciation for those plant and machinery which is used by you in office premises, and also you will not get additional depreciation on those plant and machinery for which you have claimed 100% deductions under any other provisions of income tax law. Because you have already got 100% deduction somewhere else, why should you be given additional depreciation? Now please note, I'll repeat once again. Additional depreciation is given for power people and for manufacturing people. Additional depreciation is given at the rate of 20%. Additional depreciation is given to all type of assessees who are opting for WDV method of depreciation. Additional depreciation will be given only for plant and machinery. Additional depreciation will not be given for used plant and machinery, vessel, vehicle, aircraft, plant and machinery which are used in residential accommodations, plant and machinery which are used in office premises, and those plant and machineries for which you have claimed 100% deduction under any other provisions of the income tax law. Similarly, no additional depreciation is available if an assessee opts for 115 BAC. So if you are an assessee who is opting to pay tax under 115 BAC, for you also I will not give you additional depreciation. Further, Additional depreciation is allowed in the previous year in which asset, plant and machinery is put to use. When will I get additional depreciation, sir? In the year of purchase? No. In the year when you are in the year when plant and machinery is put to use. Further, if the plant and machinery is put to use for less than 180 days, then in that year I will allow only 50% of additional depreciation and balance 50% I'll give in next year. Meaning what, sir? If I purchase an asset and use for less than 180 days, then normally I get additional depreciation of 20%. Correct? No. If I use it for less than 90 days, this year I can claim 10%, balance 10% I can claim in next year. So with an example I have shown it over here. Next, capital gain. Capital gain, section 50 talks about what, sir? Capital gain in case of depreciable assets. Capital gain in case of depreciable assets. So in case of depreciable assets, how to compute capital gain? So there are two methods of computing depreciation. One is WDV method and one is SLM method. SLM method they will not ask in the examination. I mean, that is not something which they ask in examination. What is that thing which they'll ask for calculation of depreciation? I'm telling, they will ask which methods are WDV method. Now under WDV method, when will I get capital gain? Now please note, one important point you should note, WDV of an asset can be zero, but it can never be negative. Meaning, whenever you are subtracting the sale price, no, if the sale price is more than the WDV, then you should subtract only the WDV amount. You should not subtract the actual sale price amount, because WDV can be zero but never negative. You will understand this when I discuss this. Okay, we are now finding how we are now checking how to get when do we get capital gain in case of depreciable assets. In case of depreciable assets, when is capital gain arising? Let us say I have opening WD of 6 lakhs and I have around 5 assets with me in that block. Out of and I purchased assets worth rupees 2 lakhs, which was total 2 assets I have purchased. Total worth of these 2 assets is 2 lakhs. So total value of my assets is 8 lakhs. And how many assets do I have? I have 7 assets with me. Now all these 7 assets are sold by me for 11,50,000. All the 7 assets are sold for how much? 11,50,000. Now I have assets worth 8 lakh and I have sold it for 11,50,000. So if I subtract sale proceeds as 11,50,000, can I say this amount will come as negative? Correct? No. So lawmakers are telling WDV can be zero but never negative. So how much will I subtract? While subtracting, I should subtract whatever WDV is there before sale price. So I'll subtract that amount only and all the assets are gone. Now in this case, what has happened? Do I have any assets? No, sir. Do I have any WDV? No, sir. WDV value is also zero. Asset value is also zero. So when WDV is not there, asset is not there, how will you give depreciation? On what amount will you give depreciation? So you cannot give depreciation. However, therefore, so because you cannot give depreciation, who will come into picture now? Who will come into picture? Capital gain will come into picture. Who will come, sir? Capital gain will come into picture. So for computation of capital gain, I will take full value of consideration to be the sale price less expenses incidental to transfer, if any. Then I'll get my net sale consideration. From that, subtract cost of acquisition, I'll get my capital gain. Okay, I'll get my capital gain. Now second example, what happened was I sold all the 7 assets for 6,50,000. Now what happened? I sold all the assets but at a lesser price. Lawmaker says when you sell all the assets for a lesser price, you will have a WDV but no assets are there. Please note, I sold all the assets. I sold it for 6,50,000. Now what has happened, sir? Meaning I sold everything for lesser price. Loss will come into picture. Short-term capital loss. Now because I don't have any asset with me, can I give depreciation? I have amount, but where is the asset? No asset is there. Therefore, I will not be able to give depreciation. So asset is not there, but WDV is there. Therefore, depreciation will not be allowed. So who will come now? Capital gain will come now. 6,50,000 minus expenses, nothing. This is full value of consideration minus expenses is nothing. I'll get my net sale consideration. From that, subtract my cost. What is my cost? Before sale proceeds, whatever WDV is there, no, that will be treated as your cost. And therefore, you will get your capital gain or loss. How much is your short-term capital gain or short-term cap loss? Minus 1.5 lakhs. Similarly, last case, what has happened is I sold not all the assets. I sold only out of 7, I sold 5 assets for 9 lakhs. Now if I take 9 lakhs over here, can I say this will come as negative? Correct? No. Though I have assets, I don't have any value on which I can give depreciation. So lawmaker says depreciation will not be allowed over here. You will get what? Capital gain. How will I get capital gain? Take your full value of sale consideration, subtract expenses, you will get net sale consideration. From that, subtract your cost, you will get your capital gain. That is whatever extra amount is there, that is your capital gain. Then last case, if you have a positive WDV and if you have asset, that time you will get depreciation, meaning that time capital gain concept will not come. Now, under SLM method of depreciation, they follow something called as individual asset system. What is this individual asset system? You give depreciation for each and every asset separately, individually. Over here, no, because depreciation is for each and every asset separately, and because the amount of depreciation is also what? Same for every year, here calculation becomes very easy. But here there are some terms which you have to know. There are some beautiful terms which you are going to learn about in this particular provision. What are those terms, sir? Now let us say I purchased an asset for 100 lakh. I purchased it on 15th of August 2022, and the rate of depreciation applicable on this assets is 10% SL. I sold all these assets on 31st of December 2024. I sold it for case number 1, 72 lakhs. I sold it for how much, sir? I sold these assets for 72 lakhs. Lawmaker says, first calculate the WDV as on the date of sale. When did I sell it? I sold it on 31st December. So in the year 24-25, what is the WDV? What is the opening WDV? I should find that. So because I purchased in the year 22-23, for 2 years, I will give depreciation. 100 lakhs minus 10 lakhs, 10 lakhs. SLM method depreciation will be same. So my WDV came to 80 lakhs. So 80 lakh worth asset I sold for 72 lakhs. Asset worth how much? 80 lakhs was sold by me for 72 lakhs. So 72 lakhs, which is sale price, minus WDV or cost of this asset, which is 82 lakhs. The difference, there is a negative difference, correct? 8 lakh rupees less is there, correct? See, I sold for 72 lakhs, but the value of the assets were worth 80 lakhs. I sold for 8 lakh rupees less. Now this is a loss, no? But lawmaker says under SLM method, it will not be called as a loss. It will be called as terminal depreciation. It will be called as what, sir? It will be called as terminal depreciation. And this terminal depreciation is allowed as deduction in the previous year in which asset is sold. Meaning terminal depreciation is treated as your business expenses, and you can claim it as a deduction while computing your profit and loss account for that year in which that asset is sold. Case number 2. I sold the asset at a price more than WDV. See, first case, my WDV is 80 lakhs. I sold the asset for 72 lakhs. I sold the asset for a price less than WDV. Therefore, terminal depreciation. Sir, what if I sell the asset at a price more than its WDV, sir? Lawmaker says, if you sell the asset at a price more than its WDV, what is the sale price? 90 lakhs. WDV is 80 lakhs. Can I say here there is a gain of 10 lakh rupees? Lawmaker says this gain is not capital gain. This gain, what you have got, no, that will be called as balancing charge. This gain will be called as balancing charge, and it will be deemed as your business income in the year when asset is sold. As per section 41 subsection 2, it will be deemed as your business income in the year in which asset is sold. Now, what if the asset is sold at a price more than its WDV and more than its cost? Then lawmaker says capital gain will come. So if you are selling any asset at a price more than its WDV and more than its cost, the difference between the sale price and the cost will be treated as capital gain, and difference between cost and WDV will be treated as balancing charge. For example, I sold the asset for 112 lakhs. When I sold the asset for 110 lakhs, cost of the asset was what, sir? 80 lakhs. So what is the income which I have got? 32 lakhs. This will be divided into business income and capital gain income. How much will be my business income? My cost less WDV will be taken as business income. Cost less WDV means what, sir? Cost less WDV, whatever is my actual cost less WDV of that asset at the time of sale. This will be treated as business income balancing charge. Whatever sale price is there, from that subtract your actual cost of acquisition, you will get some amount. This will be taxable as capital gain. In simple words, if I want to tell you, in case of WDV method of depreciation, let us say this is the value of the asset. This is the price at which it was purchased. So this is the cost of the asset. Now, and this is the WDV of the asset. Now please understand this carefully. I sold the asset at a price less than its WDV. Difference between sale price and WDV is called as terminal depreciation. I sold the asset at a price more than its WDV. The difference between sale price and WDV is called as balancing charge. I sold the asset at a price more than its WDV and more than its cost. The difference between cost and sale price will be capital gain, and WDV and cost will be balancing charge. Okay. Next, section 43A. Section 43A talks about what, sir? Consequence. What will you do whenever if you have purchased an asset from outside India and while making the payment, if there is any fluctuation in foreign currency? Section 43A says consequences of change in exchange rate where asset is acquired outside India. If you are acquiring any asset from outside India, what will be the consequences for change in exchange rate? Lawmaker says if any gain or loss arises at the time of making the payment for such asset which are acquired from outside India due to fluctuation in foreign currency, then such gain or loss due to fluctuation in foreign currency shall be adjusted with the cost of such asset in the year when payment is made. Meaning, if there is any increase or decrease in the value of asset because of the payment which you are making for purchase of an asset from foreign currency, from a foreign country, whatever increment is there, whatever extra you are paying, increment means, say I would have purchased for 60 rupees when the price was 60 rupees $1. Now I am paying 60 when the price is 65 rupees $1. So I am paying extra amount, add it to the cost and claim depreciation on that extra amount also. Sir, what if I have paid lesser? When I purchased the rupee, $1 was equal to 60 rupees. When I made the payment, it was 58 rupees. I paid 2 rupees less. Lawmaker says in this case it will be treated as you should reduce the value of that asset with that amount. Okay, so whatever increase and decrease is there in the fluctuation, you should add. So how will I do? Take opening WDV, purchases you take, sale proceeds if any. Now whatever, if you have paid extra, add that. If you have paid less, subtract that. And whatever amount is coming after that addition and subtraction, on that you should claim depreciation. Now in case of amalgamation, merger and demerger, sir, what should I do with the depreciation in case of amalgamation, merger and demerger? If there is an amalgamation, merger and demerger, which is amalgamation, merger, demerger or succession etc. happening, then depreciation, for example, there will be old company and new company. Old company A Limited got amalgamated with B Limited. That means A Limited is old company now, B Limited is new company now. Now amalgamation date is 31st of December. Now what lawmaker says is, because the asset would have been used by A Limited for some period of time, that is till 31st of December, and thereafter it was used by B Limited, depreciation will be given to both A Limited and B Limited. And how will this depreciation be given? This depreciation will be given based on number of days asset was used by old company and new company. Now what is this point telling, sir? Compute the depreciation for the previous year normally, ignoring the amalgamation, merger, demerger. Meaning what, sir? Ignore that amalgamation, merger, demerger happen and compute the capital gain normally. Divide the depreciation to old and new company in the ratio of the number of days the asset was used by them. Then whatever depreciation you have got, that depreciation you divide between these companies in the ratio of asset it was used by them. Okay, so I mean this is simple. Then we have a concept under depreciation, which is last concept under depreciation, called as unabsorbed depreciation. What is this unabsorbed depreciation, sir? If your current year business income is not able to take care of your current year depreciation, that depreciation which is left over is called as unabsorbed depreciation. Sir, I didn't understand. Say for example, 100 rupees is my income, 80 rupees is my expenses. So can I say 20 rupees is my profit? Correct, not correct? 20 rupees is my profit. Now if my income is 100 and if I spent 130 rupees, can I say I will not be able to actually pay 30 rupees. This 30 rupees which is extra, which is incurred by me, which is over and above my income, is called as unabsorbed depreciation. If the current year business income is not able to fully adjust the current year depreciation, then such unadjusted depreciation is called as unabsorbed depreciation. Unabsorbed depreciation can be carried forwarded for indefinite period and can be set off or adjusted against any income in future years. If your current year income cannot absorb current year expenses, it is a business loss. If current year income cannot absorb current year depreciation, it is unabsorbed depreciation. Yeah. One more point for depreciation is cost, actual cost. Meaning, on what amount should I give depreciation, sir? What is this actual cost telling? On what amount depreciation is required to be given? So should it be at purchase price, sir, or should I add any expenses incurred for purchasing that asset? Lawmaker says if you have incurred any expenses for purchasing the asset, that also should be added in actual cost. For example, my cost of asset, I will take whatever my purchase price is there, add any installation charges, transportation charges, transit insurance you are taking, packing charges, trial run, test run charges, any taxes you have paid for this, unless until you are taking input tax credit of that, any interest on loan you have taken for the asset, etc., till the time the asset is put to use, whatever interest you have paid, all that should be added. And subtract if any benefit you have received, government grant you have received, if you have received any money by selling this trial run product, etc., whatever is left over now will be the actual cost. This is the price on which depreciation is required to be given, meaning this is the price which are required to be considered for calculating depreciation. In simple words, once you purchase an asset, till the asset is put to use, if you are incurring any expenses till the asset is put to use, all those expenses shall be added by you while computing your actual cost. Next, now please note these expenses, if you are making the payment in cash in a single day to a single person for a single expenditure for how much, more than 10,000 rupees, if you are making in cash, then they will be disallowed. Please note, payment made in excess of rupees 10,000 in a single day to a single person by any mode other than account pay check, account pay demand draft, or electronic clearing system shall not be considered while arriving at the actual cost. Correct? Now there are some other points also with respect to this. If stock in trade is converted into business asset, then depreciation will be given. For that, actual cost will be what, sir? Market value of that stock which you have converted into business asset. Now, if you are getting any asset by way of goodwill, will, etc., a gift or will, then you will, whatever price the asset was purchased by the previous owner, from that time you will give depreciation till the date he transferred it to you, as if it was used for business purpose. Similarly, if you are purchasing an asset from someone at a higher price to claim higher depreciation, lawmaker says assessing officer will determine the actual cost in such cases. Similarly, if I sell an asset to someone and repurchase the same asset from that person at a higher price, then actual cost will be my sale price or repurchase price, whichever is less. Similarly, if I purchase asset from someone and give it back to the same person on lease, actual cost of that asset will be what, sir? Your purchase price or lease price, whichever is less. Then if there was any building which was used by me for my personal purpose, now I am using it for my business purpose, lawmaker says in such cases actual cost of that building to be recorded in your books will be whatever was the purchase price of that building less depreciation for that building from the time it was purchased till the time it was put to use for business purpose. Meaning this depreciation which is given, no, this actually you are not claiming deduction of this depreciation, but you are reducing the value for recording in your books of accounts. This type of depreciation is called as notional depreciation. Next topic for our discussion is scientific research. Next is what, sir? Scientific research. Scientific research means any activity for extension of knowledge and knowledge in the field of natural or applied science. Very important section, section 35. Now scientific research can be of two types. You can either do in-house scientific research, or you can do a research, you can give money, donate money to someone who is already doing a research. If you are doing in-house scientific research, then what is the provision telling? Well, let us see first. Now, if it is an in-house scientific research, meaning assessee is doing research for his own business purpose, then check when is the expenditure incurred by him. If the expenditure is incurred by him after commencement of business, whether it is a capital expenditure or revenue expenditure, it does not matter. 100% of whatever expenditure he has incurred, it will be fully allowed as deduction while preparing profit and loss account. Wait. If you are doing in-house scientific research, and if you are incurring any expenses for that kind of research after starting the business, after commencement of business, then whether that expenditure is a capital expenditure or revenue expenditure, it does not matter. Meaning the nature of that expenditure will not matter whether it is a capital expenditure or revenue expenditure. That expenses will be fully allowed as deduction. It will be fully allowed as deduction. Now, if the expenditure incurred by you is before commencement of business, if you have incurred the expenses when, sir, before the start of business, before the commencement of business, then check whether it is a capital expenditure or a revenue expenditure. If it is a capital expenditure, 100% of that expenditure will be allowed as deduction except on land. And if it is a revenue expenditure, you can take revenue expenditure only for salary, excluding perquisites and material amount. Any other type of revenue expenditure shall not be taken. And a very important point to be noted, if it is incurred before commencement of business, you can take expenditure, all those expenditure incurred 3 years before commencement of business. Anytime, any expenditure incurred before the 3 years period will have to be ignored by you. Sir, once again, can you please repeat? Yes. For example, I am a company who is involved in the manufacturing mixtures, or I am a company who is involved in manufacturing chips. So I am doing some kind of research to make new types of chips. Now, what am I doing, sir? I am doing in-house research. In-house research means I am doing research for my own business. Now, for doing this research, I have to purchase some raw materials. I will have to purchase some machineries, etc. I will have to pay rental expenses. I will have to pay a lot of different expenses, etc. Lawmaker says, if you are doing any research for your own business, and if that research is done by you after commencement of business, meaning I am already selling chips, but I want to introduce a new chips, so I am doing research after commencement of business. Now that research, for that research you may incur expenditure. That expenditure can be capital or revenue. Lawmaker says whether it is a capital expenditure or a revenue expenditure, it does not matter. It will be fully allowed as deduction, except on land. Meaning except the price of purchase of land, except that any type of capital expenditure, plant and machinery, building, etc., whatever you have purchased, that fully allowed as deduction. Fully allowed as deduction. Normally you get depreciation, but they tell no, I'll give you full deduction. And if it is a revenue expenditure, if you have paid salary, bonus, remuneration, some hiring expenses, etc., that also will be fully allowed as deduction. However, if you incur the scientific research expenditure for your business purpose, but before starting the business, if you are incurring that expenditure before commencement of business, lawmaker says here capital expenditure, though I will give it fully to you except on land, but revenue expenditure, no, I will give only for salary, which is excluding perquisites and materials. Anything apart from that revenue expenditure will not be allowed as deduction. Please note, when I am going back, I should go maximum how many years back, sir? Maximum 3 years back only I can go. Meaning I can take expenditure benefit of last 3 years only before the commencement of business. Note, because I am giving you 100% deduction on plant and on capital expenditure over here, can I claim depreciation on those items, sir? Lawmaker says no. Lawmaker says what, sir? If you have got 100% deduction, where any deduction under section 35 is allowed for any asset, depreciation under section 32 will not be allowed for such asset. You will not get depreciation for such asset. Further, if any building is purchased along with land, then the fair market of such land and building should be considered, and only deduction will be allowed only for building. if you are purchasing any building along with land, lawmaker says only if you are purchasing any building along with land, lawmaker says for building I will give deduction, for land I will not give deduction. How will I come to know, sir? You see the market value of the land, market value of building. Building, claim deduction, land, ignore it. Now unabsorbed capital expenditure is there, no, under section 35, should be treated just like your unabsorbed depreciation. They should be treated in a similar sense, meaning whatever provisions you are going to learn for unabsorbed depreciation, same will be applicable for this also. Now if you sell any capital asset asset for which you have claimed deduction under section 35, lawmaker says if you sell any asset for which you have claimed deduction under section 35, lawmaker says in such cases what will happen, sir? Following shall in such cases what will happen, sir? Following shall be business income. In that cases following will be business income. If you sell, then whatever deduction you have claimed earlier or whatever is your sale price, whichever is less will be your business income. Sale price or deduction claimed earlier, whichever is less will be your business income. And where the sale price or cost of more than cost of asset, if you have sold the asset at a price more than its actual cost, then your business income will be cost of asset or deduction whichever is lower, sale price minus cost will be taken as capital gain. Okay, whatever cost is there that will be taken as business income, and extra amount which is there that will be taken as capital gain. Next, donation to research organization or research association or researchers. If you are giving money to someone, donating the money to someone. Donation to approved research association, approved institution, approved college, approved university. If you are giving donation to approved research association, institution, college or university for conducting scientific research, social research or statistical research, then 100% of that expenditure given by you is allowed as deduction. How much ever money is given by you as donation to approved research association for conducting this research is allowed as 100% deduction. Similarly, if you are giving donation to an approved Indian company who is engaged in the business of research and development, and if it is conducting scientific research, whatever amount you are paying, 100% of that is allowed as deduction. If you are giving money to national laboratory, IIT, university, if these units are conducting approved research, if they should be doing approved research, then 100% deduction is allowed to you. Now please note, if you are following 115 BSc, you will not get deduction for this donation. If I am following 115 BSc, will I get in-house scientific research benefits, sir? Yes, but you will not get the benefit for donation. Section 35 to AB, in-house research and development in certain companies. So if you are a person who is involved in the in-house research, and if you are what type of assessee, if you are a company who is manufacturing any article or thing, or if you are a biotechnology institution, then deduction will be given for capital expenditure. 100% of whatever expenditure is incurred by you is allowed as deduction except on land and building, and revenue expenditure 100% allowed as deduction, meaning this is only for certain companies which is manufacturing and biotechnology company, etc. Not that important. Section 35 AD. 35 AD talks about what, sir? Section 35 AD gives the list of different businesses. Section 35 AD gives list of around 14 businesses. Section 35 AD gives list of 14 businesses. If you incur any type of capital expenditure for these businesses, if you incur any capital expenditure for these businesses, then that capital expenditure will be allowed as deduction for you. That capital expenditure will be allowed as deductions for you. What is this point telling, sir? Specified businesses. If you are setting up and operating cold chain, or if you are having any honey related business, if you are setting and operating warehouse for sugar, if you are across the country or laying natural gas or crude or petroleum oil, if you are building and operating 2-star or above category hotel, if you are building and operating affordable housings, etc., if you are building and operating slum redevelopment, fertilizers in India, if you are manufacturing new infrastructure, if you are building and operating hospital, warehouses, semiconductor wafer fabrication or inland container depot, or you are in iron ore, if you are what, sir, laying and operating slurry pipeline for iron ore, in all such cases Section 35 AD will be applicable. 14 businesses. What is this section telling, sir? Any assessee engaged in specified businesses and incurring what, sir? Capital expenditure except on land, building and goodwill. Meaning any type of capital expenditure you can claim 100% deduction except on land, goodwill and financial institution. Any assessees engaged in specified businesses, these 14 businesses, and if you are incurring any capital expenditure, any type of capital expenditure except on land, building and goodwill, whatever capital expenditure is incurred by you for that business will be allowed as deduction fully, 100%. Now, but this section is optional. If you want to follow this section, you follow, or else you can ignore this section and follow what is normally applicable under business income topic. Section 35 AD is optional section. Section deduction under section 35 AD is optional. Assessee may or may not opt for this section. New business. Such businesses should not be set up by splitting up or reconstruction of existing business. New plant and machinery. The plant and machinery used in the businesses should be a new plant and machinery, except, meaning normally whatever plant and machinery for which you want to claim deduction over here, those plant and machinery should be a new plant and machinery, except 28% of the total plant and machinery can be old, and imported second-hand plant and machinery can be treated as new plant and machinery. Next, deduction for capital expenditure. Deduction for what, sir? Deduction for capital expenditure. 100% deduction is allowed under this section for capital expenditure. 100% deduction is allowed under this section for capital expenditure. If it is incurred after commencement of business, it will be allowed in the year when such expenditure is, meaning when are you incurring the expenditure? Are you incurring the expenditure before starting the business or after starting the business? If it is incurred by you after starting the business, whatever expenditure you are incurring, whenever you are incurring, 100% deduction will be allowed. If you are incurring the expenditure before commencement of business, it will be allowed as deduction in the year in which business is commenced. If it is after, then whenever you are incurring the expenses, you can claim deduction. If it is before, it is allowed at deduction in the year in which business is commenced, provided that you have capitalized the expenditure in books of accounts. No double deduction will be given. If you have claimed deduction over here, you cannot claim deduction anywhere else. Then no depreciation will be allowed if you have already claimed deduction under section 35 AD for any asset. The asset for which you are claiming deduction under section 35 AD should be, there is a lock-in period of 8 years, should not be sold by you or transferred to any other business for within a period of 8 years. What if you sell it, sir? Then whatever deduction is given to you earlier will be taxable in the year of change. Then, sir, loss of 35 AD. See, 35 AD businesses, if you're doing, that means that is heavy investment business. These businesses are heavy investment business. So there will be huge amount of loss you may incur. This losses of specified business can be set off only against specified business income. You can set off it only against specified business income. Loss not set off in the current year can be carry forwarded and set off in future year, and it can be carry forwarded for indefinite period. There is no limit. Okay. So there are some questions with respect to that. Section 35D talks about preliminary expenditure. What is preliminary expenditure, sir? Any expenditure incurred before commencement of a new business of an undertaking or after commencement of business, but for splitting up or extension of existing business. If it is happening, then deduction is allowed in 5 equal installment from the year in which business is commenced. Amount of deduction, if you are an Indian company, actual expenditure or 5% of capital employed or 5% of cost of product, whichever is higher, that will be compared with actual expenditure and taken, whichever is less will be taken as deduction. But if you are not an Indian assessee, if you are any other type of assessee, but a resident assessee, then 5% of cost of project or actual expenses, whichever is less, will be allowed as deduction. Now, what is capital employed, sir? Share capital excluding reserves and surplus, debenture, meaning the money which is put is in the business. Share capital, debentures and long-term borrowings. Cost of project is amount invested in the fixed asset of new project as per the books of account. Preliminary expenses are listed below. Which are the different preliminary expenses for which you can claim deduction? Preparation of feasibility study report, preparation of MOA and AOA, legal expenses, engineering expenses, marketing expenses, expenses for public issue of shares and securities. These are all treated as different preliminary expenses. Section 35 DDA, expenditure incurred under voluntary retirement scheme. If you incur any expenditure with respect to voluntary retirement of any employee, and if you are paying money to that employee, that expenditure will be allowed as reduction in 5 equal installment from the year in which it is paid. Now 35D related one question is there. See, there is an preliminary expenses of 11 lakh incurred by a person. Cost of project is 30 lakh rupees and capital employed is 30 lakh rupees. So I'll take 5% of cost of project or 5% of capital employed, whichever is higher. What will come as higher? 5% of capital employed will be higher. That will be compared with actual cost and I'll take whichever is less. So it is 11 lakh or 2 lakh, whichever is less, 2 lakh rupees. This will be allowed as reduction in 5 equal installment from the year in which business is commenced. Next is what, sir? Next is our section 36. What is section 36 talking about? Section 36 talks about, one second. Section 36 talks about what, sir? Section 36 talks about other expenses related to your business which are allowed over here. Section 36 gives the list of different expenses which you can claim as deduction. Now, section 36 subsection 1, okay, then these are all clauses under that. Section 36 subsection 1 says, if you are paying insurance premium, if you have taken insurance for your stocks and stores, then you will be paying some insurance premium that is allowed as deduction. Similarly, if you have taken insurance for health of your employees and if that insurance premium is not paid by you in cash, then whatever insurance premium is there, that will be allowed as deduction. Then if you are paying any bonus or commission, if you are paying what, sir? If you are paying any bonus or commission to your employees, that is allowed as deduction subject to 43B. What is this subject to 43B means, sir? For subject to 43B means provided that the bonus and commission which is there, no, it should be paid within the due date of filing income tax return. So section 43B gives the list of some expenses. It gives list of some expenses which will be allowed as deduction, meaning these expenses you can claim while preparing your profit and loss account only if these expenses are paid within the due date of filing income tax return. If it is paid after the due date, sir, then they will not be allowed in that year, but they will be allowed in future years. So bonus and commission is allowed as deduction only if any bonus or commission is paid to the employees, it is allowed as deduction subject to 43B. Then interest on loan. Interest on loan means what, sir? If you have taken loan for your business and profession, and if you are paying interest for that loan, if that loan is taken from scheduled bank, cooperative society, public financial corporation, state finance corporation, state industrial corporation, and NBFC, all these are, let us call them as scheduled bank. I mean, they are all bank. They are all bank. It can be cooperative bank, whatever types of bank. They are all recognized organization. If you take loan from bank, it will be allowed as deduction. Interest, whatever you are paying for that loan, no, which you have taken for your business purpose, that will be allowed as deduction subject to section 43B. Meaning, provided that you have paid that interest within the due date of filing income tax return. The due date of filing income tax return is 31st of July in normal cases of assessment year, and in audit case or in case of company, it is 31st of October of assessment year. So you should pay. What is this 43B telling? There are some expenses you should pay within this time. Which are these expenses? Like bonus and commission, like interest from banks. Correct. Sir, what if I am taking loan from any other person? It will be allowed as deduction whether that loan interest is paid or not paid. Then deduction on what, sir? Zero coupon bonds. Zero coupon bonds means what, sir? Those bonds which are purchased, which are issued by you at a discount and redeemed at par. So because it is issued at a discount and you are going to redeem at par, there is a discount component, meaning you have issued at 100 rupees, and when you are going to redeem it, you are going to redeem that 120 rupees. So 20 rupees is there, no, that is an expenses for you because you are going to pay extra. That expenses should be amortized over the useful life of zero coupon bond on pro rata basis. How this amortization is required to be done, sir? This amortization is required to be done by you on pro rata basis. Then employer's contribution to employee ka welfare fund. So there are some welfare fund which are created by the employer, the company, for the welfare or for the benefit of employees. If I am paying money for these funds, then it is allowed as deduction. Which are these funds? Recognized Provident Fund, approved superannuation fund, approved gratuity fund, approved statutory provident fund, or any other approved welfare fund. Now, if you are putting money, no, if the company, if the employer is depositing the money in these funds, then the employer, for him, because he's depositing the money, for him it is an expenses, no, he can claim the deduction of that expenses while preparing his profit and loss account, provided that it is paid within the due date of filing return. All this amount which you are depositing over there, no, it should be paid by you within the due date of filing income tax return. And if you are contributing the money to pension schemes referred in section 80 CCD, then whatever actual contribution is there, or 14% of salary, whichever is less, will be allowed as deduction. Here there is an amendment. It was 10%. Now it is increased to what, sir? 14% of salary. Over here, what is the meaning of salary? Basic plus DA in terms. Then, sir, I am doing business, sir. For my business, I have incurred bad debts, sir. Some people are not paying the money to me, sir. Can I claim that as deduction, sir? Yes, lawmaker says bad debts, if they are related to your business, then you can claim it as your business expenditure. It is allowed as deduction. But however, if the bad debts is because you have given money to someone, therefore he's not giving back the money, that is not allowed. See, I am into sari business. I sold sari to someone. Now he has not given the money for the sari which is sold by me. Can I claim it as deduction, sir? Lawmaker says yes. But I am a person who is in sari business. I have given to one of my friend 200 rupees loan. He did not pay me. Lawmakers are telling this is not your business related, so I will not allow it as business expenditure. However, if my business is only giving loan, lawmaker says, then so definitely I should give no. Provision for bad debts not allowed as deduction. What is this? Next point telling. Conditions for deductions. If you want to claim, now please note, sometimes in the question they'll give you actual bad debts and provision for bad debts. Provision for bad debts is not allowed as deduction. Only actual bad debts are allowed as deduction. Then provision for bad debts, yes. Conditions for deductions. What are the conditions for claiming deduction? If you want to take deduction of bad debts, you will have to satisfy this condition. What are the conditions? Deduction debt was treated as income in any year, any previous year, before treating it as bad. So before treating it as a bad debt, you should have treated that as an income in any of the previous years, and that debt should be written off by you in your books of accounts. And whatever debt you are treating it as bad, no, that should be written off in your books of account, meaning you should reduce the value of that debtor accordingly. Now, what if recovery is happening, sir, of bad debts? Bad debt recovery will be taxable in the year when it is recovered. Whenever you are recovering the bad debts in that year, it will be taxable. It will be deemed as your income under section 41 subsection 4. Then family planning expenditure are incurred. So if any company is incurring family planning expenditure, if any company is incurring family planning related expenditure, if it is a revenue expenditure, 100% deduction will be allowed in the previous year in which such expenditure is incurred. And if it is a capital expenditure, it will be allowed in 5 equal installments. So repeat. Family planning related expenditure is allowed as deduction only for companies. If it is a capital expenditure, it is allowed in 5 equal installment. If it is a revenue expenditure, it will be allowed in the year in which such expenditure are incurred. Similarly, if you are using any animal for your business, at the time of purchase of that animal, they will not give you any deduction. But at the time when the animal is dead or it becomes permanently useless, at that time you can claim deduction. How much will be deduction, sir? Whatever cost of asset is there less scrap value. Security transaction tax if you are paying, commodity transaction tax if you are paying, and if you are in a trading business, you can claim that deduction while computing your trading income. So these pages are the explanation for all the above points. Now comes the last section for expenses. Section 37 talks about general expenditure. This section says what, sir? This section allows for deduction of all the business expenses. However, it does not allow the deduction for business losses. So any expenditure which is not covered above, any expenditure about which we have not yet studied at all, if it is related to your business, any expenditure about which we have not yet studied, and if it is related to your business, if it is not covered anywhere above, if it is related to your business, it will be allowed as deduction under which section? 37. What is the condition 37 telling, sir? 37 says this section allows for deduction of all the business, all other business expenses. Business losses are not covered over here. Condition to claim as deduction: expenses should not be covered under 30 to 36. So if it is already covered over there, you should not come here. That expenses should be wholly and exclusively for your business purpose. That expenses which is there, no, that should be for your business purpose. You should have incurred that expenses for your business purpose. Then that expenses should be wholly and exclusively for business. The expenses should be not of personal nature. That expenses should not be of capital nature, and that expenses should not be an offense prohibited by law. So I repeat, expenses should be covered from 30 to 36. It should not be personal expenditure. It should not be capital expenditure. It should be incurred by you exclusively for your business purpose, and it should not be an offense prohibited by law. Now, important points to be noted over here. If any penalty for breach of law is collected, it is not a expenses related to the business. But if any penalty is collected for breach of contract, you can claim it as a deduction as your business expenditure. Similarly, if you are paying salary to your employees, allowed. If you are paying salary to your partners, if it is a working partner, allowed as deduction. If it is a sleeping partner, not allowed. Similarly, salary paid to director is also allowed as deduction, and leave salary is also allowed as deduction. Insurance premium, if you are paying to your business, insurance premium paid for whom, sir? For insurance premium paid for life of an employee, not allowed as business expenses. If it is for health of the employee, allowed. Stocks and assets, allowed. If it is for keyman insurance, then also it is allowed. Advertisement expenses, you are incurring any type of advertisement expenditure for advertising your business, etc., allowed as deduction. However, that advertisement, if it is in the newspaper, pamphlet, brochure, or of any political party, lawmaker says I will not give you any deduction. If you are incurring CSR expenditure, corporate social responsibility expenditure, not treated as business expenses, not allowed. Then, if you are paying any income tax, direct tax, surcharge, cess, health, education cess, etc., or if you are paying any interest under income tax law, penalty under income tax law, nothing is allowed as deduction while computing your business income. But if you are paying GST and if you are paying interest under GST law, that will be allowed as deduction. Penalty will never be allowed. Any other type of expenses is 100% allowed, like telephone expenses, internet expenses, printing, stationery, audit fees, etc. They are all allowed as deduction. Next, we have section 43B. Section 43B, as I told you, gives the list of different expenses which is allowed as deduction only if it is paid within the due date of return filing. Which are those expenses? Flirt, bonus. These are the expenses which are paid only, which will be allowed as deduction only if it is paid. Any tax, so below are the expenses allowed as deduction if they are actually paid within the due date of filing income tax return. Which are these expenses, sir? Any tax, duties, cess, fees under any law for the time being in force. Bonus or commission to an employee. Employer contribution towards superannuation fund, recognized provident fund, gratuity fund, etc. Employer का contribution. Leave salary or interest on loan from scheduled bank, public financial institution, state finance corporation, state industrial investment corporation, NBFCs, or any other amount payable to whom, sir? Indian Railway for use of railway asset. Now please note, all the above expenditure will be allowed as deduction only if they are only if the payment is made within the due date of filing income tax return. Sir, what if income tax return is filed after the due date, sir? Then it will be allowed in that year in which the return is filed. Now here there is one newly added point. What is that point, sir? In case you are purchasing any goods or if you are availing any services from an MSME, then section 43B says you should make the payment to that MSME within that stipulated timeline. If you don't make the payment to that MSME within that timeline, then that expenditure will not be allowed as deduction for that year. A new point has been added under section 43B in relation to amount payable to micro small enterprises under MSME. Who is a micro enterprises? If the investment made by you in the company is less than 5 crores, and if the turnover is less than if the investment is less than 1 crore and the turnover is less than 5 crores, you will be called as micro enterprises. If the investment is less than 10 crores and turnover is less than 50 crores, you will be called as small enterprises. Now, as per section 43B, amount payable for an expenses to a micro and small enterprises should be paid within number of days agreed between the supplier and the recipient, or 15 days in case there is no such agreement, whichever is less. Now, the agreed date should not be more than 45 days. If the payment is made within the not made within the above period, then the expenses will be allowed as reduction in the year in which such payment is made. Next 40. Next is section 40 small a. Section 40 small a talks about TDS related points with respect to business related expenses. Expenses which are specifically disallowed, meaning these expenses though you can never claim as deductions, specifically they are disallowed. These expenses are specifically disallowed. You can never claim these expenses as your deduction. Which are the expenses, sir? If you are paying any interest fee for technical services or royalty outside India, or you are paying interest, technical fee, royalty to a non-resident or a foreign company in India, and at the time when you are paying this money, if you have not deducted TDS during the previous year, or after deducting the TDS in the previous year, or not paid the TDS amount to the government within the time limit, then 100% of these expenses will be disallowed. Okay, that year you will not get deduction. When will I get deduction, sir? It will be allowed subsequently when the TDS is deducted in next year, and if it is and paid in the year in which it is paid, basically. Now similarly, if the payment relates to a resident person, then 30% will be disallowed. What is this point telling? Any sum payable to a resident in India where TDS is not deducted, or after deduction of TDS in the previous year it is not paid to the government within the due date of section 139(1), then 30% of that expenditure shall be disallowed. It will be allowed in the year if it whatever 30% is disallowed, no, that will be allowed in next year whenever it is paid. Now this disallowance provision shall not apply. Whatever disallowance provision you are we have studied, no, that will not be applicable. That will not be applicable if the recipient has shown that income as his income in that previous while filing his income tax return, and he has paid the taxes. Now due date of paying the TDS is 7th of next month normally, and in the month of March it is 30th of April of next year. Next, any income tax including surcharge and cess is not allowed as expenditure. Any wealth tax you are paying is not allowed as deduction. Next, any salary you are paying outside India or to a non-resident in India, if TDS is not deducted and paid to the government within the time limit of TDS, it is never allowed as deduction. Any contribution to welfare funds of employee, if TDS arrangement is not made, not allowed as deduction. Any tax on non-monetary perquisites or any amount. These two sections are very important sections. Section 40A2 and 40A3. We'll see it in the next page. Wait. Section 40A2 talks about what, sir? Unreasonable or excessive payment made to a related person. If you make any unreasonable or excess payment to a related person, then that excess amount or unreasonable amount shall be disallowed. Who is a related person? For individual, his spouse, father, mother, brother, sister, lineal antecedent, lineal descendant is stated as related person. For HUF, members of HUF are related person. For firm, partners of the firms are treated as related person. For a company, director of the company, and for holding company it is the subsidiary company. Now any person who is having substantial interest in the business is also treated as related person. Substantial interest means what? Substantial interest means what, sir? 20% of more, or 20% or more voting rights, or 20% or more holding in the company. 40A3 says, if any payment is made in excess of rupees 10,000 for a single expenditure in a single day to a single person by any mode other than account pay check, account pay demand draft, or electronic clearing system, then such expenditure shall be disallowed fully. If I am making the expenditure in cash, bearer check, cross check, not allowed. If it is account pay check, account pay demand draft, or electronic clearing system, then only it is allowed. What is electronic clearing system? NEFT, RTGS, UPI, net banking, etc. Now, this limit will be how much, sir? 35,000 in case of a transporter. In case of a transporter, the limit amount, this limit will be how much, sir? 35,000. Whenever you are making a transport payment to transporter, goods carriage agency, etc., 35,000 rupees instead of 10,000 rupees. Next, 40 capital A7 says, if you are making any provision for gratuity and if it is not payable in the same year, it is not allowed as deduction. Similarly, if you are contributing any money to unrecognized funds, then it is not allowed as deduction. Next is one important point with respect to taxation of firm. Okay, taxation of firm. After this, I mean, we'll do one question with respect to PGBP, whatever we have discussed till now. So it will be good and useful for us for understanding the provision even in a better manner. Section 40B, remuneration and interest to partners of a partnership firm. Remuneration means what, sir? Salary, bonus, commission, or any other amount. Interest means what, sir? Interest on loan or capital. Remuneration and interest is allowed only if it is authorized by partnership deed. Meaning, you can pay remuneration and interest to the partners only if the partnership deed is telling you to pay. If nothing is mentioned in the partnership deed about remuneration and interest, you cannot pay it to them. Remuneration and interest is allowed prospectively and not retrospectively. Meaning, remuneration and interest will be allowed as deduction only from the date when you have started paying it, not from a previous day. Remuneration and interest, if it is paid to a working partner, it will be allowed. If remuneration, if it is paid to a working partner, it will be allowed. If remuneration is paid to a sleeping partner, not allowed. Interest, if it is paid to a working partner, allowed. Sleeping partner, then also allowed. Because interest is paid on money which is given by you, it will always be allowed as deduction whether you are a working partner or sleeping partner. Remuneration will be allowed only if you are a working partner. Maximum amount of interest allowed as deduction under 40B is 12% per annum to each partner. How much is the interest which you can give? Maximum interest which is allowed as deduction is 12% per annum. So whatever interest is given as per deed, or 12%, whichever is less, will be allowed. So if nothing is given in the deed, sir, no interest is allowed. If 15% is given, only 12% is allowed. 8% is given, 8% is allowed. Whatever is given, or 12%, whichever is less. Important, major changes have happened in this provision. Very important. There is a major amendment in this. Remuneration is allowed as per section 40B. Remuneration under section 40B depends upon the book profit of the firm. If the book profit of the firm is up to 6 lakh rupees, then the remuneration which you can give is 90% of the book profit, or rupees 3 lakh, whichever is higher. Remuneration, can the partnership firm give remuneration to partners? Yes. The remuneration which you are required to give will depend on the amount of book profit which you have. If the book profit is up to 6 lakh rupees, remuneration which you can give is 90% of the book profit, or 3 lakh rupees, whichever is higher. If the book profit is more than 6 lakhs, then for first 6 lakhs, it will be this 90% of book profit, or 3 lakh, whichever is higher. And for remaining amount, it will be balance book profit into 60%. You add this, you will get your remuneration. How do I calculate book profit? Book profit is nothing but your business income before remuneration and interest. Your business income before remuneration and interest. Take your net profit as per income tax law before remuneration and interest. Subtract the interest as per 40B. Now whatever left over is called as book profit. Now income of a partnership firm and partners. Whatever income is earned by the partnership firm is taxable at the rate 30%. It is taxable at what rate, sir? It is taxable at flat 30%. Taxability of income earned by partners. So whatever income firm is earning, that income tax at flat 30%. What about the income which is earned by partners, sir? Taxability of income earned by partners from the firm. If the partners can earn two things: remuneration and interest. Three things: remuneration, interest, and share in profit. If they are earning remuneration and interest, and if that remuneration is and interest is within the limit given in 40B, then that will be allowed as deduction for the firm, and it will be exempt in the hands of partners. It will be allowed as deduction in the hands of firm, and it will be taxable in the hands of partners as business income. Sir, repeat. See, whatever a partnership firm is giving to partners, remuneration and interest, if it is within the limit given in 40B, it will be allowed as deduction for partnership firm while computing the business expenses, meaning they can treat it as business expenses. But for partners, that same amount will be taxable as business income for partners. Then if the remuneration and interest is more than the limit given in 40B, then up to the limit of 40B, it is allowed for the firm, and for partners it is business income. And any amount in excess of 40B will be disallowed for the firm. Firm cannot claim that extra amount as deduction. And for partners, what will happen, sir? For partners, it will not be taxable in the hands of partners, because firm has already paid tax on that. Whatever share in profit a partner is earning from partnership firm is exempt under 10(2)(a). Next, section 41. Section 41 talks about what, sir? Deemed business. What do you mean by deemed business? Deemed business income, meaning they have given list of some incomes which will be deemed as your business income. For example, remission or cessation of trading liability. So if you had any expenses for which you had to pay the money, now if the person to whom you are supposed to pay the money says that please don't pay the money to me, that means it is a remission or cessation of trading liability. That is your business income. On the date when that person is telling don't pay the money to me, on that date it will be deemed as your business income. Then balancing charge. You remember balancing charge we have discussed already. Then sale of scientific research asset also it is discussed. Recovery of bad debts also is discussed. Correct. Similarly, brought forward losses of defunct business. So if there is any business which is no more functional, that business is closed. Now any loss related to that is recovered today. Say you had shown some expenses today, it is recovered today, it will be taxable in your hands as business income. Now we'll see how to solve PGBP question. So there are two methods. One is direct method, and another one is indirect method. Mostly what we use, sir, mostly it is indirect method, meaning 99% of the time it will be indirect method. Direct method, what do we do? Direct method, they'll give the list, give a complete list of all income and expenses, etc. You should see what is business related, only those income you should take, and whatever is expenses is related to the business, only that you should take. So this method is used when list of all the income and expenses details are given. For example, income you should take as per 28 and 41, expenses you should take as per section 30 to 37. Difference is business income. Indirect method is required to be used by you when the question gives you profit and loss accounts. This method is followed when profit and loss accounts is given, or when net profit is given along with extra additional information or adjustments. So what will I do for this, sir? I will take the net profit as per what is given. I will subtract the income taxable under other heads. If it is already included in the net profit, please subtract those income. Add the expenses related to other income which is shown in our profit and loss account. Add the expenses which are required to be allowed, add the expenses which are debited, meaning which are subtracted, but it is not allowed under income tax law, because that much extent my profit should increase. Expenses allowed but not debited, subtract that, meaning this is an expenses which I could have claimed but I have not shown at all. Business income which is not credited to the profit and loss account, add that, you will get your business income, final business income, PGBP income. Let us do one question.
Question. எங்க இருக்கே question? Let us take up this question.
Let us see how to solve business income question. Now this is the question which is asked in the examination. So how will I solve if it is asked in the examination? Please see this. Mr. Shivam, a retail trader of Kochi, gives the following trading and profit and loss account details for the year end. Trading and profit and loss account for the year end 31st of March 2025. Opening stock they have given, purchases they have given, gross profit, sales and closing stock they have given. Please note, whenever you are reading profit and loss account, when you read you should make sure that you should identify those items which are not related to business. Now trading account, everything is related to business only. Salary they have given, rates and taxes, interest, depreciation, printing stationery, then what is this, postage and telegram, etc. Then what they have given is loss on sale of shares. Can I say this is related to my capital gain? Because it is related to my capital gain, this should not come over here. It should go under capital gain. So we will have to remove it from here. Because I have recorded this loss, my income which is 50,000, can I say it is less by 8,100? If I would have not recorded this, my income would have been more by 8,100. So what will I do, sir? To this, I will add this amount. Then other expenses they have given. Then gross profit they have given, income from UTI. This is an income which is related to which head, sir? Income from other source. And this is related to income from capital gain. Other sources means my profit is more by 2,400, so I should subtract this income because it is not related to my business. Next, it was found that some stocks were omitted to be recorded in opening and closing stock. The opening stock was 9,000 rupees, closing stock was 18,000 rupees. What is this point telling? I have not recorded. Omitted to be recorded means I forgot to record opening stock of 9,000 and I forgot to record closing stock of 18,000. Now what is the impact? See, if opening stock I am showing less, that means my profit is more. Meaning what, sir? Meaning what, sir? If I increase my opening stock now, what will happen to, what will be the impact on my profit? My profit will decrease. Correct, not correct? My profit will decrease by such extent. My profit will decrease by such extent. So this was not recorded by me. So what was the impact, sir? If this was not recorded, my profit is more by that amount. Correct, not correct? My profit is more by that amount. So see, because if opening stock is more, profit will be less. So if I have not recorded opening stock, that means my profit is more by that amount. So I should record it now. Accordingly, I should make an adjustment. Similarly, closing stock. What is the adjustment of closing stock, sir? If my closing stock is not recorded, what will happen? Sir, what do you mean by this closing stock is not recorded? So closing stock, if I increase my closing stock, my gross profit will increase. Therefore, my profit will increase. Now I have shown my closing stock less by some amount. So my gross profit is also less by that amount. Therefore, my net profit also will be less by that amount. So now I should do what, sir? Add that amount, because to get that correct value. So what will I do over here? Closing stock I will subtract 9,000. Opening stock I will add 18,000. Then salary includes 10,000 paid to his brother, which is unreasonable to the extent of 2,000 rupees. So I have paid extra salary to my brother. How much extra? 2,000 extra. So can I say my profit is less by 2,000? I will have to increase my profit. So I will do what, sir? Add this amount to the profit of 50,000 rupees. Next, the whole amount of printing and stationery was paid as one-time expenditure. Oh, So this amount of 23,600 rupees was paid in cash. So because it is paid in cash, what is happening, sir? Income tax law says if you pay in cash, you will not get it as deduction. Can I say my profit of 50,000 is less by 23,200 because it is not allowed? So what will I do, sir? I will add this amount back. Depreciation provided in the books of accounts is 1,05,000. It is based on following information. What is the information of depreciation? Opening balance of plant and machinery they have given 4,20,000. New plant and machinery purchased was 70,000 and plant and machinery sold was 50,000. So they have given us what? They have given us the profit and loss account as per books of accounts. I should find my profit and loss accounts as per my income tax law. So I'll take opening WDV, add purchases, subtract closing WDV. How much is closing WDV? 50,000. I'll get 1,25,000. What is this 1,25,000? This 1,25,000 is WDV for depreciation. On that, I will give depreciation of what is the rate, sir? 15% for plant and machinery. 1,25,000 into 15%. 18,750. Now, what is the depreciation as per income tax law? 18,750. Sorry, I think I took, okay, this I should have taken 4 lakh rupees. 4,20,000 is value of my opening asset. Okay, I mean depreciation amount. So I'll recalculate 4,20,000 plus 70,000 minus 50,000 into 15%. So how much is the depreciation as per income tax law, sir? 66,000. So what will I do? I will add back this amount because my profit, the depreciation which is given over there is wrong. I will subtract the actual depreciation which is allowed, which is 66,000. Then rates and taxes includes GST liability of 3,400 rupees which is paid on 7th of April. See, normally any tax which is there that should be paid within the due date of return filing. The due date of filing income tax return is 31st July or 31st of now October. Now can I say he has paid the taxes within that time only? So what will I do? Ignore and write a note on this. Other expenses includes 2,000 which is paid as donation. A please note. Is donation business related expenditure? Is the donation given by any person related business related expenditure? No, sir. So what will happen to this donation? This donation is not related to your business, so it will be added back. Now shall we compute? Can I do one thing? Can I do the computation over here only instead of, or you want me to solve it fully? So solve it solely, sir. We will at least learn once. Now I am taking first net profit as per books. How much? 50,000. Now one by one I'll see all the items. So what should I do with this short-term capital loss? My profit is less by so much amount. Correct? No, I will add short-term capital loss 8,100. Then can I say income from other sources? I will subtract it because my profit is more by 2,400. So how much, sir? 2,400 rupees. Then opening stock I should subtract, closing stock I should add. So less opening stock 9,000 rupees, add closing stock 18,000 rupees. We have already discussed these points, correct? Then salary excess amount I'll add unreasonable salary as per 40A2. How much, sir? 2,000 rupees. 40A3 printing and stationery 23,200 is the amount paid in cash. Add 40A3 cash expenses 23,200. Depreciation I'll add back as per books. Depreciation as per books 1,05,000. Subtract depreciation as per what should I subtract now? I should subtract depreciation as per income tax law, which is 66,000. GST no problem. Donation I'll add back. Donation of I think 2,000 rupees. Yeah. $50,000 plus 8,100 minus 2,400 minus 9,000 plus 18,000 plus 2,000 plus 3,000 23,200 plus a 1,05,000 minus 66,000 plus 2,000. Answer comes to 1,30,000 business income. 1,30,900 rupees is my business income. Okay, so this is my business income. This is how I'll answer. Of course, this answer, if you give right answer, no, let us say it is a 10-mark question. How much will I get for this right answer, sir? I'll get only 5 marks. What are you talking about, sir? You should write a note. See, you should write a note for 48 this note, depreciation note you'll write. Why you have added back disallowed, you'll write a note. These are income taxable under other heads, write a note. Then a closing opening stock not required. Note. Correct? 5 notes will carry 5 marks. Correct? Notes are very important. Depreciation calculation is there, that will carry extra marks. So what is the answer, sir? See, note how many notes you should do. Note number 1, 2, 3, 4, 5 and working note for depreciation. Okay, and then this amount you have got. Correct? These are all different questions which we have solved in class. Now, last part of this business income is presumptive taxation. What is presumptive taxation, sir? Presumptive taxation means what, sir? Instead of you breaking your head with all the different sections which you have studied till now, straight away apply a percentage on your turnover. Whatever amount you are getting, that is your income. That is what is presumptive taxation talking about. Section 44 AD talks about presumptive taxation for business related people. 44 ADA talks about presumptive taxation for professionals, and 44 AE talks about presumptive taxation for those people who are involved in goods carriage business or transport business. 44 AD, if you are involved in any business or if you are a non-specified professionals, then you will fall under this. What is this point telling? If you are a resident individual HUF firm excluding LLP, and if you are doing any type of business or if you are a non-specified professionals except agency business or commission business or 44 AD and 44 AE people, and if your turnover is up to 2 crores, you can take benefit of this section. Repeat, sir. If you are a resident individual HUF firm excluding LLP, if you are doing any type of business or any type of non-specified professionals excluding agency businesses, meaning agency businesses are also not covered over here, then commission businesses are also not covered over here. Those people who are covered under 44 ADA and 44 AE are also not covered over here. And if your turnover is up to 2 crore rupees, you can take benefit of this section. What benefit can I say, sir? Your business income will be your turnover into 8%. Or you can take your business income to be equal to your turnover into 6%. I will take turnover into 6% if the total amount I have received by any mode other than if the total money which is there, total sales, whatever I have made, the sale proceeds is received by me by account pay check, account pay demand draft, or electronic clearing system within the due date of filing income tax return. Sir, repeat. Whatever turnover is there, no sales I have made, if that is received by me by account pay check, account pay demand draft, or electronic clearing system, and this amount is received within the due date of filing income tax return, then I will take 6% of turnover. And for all the other amounts which is there, if I have received in cash, if I have received after the due date, I'll take 8%. For example, 1.8 crores is my turnover, 50 lakh rupees I received in cash. What will I take? 8% on 50 lakhs, which comes to 4 lakhs. 40 lakh rupees I received through electronic clearing system. What will I take? 6%. 30 lakh received from account pay demand draft. What will I take? 6%. 20 lakhs I received through NEFT. What will I take? 6%. Now, 40 lakhs I received after the due date of filing return. How much will I take? 8%. Okay. So even though it is received through electronic clearing system, because it is afterwards, I'll take 8%. So the total of this is my business income, which is 12,60,000 rupees. As simple as that. Now, what is this presumptive taxation telling? Array, directly 8%, 6% you apply, that is your income. You don't have to worry about all the sections, section 30 to 31, 33, 34, all those sections which we studied. You don't have to worry. Those deduction will no more be given to you, because the 92% which I'm not taxing from you, which I'm not collecting from you, what is that? That is the expenditure. Okay. Then, can I take 40B benefit if I'm a partnership firm, sir? Answer is no. Can I claim higher income if I want to declare higher income more than 8%, 10%, 12%? Can I declare, sir? Lawmaker says definitely. Please go ahead. Sir, if I want to declare lower income than 8% and 6%, can I do that, sir? You can do that, but for that you will have to maintain your books of accounts, proving that you have a lower income, and you will also have to get your books of accounts audited by a chartered accountant. Then, deduction under chapter 6A, will it be allowed against this income? Yes, deduction under chapter 6A is allowed from gross total income. Therefore, this income also it is allowed. Brought forward business loss, if I have previous year's losses, can I adjust with this income, sir? Lawmaker says definitely yes, please adjust. Then, please note, there is a lock-in period for 44 AD. What is that lock-in period? If you opt for 44 AD for some year, then for next 5 years also you should opt for 44 AD. However, if you opt out of 44 AD in some year, then for next 5 years you will not be allowed to opt for 44 AD. 44 ADA. These are for this is a presumptive taxation for specified professionals. Who are these specified professionals? I lift come. What is the specified profession, sir? I lift come. Accountant, chartered accountant, and cost accountant. A for what, sir? Architect. I for interior designer. L for legal profession. I for IT professional. F for film artist. T for technical profession. CO for company secretary. M for medical profession, and E for engineers. So for these peoples, this section is there 44 ADA. So if they are individual or a partnership firm excluding LLP, and if they are involved in specified professions, and if their gross receipts is up to 50 lakh rupees, they can take benefit of this section. Their business income will be gross receipts into 50%. How much are gross receipts into 50%? Now, deductions from section 30 to 37 will not be allowed. 40B benefit will not be given. Higher income can be claimed by them. If they want to claim a lower income, they'll have to maintain books of accounts and get it audited by a chartered accountant or cost accountant. Deductions is allowed for deductions under chapter 6A is allowed, and brought forward business loss also can be set off from this. Now, normally, what is the limit over here, sir? 50 lakh rupees for this case, and for that it is 2 crores. This limit over here will be 75 lakhs if up to 95% of their total receipts and total expenses are in account pay check, account pay demand draft, or electronic clearing system. Meaning what, sir? Only 5% of their total receipts and total payments, if it is in cash, then they can claim the benefit of 75 lakhs. And 44 AD people can take the benefit of 3 crores if up to 5% of their total receipts and total expenses are in cash. Meaning if it is more than 5%, then they should definitely go for 50 lakh benefit or 2 crore benefit limit. This is one of the most important section, 44 AE. Presumptive taxation for goods carriage businesses, or if a person is a transporter. So if you are any type of assessee who is involved in the business of paying, hiring, leasing, renting of a goods carriage, and if you have not more than up to 10 goods carriage at any time during the previous year, then for you, if it is a heavy goods carriage which can carry gross vehicle weight more than 12 tons or 12,000 kgs, then for per vehicle per ton, it will be 1,000 rupees per ton per vehicle for every month or part thereof. And for other vehicles, it will be 7,500 per ton per vehicle for every month, 7,500 per vehicle per month or part thereof. Sir, what is this part thereof? For every month, I will take 7,500. If it is a part of month, I will take how much, sir? 7,500, meaning I'll consider it to be full month. Month should be considered from the date when the asset is purchased. Okay. For example, Mr. Dilip is in goods carriage business. He has two heavy goods vehicle of 15 ton each and four other vehicles. He purchased one heavy goods vehicle on 20th of April and another heavy goods vehicle on 28th of July. All other vehicles were purchased on 26th of May. Compute his income. Now, heavy goods vehicle, I'll take 1,000 rupees per ton. How many tons are there? 15 tons are there because 15,000 kgs. And per month, I will take that. How many months I am using vehicle number 1? Because I purchased it on 20th April, I will use it for full year. Whether I am using or not, it does not matter. I will get full deduction. And second vehicle, I purchased it on which date, sir? Second vehicle, 28th of July. So from that date, I will take how many ever months are there. 1,000 rupees per ton into number of tons into number of months. I will take the value. For other vehicles, meaning who can carry vehicle, whose gross vehicle weight is less than 12,000 ton, I will take 7,500 into what, sir? Into 4. Why 4 you have done, sir? Because I have 4 other vehicles. And how many months? 7,500 is per month. Here 10 concept is not there. Directly you take 7,500 into number of vehicles into number of months. You will get some amount. This total will be your presumptive income. This is all about your business income. Maintenance of books of accounts. One last point is there. Let me discuss this. Maintenance of books of account. Who should maintain books of accounts, sir? Section 44 AE says maintenance of books of accounts. If you are a specified professions, that is I lift come, you will have to maintain your books of accounts if your gross receipts is more than 1.5 lakhs in all 3 years, and if you are a new entity, if your expected turnover of current year is more than 1,50,000. What books you should maintain? Cash book, journal, ledger, carbon copy of invoices more than 25 rupees and original copy of invoices more than 50 rupees. Then if you are a medical professional, you will have to maintain your daily case register also, how many people has come, etc. Then what if my turnover is not more than 1.5 lakhs, sir, in the last 3 years, and current year I'm not expecting it to be more than 1.5 lakhs? Then maintain such books of accounts which will help the assessing officer to compute your income. Sir, what if I am not a specified professions, or if I am doing any type of business? Then for you, if the profit is more than 1.2 lakhs, or if your turnover is more than 10 lakhs, you should maintain your books of accounts. Which type of books of accounts? Those types of books of accounts which will help the assessing officer to compute your income. This limit will be 2.5 lakhs is the profit limit, and 25 lakhs is the turnover limit in case of individual and HUF. And if my turnover is less than this limit, sir, then you don't have to maintain books only. Majapan. Now you will have to get your books of accounts audited. Section 44 AB says audit of books of accounts. If your turnover, when will you have to get your books of accounts audited, sir? If your turnover or gross receipts is more than 1 crore rupees, you will have to get your books of accounts audited. However, this limit will be 10 crore rupees. This limit will be how much, sir? 10 crore rupees if the total cash receipts and total cash payments is less than 5% of total receipts and payment. For professional, the gross receipts, if it is more than 50 lakhs, they will have to get their books of accounts audited. And those who have opted for presumptive taxation, and if they want to show income less than the limit given under 44 AE, 44 AD, 44 ADA, then they also have to get their books of accounts audited. What is the penalty if I don't get my books of accounts audited? 0.5% of turnover or 1,50,000, whichever is less. This is all about your fantastic topic called as PGBP. We have completed all the heads of income. Now the last part which is left is your other provisionals, extra provisions which is there. This we will take up tomorrow, and we'll cover all these provisions maybe in 2 hours time in our tomorrow's discussion. So that is all from my side for the day. Let us not discuss anything more today. Let us stop our discussion over here only. Tomorrow we will complete income tax, and going forward, I mean, we'll discuss how to continue with GST or the indirect taxes. Okay, that is all from my side for the day. Thank you, students. Let me meet you again in my next class. Till then, tada, bye bye, take care, enjoy, happy learning.